to trade below that $77 per barrel, 76.6 now as we speak. And the FI selling has also cooled off significantly, and global markets compared to yesterday are stabilizing. In fact, on crude, we've got a statement coming in from Donald Trump. So let's quickly listen into it.
Yesterday, 19 million barrels of oil flowed out of the Strait of Hormuz, a very beautiful place. That's the most oil in the history of the Strait. No, it's never been any, you've never seen anything like that. It's called an oil gush. And most importantly, we are ensuring one thing very importantly, because this is why I did it. I did it for this reason, 99% for this. Iran will never have a nuclear weapon, and they've agreed to that.
We've never had a day like this. That's a statement coming in from Donald Trump. But for our own markets yesterday, of course, we had that big sell-off led by global weakness. By the end of trade, we managed to defend the 23,800 mark. But the low yesterday was 23,784. So some of the resistance levels, it continues to remain around the 24,200 mark. But let's see whether we can rebound from that level. Nigel.
Well, that's right. You know, in yesterday's trading session, the Nifty ended at the low point of the day. But there were a couple of aspects that did play out. Yesterday, the Asian markets got absolutely slammed. To put into perspective, actually, the Indian markets outperformed with a cut of only around 1% or thereabouts. It was much lower than what our Asian peers did see. You had the Nikkei that was down close to 3%, Kospi was down 10%, and even the Chinese market was under pressure. Also, keep in mind that it was weekly expiry. So particularly towards the end, that could have played a role as well. And by the end of the day, if you look at the institutional data, you wouldn't be too worried because there was no big FI net sell number of 5,000, 6,000 crores or thereabouts. There could have been an element of, large trades here. But the FI number was more or less flattish. And the DIs, they pumped in close to 700 crores. The short point was yesterday's sell-off. It appears it was more by weaker hands rather than institutional selling. That was encouraging. Now, if you look at the global cues, well, two factors we track. One is the dollar index, and that's perked up a little bit, while crude oil prices, they remain very, very well behaved. And the dollar index has now hit the highest levels we've seen in the last 1 year. Why is that? Because the Fed hike bets, well, they are on the table, and there is some safe haven buying. In fact, the Fed futures, funds futures, they are pricing in more than 85% chance that we see a hike as early as September. So that's going to be an important point to track because the dollar index has shown quite a bit of strength. It's more than a year high, so it's at around a 13-month high or thereabouts. What do the FIs do on index futures? Well, they went ahead and they added short positions. Close to 6,700 short contracts is what they added. They continue to remain net short with close to 87% of their positions on the short side. And that's been more or less the trend. I think shorts getting into the system, not so bad, provided you don't have the dollar index that actually runs away from year on. Also on stock futures, they added more shorts than longs in yesterday's trade. And when the markets fall, you have the VIX that pops up. So though the VIX was up close to 8.5% in yesterday's trading session, it's still at very, very subdued levels. At 14 odd, well, you'll take it. Remember, 45 days or so ago, it almost went to around 30. So it popped up in trade, but that's in line. When the markets correct, you normally see the volatility index that spikes up. Moving to the options data, then the 24,000 call. That saw aggressive writing in trade yesterday, as was the case with the 24,100 call as well. So between them, there was more than 1 crore shares that were written on the call side. The bears believe they can defend the higher levels. However, at lower levels, at around the 23,500 put, there was a mix of activity. There was some buying at around 40 rupees or thereabouts. So if the market cracks, then all you lose is around 30 to around 40 rupees. But there were some signs of writing as well at that particular strike. And that's an important level that you don't want to breach on the downside. Talking about levels, let's give you the near-term levels. The 20 DMA, that's important. You don't want this mark to go out because this is an important technical support. On the way up, it was a bit of a resistance. You don't want this one to break on the downside. We closed around the 50 DMA. And on the upside, this 100 DMA mark, that remains elusive from the market's perspective as well. So, you know, this is the broad range you're looking at, 20 to around the 100 DMA. The Nifty Bank, it pulled back yesterday, came in for some profit taking. You know, towards the end, it did see a bit of a downtick, but it still continues to trade above all its simple moving averages, whether you're looking at the 20, the 50, as well as the 200 DMA. The cues to track from here on are going to be the monsoon. That's going to be very, very important. The AI trade, is it pausing or is it unraveling? That may not be such bad news for India because we didn't participate on the upside. And crude prices as well are remaining subdued, which is good news. So this one's under control. Let's see how this one plays out. And hopefully, from a macro perspective as well, the monsoon progress is as good as we are expected. So we start off in the green. You'll want to build on to those gains after the kind of selling that you saw in yesterday's trade.
Yes, and that's what we'll be hoping in today's trading session as well. After a big rout that we saw in yesterday's trading session, are we likely to see a bit of a comeback? Let's get you an equity call as well. On the equities, Loris Polanco of CLSA says that the US dollar strength is reinforcing tightening global liquidity just as tech leadership and market breadth deteriorate, pointing to a near-term shift from upside momentum towards range-bound or corrective consolidation across global equities. On India, he adds that the Midcap 100, the Nifty Midcap 100, is pressing against a cup-and-handle breakout targeting 77,687 to about 78,000 with an upside bias which is intact above the 200-day moving average. In contrast, however, the Nifty, as per him, remains range-bound. CLSA flags Aditya Birla Capital and FSN E-Commerce Ventures, which is NICA, as buy candidates.
Okay, let me tell you what the interactions we've lined up on the show today. So coming up, we'll get to that in just a bit, but we have with us a guest joining in. Let's welcome from Oppenheimer, John Stolfus, MD and Chief Investment Strategist, Oppenheimer Asset Management, now joining in. John, thank you very much for joining in. You know, every time there is a large tech sell-off, we ask the question, is this routine profit booking or is this the start of something bigger? But, you know, just to put it in context, even after the big rout that we had yesterday on individual names, they are perhaps where they were a week back. I mean, what is your assessment of the tech trade?
You know, a great question, and it's wonderful to be on with you here in the morning in India. Thank you for having me on. You know, I think the first statement we would make here really is we're all on the upgrade cycle, whether we like it or not. There's a transformational thing happening in technology. There's an argument over how much of investment is overinvestment, what will work, what won't. Great time, opportunity for traders to play the volatility play. And it's recurring. If you look at it over the last few quarters, every time you finish a S&P 500 earnings season that has surprised to the upside, the most recent one, earnings growth of 27%, Q1 earnings growth. It was going into the reporting season, I think the consensus was looking for about 12 or 13% growth. But once you get over the earnings season and you're waiting for the next earnings season to begin, and Q2 will be reported July 14th is when it really begins, when the big banks report. That's when we'll really get to see. In the meantime, it'll be all about the Strait of Hormuz developments in terms of negotiations with Iran. It will be questions as to which will be the power players that will work through this. On top of that, you have a rotational market that is very much on a day-to-day basis, can go from risk on, risk off, back and forth. It's very advantageous for traders, okay, who position themselves well for it and are quick. And it's also very good, we believe, for intermediate to longer term investors who can catch babies that get thrown out with the bathwater, those perfectly good stocks for the intermediate term to long run of the market that actually are on sale when you get one of these pullbacks. But if you look at it, the S&P's only down about a little bit more than 3%. I think since the June 2nd peak, I think tech is down about 8%, so just nearing a correction. But overall, technology itself, year to date, is up. If I take a look at that, year to date, tech is up 16.58, and from the low in March 30th, it's up 33.91. So I think this looks more like a haircut or a trim than any kind of major turnaround, even though you can see some stocks are really pulling back. But look at some of the names there, and when you consider how high they are from the start of the year or from the lows in March. A long answer to a very short but a very important question that you asked. I don't think it's anything to worry about. I think it's anything. It tries investors' patience, and it's a joy for traders.
We understand that, John. You know, it's just, you call it a trim, not even a haircut. But there are fears of a rate cut being earlier than later this year. Were that to happen, could that have an impact on stocks in general and the tech rally?
No, I think it naturally, it depends, you know, how deep the rate cut would be, on what news would it be.
Rate hike, I meant, a rate hike.
Okay, rate hike. We don't think the Fed is going to hike this year.
We think that the market may very well want to play that, but how many times have we seen last year and the year before when the market was looking for more rate hikes than the Fed was going to give, and was looking for greater rate hikes in percentage terms? The Federal Reserve is very, very sensitive to its dual mandate. Even under the new leadership, we can expect that. And that essentially is to provide an interest rate regime that provides for economic growth at a sustainable pace while not causing untoward levels of inflation, okay? And while providing an unemployment rate somewhere between 3 and 4.3%, which is essentially equatable to full employment, allowing for the dynamics of the job market.
Okay. Hi, John. Good morning from India, and good to see you, Ben. The Fed doesn't hike rates. That's good news, actually, from an emerging market perspective, because in the last few days, we have seen it move from around that 98 all the way to around 101.5 odd. Tell us, what about positioning in terms of global markets? You clearly believe that the US markets are just pausing for breath and things are looking up because earnings are pretty good out there. And, the Fed doesn't hike rates, then that'll be good times for global equities as well. So how would you position yourself between developed markets and emerging markets? And where does India feature in this pack?
At first is we currently came into this year when most firms were saying that the U.S. market would broadly underperform, and it was pretty well over its major leadership. We thought that because of the innovation within technology, we remain overweight U.S., while at the same time for years now, we have adequate exposure, what we would call meaningful exposure, to both emerging and developed international markets. That said, we are greater weighted in the emerging markets than we do the developed internationals. The developed internationals have certain problems. If you look at Europe, in particular, in the UK, economic problems that they have due to the government spending and responsibilities in those countries, it is impacting their economic growth. So we think the emerging markets, we like them, and in fact, the emerging markets are the best performing. Second to that would probably be the smalls and the mid caps, particularly the small caps here in the U.S. If you look at our publications on a weekly basis, and with India is to us is the country that is sitting in the catbird seat, so to speak, in terms of when you look at the world is diversifying away from dependency on China for the global supply chain. It doesn't mean they won't do business with China anymore, but they need more partners and big partners. And it would seem that the sophistication that India has shown, including related to healthcare, to technology, to manufacturing, positions it very well. It would appear to us there needs to be some infrastructure spend to get things more efficient in terms of getting things in and out of the country. But we think from an intermediate and longer term position, India, Mexico, Brazil, and two developed countries, Korea and Japan, are very well positioned for this re-globalization process that we believe is in the process of over the last few years has been taking place and is actually accelerating.
It's accelerating, but unfortunately not showing in the Indian equity prices, right? We've underperformed for the last 18 months or so, perhaps due to the lack of an AI trade. But we just wanted to understand that what do the next 12 to 18 months hold for India in terms of returns? What would your expectations be?
Well, our expectations would be after this underperformance that we've seen, which we're quite aware of when we look at our Bloomberg screen, whether we look at local currency or in dollars, India's markets have been on the weak side, to say the least, and with red ink. We do think that the fundamentals that will develop with the AI trade and with the increased involvement in the process of globalization, globalized trade from India, and just movements towards, remember, markets are discount mechanisms, will likely see investors in India begin to get rewarded. We think we're getting closer, but I would have to say it could be in the next 6 to 12 months. It may require patience, but remember, some of the classic and best investors like Warren Buffett usually are buying when nobody wants to buy those stories that are the great stories that are coming ahead. instead of chasing the markets later on. So we think there's reason for people who are invested, but you must be diversified is the other thing. So diversify globally, diversify by sectors, by market capitalizations, and also diversify by style, growth versus value, and do that on a global basis. We think this is the age of diversification, or the return of diversity, and trying to avoid over concentration, which creates near-term risk that you don't need to really take.
Right. John, thank you very much for joining us, staying up late, yesterday. Thank you very much. It's the age of diversification. Perhaps the age of concentrated AI bets is now behind us. And maybe in that age of diversification, India has a place. But let me tell you all the interactions lined up on the show today. So first up, 8:35, HFS Research, Phil First will join in on the global tech sell-off and the road ahead for the AI trade. 9 a.m., Nandan Kulkarni of Bernstein joins in as US FDA seeks Indian pharmaceutical companies' help to tackle the shortage of key cancer drugs. 9:20, Devina Mehra of First Global will be the market master for the day. 9:35, the management of Patanjali Foods join in on the impact of delayed monsoon. Following that, the management of UPL will chat with us at 9:45. Towards the end of the show, Lata will discuss the corporate capex cycle with Mahesh Vyas of CMIE and Hiren Lodha of CRISIL.
Time to slip into a quick break. We've got a lot of stock-specific action to track for us. On the other side, in our special Top 10 segment, we look at Infosys, Tata Power, Honasa, Rashi Peripherals, City Union Bank, Go Fashion, SIS, Solara Active, and Garden Reach Shipbuilders. All of them will be reacting to positive news flow, while you have IRFC that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
And here's a big milestone that we would like to share with you this morning. CNBC TV 18 has crossed 5 million subscribers on YouTube, and that number belongs to you. A big and heartfelt thank you to every viewer who's tuned in, shared and subscribed and stayed with us through the highs and lows of the market. Here's to many more milestones together and to telling India's growth story the way only CNBC TV 18 can.
Welcome back. You're watching us here on Bazaar Morning Call. Let's get you a lot of stocks that we're tracking this morning, and we start with our entire team joining in. And Rima, Infosys, the AGM that happened yesterday, what are the key takeaways?
Well, the chairman, Nandan Nilekani, spoke. He started the conversation, he started the discussion around AGM. And I think the key is listening to his views on AI and where Infosys stands in this AI era. So his view was that more than 3 years after generative AI's launch, Infosys is more relevant than ever before. It's positioned well for the decade ahead. And he categorically said AI will not replace companies like Infosys. The AI revolution has made legacy modernization urgent. Companies are looking to urgently retire the technical debt which has been accumulated over the decade. The AI deployment gap in large enterprises clients is large, it's real, and closing that gap is where there is a lot of work which is required from service companies. He said we're already collaborating with 90% of the top 200 clients on their AI journey, and this positions the company well. And he reiterated that the opportunity for AI-first services companies like Infosys is $300 to $400 billion by 2030. The shareholders asked also a lot about the CEO succession because Salil Parekh's term ends in March 2027, but they were very tight-lipped. In fact, it wasn't even on the agenda, but shareholders had questions on that. And also just, while there was a tech rout that took place yesterday, many of these software companies were fairly resilient. So Accenture or SAP or Salesforce, these companies actually didn't fall yesterday. And maybe that's the cue for the Indian IT stocks today.
Right, we take that point. That's about the IT pack in today's trading session. Let's talk about IRFC and Tata Power. Vivek joins in with some details there. Vivek.
Well, that's right. Let's start with Tata Power. Tata Power, the Mundra power plant continues to remain in focus. So some further relief coming in there. Remember, this is a temporary measure. The Ministry of Power has given directions to extend Section 11 or the use of the plant or the running of the plant under emergency measures. This is for the permanent power plant, and the measures have been extended from 30th June 2026 to 30th September 2026. This is likely to be the last extension, given the fact that the company is already in discussion with all of the states to go ahead and sign supplementary PPAs. In fact, on 20th March, the Gujarat state government has signed a supplementary PPA, and the company has indicated that that particular PPA will serve as the base or will serve as the model for signing PPAs with the other states. Now, talking about IRFC, the government has gone ahead and launched an OFS for a total of 2% equity, with the base size being 1% and a green shoe option being an additional 1%. So for non-retail investors, today is the start day or day one, and for retail investors, they can bid tomorrow, that is Thursday, June 25th. So IRFC, one more OFS from Deepam as far as the PSU is concerned.
All right, Vivek, thanks a lot for that. Let's talk about Honasa now, the Mamaearth parent. It's gone ahead and made an acquisition. It's acquired about 58% stake in Fluence Pharma for an enterprise value of 135 crore rupees. The important part, it offers Fluence Pharma, the target company, offers condition-specific OTC supplements. So this is their foray into nutraceuticals. The brand that they use are HairFact, SkinFact, and ProFact. And after this 58%, they will acquire the remaining 42% over the next 5 to 7 years. Nutraceuticals is an important market for the beauty and personal care space because now, it's a 16,000 crore market, which is growing at around 11% in CAGR. The important part is that Fluence Pharma, the FY26 revenue of the company was 40 crores, but margins are over 20%, and that's a positive because it's margin accretive. So let's see the kind of scale that Mamaearth's acquisition can bring to it right now. And in any case, in their last analyst meet, they did say that next horizon categories, which include the likes of fragrance, nutraceuticals, and oral care, could be anywhere around 250 crores each over the next 5 years, which is by FY31. So this is a step in that direction, an acquisition made, and this is a positive for Honasa. A stock has been doing well for the last 3 or 4 months, ever since it's reported its fourth quarter update, then the results, and then its analyst day meeting. So expect green to continue for Honasa.
Okay, that's about Honasa. Let's go across to Vinny now for some more stocks which are in the news.
Hi, morning. First up, Rashi Peripherals. That's going to be in focus today, and we'll expect some green here after the company is set to acquire 67% stake in VDA Infosys Solutions, and this is at a price of around 368 crores for the 67% stake. And obviously, they will be acquiring the other 33% by August 2029 as well in 3 equal tranches. 27, 28 and 29 where they'll be acquiring 11%, 11%, 11%. And obviously post this 67% acquisition also the company will become the subsidiary of Rashi Peripherals, and this is mainly to strengthen its enterprise IT distribution capabilities as well as expand the market reach. The next one, City Union Bank, we'll expect some green year after the board and shareholders are considering raising funds via QIP. 500 crores is what they're talking about. They'll be meeting in August in an AGM to discuss this as well. Go Fashions, that could see some green as well. The promoters have released a significant part of their pledge shares as well. So this is Rahul Sarogi who had pledged around 68 lakh shares. Now they've released around 46.8 lakh shares. So it's significant in terms of 70% of their pledge shares is what they've released. So that's why some green here. SIS Limited, we'll expect a green here as well. The board is set to meet on 29th of June to consider a buyback. This is the 5th buyback in 5 years for the company. So interesting to watch out for that. Solara Active, that also is going to be in focus. And green here as well. The CRISIL has upgraded the ratings for the bank facilities for the company to CRISIL BBB plus versus a previous CRISIL BBB stable CRISIL A3 was the rating previously. GRSC, that also is some green expected. Order win, lowest bidder coming in here as well. 40 crores is what the order is for. So that is why positive news for here as well.
All right, take that point, Vinny. Thanks a lot for that. Let's get you a quick recap of our top stocks with positive news flow. Infosys, Tata Power, Honasa Consumer, Rashi Peripherals, City Union Bank, Go Fashion, SIS, Solara Active and Garden Reach Shipbuilders. While IRFC is the only stock on our radar which is likely to open in the red. Right, with that, let's go across to Manisha Gupta now for a roundup of all the actions coming in from the commodities market overnight. Manisha, the dollar index strength may have an impact on the metals, but crude continues to be lower.
Well, yes, when you look at across commodities, it is a bit of a decline that you are seeing here. The strength in US dollar index, the hawkish US Fed is what seems to be really weighing onto the markets. And I'll start with metals because that is where the major decline really has come in for as well. It has been 3 to 4% of a cut for copper, aluminum, zinc, all of those metals in the overnight market. And Asia is trading very flat right now. We also have seen declines come in for the precious metal prices. Gold is trading at a 7-month lows. Silver prices fell 4.5% overnight and is trading at a 6-month lows as well right now. The expectations of tighter Fed policy going forward really seems to have taken the money out of many of these markets. But that's exactly what we are looking at in case of crude as well. When you look at the CFTC data, it shows you that the hedge funds have hiked bearish positions on crude to a 5-month high. 10,000 gross short positions were added in WTI over a matter of last 3 days, taking the total shorts now at 102,000 contracts. So that tells you that the sell-off or the short positions were being created even before the peace agreement came in. And since it has come, we only have seen more short positions being created right now. The number of tankers crossing the Strait of Hormuz also has risen, so the geopolitical premium seems to be coming off the market, with the street suggesting that 75 perhaps is where crude prices could be taking support at.
Thank you very much for that. We will get into a break. On the other side, we'll connect with Amisha Vora of PL Capital for some fundamental stock talk. After that, we'll talk about the global tech rout and what it means for the Indian IT companies. HFS Research, Phil First joins in to talk about the road ahead. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. The Gift Nifty indicating a slightly positive start. Let's see. Oh, now that's sold off a little bit. From a 10-point uptick, it's gone down to about 40 points lower. Let's see whether bulls lap up this dip and we see a recovery in today's trading session, given the sort of recovery that we're seeing from the lows in the Korean markets and the other Asian indices as well. Let's welcome Amisha Bora, who's the chairperson and managing director, PL Capital. Thanks a lot, Amisha, for joining in. Good morning. A bunch of stocks on our radar this morning, and one of them that stands out is Honasa. Ever since its fourth quarter result update coming in, thereafter the results, margin expansion, its analyst day as well, the stock's been doing extremely well. Now it's gone ahead and made an acquisition in the nutraceutical space, which is a near 16,000 crore category, and they have targeted about 250 crores revenue coming in from this category by FY31. What do you make of this acquisition and, more importantly, the stock in general?
First, a disclaimer that this is not under our active coverage, but as an observant of the market, I know that Honasa had a little bit of their downside on the markets in the last 2 years, but it is bounced back with the strategy. And I think that this acquisition is also very apt, niche, and overall strategy is also in place with the change in margin profile now reflected. So I think that the stock is and the business is in good gear now.
Okay, all right. Hi, Amisha. Good to see you in this morning. You're tracking Honasa closely, but you all must be recommending to your clients, as well as your research team, will be coming up with some interesting ideas. Fill us in with two.
So from the perspective, the way markets are now set up, that we have seen one of the highest ever selling in first 5 to 6 months in India. And naturally, when FI sell, it has to be led by selling in banking stocks. And we were faced with a likely inflationary outlook because of the high oil prices and interest rate. I think the banking stocks were having a complete pounding. And so from here on, I think that the rally will be led, recovery will be led both on markets and on actual fundamentals by banking stocks. And some of the private sector bank and one large PSU bank, particularly SBI, I think are very well placed for better credit growth, with rising or stable interest rate outlook, better name, reasonable asset quality, and extremely attractive valuations. So I would say that we can continue to focus on large cap, and ICICI Bank and SBI may continue to be the two favorites.
Okay, got that. What about the metal pack? That's the other segment of the market that, after giving solid returns, actually it has outperformed the Nifty as well. Now, that trade has gradually started coming in for profit taking. Stocks have corrected 10-15% in a jiffy in a matter of a few trading sessions. The problem is the dollar index, that's shown some strength. And also, as we enter a monsoon period, well, the interest levels in terms of demand itself would go down. What do you think? It's a time to get in? Or do you think it's run its course and you wouldn't look at? If you're looking to get in, which of the stocks do you like?
We'll have to have a little more patience in entering the metal stocks. I think that 2 to 3 year outlook may continue to still remain very positive. And we continue to remain positive on steel. And there are good enough large and mid-cap stocks. I continue to remain positive on copper and Hindustan Copper also, but it will give us little time of consolidation before the next strong move.
Amisha, hi. Good morning. Rima here. Just request you to stay on, and we've got another guest joining in to talk about the global tech route. But before that, let's listen into some key bites that we heard from Nandan Nilekani at the Infosys AGM, and lots of questions. And he began his speech by saying that every time there is a technology transition, questions are being asked about the survival, the relevance, and this time, because AI is so deeply entrenched, the questions are more louder, they're more persistent. And here's what he had to say.
existential question that is being asked of us is, if coding becomes automated, then why are we needed at all? More than 3 years after Gen AI's launch, Infosys is more relevant than ever before and well positioned for the decade ahead. The AI deployment gap in our large enterprise clients is real, and closing that gap is where the work is. AI will not replace companies like ours. It will amplify those who move with purpose and adapt with speed. We're already collaborating with 90% of our top 200 clients on their AI journeys.
Okay, let's welcome Phil First, CEO, Chief Analyst, HFS Research, on the show now. Phil, thank you very much for staying up late for us. Let's begin, before we get to the Indian services companies, let's begin with the global tech route. Where do you stand on the AI cycle? Is this a warning sign that the cycle may be plateauing, or is it just healthy correction?
I have to be honest, I think we're definitely seeing a warning sign. The global economy is taking a giant bet on AI. Sorry, and it really has reached points with the SpaceX IPO that really hit the market hard. A lot of money's being pushed there. You've now got OpenAI and Anthropic looking to push the IPO very, very quickly. And the question here is, what happens after that? At HFS, we think there's going to be a correction in the market. It could be quite a marked correction. And I don't think it's a bad thing for Indian services. I actually think right now, Wall Street is obsessed with the AI models and the software and the infrastructure build out. It's not looking at what Nandan quite correctly points out as the need to actually take enterprises into an AI environment, because that's the real problem right now, is for AI to reach potential, the dependence on people-based capability, the foundations that services can deliver have never been stronger. It's just going to take time for this to play out, and there needs to be some patience. We're in a J curve, and I think we're in the down part of the J curve before it goes up, and I think it's going to be a tough few months as we play this all out.
Phil, one more question on the global tech stocks before we get to Indian IT services companies and the J-curve. The pushback, because you're expecting a correction, a meaningful correction in the AI stocks globally. The pushback against this is that demand is very strong. Look at Cerebras numbers overnight. It's a 94% revenue growth. Micron, when they come out with numbers, are expected to have gross margins of 80%. So the demand side of the equation for many of these AI stocks is still very strong, and they're not very, very expensive. So many on the other side believe that this is perhaps just a blip. These are routine corrections that we will see when stocks have run up too much.
I think we have to look at the size of what's happening. So when we take the three IPOs together, Anthropic, OpenAI, SpaceX, that's $4 trillion. That's 6% of the entire global public equity market. That exceeds the combined inflation-adjusted value of every .com IPO ever filed. When you look at the numbers, OpenAI is already burning $40 billion this year. Anthropic is valued at about $900 billion. And there's a lot of revenue that is really unaccounted for in terms of where they're going. So there's a lot of, I think, bets being placed on these IPOs that's going to change the face of the market. So however we look at this, and I know Micron's doing well with seeing really strong demand for AI amongst certain businesses, we are going to see a correction in the market. It's pretty inevitable. When we talk with experts in the States across different investment funds, everyone is expecting it. It is 1999 right now. We are going to get a correction. And I don't think it's a bad thing. I think it's going to create some reality in the market. It's going to create some more focus on which companies can actually help us get from here to here. So right now, barely 10% of the Global 2000 have any type of maturity with AI. Yes, they're spending money. Yes, they're trying to invest in infrastructure, but the gap between where they are and the maturity they've got to get to depends on a lot of traditional type of services and expertise to move it. And I think that's good news for India. I think it really is. I think while there's going to be a tough 6 months, maybe 9 months coming through this, out the other end, there will be, I think, a slow shift back to more traditional capabilities to get us there.
Okay, it's the J curve, right? There is that initial transition period where revenues, margins, it gets compressed. But after that, that rebound takes place. And I think the question that everyone's grappling with, that there is that opportunity. Nandan Nilekani spoke about a $300 to $400 billion opportunity for services companies in the next 5 years. But when does that rebound start? You know, one quick view that we got from JP Morgan earlier today, and they downgraded their ratings on HCL Tech, Wipro and Tata Technologies. So these stocks have been downgraded by JP Morgan, and they're saying that enterprises are facing FUD, F-U-D, fear, uncertainty and doubt. Tech budgets are being crowded out by AI tokens, cloud spend, and they go on to say that IT services industries have been stuck in that 2 to 3% revenue growth for the last 3 years, but AI deflation is still in year 2 only, which means they see further headwinds to growth for the next 2 years. And they don't see large caps hitting mid-single digit growth. They expect large cap IT companies to grow just between 3 to 4%, which is why they've cut revenue estimates over the longer term, medium term. And they've also cut the PE target multiples for these companies by 10 to 25%. And that explains some of the downgrades and the target price. Earlier, the previous target price and new target price is up for you on your screen. Phil, so the question to you is, when do you think the rebound in the J curve takes place? Because you did a recent study in partnership with Genpact, and you see $18 trillion of value imprisoned inside Global 2000 companies. So, when can AI help unlock this for IT services companies? And in that, can Indian IT companies really benefit from the opportunity, or will there be other competitors who will get an outsized portion of the gains?
Fantastic question. And you're right, there is $18 trillion of unlocked value that's to be mined out of the Global 2000. And that's the opportunity for services firms. So what they've got to do, they've got to retire the headcount model. They've got to stop selling this FTE effort and start selling measurable outcomes. They've got to build a credible services as software narrative that can excite investors. So, you know, PSR expansion requires a visible shift from headcount economics to platform economics. So stop trying to be an AI company and try and be a foundation partner to get clients there. Move the conversation also from the CIO to the broader C-suite. So the pitch has to land, you know, in P&L terms from that first meeting. So this isn't just about IT. They need to move into the broader C-suite, the CMO, the CFO, these areas. You look at the Palantir model. Palantir only sells to the CFO and the CEO of the organization, right? I also think the Indian firms need to invest in the mid-market before AI labs claim it. And they need to stop, focusing on this, we're just going to implement AI as a technology, because that's the loser proposition right now. They need to be, I call it, a foundation fixer with services and software. They need to be the ones to come in and move the needle to unlock the value within enterprises that is trapped right now. And the big AI firms aren't going to get that value out. That's where Infosys, Cognizant, Wipro, these companies, they have a big opportunity if they get it right. I think they know what they're doing. It's just going to take a little time and patience and convincing investors. That's the real challenge, is convincing investors, you know, beyond the bubble. This is where things happen, and we have to look beyond this. There is going to be a correction. We can talk about this all day, but, you know, everybody fundamentally believes that, you know, the market is not in a realistic situation and there needs to be a shift. And we're going to see that towards the end of the year.
So do you believe the investment made by HCL Tech in a company, a minority investment in Sarvam, is the right step?
I think it's a good step. I think it's, one, aligning themselves with AI. It's a good investment for the company, you know, from a perception standpoint. And it also accentuates their ability to do services around AI, these foundational services to say, look, you know, we're investing in the models, but ultimately the models become commoditized. It's really about infrastructure. It's about process. It's about data. It's about taking companies from here to here. And I think making these partnerships, getting more noticed in that type of world is very, very important. And I think it was a positive move.
Very quickly, the companies best place, the Indian IT companies, you interact with them, you advise them, which companies are taking the right steps? If you have to name 3 companies for us.
I think you mentioned Infosys. I think Infosys is a solid company. They're trusted. They're seen as a safe pair of hands. And I also think with Topaz and some of the deals that they've made, I think they're going in the right direction. I think HCL Tech has a great infrastructure story. I think they're doing the right things as well. They've started to talk a lot about this sort of future deployed engineering model, which is very core to their DNA. I think they're strong. I also like Cognizant from the fact that they're putting a lot of bets on bringing in young talent into their organization and looking at the way that they're building out the model from a hierarchical standpoint, I think, and their agentic standpoint. Those are 3 companies I think I see moving fairly quickly.
Phil, great conversation. Thank you very much for joining in. KOSPI has reversed the early gains. It was up 3% when we began trade and now has dipped into the red. So it slipped from the high point of the day. And the Taiwanese markets have extended the morning losses. It was down 1.5% at 8 a.m. and now it's down close to about 2.5%. So some of the rebound in the tech names has reversed.
And I think, Rima, the KOSPI went up 100% in the first 6 months. It doubled, as of yesterday. So that's one of the reasons. Besides that, they're talking about taxing unrealized profits as well out there. And it became a 2-horse story, right? You had Samsung as well as Hynix. 50% of the index was attributed to both these two. They pull back a little bit and that market becomes a little bit brittle. Let's see how this AI trade, it continues. These chip makers have come in for some profit taking. Is it profit taking or is it a turn of events? We'll have to see how that goes.
Okay, that's an evolving story for now. Quick break. On the other side, we'll continue our chat with Amisha Bora. We'll also connect with Mitesh Thakkar and Sudarshan Sakhani for some technical trades.
Welcome back. You're watching us here on Bazaar Morning Call. Things have taken a turn for the worse this morning in Asia markets, as well as reflecting in the GIFT Nifty right now, which is down about 50 points. Let's see where we go from here. But a bunch of stocks which were moving around yesterday's trading session. We had few big movers on either side, and a lot of them with heavy volumes. Hormaz, as always, joins in with the delivery data.
Good morning, Manglam. And metals were the biggest casualty in yesterday's trading session, as has been the case over the last few days, considering the stronger dollar. And Nalco was one such name, barring Vedanta, of course, because of the block deal. It was the second worst performer on the metals index, ending 6% lower, the biggest single-day fall in 2 months. The volumes were the highest in the month of June so far. Already yesterday, 2 crore shares were traded. The 20-day average is 1.5 crore as well for Nalco. More than half of those shares were marked for delivery. So 1 crore shares for delivery. That too was double its 20-day average, and it is the third worst performer on the Nifty Metals Index in the month of June so far. Is down around 17% for the month. Is still holding on to gains of around about 10% for the year. Still down around 20% from its 52-week high levels. A couple of outperformers that bucked the trend yesterday. One of them was Misho, of course, ending around 8% higher. The biggest single-day gain in 2 months. It's gained in 3 out of the last 4 trading sessions, and 11.5 crore shares were traded in yesterday's trade. The 20-day average is just around 3 crore shares. A quarter of those were marked for delivery, so around 3 crore shares for delivery. 1.5 crore is the 20-day average as well, and it was the 4th most traded stock on the Nifty 500 in yesterday's trading session. A post-listing high of 254, still down around 26% from those levels. And the one stock that was a big outperformer yesterday was Cohance. Was the top gainer on the Nifty 500 in yesterday's trade. The biggest single-day gain in volumes in the last 2 months. It snapped a 4-day losing streak as well in yesterday's trading session. 2.5 crore shares were traded yesterday. The 20-day average is only 7.5 lakh shares, and only 10% of those shares were marked for delivery. So around about 26 lakh shares for delivery. The 20-day average is close to 4 lakh shares. But even after this, it's been a recent outperformer is Cohance, but from its 52-week highs, which is well over 1,100 rupees, the stock is down around 60% from those levels.
Got it. Thanks a lot, Harmaz, for joining in and always putting together a nice, neat list. Well, let's get back to Amisha Vora, who's been waiting by. Amisha, you heard the chat that Rima had, with the global expert on tech. What are you making of tech stocks right now? As we speak, that AI trade has got a little bit jittery globally, but there have been massive returns out there, 100, 200, 300, 400% returns as well on individual stocks in a matter of a year. Our tech stocks have underperformed, but now it seems they're trying to innovate, they're trying to make their presence felt for a better next few years. Are you all interested, or is that in a sector that you all are avoiding?
It is underweight as of now, from my institutional research perspective. But we do feel that 2 things we feel will happen in India. One is that some of these, our software giants, will be the partner to enterprises to adopt AI in the initial phase. And also one more ecosystem which will develop in India is like what happened when the internet came, and then came your Mintras and so on and so forth, till all these platforms. And we will also have a lot of AI-led platforms, services, usage companies coming up. But coming back to the listed space of our software giants, I feel that a lot is captured in the valuations. Only pain will be for next couple of quarters, where it will still continue to show us very, very tepid growth. And in that, where the rest of the sectors might do slightly better, the overweight or quite a large holding in mutual funds of these stocks might continue to weigh a little pressure. So I don't expect a huge outperformance, but I do believe that a lot of pain is already captured.
Right. On the financial space, Amisha, I wanted your thoughts. Everyone's fairly sanguine on the financial space. What, according to you, offers the best return opportunity here? Will it be banks? Will it be NBFCs? Are you looking at capital market plays? If you could, make up a list for us.
I think that you see the particularly private sector banks itself. And if you see last 2 years, 2.5 years, when the interest rates were softening, their NIMs were softening. The credit growth in the economy was very, very slow. So they had a slow top line, compressed margins. And if you see as a combination of that, the price to book, some of these private sector banks used to be always 3 and above 1 year forward. And if you see now, they are in the range of 1.3 to 1.7 price to book 1 year forward. So I think that they have come to a very sweet spot. And one of the reasons they've come to this kind of a valuation is also because there was a global sell-off, FI sell-off, and they were very high on our BFSI and particularly banking stocks. So I think that from a 1 year, 2 year perspective, if you see, private sector banks will do very well as a first phase. Select NBFCs will do well who are hugely capitalized, as you know, because they have just raised large capital, strategic, non-strategic. I think they'll continue to do very well. And largely when it comes to capital market play, a lot of capital market play continue to do better even during this consolidating or correcting market. And their valuations are not so very cheap. While yes, their growth will improve with improving market sentiment. So there we will just get little growth. While in banks, I feel we will get growth plus a bit of re-rating.
Amisha, request you to stay on. We will slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Nandan Kulkarni of Bernstein to talk about the pharmaceutical sector. US FDA has sought Indian pharmaceuticals companies' help to tackle the shortage of key cancer drugs. How big an opportunity is this? We'll discuss that with Nandan.
Right, we're getting early rates from pre-open. Obviously, we'll wait for them to settle. Less than 15 minutes to go for market open as well. Perfect time to welcome Mitesh Thakkar of Bonanza Portfolio, Sudarshan Sukhani joining in for a quick technical view on the indices. Let's start with Sudarshan first. Sudarshan, you're positive on the index. We saw a fair amount of returns. At higher levels, we saw some profit booking as well. And now we're back below that 24,000 mark, with the Asian markets not looking particularly supportive right now. What's your bias on the Nifty and the Nifty Bank?
Yeah, this has been disappointing. 24,100 has acted as strong resistance. So the rally fizzled out there. We are into a very large trading range now. That is, say, 23,300 or 23,400 on the lower side and 24,100. This is a 700-point trading range. It's very difficult to trade. So the bias is now we are no longer upbeat. Either the Nifty dips towards 23,400 when we become buyers, or it crosses 24,100 decisively. So this 700-point range, at least for now, is a complete no-trade zone. It's very difficult, I know, but it's better to preserve capital than to fall into trouble.
Okay, preserve capital rather than fall into trouble. Got that, Sudarshan. Mitesh, what about you?
Yeah, I think, I also have been maintaining a positive view on the indices. And I was, of the opinion that the decline might come to an end soon because all the short-term moving averages are in a rising mode. And then there's gap as well, which happened between the 12th, which was a Friday, of June, and 15th, which is Monday. So this entire zone is filled with supports, but a lot of stocks are given a breakdown. So for the timing, the idea of buying around 23,800, 750, I think I'll keep it on hold and see how the market reacts post the gap down, which is it's not a big gap down, it's about 60, 70 point kind of a gap down opening, but we'll see how the market reacts. And on stocks also, we've kind of, with yesterday's decline, kind of exited and taken some profits on long positions while added some on the short side. So trying to balance more towards a neutral approach and seeing what kind of directional cues we get from the indexes.
All right. Your stock picks, Sudarshan, index is a no-trade zone. I'm sure a lot of stocks are offering a lot of opportunities.
Yes, they are. Apollo Hospital is a buy. Now, I have wide stops because we have to make these positional buys rather than intraday. 8,220 is the stop. Union Bank is a buy with a stop under 165, 166.50. Actually, it's not just Union Bank. I think most banks are buying opportunities. Motherson is a short sell with a stop above 145. And JSW Steel is another short sell with a stop above 1265. So it's a mixed bag.
Okay, all right. And what about you, Mitesh?
I have a mix of buys and sells. I have a buy on LIC India. If it trades around 436, 435, keep a stop at 425. Look for targets in excess of 455, and a buy on Zydus Life with a stop below 1,090 for targets of 1155. Couple of banking names on the sell side, and Canara Bank has had some kind of a minor breakdown. So sell here with a stop at 133.5 for targets of 124. And IndusInd Bank is a sell with a stop at 921 for a first target of 875.
Got it. All right, gentlemen. Appreciate you joining in. We'll touch base again at around 9:10 to get a couple of fresh calls. Let's turn our attention to the outperforming sector yesterday, which is the pharma index. Remember, yesterday we heard that the US FDA has seeked Indian pharma to help out, tackle the shortage of key cancer drugs. To discuss this, what kind of impact it can have for, companies listed here in India, we have Mr. Nandan Kulkarni, the Director, India Healthcare, Senior Research Analyst at Bernstein, who joins in. Hi, Nandan. Good to see you in. Thanks a lot for joining in on this rainy morning here in Mumbai. There's reports suggest that there's going to be a shortage, and that's why the US FDA has reached out to India. How would you view it? Before we get to analyzing the news, the shortage with regard to cancer drugs is something that's extremely depressing. Coming from a family where I've seen a lot of survivors. It's painful. But since we have to address the financial aspect of things, what would your view be? Yesterday, pharma stocks were strong. You had some of the CDMO companies, actually, that were even stronger. So your initial take.
Sure. I will break this down in two parts for us quickly. Number one, short to medium term, and then a little longish view in the second part of it. As you rightly said, it's really painful to witness a cancer patient waiting for the drugs in the hands when most needed. And that's a humanitarian call that Indian biopharma historically has always stood, right during the COVID times or even before, as being the powerhouse of the global pharma sales. I believe in the short to medium term, these shortages are predominantly a function of evolving economics out of geopolitical uncertainties, which has rendered many players in the US to kind of withdraw their supply position historically, given the fall in the prices and therefore market being unserviceable. And that has led to some of these acute shortages in specific type of cancers like neoplastic cancers and colorectal cancers and so forth. So in the short to medium term, Indian biopharma with its sufficiently large capacity is expected to service this demand at a reasonably healthy margins and also at a good volume base. So that's first part of it. And within that story, therefore, once you go down the value chain beyond the top front-end names which are actually supplying, the answer starts emerging to be CDMOs who play majority in the intermediates, bulk drugs, or even some of the chemical entities that go into these products, including chemotherapies or immunoproducts or onco products. So that's how the entire structurally the sector got cascaded in terms of the short-term uplift on demand shortage. Moving forward, when you look at it from a really a mid to long term, as we had highlighted in our report, the humanity particularly, especially in the Western world, is going to brace the issues from lifestyle, environment, and aging population, which means the disease burden is going to be exponentially high. And we estimated close to about 100 million patients annually getting added globally to these chronic disease pools. And that large burden, Indian biopharma is really geared and poised to service through its right costing structures, better quality controls, and access to these Western markets through its deep legacy and rich understanding. So therefore, in the short term, a good volume bounty. In the medium to long term, a structural drive for Indian biopharma to double down on this value chain and innovation to serve this disease burden.
Right. But apart from just that, which is an opportunity, the others are also looking at the GLP-1 opportunity in India. Have you been able to so far figure out the total addressable market? Now we've had a little over a month and a half. What have the initial trends been like, and who could be the key beneficiaries here?
Sure. It's a very interesting geography for GLP-1 as a drug category. And we believe, number one, India's adoption story on GLP-1 is going to be fundamentally different from that of a US or a Western market because of our lifestyles, because of the diet we have, and also the socio-economic fabric, where in majority of the cases, obesity is still not considered a problem or a disease to begin with. So therefore, we believe after the first early adopters were broadly covered in the month of March, April, because of all the generic frenzy, there is going to be certain amount of pressure in the short term on the GLP-1 drug demand to fully kind of compound. And education will actually proceed for the next few quarters or a year when you're actually explaining and detailing what obesity is to this large population devoid of that rich education in the past. And remember, regulators are also having a very tight watch on what education are you giving versus the advertisements. And therefore, that is a very scientific detailing path which takes time. So in the short to medium term, GLP-1 is going to be a little slower in terms of uptake, at least on the semaglutide front. In the medium to long term, we believe this is going to be about $1.5 billion to $2 billion market over the next 5 to 6 years. And that's predominantly going to be shaped by equal mix of expiry patent drugs like SEMAs and also new drugs like tirzepatides and licensed drugs from China that increasingly companies are turning towards. So it's going to be a mix rather than one drug. And key beneficiaries will be one that who hold the value chain, including Zydus, Lupin, Sun Pharma, and we like these names for their depth, presence, and scientific approach.
Thank you, Nandan, for joining in. Next time, we'll get chatting about individual stocks and why you like Zydus. Zydus is your top pick with a target price of $14.57. So that is about a 30% upside, and it is a play on the GLP-1 opportunity and perhaps benefits even from the cancer shortage in the US. But it's 9:10, so let's quickly get in our 9:10 calls from our expert, Sudarshan.
It's Apollo Hospital. Buy Apollo Hospital with a stop under 82.20.
Apollo Hospitals. Mitesh?
I'll go with the buy on LIC of India.
And do you have levels on LIC?
Yeah, try to buy around 435, 436 and keep a stop below 425 for targets of 455.
Got that. We'll come back to you, gentlemen. For now, it's time for the brokerage call of the day. Our Sudarshan joins in with that.
So I start with Adani Enterprises. Morgan Stanley has initiated coverage on that with an overweight call, and target here is 3,638 rupees per share. It says it's India's premier incubator with exposure to multi-decade themes, and it forecasts EBITDA to scale up 3 times by FY30, and that would be driven by airports, new energy and primary industries. FY27 drivers: Navi Mumbai International Airport, Ganga Expressway, copper plant and new energy capacity expansion that company is undertaking. By FY30, it expects company to handle 145 million passengers across its airports and have 2 gigawatt DC portfolio. So considering all these factors, it's positive on that. Next one is Vedanta Aluminium. CLSA has initiated coverage with an outperform call, and target is 540 rupees per share. It says outperform call is supported by longer aluminium cycle and robust operational tailwinds. Expects backward integration to lift company into the first decile of global cost curve, and strong free cash flow generation is likely to support deleveraging and dividend payout. Last one is Varun Beverages. Investec maintains buy call with a target price of 609 rupees per share. It says company's alliance with Asahi marks its first non-PepsiCo mandate in India, and MOA amendment and removal of SPV restriction opens door to a far broader partnership, and Super Dry, Peroni and RTD brands could be channeled into India or even in companies' international markets as well.
Peroni, early in the morning. Great. Thanks a lot, Sud, for joining in and giving us the top brokerage calls as well. Well, here's a quick recap of all the top stocks that we covered earlier this morning. IRFC, Tata Power, Garden Reach Shipbuilders, City Union Bank, Infosys, Rashi Peripherals, you have Honasa, Go Fashion, SIS, Solara, Active Pharma. All of them will be in focus for today's trading session. But talking about Honasa, Manglam, they've gone ahead and done an acquisition. Tell us more.
Well, they've gone ahead and made an acquisition in a pharmaceutical, nutraceutical company called Fluence Pharma, 58% for about 135 crores. And they offer condition-specific OTC supplements, over-the-counter supplements, Hair Fact, Skin Fact, Pro Fact. So whatever you need, if it's specific, go ahead and get it from Fluence Pharma. They will acquire the remaining 42% over the next 5 to 7 years. And nutraceuticals is a market that's growing very fast. 16,000 crores is, as of FY25, growing at around 11% in CAGR. And Fluence Pharma by itself, while, last year they did a revenue of almost 40 crores, the important part here is margins. It's over 20%. So this acquisition will obviously scale the company going forward. And Honasa in its recent analyst meet also said that the next horizon categories that they have, fragrance, nutraceuticals and oral care, are targeted to do a revenue of almost 250 crores in the next 5 years. So that's where, the company is actually going ahead and taking a step in the direction which they pointed the analysts towards already. My sense is that the next leg of beauty will be inside out and not necessarily outside in. So far, people were, looking at beauty as an external thing. You apply things on your face or, skin and hair and all of that and stuff. The next leg will be inside out, where you, consume all of these nutraceuticals eventually, which will lead to better health and hair health and skin health.
Beautiful. Well put, Manglam.
All right.
All right, we've got about 1 minute to go before we open for trade. And stocks that you should have on your radar include these IT names, 2 of them, Wipro and HCL Tech, because they've been downgraded by JP Morgan. For Wipro, the target price by JP Morgan stands at 160 rupees. It's now an underweight. And for HCL Tech, the target is about 10% lower than the current market price at 1,000 rupees. And these are the stocks which could see some amount of pressure. On the mid-cap end of trade, there are some downgrades. JP Morgan has downgraded Tata Technology. The target price is 550. So that's the other stock in the IT basket you need to watch. 9 seconds to go. Yesterday, we had a deep sell-off in the markets. The Nifty was down over 200 points, and the recovery in Asia has not held, and Asia right now is in the red. The bell has gone. The first tick on the Nifty is 23,800. So we've opened mildly lower, about 25 points down on the Nifty. The Sensex is lower by nearly 60 points. So about 0.1, 0.2% down on the benchmark indices. Midcap index is flat. The Nifty Bank is on the flatter side. The advanced decline ratio for now is in the green. So what's on the way down? Well, you've got these IT names. So HCL Tech on the back of the JP Morgan downgrade. Bajaj Auto is selling off, so that's 1.3% down. Bharti Airtel is lower. Reliance Industries has had a good run on Monday. So Reliance Industries, though, is tad under pressure. You've got Eicher Motors, Grasim, NTPC, JSW Steel, Adani Enterprises should come up for you on your screen on the back of the Morgan Stanley note. They believe that this is a good company to incubate the decadal themes, and their target price, Morgan Stanley's, is more than 3,800 crore. On the way up, Tech Mahindra sees buying. Infosys post AGM, some confidence being built into the stock. ICICI Bank has been a mover this week. ICICI Bank up and about. Apollo Hospitals, a recommendation by Sudarshan Sukhani as a buy idea, so that's seeing some buying. Interglobe Aviation, Dr. Reddy's also up. Now back in the green now, 23,850 guys on the Nifty.
If you look at the mid-cap index, it's largely in line with the frontline end as well, though we have at the open a few more stocks which are advancing than the number of stocks which are declining. Among the ones which are declining, the notable one is IRFC, obviously, because of the supply expected out there. The government launching an OFS for 2% equity with a floor price of 91 rupees per share. That is the top loser. Apart from that, we are seeing some, profit booking in names like Hitachi Energy or even, some of these gold players, IFL Finance, Muthoot Finance not doing particularly well. Maybe that's on account of the dollar strength and the concomitant negative impact on commodity prices. Pharmaceutical continues to find some buyers. Second day running, Piramal Pharma up 2%. We are seeing some traction in Zydus Life, Alchem Labs, Syngene as well. Shree Cement is among the gainers in the F&O gainers list too. And if you look at some of the broader market names, Spencer's Retail has found some purchase. In fact, the entire RPSG group, we're seeing some traction in PCBL as well as National Peroxide. So that entire space, Sanjeev Goenka group stocks are seeing some buying. Genus Power, which was among the bigger gainers in yesterday's trading session, is coming for some more buying, up 2.5%. And we are also seeing some purchase in QSR, which continues. So United Food, which was earlier known as Barbecue Nation, seeing some buyers here. And we are also, finding some buyers, maybe in early trade. It's Burger King, which has opened marginally higher. Let's see where that goes. Nigel.
Well, that's right, Mangalam. You pointed out the Genus Power continues its good form. There are a couple of other stocks from the pharma pack, the CDMO space, that have continued their good form as well. You have Piramal Pharma that's up close to around 3%. Good pullback is what you're seeing on that name. Another stock, Cohance, that as well, I think, was up close to around 5-8% yesterday. That one as well is putting on close to around 2%. Pace Digitech, ambitious guidance is what they put out. Yesterday, the stock, I think, was up 10%. Today, it's running along. Keep in mind, the peak, I think, was around $230. So even after this big move that we've seen, still it's a far cry away from those levels. Vedanta Group stocks like Vedanta Iron and Steel as well as Vedanta Power, both of them are down 2.5% to around 3.5%. Some of the stocks are going circuit to circuit. Even the oil and gas stock, that's Vedanta Oil and Gas, that one as well is down. So all the demerged entities trading in the red for today's trading session. Pull up Vedanta Aluminium in the last, I think, 5 or 6 trading sessions. You have brokerage notes coming in from Citi, Kotak as well as CLSA. All of them coming out with buy calls. However, because of the correction that we've seen in aluminium prices, that's why the street is a little bit skittish. But for the time being, it's reacting to that CLSA note. Stock is up close to around 1% in today's trade. Another stock that's moving up is Rashi Peripheral. They've gone ahead and done that inorganic growth. We'll have to see what kind of TAM are they targeting with regard to that one. But for the time being, the stock, I think, is up close to around 6%. We'll try to get you more details on that one. ZF Commercial, that's another stock that's opened up with some good gains in today's trade. A couple of other names that actually have done pretty well in the last few days that have come in for profit taking. You have Kirloskar Oil. Stock is down, I think, close to 2%. Big move is what we've seen. That's coming for profit taking. And Sterlite Technology is another stock that went one way from 100 to 600. Well, that as well is down in today's trade. Keep in mind, there are a couple of stocks actually where there are very large trades that have taken place. Pull up Shadowfax. I can see a very large, huge trade out there. So Shadowfax is one stock that should be on your radar. We'll wait by in the evening to see what the disclosures throw up. And the other one is GMR Airport. That one as well, very large trade being seen on both those two names. So that's why we're seeing massive volumes just in the first minute or so. For the time being, guys, we're in the green, 25 points higher. Asian markets have come off the top. So it seems India's outperforming marginally yet again.
All right, it is outperforming marginally yet again. So let's see whether this outperformance continues or not. So let's pose that question to our market master of the day. We do have Devina Mehra, founder, chairperson, and MD, First Global, joining in. Thanks a lot, Ms. Mehra, for joining in. Have to ask you, the underperformance that we've seen over the last 18 months or so for the Indian markets, and it's been a large difference between the ones that gained and ones that didn't. We're among the few underperformers. Do you think this turns at some point in time? The AI trade, the excesses come out. And what's the next 12 to 18 months looking like for the Indian markets?
So India as a whole has done pretty poorly. I was looking at the 42 major indices that we track, and I think we are 38 or 39, so pretty close to the bottom. And but of course, the good news always is that usually out of the lot that are in the bottom five, very often, many of them move to the top five in the next period, and that is even when the country is actually in a crisis. So Sri Lanka, Turkey, Russia have all seen that over the last few years. And the whole thing of that India is doing badly because it doesn't have a AI story. It doesn't really hold, because in the US also, if you see the small and mid cap index, which is the Russell 2000, has done more than double the move of the S&P this year. So that has included, of course, the technology-related stocks, but it has included a whole lot of old economy stocks also. And talking real old economy, the Dow Jones Transportation Index, which has stuff like freight and car hire and airlines, is actually up 30% for the year, as against 9% for the S&P. So, the narratives that you hear in the markets are not quite what has happened, or at least not the full picture of what's happened. And I remember around March, when I was on your channel, I had said that I think the Indian market is in the bottom range, and I don't know whether it will start moving up in 2 weeks or 2 months, but definitely it was time to be invested. And that's still my recommendation, that don't be 100% in equity, but definitely it's time, whatever is your India equity allocation, be invested. And the good thing, of course, compared to 2025 in the Indian market itself has been that 2025 was a very narrow market. It was essentially only large caps, which showed up in the fact that almost every Indian market index was up for 2025, but more than half the stocks were down. 40% of the stocks were down more than 10%. And at its narrowest, only about 12-15% of the stocks were outperforming the market, as against a norm of around 35-40%. Now the outperforming stocks are the majority. I think it's a little over 50%. So which means the market has really broadened, which is a good sign. So it is kind of at a good base and a place to start.
Devina, just to zoom out a bit and talk about the global tech names, and at First Global and you've been looking at these indices, these individual stocks for the last 25 years. And I go back to our earlier conversation where you had categorically said that AI is a bubble. It's not a question of if, but a question of when. And now, we were just chatting with one of our earlier experts, and he also sort of concurs that it's gone up too fast, and there could be a meaningful correction ahead. I mean, take us through, because every day is a new day when it comes to AI and the kind of news flow. So from the last time, in the last 3 months, how has your view on AI changed? Has it become stronger, that we are in a bubble? And what could the correction look like?
So, Rima, the thing is this, that it is not as if I'm saying AI will not be a transformational technology. That's not my view. The point is that whether investors make money in it. So because in the world, there have been many technologies that actually have completely transformed how human beings lived, from railroads to the internet, with automobiles and aviation in between. But most of these new technologies have been a graveyard for investors, because typically in the beginning, there is a lot of overinvestments. You don't know who will succeed and which company or which technology. And in AI, it's kind of on steroids. So you started with ChatGPT being the leader, then it moved to Gemini, then it moved to Anthropic's products, and that thing is still going on. The other thing, which is a bigger negative for AI compared to even undersea cables for the internet or the railroads, is that whatever they are spending on has a very high level of obsolescence. So it's not even as if all these other technologies, what would even happen that suppose you overinvested, somebody else bought it from you at 30% of your cost price and could make money on that. But what AI is spending on will not be usable if a company goes bust 2 years later, nobody can take over those assets and use them. They have to be junk. The other part which people are not factoring in is the huge environmental load, the power, it uses fresh water. So there's going to be huge. I mean, currently in the US, most communities and states are fighting against allowing data centers in their community, which is very different from what we are doing. So those are the risks in AI. As I said, it is not a bet that AI will not change the world or everybody will not be using AI. That's not the bet, but whether you will make enough return on capital. The other part, see, from AI, actually, the thing is that, as you said, I've been doing it 25 years, and those specific companies, Micron and the NVIDIA, Broadcom, Samsung, all those specific companies we've been covering that long. And the thing is, people don't understand the cycle of semiconductor and semiconductor equipment. So anyway, the kind of baton had passed on from what were earlier the AI mega scalers, which were the drivers of the S&P in 23 and 24, the bull tired in 25. Currently, as we speak, out of those magnificent seven, as they were called, or they're still called, 3 are down for the year. So, Tesla, Meta, and Microsoft are all down significantly in 2026. So now the thing was, it's all going to be the semiconductor and the hardware and all that, which is what has actually driven a lot of the indices. But these are highly cyclical industries. And the reason is very simple. One, the industries themselves are highly capital intensive, and most highly capital intensive industries tend to be cyclical, whether it's cement or steel or hotels. The other part is that they are supplying for somebody else's capital assets, and that's a difficult, that's a different kettle of fish. If you're selling soap or toothpaste, if you sell 500 crores this year, there's no way you'll come down to 100 crores the next year unless your factory shuts down. It will be plus minus from those 500. But if you are supplying capital equipment to someone, I mean, this year the AI mega scalers are spending close to $1 trillion on setting up AI facilities. So that is what is driving the demand for all these companies supplying to them, high demand and high pricing power. But 2 years later, will they be spending $1 trillion? That's a $1 trillion question, because remember, these very same companies 2 years ago, their total capex used to be 150 billion. So 150, they've gone to 800 or 900 billion. But who knows whether 2 years later they'll be spending that much. So there are also, while I'm talking that AI is a transformational technology, there are many risks to that, from exposing all your data to AI provider who might use it to train models which will help your competition, to the regulatory risk. We just saw the US government saying that certain Anthropic models could not be used by non-US users. So there are many, many factors like that. So, there are too many question marks, too much of euphoria. And I think the SpaceX IPO, to an extent, was an example of how extreme this is. I have no doubt that in future editions of books on financial models, of financial bubbles, you will see a chapter on SpaceX.
So, Vina, so you buy tech or don't buy tech in India?
The IT services companies?
Yes.
So, I mean, we are not overweight, but we do have holdings in IT services. I have not been the sort who thought this was an obituary for IT services. And I think I've said before on your channel also that the obituary of IT services has been written many times, from Y2K, that all the business was Y2K, what will they do now? Or digitization, or when SaaS, the software as a service, came in. But that's not how it has happened. And see, even if a company, an enterprise wants to use AI, they're not going to hand over the keys to their database and systems to the AI company. They will still need an intermediary. My bigger concern is that IT services companies were the big driver of employment in India for the last 25 years. They were the major driver, both primarily and then secondarily driving demand for real estate and food delivery and driver and security guard and nannies and all of that. And that is the big question mark, that already we're not doing too well on employment. So it's more a macro concern for me than an IT services business concern.
Okay. All right. Since you mentioned nanny, Devina, that's the most important member. But anyway, getting back to markets then, I think one of the themes that you liked was pharma. And unfortunately, there's a bit of a shortage that's playing out on various drugs in the United States. And it seems that the Indian pharma companies could be well placed on that front. Is that one of your top themes that you like? And if you could give us a little bit more clarity on what you like, the larger players, the CDMO players, what is it?
So, I mean, your voice kind of faded away, so I couldn't hear everything very well.
On pharma, what is the call?
Yeah, I mean, I know you're asking about pharma. So,
yes.
We have been overweight pharma since the beginning of 24, so almost 2.5 years now. 24 was good for pharma. 25, it was like treading water, didn't do much. It has now started to move up, and still we like it. In fact, in the last rebalance, we had added a little bit of weight in pharma. Though our companies, the stocks we've invested in tend to be little more domestic oriented than totally export oriented companies. And we are quite comfortable with that profile.
Right. And what else looks attractive to you right now in the Indian market, if at all there is an opportunity? And for those who don't have, the chance of investing outside of India in AI themes, etc., and probably not the expertise either, who have to look at the opportunity set that we have here, where would you suggest one put their money?
So first of all, I mean, do have global in your portfolio. I have been an advocate of that forever and ever. So I have not discovered it in the last 1.5 years when India didn't do well, because that has to be part of your asset allocation. When I started working, the dollar was 12 rupees. So, that's your long-term financial goals right there. And we have a product that starts at $10,000. But coming to India, we continue, as I said, pharma we continue to like. Auto components, and to some extent, autos is again a theme we've played for over 2 years. And I mean, we always, when we're overweight something, every quarter we ask, is the story over? But the story still doesn't appear to be over. So we still overweight. Other than that, I think capital goods, again, the industrial machinery, we would have become slightly overweight. And bottom up, of course, we have names in chemicals, FMCG, etc. Banks, while we are not overweight, we continue to hold more than what would be our 5-year average. And the sectors that started looking a little better off late and where we have added have been power equipment related. So that would be broadly where we are. Of course, right now, I mean, some beaten down sectors are also doing very well. I mean, real estate being one, but we don't have exposure there.
All right, take that point. Thanks a lot, Devina. Always a pleasure speaking with you. We'll obviously, come back to this conversation in the next few months and see how this entire story does play out. And we'll keep an eye out on SpaceX and its future. With that, let's move on. Let's get in a corporate conversation. Sanjeev Asthana, CEO of Patanjali Foods, joins us now to discuss, obviously, the important focal points. One is demand amid delayed monsoon, raw material inflation, margin outlook that the company has, and navigating competition. We recently heard from a large player in their annual general meeting that they want to be the largest FMCG company in the country, and that's Reliance. So let's get in, Sanjeev Asthana. Thanks a lot for joining in. Obviously, the first quarter, you had earlier said that there may be an impact due to drought-like conditions. What's the pickup in rural and urban been so far? It's just been 2 days of rain here in Mumbai, and the latest report that we got, the sowing this time has been almost 40% lower. Do you see that as a problem for the current quarter and the next few?
So definitely it is. I think, for the country, there is a challenge on the delayed monsoon, and it will definitely impact both the sowing, the commodity inflation that companies have to deal with. And certainly from the performance perspective, it will have an impact. There are two sides to the impact that we deal with. One is the positive impact on the commodity price inflation, where we are long only positions on the veg oil. We tend to gain. And it becomes an input for us in multiple other FMCG businesses. There we tend to have a larger cost to deal with, and then it impacts the profits as well. Net, the impact on us will be lesser. But overall, I'm anticipating that it will be a challenging times ahead, certainly for this quarter and the next one.
Right. So when you say it's challenging times, how does that reflect in your own guidance? Because you had targeted around 3 to 5% volume growth for the edible oils business, FMCG business doing about 8 to 10%, with beauty and personal care growing 15%. Does this challenging environment put a bit of a downside risk to this guidance?
No, Manglam. In fact, I'm confident that edible oils actually have come off a very low demand 3 months that we faced in the previous quarter. So it's actually bouncing back, and till June, it's a slower quarter in terms of the volumes. But July onwards is a peak demand period when it starts to build up. So that's a positive side that we see in the veg oil side. But the FMCG will have to really see what the level of rural stress is. Overall, it looks still positive because, as I mentioned last time, that for Patanjali overall, the size of the white spaces that we have and the continuous distribution expansion, we don't expect much of a change from that. But yes, overall, if you look at the demand profiling, if you look at the stress in the rural areas, if you anticipate, how the markets are going to be, overall, yes, overall FMCG sector will face a challenge.
So then what happens to the growth and EBITDA in particular? You targeted about 12 to 15% EBITDA growth as well in this vertical. Do you see a challenge there because now raw materials will see an inflation?
So partially, yes, but that's more than offset by the gains that we have on the veg oil side. So for example, last year, we almost nearly dropped quite substantially on the veg oil EBITDA because on account of the volatility in the market. This year, on account of the inflation that we are seeing on the veg oil markets overall, driven largely by, the petroleum prices, and the overall shortage that has tended to offset. So I'm quite positive on the edible oils playing out over the next 2 quarters, which is the first one and the second quarter of this year. I am positive that we will have good growth in the HPC category. Food, and especially in the staples category, is where I anticipate that there will be some stress. But we are pretty much on course to achieve our, the both in terms of growth in the EBITDA, as well as the overall margin, construct for the company.
Okay, all right. Hi, good morning, Mr. Asthana. Always good to see you in, sir. You had told us the last time around you're looking at expanding and enhancing your distribution network as well. And you could probably be on the prowl. Any updates on some inorganic growth, some acquisition? Should we hear something when you declare your numbers, first quarter numbers, or is it in the coming quarters?
No, I'm afraid not at the moment. The focus right now is to deal with the situation on hands, which in any case is quite challenging. So we've just come off this Gulf War volatility, which impacted the supply chains big time. It was at the back of lower demand in India on account of this volatility and the price challenge that we had in the previous fourth quarter of the last year. So acquisition-wise, be careful. We're not moving ahead with anything right now. And there's nothing on cards. Right now, the focus is on, driving efficiency in the operations, maintaining supply chains, and, of course, looking at the margin construct, which I was just speaking about. How do we maintain that and, continue to grow that based on the projections that we've given? So that is the larger effort right now.
And, sir, for biscuits and oral care, what is the projection? How has Q1 been?
So Q1 in the oral care is very good. I think one of the stronger brands, largely immune to all that we discussed about monsoons and commodities. So that is going pretty well. So Dant Kanti, for example, we have launched a range of variants of Dant Kanti, which are doing exceedingly well. On the oral care segments, the toothbrushes which have launched have picked up exceedingly well. So we're expanding the range. We're building on the category. There's a lot of segmentation that is being done now to the extent of micro segmentation on basis of the population, the choices and, the Gen Z sort of requirements for a particular kind of toothpaste. So that work is going on. So we're pretty optimistic that we should have 15% plus growth in the oral care, which is our largest category in the HPC in any case.
All right, 15% plus growth in the oral care business. How do you foresee the industry by itself to, move going forward? And this comes in context of the commentary that was made by Reliance in their annual general meeting. Their consumer products business has crossed 22,000 crores in gross revenue last year. And they are targeting to reach 1 lakh crore over the next 5 years. That's the immediate target. And eventually wish to be the largest FMCG player in the country. They have presence in a lot of the categories that you're present in as well. How do you see their competition, or how do you see competition evolving from here on? And do you see some more aggression coming in?
So Reliance is obviously a formidable player with deep pockets and, larger ambitions, around the FMCG now. And large part of their growth has been driven by the inorganic acquisitions, and riding on top of that in terms of all the acquisitions they've done, they've grown that. Retail gives them added heft. So Reliance is a strong competition. The other players are also equally strong. We know that. But there's a space in the what I've defined repeatedly, that for Patanjali, the health, wellness, yoga, and Ayurveda as a core category, and the Indianness of what we have. So we are feeling pretty confident that this is a good window that we have of continuously growing, and this market is expanding as well. Pretty much. So Patanjali, in terms of the right to win in our categories where we operate, is very high on the list. And that we feel very strongly and comfortable about, that we'll be able to grow that at the stated intent. But yes, overall business of FMCG is growing. But there are different ways in which how this entire is going to play out for the respective companies. Yes, Reliance and others will do their bit, and we'll do our bit.
All right, Mr. Asthana, before we let you go, what's the target with regard to the oil palm business? What kind of levels are you looking to scale this business to? I think last year you did around 1,700 crores approximately, with a bit of around 350 crores. So growth trajectory out here, and what's the peak level?
So oil palm plantation business is, as I had mentioned always, that's a more like an annuity business when the high price environment, if we staying in. So I'm anticipating that oil palm will continue to grow at the rate of 50 to 70 crores of EBITDA. We'll keep adding each year. This year we should cross 400 crores plus. We have 120,000 hectares which are planted. This year we should do additional 30 to 35,000 hectares of more plantation. So I'm definitely expecting in the next 5 to 6 years' time, we should have a 700 to 800 crores of EBITDA business that should be continuously there with us for next 25 years.
All right, final question then. I'm looking at last year's cash flows. Your OCF turned negative. I think you had given out some credits. Will that realign itself, and will it revert back to a positive number for this year? Last year, I think OCF was negative 300 crores on.
Yeah, no, entirely. I think this was a short-term, change that we had in the balance sheet. Some of the credits that were there, I think this should reverse in the second quarter, or by this year's second quarter, we should be reversing it.
All right, take that point. Thanks a lot. Just before we let you go, one more thing. Recently, a very small part of your business had an FSSAI or regulator run-in. Do you want to comment on that?
So this was on the medicine part of it, which is not part of the listed entity, but that was a particular issue which they had overall, not just on our business, but overall, on the Ayurvedic medicines that was there. So that's already passed, and it was one of the smaller medicines which was there, which was done, but that's already over. It was in Maharashtra, and that's already done. We have clarified on the exchanges as well, so that we've already contested that, and it will get reversed.
All right. So there is the sorghum flour batch in Kannur district. Is that the one?
No, it was much earlier. So there were two parts. One was on the Ayurvedic medicines in Maharashtra, and one was a smaller part of the sorghum bit, which is not even a 0.0001% of our business. So that we are working with the regulator in terms of the particular issues what they had, and we are working on closing that.
All right. Take that point. Thank you so much for the clarity. Wish you good luck for the next couple of quarters as well. With that, we'll take a short break. Come back. On the other side, we have management of UPL chatting with us on the company's FY27 outlook and a lot more.
Welcome back. Well, the headline index is trading in the green, but a couple of stocks in the Nifty pack itself have come in for some profit taking. So if you pull up the life insurers, SBI Life, that's moved a little bit lower. HDFC Life as well has moved to the low point of the day. So life insurers and a couple of these auto-facing names, they as well are seeing some pressure. Maruti has moved to the day's low, and Bajaj Auto as well has moved to the low point of the day. So, both those two stocks are seeing some selling. On the life insurers, has been a particularly sharp decline. We'll see whether or not there is some news flow that's expected on the life insurance front. But even the breadth of the market, number of stocks advancing were way more than the number of stocks declining. It appears they're getting a little bit closer to each other as we speak. So I think we should get those two. In fact, now we have more number of stocks that are declining in comparison to the number of stocks that are advancing. That said, it's time to invite our next management, that of UPL. We have with us Vikas Prasad, the Group CFO of the company, who joins us. Hi, Vikas. Good morning. Good to see you, Ben. Well, we want to address three broad points which should come up for our viewers on the screen: the restructuring that was announced, the impact of the West Asia conflict, and what's the outlook in the near term. That's FY27. Well, Vikas, let's focus first on that restructuring exercise. Now, going by the stock price reaction, it appears investors had some concerns. Will you all have any kind of relook at the plan? Will you look to restructure the plan in the current form? I'll tell you why. Concerns are stemming that the debt overhang stays, and also the company will now call for a holding company discount. So that's why minority investors were a little bit disappointed. So is there any plan to relook at the current structure, or are you all going ahead with what it is?
Yeah, good morning, everyone. And it's a privilege to be here. As you know that we have grown our business in over 140 countries. And with expansion and size and scale also comes the complexity. So we always evaluate our business structure, organizational structure, to make it more efficient. And the recent restructuring that we have announced is one of such outcomes that we have looked at. Now, I'm surprised to see your question about the market reaction. Yes, post our announcement, we have engaged with various investors. Initially, there were some queries and doubts about how the restructuring will take place, about the swap ratios, about the benefits for the minorities. I think most of the discussion that we had with the market and the investors, they have been able to understand it much, much better. And if you are talking about the reaction, it was immediate reaction after the scheme document was submitted. However, a lot of our additional documents were not submitted by the time the market showed their reaction. Subsequent to that, we had submitted a detailed FAQ document. We had submitted the valuation report, which clearly showed the swap ratios, the share entitlement ratio. So all the details were fully provided. And we also had a discussion with multiple other investors, and we continue to engage with them. In fact, we are seeing quite a positive traction from most of the investors after they have fully understood the restructuring and the scheme. We feel that by doing this restructuring, we are going to simplify our corporate structures. We will have 3 pure play platforms. It will simplify. Second, it will also build the market dominance. By combining the India crop protection business with our global crop protection business and getting it listed, it will be the world's second largest.
So basically what you're telling us is that initially there was some kind of, investors were nervous, but you have clarified with them, and now you believe that investors are on board and they're happy with what the restructuring plan is in current form. So you're not going to be altering the plan, right?
Yeah, as of now, we don't have any plans to alter it. We are seeing a positive traction from most of the investors.
Could you give us a sense on the debt distribution on 3 entities, and what would be the deleveraging plan for all of them? Will you be raising funds individually in any of those entities?
I'm glad that you asked this question on the debt. I know that there's a market overhang on the debt, but probably the focused action that we have taken in the last couple of years, probably the market has not taken full note of that. Just to recap, our net debt to EBITDA, the gearing ratio was about 4.6 times after FY24 industry impact had happened. Then that 4.6 times reduced to 2.1 times in FY 2025, which further reduced to 1.6 times in 2026. And if you look at the absolute amount of the debt, we reduced our gross debt by about $850 million during FY 2026 and net debt by $400 million. So the short-term guidance, short to medium-term guidance of 1.5 times or slightly below that we have given to the market. We are always there. And this is a level of where we are very comfortable with the level of debt that we have and the gearing ratio that we have.
No,
now, post-restructuring, most of these debts will move to UPL Global. While Advanta is a cashless company, they are sitting with cash on their balance sheet. So most of this debt that we are seeing today at UPL Group level will move to UPL Global. And upon listing, which we are expecting somewhere between say June to September 2027, we are expecting the gearing ratio for UPL Global to be between say 2 to 2.2x times. So each of the pure play listed platforms will have their independent capital structure to meet their growth investments.
And what would that capital structure be on the debt? If you could give us a ratio for the company, you've given around 1 to 1.5 times EBITDA. For all the listed, each of the listed entities, once the demerger happens, what would that number be? And if you could give us absolute numbers, that would be even better.
Yeah. So as I said that most of the dates are today at the UPL Global level. So upon listing in between June to September, we expect the net debt to be around $2 billion. And that will translate to a net debt to EBITDA of between say 2 to 2.2 times.
Hi, good morning, Rima here. On account of the deficient monsoon in India, how does it impact your business? Because Kharif sowing has been impacted. Is there some sort of a sensitivity analysis? What will Q1 look like? Because you've given a guidance of 10 to 14% revenue growth and 14 to 18% EBITDA growth. Is there a risk to that?
Yeah, I think good question. As we all know that monsoon is delayed in India. However, it's too early in the season. If you feel that if the monsoon comes by end of this month or early first week July, it will not impact much in terms of the agricultural production. So we expect that the Q1 forecast that we had, we are in line with that at the group level. But even at the India crop production level, we are comfortable with the plans that we have for Q1. And also at the same time, we expect our Q2 to be stronger than the last year's Q2. So I think it's early now, while IMD forecast is showing about 10 to 15% lesser rainfall this year. But we have to wait and watch to see that how it unfolds.
But despite not having any rains in the month of June, you're on track to meet your Q1 FY27 guidance, both on the revenue and on the margin. So that's good to hear. What about the full year guidance? Because last time you withheld giving the FY27 guidance, citing volatility, geopolitical tensions, etc. Do you think you are in a position now to give it maybe when you declare your Q1 numbers? And broadly, ballpark, what could the numbers look like?
Yeah, I know. I understand your excitement about the full year outlook and the guidance that we want. We will assess that. We will assess that at the end of Q1. And when we come to the market to announce our Q1 results, that point in time we'll update the market further, whether we want to give the full year guidance or not, depending upon the market conditions and evolving West Asia crisis.
Okay, all right. Vikas, tell us a little bit about business then. If I look at the mix between agro and specialty, currently you're more tilted towards agro. However, you've made this point that specialty will grow at a faster clip. So what are you factoring in terms of the specialty growth? How do you see the mix evolving and by when?
Yeah. So right now, if you look at our Superform business, which is the manufacturing and specialty, the mix between agro and specialty is improving. 2 years ago, the mix was about 80-20. In FY26, the mix has changed to now 72% for agro and 28% specialty. and the various advanced chemistries where we have built our capabilities, whether it's sulfur-related chemistries or phosphorus or phosgenation, caffeine, acrolein, we do see huge opportunities, and especially after China Plus One strategy, we are seeing that a lot of long-term industry players in various industries, they are talking to us, and they are talking to us for sourcing our capacity for long term, ranging from 5 years to 10 to 15 years. So we are seeing huge opportunities on a specialty, and we feel that over the next 3 years or so, the mix will be tilted more towards 55% agro and 45% specialty. And with that, it will also help us to elevate our margins. As we know that agri, our EBITDA margin, because of the transfer pricing agreement that we have with the different platforms, is between, say, 12 to 13% EBITDA margin. However, specialty is between 18 to 20%. So with the improvement in the product mix, overall margin for that platform will also improve.
Okay, we'll leave the conversation here. Thank you very much for joining in. That's the word coming in on UPL. For the markets, I think there's been quite a slide that we've seen in the Midcap index. So that should come up for you on your screen. The Midcap index is under pressure. The advanced decline ratios we highlighted has turned in favor significantly in terms of the declining side. The Nifty, though, is managing to hold on to the green line. So that's attempting a bit of a rebound as we speak, but the Midcap index is a tad bit subdued, and IT is selling off. So you've got a Tata Tech down 2.5, you've got a First Source, Nazara, Mastech. These are stocks which are struggling in trade. There's a JP Morgan note today, and they're basically saying that there is no recovery in sight for the Indian IT companies. They're saying that Indian IT companies have seen a low single-digit revenue growth for the last 3 years. For the next 2 years at least, they aren't seeing any pickup. They don't even see large-cap IT companies growing in mid-single digits, because IT companies, according to them, are navigating what they call a FUD, which is basically fear, uncertainty, and doubt. And whatever tech spends are there, they are being redirected towards capex spend, cloud spends, using it for tokens. So there's not that much money which is left for services. So 3 years of low single-digit growth, and according to JP Morgan, another 2 years of low single-digit growth is what they expect for the large-cap IT companies. So they expect growth to hover around 3 to 4%, which is why they've even brought down the PE multiples. They've downgraded in HCL Tech, Wipro, and in the mid-cap space, they've downgraded a Tata Technology to an underweight. Their top overweights remain TCS, Infosys, Tech Mahindra, Coforge, Persistent, and Sagility. So that's the view on IT.
Well, just keep an eye at a couple of stocks actually from the broader markets. KPR Mills, that stock is moving, and it's moving on very, very large volumes. Remember, the sector itself had a lot of headwinds that are gradually turning into tailwinds. And for a company like KPR Mills, the spread out there has been improving. For the last few months, it's been improving. And if you take a look at it, I think in the last 45 days or so, the stock is up close to 25 to 30%. So big move is what we're seeing on this particular name. Volumes are very, very high as well. I'm not seeing any big news flow, but that's a stock that you should be keeping on your radar. Just take a look. 3 months, in fact, the stock is up close to 50%. I recall, explaining a bit of the stock on Editors Roundtable around a month and a half or so ago. The textile pack on the whole, that some of those headwinds were gradually turning into tailwinds. And the sector itself has come back into spotlight. You look at a Welspun India for different reasons, because they have a high exposure to the United States. That's moved from 130 to 160 bucks. KPR Mills, I think, was 900, 950 rupees. That one as well has moved to closer to around, 1,300 rupees. We're talking about Welspun, the textile company. Welspun Living is the one that we're talking about out there. Well, let's get in Nagraj Sethi then. Nagraj, markets a little bit nervous, but we have the Asian markets on the whole actually that are nervous. What are you making of the current, volatility we are seeing? And would you be a buyer at around this 23,800 mark?
Hi, good morning, Nigel. Yes, market has reacted down from the crucial hurdle of 24,200 levels. At this point of time, there may be a smaller term, looks like negative, smaller dip is likely, but the overall market picture is remain clear, very positive. I think at the lower levels, there is a strong support emerging somewhere around 23,600 level, which is a recent opening upside gap, which is a significant one. I'm not expecting a bigger decline from here onwards. a smaller decline, consolidation moment at the lows, somewhere around 23,600 to 23,500 levels. I'm expecting a sharp bounce back in the Nifty from the lows. On that perspective, I have two stocks from the long side. First one is from a pharma front. Biocon has been in a consolidation phase over the last couple of weeks. Recently made an attempt of upside breakout of the consolidation, currently showing consolidation minus sell-off from the highs. Overall chart pattern is looking positive. I'm expecting a breakout in this pharma stocks, currently trading around 422. One can look to buy at this point of time. Immediate target would be around 445. One can place a stop loss at 400. Second one is from IT side, OFSS, Oracle Financial. The stock price has been in a constant up move over the last 4 sessions after forming a higher bottom somewhere around 9,000 levels. The overall chart pattern is indicating a chances of upside breakout somewhere around 10,500 levels. So one may look to buy Oracle Finance, currently trading around 10,237. The immediate target would be at around 10,000. One can place a stop loss at 10,000.
All right, take that point, Nagaraj. Thanks a lot for that. It's Wednesday, which means that tomorrow will be the BSE FNO expiry as well, and that's where we're looking at some important trends right now. The Sensex is holding well, about 250 points higher, though off highs from the lows. It's seen a recovery, and that's largely courtesy the BSE IT index. And we are seeing, the HDFC bank stock do extremely well. It's crossed past its 50-day moving average in today's trading session. 76,228 is where the 50-day moving average is. The Sensex is at 76,500, closer to 76,500 right now. 77,788, which is the 100-day moving average, proves to be a bit of a resistance on the Sensex. So that's the broad range that we're looking at. But in the very near term, I will be monitoring how the BSE IT index pans out, because if both the IT index as well as the banking index does well, then we'll have the Sensex move higher from here on as well. The IT index up nearly 0.75%, and we have HDFC Bank, which is doing extremely well as well at the high point of trade, a fair weight on the Sensex. But in terms of calls, which are fairly active, and these are ones that expire tomorrow, we have the 76,400 one that comes up for you. Premium of 300 rupees tells you around 76,700 thereabouts. So we could see some sort of resistance happen. And at lower levels, obviously, there is support coming in. 76,300 put, which has a premium of around 300 rupees as well, tells you 76,000 is an important support level. We are also seeing some writing at the 76,200 put. So basically, broad range for the Sensex, 76,000 at the lower level to about 76,800, 76,700 to 76,800 at the upper level, with all eyes on BSE IT and BSE, the banking index, that is. With that, we take a short break, come back. On the other side, we discuss the commodities arena with Manisha Gupta.
Welcome back. Let's talk about commodities now. Manisha is now joining in to give us a complete roundup of the action here. Manisha.
Well, thank you so much for that. I'm looking at the base metal prices because this is where we have seen very sharp declines come into the space there. If you look at the overall prices, that has been down because of various factors, really. To top it all, it has been about the strength in US dollar index, holding above 100 and holding quite strongly. And then the hawkish US Fed statements is something that we've been discussing, and a higher probability now that you could be looking at one rate hike in the month of December from the US Fed. It also has to do with the weak weak China data, which has led to some concerns into the markets as well. We are also looking at industrial numbers, all of that coming on the weaker side from China. Add to that, it's also about the slowing automotive and industrial demand from China and various parts of Europe that seem to be impacting the market. It also is going to be about institutional profit-taking that we have seen in case of metal prices in the last 3 weeks or so, only getting more stronger in this week itself. The selling also has happened from investors to raise cash amid market pressures. The kind of sell-off that we've seen in AI and tech also has led to selling across commodities that were actually profitable for a very, very long time there. So I'll start with copper, which has seen a 3% of a decline in the overnight markets. The prices have declined 3.5% in the matter of last 1 month. Still positive, though, for 2026, still time. But for copper, it is about the global shipments, which seem to be coming back, especially in case of copper concentrate. With the West Asia conflict now easing, the sulfuric acid, which was a concern, also will start flowing into the market. So smelters, refining, all of that would see that availability of sulfur, pardon me, coming back. If you look at the copper imports therein for concentrate, well, that has remained slightly subdued also. The treatment charges also are at around record low. So everything that was in positive for copper seems to have turned around slightly. Take a look at zinc, though, and this actually has done quite well. Just about a percentage point down on a month-on-month basis and 12% up when you look at this current year. For zinc, it clearly is about regional polarization because what we are looking at is massive production surplus in China versus tight bottlenecks that we are looking at in various Western markets there. Aluminum has been a very volatile market in this year, but when it comes to the price movement, we've seen a very sharp decline on a month-on-month basis. But so far in this year, it still is trading 9% on the higher side. And with that should come the precious metals on your screen because it has been a very sharp sell-off that we've seen in all of these in the last 1 month, last 1 week or so. So with that, all the precious metals are now negative for 2026 after hitting all-time highs in the month of January. It has been a constant decline. So gold is down 10%, silver 21% of a decline in this in the last 1 month, and 15 to 12% of a decline. It's what we are also looking at in case of platinum and palladium. So another day when the metals have extended declines.
Thank you very much for that. On that note, we will get into a break. On the other side, Lata will discuss the corporate capex cycle with Mahesh Vyas of CMIE and Mirain Lodha of CRISIL in our special segment, It's the Economy.
Welcome to It's the Economy. Today we are looking at India's capex cycle. The GDP data for FY26 showed that the entry gross fixed capital formation grew by a strong 8.2% in FY26 in real terms, constant prices, and by 9.9% in nominal terms, current prices. However, the central government capex for the same year actually was very tepid. It was only 1.6%. And these are hard numbers in the government database. So the question we are asking today is, was private or corporate capex strong enough? And is that why we have a big GDP number? This is a tough question because no direct government data is available on corporate sector capex or infra capex. They're all derived numbers. So we turn to the experts. Joining me now is Mahesh Vyas, the CEO of CMI, the only organization that has a long record of collecting investment data, and CRISIL's Senior Director, Miren Lodha. Miren and Mahesh, thank you very much indeed for joining me. Mahesh, you go first. The strong 8.2% in real terms and constant terms, almost 10% growth in investment. Does it gel with what you have collected?
So we don't find the capex cycle that we saw by the middle of 25-26 to have sustained by the end of the year. So by September, we were talking of a very good capex cycle, whether seen from the CMI capex database or from the balance sheets data available for listed companies as of September 2026. Both of these, 25, sorry, both of these did show a very strong pickup in the capex cycle. We also saw from other sources like the sales growth of capital goods companies, order books placed. So we kind of triangulated from multiple sources and concluded pretty convincingly that the capex cycle had begun sometime in the first half of 25-26. But when we look at the March numbers, they don't look like they have sustained themselves. Part of the reason is the March month itself. We saw in that month a big difference in the capex announcements and completions. So I think the West Asia war may have played a role, but for many other reasons as well, the cycle that we saw building up, gathering pace in the first half of the year seemed to have fizzled out by the second half of the year. We don't see a capex cycle in 25-26, and we don't see one in the first quarter of 26-27 as well.
Okay, that's important. Your April-June numbers are also there. It's flashing on the screen. And clearly, the April-June number for total is higher, but manufacturing is lower, distinctly lower. From 3.7 trillion, it's down to 2 trillion. So there's clearly a fall as far as manufacturing new investment proposals are concerned. I have not been showing the net fixed assets data that you gave me. There as well, September showed a 16% growth, but by the time we come to March, it is a 7%. Okay, there it is. So as you can see, it seemed to grow very well till September, as Mahesh pointed out, but March was tepid. It's not even made it to 8%, though our gross fixed capital formation number is saying 9.9 in current terms. Miren, what has been your assessment of FY26 first?
Okay, so see, when we do a bottom-up analysis, I think our numbers indicate about 25 lakh crores of investment in the economy. This includes both infra and industrial. I think infra is largely government-led, I think, except for if you keep possibly the renewable sector outside. We've not seen a material pickup in the private capex there.
Okay.
On the industrial side, I think, our estimate is close to 7.5 lakh crore of investments in FY26. This is, I think, our numbers indicate a 3 to 4% growth over the previous year. I think fiscal 25 was a strong base. We saw a pretty good growth, a very strong double-digit growth there. But fiscal 26, on that high base, the industrial capex is barely growing at about 3 to 4%. That's our assessment.
Okay, no, that's a fair point. But you also point out, Miren, that although FY26 overall for you is only 3%, power capex was very good in FY26. So certain specific sectors have outshone, even if the overall infra and all is not very good. I mean, I guess that the infra won't be good because look at the government capex also. That looks very tepid. But you all have some very strong numbers for power.
Yeah. No, absolutely, you're right. So I think there are three themes playing out, Lata, if you ask me. I think one is definitely on the power side. Fiscal 26, we've seen almost a 45% growth in the power investments, entire value chain I'm talking about. A lot of it is renewable led, but then the investments happening in every pocket. I think this is also requiring a further investment in transmission infra, and I think we're seeing good growth in the entire value chain, even in the upstream, which is the module manufacturing. There are significant investments lined up there as well. So power is one theme. I think the other area where we see investments happening is possibly the entire oil and gas space. I think energy security as a theme has started playing out. It started playing out well in advance, but I think with the entire West Asia crisis, it's picked up pace even further. And the third is the entire set of investments happening in the emerging or the new age sectors, be it possibly the entire battery manufacturing or semiconductors, electronics, even defense. I mean, these are all the areas where we're seeing almost 2x investments happening over the next 2 years compared to past. But if I keep these three themes outside, then I think the other areas are pretty muted in terms of capex growth.
Yeah, no, actually, both of you are giving us the same message that FY26 was a disappointment compared to FY25 or even the first half of FY26. Mahesh, what are the strains that we can pick for FY27? You pointed out that the first quarter didn't look good. Is there any sectoral, is there any other data that you track that gives you the impression that we may get over this? I mean, I'll tell you, there are some strong numbers. Auto sales numbers are very good. PMI numbers are very good. And they are all very lead indicators. You get it for the latest month. Those look very good, actually. FMCG has not done too bad. Consumption looks good. But you tell me, what is the capex looking for FY27?
So a couple of things over here. The first important takeaway is that manufacturing sector as a whole is taking a beating. So in the corporate sector data that I shared with you, which showed that the net fixed assets of listed companies grew year on year by 16% in September, which is a record of sorts. One hasn't seen that number in nominal terms for a very long time, which fell to 7% in March. Okay, now that 7% in March has got within it only a 4% growth in manufacturing. So manufacturing actually saw only a 4% nominal year-on-year growth in net fixed assets. And it does tie up with what you have said earlier. The emphasis is more on the machinery sector, partly automobile sector, but it is machinery which ties up with the power story that was being discussed earlier. But if you look at the 26-27 first quarter numbers, that has got a deeper story in it. So the first thing we see is that there is a pickup in new investments over there, and that's kind of odd. But manufacturing has fallen. Now I'll give you an idea of what that new investment in the first quarter is. First quarter is not complete as yet. We still have a week to go. But nevertheless, these numbers are more or less giving you an idea of where we are headed.
Okay.
Mind you, 33% of the new investments in the first quarter is from data centers.
Oh.
This will tie into the power sector, mind you.
Yes.
Because data centers are power hungry, we require investments for that. And the bigger thing is, the biggest investment in the first quarter is nuclear power plants. 48%.
Okay.
48% of the new proposals made in the first quarter were nuclear power plants, mostly in Maharashtra. And if you add nuclear power plants and data centers, you cover up 80% of the new investments being proposed in the first quarter of 26-27. Renewable energy, which accounted for about 25% of new proposals being made in 24-25, now accounted for only 2%.
Yeah.
Manufacturing has fallen from 38% to 14%. So structural shift, data centers, power, renewable energy is the new story. Manufacturing is just falling by the wayside.
Fair point. And your data very clearly shows that. And look at even the stocks that did well. If you look at the year-to-date gain, GE Power is 219% higher year-to-date. Hitachi Energy 87%, Adani Power 61%, BHEL 40%. So clearly the market is also smelling the same theme that both of you are saying. Miren, I wanted to ask you, how are you looking at FY27? Since CRISIL has a broader mandate of the financials of the companies, from your other data, I gather that companies are still not raising money from banks, that their net cash flow is actually higher than their capex plans. So funding is not an issue.
Yeah, you're right. So I don't think funding is something which is constraining investments. I think it's the general macro environment which is. Let me break this. So I think our overall capital investment number for FY27, we're expecting about 8 to 10% growth. Broadly in the same range for both industrial as well as infra investments. The point is, numbers might make it look like as if it is broad-based. It is not. This is concentrated in pockets. I think the themes which I spoke about earlier, power, oil and gas, as well as, emerging sectors. These three are the pockets which are driving this growth. Other sectors, I think a lot of the traditional sectors have already peaked in terms of capex in FY25. So I don't see a material increase in capex in some of these traditional sectors. So be it, metals, cement, auto, or pharma. We're not seeing any growth in capex in any of these sectors because a lot of these peaked in FY25.
No, go ahead.
I think what is also happening is, your export led sectors are still waiting for clarity. I think there's still a lot of global uncertainty, and hence I think some of the capex further uncommitted investments are taking a while to materialize there.
Okay. No, fair point. And this year, the government also may not be able to contribute to capex spending. It may be another slow year of government capex as well, considering the amount of revenue expenditure that they had to lift on fertilizer and fuel subsidy. And possible there will be even a tax collection hit. Just possible, though, of course, the latest data, the May data, doesn't seem to indicate that. Mahesh, anything that policy can change at this juncture, since you are a long-time observer of the space?
Well, this is a difficult time to make structural policy changes, or it's an opportunity. You can see it that way. When you have a West Asian crisis still not resolved, when you have international trade which is not in the best of times for us, when you have an El Nino year, we are actually battling short-term challenges right now. We can't make structural changes right now. But if I were to make structural changes, I would say that we require to somehow spur private sector investments in the form of animal spirits. So, I summarize the current investment scenario in the following way, that total investment proposals seem to be going up. The numbers in the first quarter look like they're better than in the last year, but animal spirits are missing.
Yeah.
All the investments are in those places where tax breaks were given. Data centers is because of tax breaks. Nuclear power plants is not animal spirits. It's all because government desires these investments be made. So while we are seeing enterprise putting money, they're putting money only where there is a government involvement in a reasonably big way. So I think we require to revive animal spirits, and that's the problem. This is not the right time to do it. Right now, we are fighting with the back against the wall. We require to fight El Nino and the rest of it.
Yeah, fair enough. Survival time, and therefore everyone's relying on MyBAP for handholding the government. Very quickly, not enough time, but Miren, FTAs will actually challenge, I thought, because our import tariffs were higher. When we sign FTAs, ours goes down. Our partners, whether it's Australia or Europe, already have lower tariffs. So will that make actually investment more difficult?
Well, not really. I think, if you look at the competing nations, like Bangladesh, Vietnam, they already have market access, which we lacked.
Okay.
FTAs will, at least for some of the sectors like textiles, footwear, will make it easier for us to export some of these goods to the especially the European region, the UK, the EU. So we see the benefit of FTA kicking in, but it will take a while. I mean, it's not going to be immediate. It's not going to be in a spurt. It will play out over the period. I think starting FY27 second half, we could see some material increase in investments in some of these sectors. But for now, I think global uncertainty is a bit too high for anybody to commit large investments around these sectors.
Fair point. Actually, that uncertainty has been rife from last year. And I think as both you and Mahesh point out, that explains why FY26 was actually a tepid year in terms of capex. And perhaps some of it is rolling over. But power, nuclear power, renewable data centers, these are the shining outliers, partly because government is coming in and taking a huge, giving a tax support to these sectors. Thank you very much, Miren and Mahesh, for laying out the terrain for us and helping us better understand the nuances of a capex cycle. Not gangbusters, but there are some shining spots. We wrap up on Bazaar. On that note, Chartbusters off the break.
Bajaj Auto is the top index loser today. The record date for the company's 5,600 crore rupee buyback, priced at 12,000 rupees a share, is today.
Metal stocks, they are the top sectoral losers today. Base metal prices decline on stronger USD, a hawkish Fed, and weak industrial demand from China. Hindustan Copper, Nalco and SAIL, all of them lead the declines.
Honasa Consumer bets on nutraceuticals with the acquisition of a 58% stake in Fluence Pharma at an enterprise value of 135 rupees a share. Stock trades under pressure.
Go Fashion rallies in today's trading session. It's up 3.5% after the promoter releases pledge on 46 lakh shares, which form close to around 70% of the total quantum of its pledged shares.
IRFC under pressure after the government launches an offer for sale to offload up to 2% stake at nearly 91 rupees, a floor price of 91 rupees a share.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets are trading in the green. Actually, there's been a good recovery from the lows of the day. The Nifty is now up close to 150 points from the day's low. And the Nifty Bank, that's the one that's leading the fight back. And at one point of time, we had more number of stocks declining than advancing. Well, that gap has narrowed. I think now we have more number of stocks that are advancing in comparison to the number of stocks declining. And going by what's happening in the Asian markets, Mangalam, you should be happy if you're an India investor, at least last couple of days.
At least last couple of days, you've been outperforming and not falling yesterday as much as the other global indices, and right now 100 points higher. The interesting part is two engines are firing today. You have, the Nifty Bank, which is obviously moved to the high point of trade. That dip on the Nifty was bought into. The Nifty Bank finding support at the 200-day moving average. Look at the IT index as well. After a rout yesterday, we've seen some recovery come by today as well. So, there has been a downgrade from JP Morgan on HCL Tech. That stock's actually higher. The Nifty IT index as well, higher by about 1.5%. So both those engines supporting the overall cause of the Nifty, not reflecting so much in the broader markets, but let's see how the day progresses. Good time to get in Sachidanand Tekar for a quick check on the markets. Sachi, today both the Nifty Bank and the IT index taking the Nifty higher, but at higher levels, do you expect some sort of supply to come by, or maybe do you believe that it breaks out from here?
Good morning, Mangalam. Mangalam, when we look at the Nifty Bank itself, even yesterday we had the same discussion that Nifty Bank, the trend has been very significant. The relative outperformance is expected to be continued. We were waiting for a dip, and that particular dip has, matured well. We saw, Nifty Bank again taking support somewhere close to around 57,630, 700 kind of a zone. And from there, we have seen a good turnaround. We are expecting that eventually there could be a flat pattern breakout when it comes to Nifty Bank. And the pattern target is placed somewhere close to around 59,000. So I think the trajectory for Nifty Bank is very clear. When we look at Nifty, there is a hurdle, at least for the day, somewhere close to around 24,000 levels, where it's a 5-day exponential moving average, which was acting as a support, has now turned into a resistance. But eventually, even here, we expect that the most critical hurdle for the index would be at 24,200. So I think this oscillating range for the Nifty may continue. But looking forward, since Nifty IT has also started contributing, the probability of a breakout about 24,200 also looks bright. So eventually we see both the indices helping Nifty to scale about 24,200 mark.
Got it. Okay. All right. What about individual stocks, Sachi?
Good morning, Nigel. Nigel, AU small bank, the structure has been very significant. We have a bullish flag pattern breakout exhibiting the price target somewhere close to around 1,092. So we continue to build long positions here. Recommendation has been given to our clients as well. One can keep a stop loss at 1,030 on closing basis and expect a move towards 1,092 in a week or so. The other stock which has hit our radar because of the crude oil effect is Indigo. It was already performing well, but if you look at the overall structure today, it has broken out from a 4 days consolidation. It's a bullish flag formation on the daily scale. Plus the weekly averages have converged on the positive side. So we are expecting that this particular rally may continue towards 50 to 80, where the significant gap was witnessed on 8th of December. So I think that this particular level would be filled in this ongoing progressing move itself. So we are recommending building long positions in Indigo. One can keep a stop loss at 5,010 on closing basis and expect the rally to continue towards 50 to 80.
All right, Indigo flying high right now as we speak. Oil prices lower helps their cause a little further as well. We are seeing some traction in Ashok Leyland. That's moved higher, and Shree Cement continues to do well as well, 3.5% higher on that stock. We'll take a short break, come back on the other side. We have Rashi Peripherals. That's announced a new acquisition today. The management joins us on the other side to discuss the details. Welcome back. You're watching us here on Chartbusters. The stock on our radar is actually Rashi Peripherals. Irrespective of today's move, if you look at it over the last few months, in 2026 so far, it's up around 2% today. Pull up a longer chart, you'd see, the last 14 days, the stock is up around 41, 42%. That's a serious outperformance. And if you look at it from the start of this year, the stock has actually doubled from levels closer to 350. Stock's moved all the way up to 750 in this year itself. Now, they've gone ahead and made an acquisition. They will acquire 67% stake in VDA Info Solutions for about 368 crores in cash consideration. Kapil Pansari, who's the managing director of the company, joins us on the show. Kapil, thanks a lot for joining in. Just to get the basics out, you are, valuing this company at around 550 crores. They did a revenue of 850 crores last year. If you could give us a sense on at what pace can this company's revenue scale, and what are the margins that this business has? How much different are they from your current margins?
Right. So this company, historically, when we looked at this, their growth trajectory, they've been growing at about 25 to 30% for the last 2 to 3 years. It is last year since the price rise and the AI demand for memories, CPUs, GPUs went up. There was a small blip, but long term, there has been a sustained growth of about 20-25% in this company. When we analyze the sector earns anywhere between 4 to 5% PAT margins, and it is like services and a value add beyond distribution. So our distribution margin typically ranges between 1.5 to 2% PAT margins. This is almost double. So trajectorily, it looks at for Rashi Peripherals to expand our presence in the enterprise segment, to expand our margin profile at the same time.
And what is the kind of synergies that you expect in terms of scale, cross-selling opportunities here? If you could, because it's in servicing and you are obviously in the hardware distribution business, the additional servicing solution that you would provide to your customers could scale the revenue higher as well, right? So what could this opportunity be? And then net, say year 3, year 4 from now, what's the kind of business that we're looking from here?
Yeah. So I think when we do a hardware distribution, it is more supply chain economics that plays in the segment. With this acquisition, we will have the capabilities to add cybersecurity, data protection, virtualization, storage, cloud technology, and so on and so forth, which brings stickiness to our enterprise portfolio. And the growth in this segment with AI boom that is happening, the technology adoption that is increasing in India as a country, there is a multi-fold growth opportunity for us.
All right. Hi, Kapil. Congratulations on this acquisition and wishing you and the team all the very best. Give us some more details in terms of the acquisition cost. You'll be purchasing 10% over the next few years. So the total acquisition cost will be around 550 crores?
Yes, so the current valuation that we've evaluated is based on the 550 crores with the 67% on all cash consideration at this point in time. We have an arrangement where we will continue to acquire 11% for the next 3 years until 100% holding comes for the Rashi Peripherals.
The next obvious question, how do you fund it?
Yeah.
How do you fund it? That's the next obvious question.
The funding is through our debt funding. I think we have a capability, we have a capacity internally. Currently, our debt is 0.4 to 0.5 times of our equity, and we will use some portion of our debt instrument to fulfill this obligation.
So out of the 550 crores, if I had to tell you to break it up, there could be some internal accruals, there could be some debt, as well as, I don't know whether you'll want to raise some equity. You could clarify on that. Break it up for us.
So internal accruals, going forward for the next 3 years, there will be internal accruals with which we will fund it. But right now, for immediate cash consideration to acquire 67%, it is more of a debt instrument.
So majority of it will be debt?
Yes.
At a borrowing cost of?
It is anywhere between about 8 to 9%.
Okay, all right. Let's get some more details going then. What is the revenue growth that you're looking at in this acquired asset, which is VDA? We get the point that the PAT margin is better, but what kind of growth are you looking at on this business?
So this business will grow for us from 850 crores by about 25 to 30% for the next 2 to 3 years.
All right, 25 to 30% for the next 2 to 3 years. Also, since you've been speaking so much about AI and the opportunity that it provides, you also said that you've consciously stayed away from some of the projects that came your way because maybe the ROI metrics weren't attractive enough. Can you give us a sense on whether you are looking at it again in FY27? And the semiconductor business, which is doubling every year, how much is in your overall contribution right now? It's very small, but could you give us a range and where does this go from here?
Great question. I think these are two very important growth strategies for Rashi Peripherals. The enterprise segment and the AI for us, it is still very nascent and has been growing for the last couple of years with partnerships like NVIDIA, Dell, Supermicro, ASUS, etc. of the world. This business has a potential for us to grow. And the second one that you asked about semiconductor is that semiconductor right now is a 3-year-old story for us. We did about a little over $15 million in revenue with Make in India, and the localization of supply chain in this segment gives immense opportunity to grow the semiconductor portfolio.
Okay, all right. Just getting back to the numbers, if you grow at 25 to 30% on the acquired business, you should be ballpark around 1,600 crores to around 1,700 crores in the next 3 years or so. But with PAT margins at 5%, it could add net profit of close to around 80 crores on this base of around 280 crores. So just to put the numbers into perspective, in terms of revenue contribution based on the trailing basis, it adds close to around 10% of revenues. But on the net profit number, it could add close to around 25 to 30%. Fair assumption?
Absolutely right. I mean, that's the logic for this acquisition.
Got it. I think this acquisition, VDA, also helps you to focus a little bit on annuity, which will be a more steady income. Is there a number you have in mind in terms of annuity income that you're looking at for the business, say, in the next 3 years or so?
So at this point in time, it is too nascent to make any comment on the annuity business portfolio. We're still getting involved in their business. I think next 6 months will be very crucial to understand what is the profiling of the services and the annuity business going forward.
But generally, you are looking to also get into businesses which are a lot more stable, right? In terms of cash flow generation for you. What would the proportion of that be? And in light of that, what could your next course of action in terms of strategy be?
So one of the key business components is the cash flow and working capital cycles because of the nature of the distribution business. With services brings a lot of cash surplus as well in the economics, which may have the potential to offset and accelerate the amount of investments that we do for the growth of the business. The AI opportunity, the data center opportunity, the enterprises, everyone is going to go through a refresh cycle of their infrastructure, the PCs, which will enable us to capture more share and more growth story in next probably 4 to 8 quarters.
So what's the revenue for the overall company that you're projecting in terms of growth for the next, this year, FY27 and FY28, since you spoke about next 4 to 8 quarters? If you could give us a sense on how fast can the overall revenue of the company grow and margins as well. I mean, it's the nature of the business model where margins are stuck between 1.5% to 2.5%. But at some point, you would want to see expanding, margins as well.
Yeah, so there are two profiles of the working. Is that first is Rashi Peripherals continues to be a very distribution-centric with some value added on the hardware portfolio, which has an economics of 5, 3 and 1.5% from gross to EBITDA. This continues, and we've always given the guidance that we have grown by 20% CAGR for the last 20 years, and we continue to grow at 15 to 20% even at this point in time. Last quarter, Q4 of FY26, if you look at our numbers, we've grown by about almost 50% plus, which has a strong tailwind on the hardware and the compute ecosystem, demanding AI capabilities. This trend is expected to continue for quite some time. Giving a judgment on what it is going to translate to is going to be very difficult because nobody has predicted, nobody has seen such cycles in the economic. We are going through a very super cycle of hardware refresh and hardware scale, which is giving us a higher growth opportunity than the general CAGR that we've achieved till now.
Going by all that you said, 280 crores is what you did of net profit in the past year. Going by the growth estimates with the margin profile as well, effectively in the next 3 years, your net profit becomes 600 crores. Would that be fair or more?
I think it is too bullish to make a comment on this one. I think I'll leave it all of you to make that judgment.
No, mathematically, we were working it out that 20% the core business grows at 2% margin, and this business at 5% margin if it's 1,700 crores. But we leave that discussion for another day. For the time being, congratulations on this inorganic growth, and we'll track progress on this development.
Absolutely. Thank you so much.
All right. Thank you, Kapil, for that. With that, let's talk about a big milestone that CNBC TV18 crossed. It crossed 5 million subscribers on YouTube. And that number belongs to you. And for that, we have no one but to thank you. A heartfelt thank you for all of you who tuned in, shared, liked, subscribed, and stayed with us through the highs and lows of the market. There's so many, many more milestones together and to telling India's growth story the way only CNBC TV18 can.
Well, the Reserve Bank of India has released a detailed FAQ answering all the questions on the recently announced swap facility for the FCNRB deposits, ECBs, as well as overseas foreign currency borrowings. But have no fear, Ritu is here. She's here to explain all of that to us. Ritu.
Well, overall, Nigel, these clarifications are positive for banks that were looking to attract these foreign currency deposits. And the biggest takeaway is that Indian banks, including their overseas branches, can now lend against the FCNRB deposits, issue standby letters of credit to overseas lenders, and even mark liens on these deposits. Now, remember, before this FAQ actually came out, there was a bit of uncertainty in the banking system over whether, an Indian bank's overseas branch could directly use the FCNRB deposit as collateral to be able to lend abroad or support overseas borrowing, but that clarification now comes in, and therefore it significantly expands the utility of this deposit scheme as well, beyond just raising funds. Now, RBI has also separately clarified that its swap facility is only going to cover the principal amount of deposits, not the interest component. Also, very importantly, banks are going to be allowed to offer differential interest rates based on the deposit side and the tenor of the deposit, which many on the street believe can help boost deposit mobilization for a lot of banks. Now, on the external commercial borrowing side, there are borrowings with an average maturity of 3 years or more that will be eligible for the swap window, while the swap tenor is, of course, going to be linked to the repayment schedule, subject to a maximum cap of 5 years. Now, overall, the street is quite positive on these clarifications that have come in. Jefferies, for instance, says that these FAQs address the key concerns around the overseas branch participation, especially, and the deposit pricing flexibility. And they expect banks to raise the rates, especially for large ticket 3-year, FCNRB deposits. Citi even goes a step further. They say that these clarifications transform the scheme from, a simple funding cost arbitrage into a broader balance sheet expansion opportunity. They also believe that this can attract stronger foreign deposit inflows than what we saw in the 2013 scheme, particularly for banks that have a strong global franchise and the execution capability. And that, of course, is the large public and private sector banks that they seem to be referring to.
Right, Ritu, thanks a lot for that. It will be very interesting. So far, everyone's been penciling around $30 to $40 billion, some even $50 billion coming in on account of this. And now, the clarifications have come in from the RBI. Let's get you some more ideas for profit coming in from our colleagues at Money Control Pro. Anant Chaudhary joins in with the stock. Anant.
The company that we are discussing is Sirma SGS Technologies Limited, a leading player in India's electronic manufacturing industry, with capabilities across PCB assembly and PCB boards. Stock is more than doubled since our initial recommendation of June 2025 on the back of superior performance in Q4 and FY26. Management remained aligned to strengthen its presence in non-consumer verticals. Strong traction is expected from industrial and auto segment owing to India-Europe FTA opportunity. Sirma is strategically investing 1,600 crore over the next 3 to 5 years for PCB manufacturing. In first phase, the company is investing around 900 crore for multi-layer and single-layer PCBs, which will be operational around March 27. Second phase will be executed in FY28, where the company is planning to invest 700 crore for HDI flexible PCBs and copper clad laminates. These initiatives will not only strengthen backward integration, but also open up potential revenue opportunity of more than 2,000 crore revenue, with 1 to 1.5 times asset turnover. These segments will have superior margins compared to the existing business. The stock has rallied 100% over the last 6 months and currently trades at 45 times on FY28 earnings, which appears slightly expensive to us. Investor may consider booking partial profits and wait for a better entry point to accumulate the stock.
Thanks a lot for that, Anand. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay tuned. The team of Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Patakia. Joining me as always is Ritu Singh. It's a good start to the midweek trading session, the penultimate trading day of this truncated week. We've recovered at least a third of what we lost in yesterday's trading session. So the bulls would be happy for that, and also for the fact that we are trading at the highest point of the day. Currently, the broader markets are also looking to recover from their opening lows, but it is the Nifty and the Nifty Bank that is making headlines as of now, Ritu.
That's right. Nifty Bank, Nifty IT Pack as well. I mean, all of them are putting their hands up, doing pretty well in trade today. And that's why you have the markets recovering from the kind of sharp sell-off that we saw in trade yesterday. What's not doing so well is the broader markets. It's a bit in the green for the Midcap index and the small cap index. Both are down in trade, trading with, cuts of about 14 to 40 points. The Bank Nifty, attempting to get to that 58,000 level, but still, a good few points away. We'll have to see if it crosses that level from here. The market breadth tells you it's pretty much even, Stephen, though a tad more stocks are declining than they're advancing overall. The IT Pack doing pretty well today, up by almost 0.8%. What's also doing well, is the Bank Nifty. Again, some of those clarifications coming in from RBI on this foreign deposit scheme is helping sentiments. What's not doing so well is the Energy Pack, the Metal Pack, the Auto Pack, among others. But first, as always, let's go back across to the studio. We have steady gains in shares of Tata Motors that have come in, Tata Motor commercial vehicles, that is. The management says that the potential for double-digit margins is there and a 40% market share by FY28 as well. Let's go across to Sudarshan now for more on this one. Sudarshan, take it away.
While Autopack overall is not doing well, but one segment that is bucking the trend is the commercial vehicle segment. And one important name, Tata Motors commercial vehicle. Yesterday it was under pressure along with the market, but today Tata Motors commercial vehicle is up more than 4%. Remember, yesterday company held the investor day in which it has released FY28 outlook. And on the volume front, on the revenue front, everywhere they have given the outlook. But first, talk about the market share. They are targeting domestic commercial vehicle market share of 40%, and by FY28 that would be an increase from current market share that company has of 35.6%. As far as the margin is concerned, through the cycle they are targeting double-digit margin, and if there is an up cycle, that margin can increase to teens. And also investment spend, it would be 2 to 4% of total revenue, and on ROCE they are targeting the range of 30 to 35%. Remember, last year they had acquired Iveco, and from there that acquisition is expected to be completed by Q2 of FY27, and once that acquisition is completed, they believe that there is an opportunity to become the fourth global CV player if that opportunity fructifies going forward. Now today brokerages have come out with a note on Tata Motors commercial vehicle. First one is CLSA maintains outperform call and target is 527 rupees per share. It believes that new product launches will aid market share for the company. HSBC too maintains positive stance, has a buy call target of 490 rupees per share. It believes that near-term demand remains robust, competitive positioning in M&S CV stays strong, and LCV underperformance may have finally bottomed out. Nomura has a neutral call and target is 402 rupees per share. It says market share gain, margin discipline and non-cyclical growth remain key priorities as far as Tata Motors commercial vehicle is concerned. So yesterday, as I told you, that company has given a positive outlook, strong outlook for FY28, and it's reflecting even in the Vahan data. Company has been gaining market share while Ashok Leyland is losing market share.
That's an interesting notes coming in on Tata Motors and a good positive outlook as well. Sudarshan, thank you for that. The stock doing well in today's trading session, almost 3.5% higher. As the entire metal space, though, continues to lag, underperform, considering a stronger dollar. But can say a contra call on Nalco that's come in, and that is from Antique. And Nigel is here with more on that. Nigel.
Well, that's right. Antique has come out with a note on Nalco, and they believe the recent correction is providing a good entry point because they have a buy rating with a target price of 463 rupees. They're giving us 4 broad points. They say that the firm aluminium prices as well as additional alumina volume, that's going to aid the top-line growth. Second factor they're focusing on is backward integration. They say that the reduced bauxite mining cost, the coal cost advantage, as well as rationalized employee costs, that's what's going to help them drive the cost reduction and also support margins. The third point they are highlighting is the expansion. Nalco's new 5th stream, that's the 1 million ton alumina refinery that is likely to be commissioned in the first quarter of FY27. that could contribute close to around 0.2 million tons of alumina capacity in FY27. So that's total 8 volume growth. And finally, they say that the management has targeted to increase the value-added products capacity over the next few years. So put all that together, that's the counter call coming in from Antique. On Nalco, they have a buy rating with the target price in excess of 460 rupees. Back to you.
All right, so that's Nalco. We also discussed Tata Motors CV earlier, but let's get you the full list of the movers and shakers in trade today. Hormas has walked over to the ball to give us that update. Hormas.
It's a good start, as I was mentioning right at the start of the show. The bulls will be taking that, especially considering that expiry-led sell-off that you saw in yesterday's session. The Nifty is at the highest point of the day, and it is led by the banks, and they are the ones that are doing the heavy lifting. The Nifty Bank, after that 750-point sell-off yesterday, has recovered most of those losses, already up 650 points. So it is back to where it was as of Monday's closing. So that is something that the bulls would be pleased with. It is back at the higher end of the range of that 57,000 to 58,000. There are divergent opinions coming in on the IT sector today. JP Morgan has downgraded a whole host of IT names. On the flip side, Axis has upgraded a whole host of IT names as well. And the reactions are on the positive side today. Oracle is up 3.5. Of course, Oracle is the only IT name on the IT index that is positive on a year-to-date basis. Tech Mahindra is up 2.5. Infosys is also seeing some bit of rebound after its AGM yesterday. Textile stocks as a sector is buzzing. There are multiple factors behind that. Of course, there was a Motilal Oswal note yesterday that came in where it initiated coverage on a lot of these names, including KPR Mills, Indocount, Wellspun Living, and of course the US-India trade talks as well. A look at KPR Mill though. At one point the stock was up 18%, still holding on to gains of around 11. SP Apparel, Indocount is up 8, Wellspun is up 5 as well. So good going for a lot of these textile companies. Look at the newsmakers in today's session. Pine Labs had a block deal earlier in the day, around about 1.5% equity changing hands, so 5.5% higher on that stock. Of course, still well below its IPO price. SIS is going to consider its 5th share buyback in as many years, so that's another positive, 7.5% on the stock. We just heard Sudarshan on Tata Motors commercial vehicles, and IRFC, of course, after the OFS, which has opened for non-retail investors today. Look at the profit booking coming in for a lot of these capital goods companies. GE Vernova is down 5, Hitachi is down 4, Siemens is down 4 as well. Of course, not to take away from the fact that all of these names have gone up anywhere between 80 to 100% already this year. Then look at some of the small cap names that are up at 52-week highs in today's session. Look at Aether Industries, that's up 8% and at 52-week highs. Talbros and Kaplan Point 2 forming that list of stocks that are doing well for themselves today, Ritu.
All right, Hormas, thanks very much for running us through that list. We'll slip into a short break, but when we return, we'll focus on the bond market with Manisha Gupta. Welcome back. The Reserve Bank of India has issued detailed FAQs on its FCNRB deposit swap scheme, and the clarification seems to be a positive for banks that are looking to attract foreign currency deposits. That's why you have the banking pack up and about today, doing well in trade. The biggest takeaway from this clarification is that Indian banks, including their overseas branches, can now lend against these FCNRB deposits, issue standby letters of credit to the overseas lenders, and even mark liens on these deposits. Now, remember, before this FAQ came in, there was some uncertainty about whether, the Indian bank's overseas branches can directly use this FCNRB deposit as collateral to lend abroad or to support overseas borrowing. But the clarification now significantly expands the utility of this FCNRB deposit scheme beyond just raising funds. Now, RBI has also clarified that its swap facility is going to cover only the principal amount of the deposits, not the interest component. And importantly, banks are going to be allowed to offer differential interest rates based on the deposit size and based on the tenor of these deposits, which, many on the street believe can help boost mobilization to a larger extent. On the external commercial borrowing side as well, borrowings with an average maturity of 3 years and above, they remain eligible for the swap window, while the swap tenor is going to be linked to the repayment schedule, subject to a maximum of 5 years. Now, brokerages on the street are pretty constructive on this. Jeffrey says that these clarifications address some key concerns around overseas branch participation and deposit pricing flexibility, and they expect banks now to raise the deposit rates, especially for large ticket 3-year deposits. Citi goes even a step further. They say the clarification transforms the scheme from a simple funding cost arbitrage into a broader balance sheet expansion opportunity. They believe the framework can attract stronger foreign deposit inflows than what we saw in 2013, particularly for banks with a strong global franchise and execution capability as well. So, Hormaz, that's the big clarification coming in from RBI, on the back of which banking stocks buzzing in trade today.
Oh yes, they are, and that is something that is keeping the market afloat as well. The Nifty Bank is now up almost 700 points, so almost recovering everything that it lost during yesterday's sell-off. And the heavyweight banks are also putting their hand up, be it HDFC Bank, be it ICICI Bank. So it is the Nifty Bank that is, after yesterday's minor blip, is back to winning ways. But as promised, Manisha Gupta is now here with the latest updates from the bond markets. Manisha.
Trading in the secondary market on a very active mode here. What we do understand via various reports is that the OMCs and banks seem to be buying, while the state-owned banks are selling paper. The mutual funds also are known to selling corporate bonds. This is due to redemption pressures right now. And when you look at the FII numbers, while they have been very, very enthusiastic in participation in government securities, they have been kind of absent when it comes to corporate bonds, because the same measures that have been put in sense of government securities do not apply to corporate bonds. There is the reason when you look at the overall India corporate bonds, they just about account for 1/5 of the country's total bond market, and the banking sector is perhaps responsible for nearly 50% of that. In the last 15 years or so, when you look at as a percentage of GDP, equities have surged to nearly 30%, while the corporate debt market is just about at around 5% therein. The secondary market trading volumes, though, have seen a bit of a gain coming in. Monday was 141 billion, which gained up to 174 billion by the time it was Tuesday. And the primary market bond issuances also seem to have more than doubled, really. On Monday was just about 48 billion. Tuesday was 117 billion. There were a lot of bond issuances yesterday. And with that, let me take you through the bond issuances that are anticipated today and tomorrow as well. There's a lot of bidding expected today as well. You have Cholamandalam Investment and Finance Company today looking to raise nearly 20 billion, and they are doing it via issuing 7-year bonds. Muthoot Finance also in the market, seeking bids to raise nearly 20 billion. They are reissuing the 7.85% Feb 2029 bonds for this. You also have True Home Finance, which is tapping the market to raise nearly 5 billion, and they are doing it through 3-year floating rate bonds maturing in 2029. There also is Early Salary Services. They are in the market planning to raise nearly 1.2 billion. They are doing it via reissuances of bond maturing in 2029 yet again. And finally, Tata Projects as a company should come in on your screen because they're looking to raise 2.5 billion. They're doing it via issuance of 3-year bonds maturing in 2029 as well.
All right, Manisha, thank you so much for joining in with that update on the bond market. Now, here's a big milestone we'd like to share with you, our viewers. CNBC TV 18 has crossed 5 million subscribers on YouTube, and that number belongs to you. A big and heartfelt thank you, therefore, to you, to every viewer who's really tuned in, shared, subscribed, and stayed with us through the highs and the lows of the market. Here's to many more milestones together and to telling India's growth story the only way CNBC TV 18 can. And we'll slip into a short break on that note, but when we return, we're going to discuss market technicals with Pritesh Mehta of Yes Securities. Also get his top trading bets.
Welcome back. It's now time for our special segment, CNBC TV 18 Unpacked. And this week, Vivek has taken a deep dive into India's renewable energy space, where CleanMax is leading as an emerging key player in corporate clean power ecosystem. Take a look.
Clean energy is fast becoming the backbone of India's corporate power demand. And one company leading that transition is CleanMax. Let's take a closer look at what makes this renewable energy player stand out. Remember, CleanMax is India's largest commercial and industrial, or CNI, renewable energy provider. As of FY26, the company has an installed power sales capacity of about 3.1 gigawatts. And when you look at its client base, it reads like a who's who of global tech, with big tech and data centers accounting for nearly 42% of its 5.7 gigawatt contracted portfolio. In fact, CleanMax recently announced a major 900 megawatt renewable energy platform with Meta, where the tech giant will purchase all environmental attributes. Now, what sets CleanMax apart? Now, unlike traditional power companies, CleanMax directly supplies renewable energy to businesses instead of relying on distribution companies, and it operates through open access routes as well as long-term contracts. Now, this particular model allows CleanMax as well as its clients to save close to 30 to 40 to 5% of power costs compared to grid tariffs, while also helping them meet rising sustainability goals. Now, when you're looking at what brokerage note HSBC has to say, it notes that CleanMax's business model, number one, is difficult to replicate thanks to its client-first approach, repeat customers, and its ability to invest upfront capital. Now, the commercial and industrial segment in India, which covers offices, malls, as well as data centers, is a massive opportunity. Remember, India's total CNI renewable installed capacity already stands at over 55 gigawatts and is growing. Now, CleanMax, with its 3.1 gigawatt installed capacity, remains a clear market leader in this particular space. Now, looking ahead, the company is targeting at least 1.5 gigawatts of new capacity in FY27, and over the next 3 years, plans to add 3 gigawatts more, while aiming to double its EBITDA from FY26 levels. Its customer pipeline continues to expand, including global giants like Meta, Google, Apple, Amazon, as well as Equinix. Now, talking about valuation, CleanMax trades at a premium to traditional utilities, and its FY27 estimated price to earning stands at around 71 times, higher than peers like NTPC, Tata Power, as well as JSW Energy, which reflects strong growth expectations in the renewable CNI segment. One thing to note, the stock has done remarkably well after opening out on a very weak note. Remember, this particular company listed at the height of the West Asia crisis.
Welcome back. And the Nifty Bank has now recovered everything that it lost in yesterday's trading session. So 750 points higher on the index, and that is continuing to take the Nifty higher, which is now within touching distance of the 24,000 mark as well. So just around about 20 points away from returning back to the mark of 24,000. Well, it's a good time to tell you what are the FNO trends indicating as well. And Sudarshan is joining us from the FNO desk to tell us just that. Sudarshan.
So good recovery we are seeing in the market, and two segments that are playing major role are IT and Nifty Bank. Just take a look at Nifty Bank from the level it has seen a recovery, and that's the key level, 200 DMA of 57,080. That's your intraday low for Nifty Bank, and from there it has seen a sharp recovery and currently up more than 700 points. Another segment that is doing well today after sharp fall that we had seen yesterday is the IT pack, and that has come after Infosys management's commentary in the AGM, positive commentary that AI is not going to have a major impact on companies like Infosys, and it has lifted the entire pack. TCS is up, all the other IT stocks too are seeing buying. Another stock that is playing a major contribution role is the Reliance. It has also seen a sharp recovery from day's low and currently up. Currently it's a flat, but it has seen a sharp recovery. Now coming to the Nifty's key levels, and that will give you the range also. So 50 DMA of 23,850 and 100 DMA of 24,185. So it's finding a major support around 50 DMA, and major supply is coming when Nifty tries to hit the level of 24,200, and that's reflecting in the options data too. On the put side, two put options that are most active and seeing a sharp fall in the premium are 23,900 and 23,800. On the call side, if you come, 23,950 and 24,200 is seeing a maximum increase in the open interest, and premium for both these call options has seen a sharp rise in today's trade. Now, what about stocks? One stock that is seeing a buying is Adani Enterprises. Today, AGM is also underway, and there's a positive commentary is coming today. Morgan Stanley has initiated coverage on Adani Enterprises with overweight call, and the stock is up currently almost 2%. And all the cement stocks are saying buying, and amongst all, one stock that is looking the strongest is Shree Cement.
All right, Shree Cement is looking strong also. Thanks very much, Sudarshan, for joining in with that. Take a look at the flashes at the bottom of your screen. Another cement company, Star Cement, perking up in trade today on the back of being declared the preferred bidder for the mining lease for Boro Lakindong West Block. So that's the flash at the bottom of your screen. But let's move on. We have Pritesh Mehta, Executive Vice President of Yes Securities, joining us now for a quick technical check of the market. Pritesh, welcome. Thank you very much. For the frontline index, just a few points away, about 25 points away from that 24,000 mark. It's crossed that 50-day moving average. Near-term technical levels that you're going to be looking for, and in the current market, your top stock picks.
Sure. Good morning. See, I don't want to be termed as a party pooper, but again, our view remains intact, and nothing is going to happen as far as headline index is concerned. Since early March or Feb end, Nifty has navigated multiple headlines, whether the crisis in Middle East, spiking oil prices, or lack of participation in index big boys. Index has been largely range bound between 23,200, 24,200. And I think now we are facing a new challenge, that is comeback of King Dollar. So dollar index has created a good base, on a 96, 95 level mark. Now I think the way it is shaping up, I'm expecting a move towards 103, 103.5. So that could also act as a dampener right now. So it could halt this upward index. 24.2 is the maximum upside we can see from here on, at least in the near term. So I think, cause for celebration index is not too much, but yes, beyond index, broader markets, mid-tier banks, they are the ones we need to focus on.
So what are those specific stocks, Pritesh, that you're recommending this morning?
So yes, one which we like from the banking basket is AU Bank. Now, AU Bank, we had a sharp rally a couple of months back, thereafter a bit of retracement. Now, what we can see is a bullish startup breakout coming in. So from here on, we can see rally towards 1250 levels, and a stop would be around 970. Second stock that we like is Eicher Motors again. This stock surpassed the peak of April 2026 recently. Thereafter, it has been consolidating. We have seen a bullish startup break coming in. So a move towards 8,500 is possible.
Pritesh, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Continuing our conversation on the markets, then Sonam Srivastava of Right Research is joining in. Sonam, good morning. Thank you for taking out time I was going through your fact sheet as well, and you've mentioned about some of the big entries that you have made, including names like Power India and stock and points where you have exited as well. But since you're reading about Power India, you exited that last year. But all of this capital goods theme in general, there have been some reports that are coming in about the capex reaching a bit of a plateau right now. The stocks going up 80-90% already. Do you believe that the valuations have already factored in the best, and it would be prudent to take some money off the table and await a better entry point?
See, I think our outlook sort of remains still pretty constructive on these names. I think there's a momentum cycle that is going on, and on the capital goods space, I think this is specifically driven by the data center flow, right, and the manufacturing revamp that's happening in India. So we still remain constructive, and we are watching, right? I think in our fact sheet we mentioned that our strategy are good at finding that exit point. So we haven't reached that exit point on these stocks yet, and I think there's a lot of stocks in that particular theme, not just the capital good ones, but even the ancillaries in this space, and even a lot of auto ancillaries are now coming into this space, right, which is catering to the data center theme. So we're seeing a lot of exposure there, and we're not booking out just yet.
Okay. Hi, Sonam. There are two sectors, IT and metals, that seem to have borne the worst of the market, the brunt of the market fall in the last few weeks. IT doing relatively better today. It's been flip-flopping a bit. But how does it look from a risk-reward perspective there? Or would you just avoid catching this falling knife?
See, I think IT definitely is tricky, and it's been undervalued for a while, right? I think there's no doubt that Indian IT is pretty undervalued. But yeah, I think you have to look for some significant value unlocking before you can expect a significant up move here. I think the commentary by Infi recently that came out was constructive. They're adapting towards usage of AI. They're not in the fundamental model space yet, but I think IT services, right, which they are experts at, would be a good space for them to be in. I think IT would be under pressure. I think until unless we get the IPO, the big IPO, the OpenAI and Anthropic come in place, and there's a valuation reset in case that happens. But yeah, I think it's constructive, the moves that Indian IT is making in adopting AI.
Sonam, very simply put, if you had fresh money to allocate today, your top 3 bets, sectorally, or if you could go more specific.
So my top 3 bets, I think sectorally, I'm still constructive on the data center sort of theme, and not just the big names like MTAR or Hitachi Energy that we talked about, but there are other ancillaries where you're seeing movement. I like the capital market theme, which is being unlocked after the ceasefire announcement, and you're seeing metals, like you said, they are correcting, after the crude price correction, and seeing other themes like the capital market theme, which is unlocking. So I like that, and then I would like some smaller names in the broader market. So I think selectively, right? So even if you look at the IT pack, right, you'll see certain names like RateGain, etc., which are doing well. So we would like, and even in the consumer pack, right, you'll see Nykaa or Mamaearth and different names which are still doing well. So we would be selective in the broader market. I don't have confidence in the beta of the market, which is the directional strength of the Nifty. But yeah, on the broader market and specific opportunities, I'm actually quite bullish at this moment.
Where within capital markets, Sonam, you mentioned that as a theme, but discount brokers, asset managers, wealth managers, or just the exchanges?
So we have taken a bet in a few brokers, in a broker right now. And in the AMC space, we were invested in the AMC space in, till recently. But right now we've taken a bet in the broking space.
What about pharma then, Sonam? In that sector in itself, when the market has been underperforming, pharma as a sector has done well. There are a couple of positive developments that have also taken place with regards to a lot of these domestic-oriented companies as well. Where does your preference lie? The generic players, the contract manufacturers, or the larger names like the Sun Pharmas or the Ciplas?
Yeah, so I think pharma definitely is looking quite constructive to us as well right now. And, we haven't taken bets in the larger names, but there are smaller names like Laurus Lab, which has been doing quite well, where we've taken a bet. And then similarly, Markson's Pharma and Gland Pharma, the specific names we'll be seeing. I think pharma definitely, has been an area of interest.
All right, we'll leave it at that. Sonam, thanks very much for joining us here today. We appreciate your time. We'll slip into a short break on that note, but when we return, we'll get Louis Cao, he's of S&P Global Ratings, who'll be joining us to discuss the Asia-Pacific investment strategy and the way forward for the Indian equities. Stay tuned. Welcome back. Louis Cao, who's the chief APAC economist of S&P Global Ratings, joins us now to discuss the Asia-Pacific investment strategy and the way ahead for Indian economy and the equities. Louis, thanks very much for joining us here. I hope we got the pronunciation of your name right. Interesting report there. Your thesis is that the AI exposed economies are going to outperform, and most of the gains today are really going towards semiconductor exporters like Taiwan, South Korea, and whatnot. Would you say markets are overlooking India's role in this AI value chain, whether that is through our IT software, services, digital infrastructure, or, where do you see India fitting into this AI theme?
Yeah, that's a good question. So, the Indian economy is not going to go away, and it's going to continue to grow pretty solidly in our forecast as well. But when we look at, say, how have our forecasts changed over, say, the last half a year or so, we noticed that we have been downgrading some forecasts and upgrading some others. And the theme was that where we have upgrades, those are the economies that are fitting in a particular part of this whole AI story. It is basically the economies and the companies that are producing chips. And so that is Taiwan and South Korea. That's where we have seen the largest upgrades. We see some similar kind of trends in other economies that also are in that supply chain that relates to those semiconductors, those chips, like Malaysia, China, and of course at the top of it you have Japan that is involved in the equipment making and some sophisticated services towards that industry. But the other economies in Asia that are less active in that particular realm of semiconductors, of chips, they're still growing, but we haven't really been able to upgrade their prospects.
Louis, thank you for taking our time today. I call it playing the devil's advocate here. There is something that the street does not like. That is the fact that a lot of these mega tech companies are embarking on massive fundraising sprees, despite the fact that their operating cash flows are still fairly robust. And when earlier they claimed that they are going to fund all their $100-200 billion capexes through their own internal cash, now they are raising funds, and not just $1 billion or two, they are going up to levels of $80-100 billion. If and when there does happen that it starts to slow down, would this become the major focal point or the reason as to why this entire trade gets unwound in the future?
Absolutely. You really zoomed in on a weakness in all of these beautiful positives that we are seeing in these economies like South Korea, Taiwan, where the stock markets go haywire. It is all based on a fairly narrow foundation of the decisions by, especially, it's not that the US hyperscalers are the only clients of those companies, but they probably buy nowadays 80-90% of their products. So it is to a very large extent dependent on those hyperscalers, their decisions, their outlook on this story of, the monetization of these LLMs and of all that compute. And as you said, it remains to be seen that this is going to continue to be that promising story that can be monetized. And of course, if you sell to those hyperscalers, you're not front in line. So if the hyperscalers don't make money, their shareholders are definitely getting the hit. If you sell to those hyperscalers, you'll be in the second round of those who get hit, right? So it's definitely an issue that then the foundation is pretty narrow.
The foundation is pretty narrow, Louis, and would you go to the extent of saying that the Asia growth story is just too dependent on a handful of these US hyperscalers, and if the spending there slows down, would that then become a bigger risk for Asia, for countries like India, more than the current market worry, which seems to be concentrated on what's happening with oil prices, what's happening to our macros, when is the end of the Iran war?
Yeah, I guess there will, at any point in time, there will at least be one thing that we worry about and fear, right? So we're still not completely out of the woods on the oil front. It's getting a little better in terms of the prospects, but prices remain high, and a lot of that energy price pressure still needs to work its way through our economies here in Asia. But that the people worry in the US about more generally a fairly, some people call it narrow foundation, other people talk about the K-shaped economy, that it is not a beautifully a beautifully widely spread kind of prosperity, but that it is quite segmented, quite concentrated, and that always increases the risks a little bit. I would say, I never want to be too negative about our Asian economies, including the Indian one, in the sense that it's not only about exports. We have quite solid domestic demand stories. And of course, India is a prime example of that, but that's also true for many of the other emerging markets in Asia. So the domestic demand story continues to be a positive. But if you look at these, spectacular increases in stock markets in South Korea, Taiwan, that exposure is quite narrow and it could turn around.
Just before I ask Louis the next question, 24,000 is back on the Nifty and 58,000 is back on the Nifty Bank. So both the indices now heading towards the highs of the day, and the banks are the ones that are taking the Nifty higher. So 180 points on the index and 850 point up move on the Nifty Bank. Louis, with the end of the Iran war, at least for now, and the subsequent fall in oil prices, has the case for a rate hike from the Federal Reserve by the end of the year put to rest, at least for now? And consequently, a same question for the Indian Reserve Bank of India as well. So in case we may not be in a rate easing cycle anymore, but has the start or the onset of a rate tightening cycle been pushed back, at least a couple of more policies, if not more?
Yeah, maybe to start on the second, I think that indeed, when things looked quite gloomy on the Iran front and in terms of the energy stress, we were at some point penciling in 2 hikes by the RBI in later this fiscal year. Now we only pencil in 1, so that is a little bit of an easing in terms of not as gloomy a picture in terms of rate rises. In the US, it is a complicated picture because we hear how central bankers in the US are very much also taking into account, things like unemployment and growth, but inflation is ticking up. It is already quite elevated and rising. So it's very hard to see interest rate cuts coming anytime soon. We had expected even an increase in interest rates by end of this year, early next year. Now with the easing of the oil prices, that may not be necessary. But again, at the very least, the cuts in U.S. policy rates have been postponed by what has been happening in recent months. Even though the outlook in the U.S., as is the case in India, is not as gloomy as it was, say, a month ago.
Be that as it may, again, your forecast for India's growth is at about 6.6%. It's very much in line with what RBI is projecting as well. But very quickly, is this the base case scenario? What are some of the biggest risks that you're factoring into this number? And this prolonged pause that you're expecting from RBI, only 1 rate hike, perhaps later in the second half, would that be supportive of growth from here then?
So I guess one way to put the picture for the Indian economy is that we had a bit of headwind, especially on the energy front. We will probably be able to consolidate the economy and start to see that resumption of domestically led growth, which continues to be a pillar of the Indian economy. The export story is where we've seen some weakness. We're waiting to hear what's coming out of those trade negotiations with the US. That once that is settled, that will probably provide some clarity for all those companies involved in the export trade. So I think that, a few months of consolidation, like consolidation doesn't mean we're standing still, we're still growing on the domestic front, but probably it is when the export picture clears up that we can see some resumption of an acceleration, perhaps. And then on the front of the RBI, I guess it is that inflation picture that they will look at very much, and of course the currency picture. And I guess once we have some clarity on the trade front, on the US trade tariff front, that should be of some support to the currency as well, making it a little less likely, less needed for the RBI to increase their policy rate.
Louis, pleasure having you today. Thank you so much for sparing time and joining us. Looking forward to more such conversations. Take a short break. The markets are at the highs of the day. The macro signals on the other side.
Welcome back. Let's get you the macro signals before the markets up first. I mean, they've crossed the 24,000 mark, holding up just above 24,000. Fingers crossed. That level is not broken, and we see an upward move from here. What's helping is the Bank Nifty, which has also crossed the 58,000 mark, trading with gains of more than 900 points at the moment. You have the Nifty IT pack as well, doing pretty well with gains of 1.3%. That's the upward move. We're seeing that the broader markets have also made a bit of a recovery in the last half hour or so. Take a look at some of the other macro indicators. You have the rupee that saw some weakness today with the dollar, and that's primarily because of the dollar. That's at more than a one-year high on the Federal Reserve rate hike expectations and that safe haven demand. So that recovery in the rupee that we saw last week has run into some headwinds on the back of rising expectations that the US Fed is going to hike rates perhaps as early as its September meeting, and that is despite oil prices extending their decline. But for now, you have the rupee at near a one-week low, 94.7 against the greenback. As for the oil prices, they've fallen today to below $77 a barrel. They're extending the week's losses and trading near 4-month lows, that we've hit in the previous session, on signs that more oil tankers stranded in the Strait of Hormuz, are set to move out. Remember, the US has granted Iran the 60-day sanctions waiver following those initial peace talks, and that allows for the resumption of the Iranian oil sales. The 10-year benchmark government security yield, again, that's hovering around 6.8% kind of a mark. We're seeing some consolidation at around that 6.8 mark, which is near the 3-month low, because the market is balancing what we're seeing in terms of strong foreign demand against the mixed global signals that are coming in. Yields, remember, had peaked to about 7.1% in May, but since then they have been trending downwards throughout June so far. So that's as far as the macro setup is concerned. With the markets holding up above 24,000, we take your leave here on Trading Hour. From Hormaz and me, it's a goodbye, but stay tuned. The team of Halftime Report will take all the action forward.
Stocks steady after the sharp sell-off on a Tuesday, with large caps gaining ground, mid caps too off intraday lows. IT, financial, cement gain, while consumer durables and autos drag. Infosys Chair Nandan Nilekani tells shareholders at the AGM AI will not replace IT services. He adds that AI services can be a $400 billion opportunity and the company's already working with 90% of its top 200 clients on their AI journey.
After Coal India, Central Bank of India, NHPC, GIC and NLC, now the government launches an offer for sale for the IRFC, Indian Railway Finance Corporation. This is the sixth sale, likely one among a long list of divestment offers lined up. Gold slides to a near 7-month low, while silver drops to a 6-month low. Dollar strength and fears of Fed tightening drag the precious metals lower. Good afternoon, you're watching us here on Halftime Report. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangla Malu, with me Vinny Motiwala, and looking extremely good for the market right now. The Nifty has gone ahead and reconquered the 24,000 mark, and those were the expectations. You know, this morning when we saw the GIFT Nifty absolutely flat, we were outperforming. Yesterday as well, we fell a lot lesser than all the other Asian peers, and now as we speak, the initial dip on the market was bought into, and we are above the 50-day moving average as well. At the high point of trade, above 24,000, the question is whether we go past that 24,150, 24,200 mark, which has been a bit of a congestion in the past or not. The mid-caps as well, after underperforming for a bit, have started to recover, and as the index has moved into the green, the crisscross lines come back and have crissed and crossed once again. We have 1,530 stocks which are advancing for about 1,400 stocks which are declining. So the green line, a smidge above the red one.
Hi, Mangalam. Good afternoon. Glad to be anchoring again with you, HDR. But, that's why markets also cheering it maybe. And we're seeing IT today holding on to good gains, pharma holding on to gains, banks also doing well and holding on to some strength there, while media as well as metals are seeing some bit of a pressure. But we have a very exciting lineup for you all on the show today. We'll speak with the management of Questcorp on their collaboration to establish an Indo-Japan GCC corridor. Then moving on, we'll also have a movers and shakers segment where we will focus on Tata Motors CV, textile stocks which are buzzing on the back of brokerage notes, and we'll also focus on some more buzzing stocks in trade today, so stay tuned in for that. And in a special crypto segment, Manisha will focus on key developments and events to watch out for in the crypto space as well, so stay tuned in for that. But first up, let's go across to Vivek, who's here to take us through the stocks that are moving around in the trading session. Afternoon, Vivek.
Well, good afternoon. It's a session where you've seen extreme volatility. We opened mildly in the green, but post at both a sharp dip as well as a very strong recovery, like you can see nearing the day's highest point. So advance decline ratio now, like you just pointed out, again moving towards the advances. In terms of individual names, Tata Motor commercial vehicle, that particular part of the business doing very well, very strong guidance given by the management in the investor meet. A whole host of brokerages have come out with very positive notes. That particular stock high by 5% now. The entire textile pack, like you just mentioned, positive brokerage notes. That particular stock, KPR Mill, Trident, Gokaldas, all of these names surging in the session today. KPR Mill up almost 9%. JSW Infra, this particular stock has done extremely well in the last 2 weeks. A strong QIP of over 7,500 crore. Very good demand over there. That particular stock high by 6.5%. Pine Labs, one of the top movers as far as the NSE 500 index is concerned, on very good volumes as well today. And lastly, the entire IT pack, after seeing a very sharp gash at the opening, has seen quite a bit of a recovery. So names like Tech Mahindra has recovered over 2%. Even Infosys doing very well in the session. On the other hand, a bit of a sell-off seen across the entire capital goods universe. Terms of capex spend is something that the street is keeping an eye out on. So most of the names like ABB, Siemens seeing a bit of selling pressure. NIACL, that is New India Assurance, among one of the top mid-cap laggards in the session today. IRFC, again, that particular stock under quite a bit of pressure after the OFS that Deepam has launched. And Swiggy, one of the top laggards as far as the F&O space is concerned today.
All right, we take that point. Thanks a lot for that, Vivek. A bunch of stocks which are buzzing around today. Just pull up the intraday chart of Trent. That stock's actually moved higher. Yesterday, there were decent comments coming in from Noel Tata in the annual general meeting as well. Growth prospects for Trent have been fairly good. Stock up 15% this month, currently as we speak at the high point of trade as well. But Vivek did allude to Tata Motors commercial vehicles. Steady gains coming in for that stock as well. And the management has marked the potential for double-digit margins and 40% market share by FY28. Sudarshan joins in with what's driving Tata Motors CV. Sudarshan.
So yesterday, company held the investor day in which company talked about FY28 outlook and targeting domestic CV market share of 40%, and that would be an increase of almost 500 basis points from the current market share that company has of 35.6%. As far as margin is concerned, through the cycle, they are targeting double-digit margin, and if there is an up cycle, the margin can be in the teens. As far as the investment is concerned, it will be 2 to 4% of total revenue, and on ROCE, the range is 30 to 35%. Remember, last year, company had made an acquisition of Iveco, and now that acquisition will be completed by Q2 of FY27. And once that is done, company believes that there is an opportunity to become globally fourth CV player. Now, brokerages have come out with a note on the same Tata Motors CV today. CLSA maintains outperform call target is 527 rupees per share. It says new product launches will aid market share. HSBC too maintains positive stance, has a buy call target here is 490 rupees per share. It says competitive positioning in M&HCV stays strong. Even LCV underperformance may have bottomed out. Nomura, though, has a neutral call and target is 402 rupees per share. It's a market share gain, margin discipline, non-cyclical growth remain key priorities for Tata Motors commercial vehicle. So, in the auto pack today, only one segment that is working well is commercial vehicle. Both Ashok Leyland and Tata Motors CV are higher in the trade.
Okay, thank you so much for that, Sudarshan. But let's move on, talk about textile stocks, which are buzzing in trade as well. And they've been buzzing for this month, specifically after the India-UK FTA has come in as well. Now, we had a note that came in from Motilal Oswal as well, talking about how the narrative of the sector is changing. To get us more details on this one, let's go across to Devyani for that. Devyani?
Well, the Indian textile space is all buzzing today, and it's not because of a single event, but the strengthening investment narrative around the entire Indian textile exporters. Now, Motilal has come out with a coverage on the textile space, and it says that after a flat and volatile current year 21 till 25, textile demand has finally started stabilizing. The key reasons for that include India emerging as a major sourcing alternative against China under the China Plus One strategy, with Motilal emphasizing on the supplier consolidation, which favors larger compliant players with streamlined audit processes over the smaller ones. And the upcoming implementation of the UK and EU FTA is also expected to eliminate or reduce import duties on the Indian textile and garment exports, which will be a big boost for our exporters. Now, reduced tariff uncertainty is also a positive for textile companies, with US tariffs having normalized around the 10% mark, while competitors are largely still facing around the 20% mark tariffs. Now, the major US retailers have also largely completed their inventory correction cycles after 2 to 3 years of destocking and are resuming their regular ordering cycles, which is a direct positive for our exporters as well. In light of all of this, textile companies are now incurring fresh capex to grow their capacities, and Motilal has initiated coverage on this particular space, with Gokuldas, Arvind and Pearl Global emerging as their top picks in this particular space.
Right, Devyani, thanks a lot for that. So those are a bunch of textile stocks which are on our radar this morning. The entire space has been abuzz. What we'll do is take a short break, and as promised, on the other side, we get chatting with the management of Quest Corp on their collaboration to establish an Indo-Japan GCC corridor, the impact of that on their business, also discuss key hiring trends. Stay tuned for that. Lohit Bhatia joins in.
Welcome back to Halftime Report on CNBC TV 18. Markets just slightly below the 24,000 mark, right? Right now, the Nifty still holding on to gains of 160 points in the trading session. But let's put the spotlight on Quess Corp. We have Lohit Bhatia, who's the Executive Director and Group CEO at Quess Corp, joining us right now. And we want to discuss three important points with him. One, yesterday, the company announced a collaboration with IGS as well as IPA. This is mainly to form a corridor for GCCs on the Japanese front and Japanese company and help them in hiring trends there. We'll understand that. We'll understand hiring trends in the GCC segment as a whole. And IT hiring trends, are they still under pressure? Are we seeing a recovery? What's happening there? We want to discuss all of this. Lohit, good afternoon. Thank you so much for joining us on the show. First up, let's start with this partnership and collaboration, right? IGS as well as IPA, you have signed a partnership with them. And this is mainly to open the Indo-Japan GCC corridors for them. You've spoken about certain sectors like AI, BFSI, cyber security, engineering is what you all will be focusing on. This is mainly through a subsidiary, but you've said that this is not a material subsidiary for the company. One, how does this partnership actually work for you all? How will you all be making the revenues here? And when do you start seeing these synergies materially come in for Quess Corp?
Thank you very much and good afternoon. Glad to be on your show. Yes, this is a important milestone for Quess. We've been the largest in the labor market as far as India is concerned, with about 480,000 people here in India in workforce management, the largest by all counts in Asia as well. However, 98% of our deployment has been in India, and we work in a market which has the benefit of demographic dividend, both in technology talent as well as non-technology talent. You may be aware that every month Quess sources, recruits, and places 20,000 people from our sourcing engine with our general staffing customers, and another close to 1,500 to 2,000 from our sourcing engine with our technology clients. What we've also been looking at is newer markets which have not yet participated in a very big manner as far as India's GCC story. If you look at 2,100 GCCs in the country today, only 5% of them are the ones from the Japanese, backgrounds. Japan itself and the government of Japan itself has come out with a large position paper on talent shortages, and it shows that in the next 4 years, they will have a shortage of nearly 790,000 skills in technology. And you couple this with the fact that India is the largest technology talent availability market, both in quality and quantity terms, but the third largest AI services market as well in terms of people with AI skills. So when you couple all of this, you see the last 18 years of what Quess has accomplished in the workforce management, and you look at a country where we've had very, very friendly relations in the last 77, 78 years. It was but natural that one of the first corridors that we would have liked to do a partnership, and we are glad that we were able to cement this yesterday, and we will begin. To your second point, what happens after this partnership and what are the next steps? So the three of us have started the identification process on who could those 50 and 100 Japanese corporations be, whether they are in the heavy engineering space, whether they are in the renewable space, in the banking space, in the design and development space, and what kind of talent would they require from a country like India, and how do we house them? While Quess does 80% of the heavy lift always, which is talent mobility and placement, Quess and Quess group of companies are also very strong when it comes to infrastructure management and other support functions. So it became natural for us to cement this relationship and use the best advantage of India today.
Right. So basically what you're saying is that from a look west policy, now we have to also look at a look east policy, because so far a lot of the GCC, businesses that would come from the western parts of the world. And now there is, there always was an opportunity in the eastern part. We are compelled to look at that as well. What does this mean for your company as an incremental revenue opportunity? If you could spell the numbers out for us. How many seats are you looking to add? What does that do to Quess's own business? And what's the timeline that you've put yourself for, the targets that you've set out?
So we've made a 5-year plan on this already. The current financial year is going to be to identify the right customers, which space and segment they belong to, what kind of talent they require, which parts of the country can we offer the GCC services to be for them, and how do we participate in their digital transformation journey as far as the clients are concerned. So this financial year is going to do majority of that heavy lifting when it comes to the execution. The next financial year onwards is when we start looking at revenues to start fall into our subsidiary, which is 100% wholly owned subsidiary of Quest. So it will eventually come under our professional services division. Today, 30% of our profit pool comes from our professional services. We do an EBITDA margin of about 12% plus there. So we want to continue to remain in that EBITDA margin. But I think the most important thing with these corridors that Quest is looking at, and there are 5 in total that we've identified for ourselves. Japan is the first that we've announced. What we are looking for is that currently Quest has about 7 to 8% of its revenue in dollar denominated terms. In the next 4 to 5 years, that is an area where we significantly want to have more dollar denominated or Forex denominated earning potential for the company as well. And this is a path in that direction.
Lohit, what I want to understand also, right, that AI talent or the talent required for AI and ML, are we seeing a bit more of a plateauing there? Because in terms of the JobSpeaks numbers that I was looking at, AI, ML, you've seen very good hiring trends there. But is there enough talent for this trend as well? And are you all upskilling talent, or is that the requirement also that is there right now?
You're absolutely right. There isn't enough talent available as of date. There is a shortage when it comes to the kind of niche skills which customers are looking for, and that's exactly the kind of work that Quest does. We find the most appropriate near talent which is available, and then near skilling, upskilling, and reskilling is something which significantly has to be done. This is an area where Quest will have to participate meaningfully along with all the other participants, partners in the Indian ecosystem, including what Government of India is also trying to do from a skilling perspective. India has about 6.5 million professionals in technology. We are one of the largest markets where BTech and STEM graduates participate and pass out every year. But a majority of them have not yet, fully understood the power of AI and ML. And that is an area which we'll have to do. The second we'll have to do is, from a cultural assimilation point of view, we'll also have to see how much of the talent is suited for Japanese companies, because there is a certain way of doing business in Japan. They would obviously want their employees or their setups in India to replicate and emulate very similar to what the Japanese standards are. And that's also something which Quest will have to put into place. So yes, those will be the areas of focus for us.
Rohit, would this require more experienced people hiring versus fresher hiring? How is the overall trend on that front versus what is the requirement now? If you say that there's a specific requirement that comes in for these special corridors, you have one with Japan, you said you're more lined up, then will it be more experienced hiring?
You're absolutely right. Way back in 2019 and 2020, when we were heavily reliant in our professional services piece on IT services as a bouquet, we used to primarily work within the 0 to 3, 0 to 5 years experience set. And we started, rebuilding our business in a different and a more meaningful manner in professional services. Today, 70% of our book is aligned towards GCCs, 20% is in IT companies within enterprises, and 10% is with IT services. What that has changed for us is, from a book which 5 or 6 years ago used to be 0 to 3 years, 0 to 5 years of experience, has today moved in the 3 to 13 years experience category. This requires us to go after niche talent. It has required us to change a lot of things internally, whether it's our delivery functions, our recruitment practices, our skilling practices, and the entire management of the associate engagement that we do. And all of this has been the work that we've done in the last 5 or 6 years. So we've created a foundation for this in future. Obviously, as you open new markets, as you interact with customers from new cultural backgrounds and corridors, you have to also understand that. And that will be the path that we'll take in the next 4 to 5 years.
All right, we take that point. Just a final question before we let you go. All of these are, opportunities in the next 4 to 5 years, what we need to also navigate are the near-term challenges, and that's with regards to IT hiring. Could you give us a sense of what you're seeing on the ground right now? We've heard from the annual general meetings of a lot of these large IT services companies, and none of them are very sanguine on the number of people that they will hire over the next year or so. So if you could give us an outlook on that. And additionally, the near-term opportunity is also blue-collar hiring. So if you could project both the near-term IT outlook and the non-IT blue-collar hiring.
So while we are still the largest in the country when it comes to GCC hiring and our professional services hiring, I must tell you that, across our permanent recruitment, MSP, RPO, as well as our technology staffing business, we work with about 276 to 280 clients. India has 2,100 GCCs. So we have a long way to go even for us to capture 50% of that market. India continues to gather another 100 new GCCs coming every year. Just last year, a professional services unit in the technology staffing added actually 68 clients. And this year, as we speak, we've already started the year with slightly better run rate of new customer acquisition and new MSAs that we are signing. So this will be a path that we will continue to progress on. As India attracts more and more GCCs and through our corridors that we create, obviously we will also win many of those deals. There is a lot of TAM available for us in this space even today.
All right.
To your question on what's happening in the blue collar space and the overall broader economy and the broader market, sorry.
Right. We take that point, actually. We'll leave the blue-collar conversation for another time, running out of time, not necessarily out of questions, but this was valuable insight, Lohit, So we'll continue our conversation on another occasion. Thank you so much for joining in, and good luck with the Japan foray as well. But as we, take a short break, we also have to take a moment to celebrate a big milestone that we've achieved today. We've crossed, CNBC TV18 has crossed 5 million subscribers on YouTube, and that number entirely belongs to you, and which is why a big and heartfelt thank you. Every viewer who's tuned in, shared, liked, subscribed, and stayed with us through the highs and lows of the market. Here's to many, many more milestones together, and to telling India's growth story the only way CNBC TV18 can. As you can see at the top of your screen, holding just below that 24,000 mark for the frontline index. Stellar recovery is what we've seen from the lows, and that's why it makes it the perfect time to look at all things F&O in the market right now. If you look at the Nifty, it's powered by two engines today. It's both the Nifty as well as the Nifty Bank, both of them doing extremely well, and that explains why frontline index has actually seen a near 0.75% of a gain. The Nifty IT index is up around 1%. The Nifty Bank actually has bounced from a very crucial level. So if you look at the Nifty Bank low today, it's 57,075, which is just at the 200-day moving average, which is an important support. So after underperforming yesterday, the Nifty Bank saw support at the 200-day moving average and has bounced right back from that, 1.5% in terms of gains. And that has led the Nifty to actually cross the 50-day moving average as well, 23,848, which will now act as an important support after the recovery that we've seen from the lows. On the way up, however, the 100-day moving average of 24,185 still remains elusive, and above that, we have faced resistance between 24,200 and 24,250, and that's exactly where option writers are positioned as well. Today's recovery from the lows has given a lot of ammunition to put writers to go ahead and write important strikes. 23,900 put, a premium of 100 rupees, tell you 23,800 is an important support. 24,000 put writers also fairly active. These are, remember, options that expire next Tuesday on the 30th, which also coincides with the monthly expiry of this series. So 150 rupees on 24,000 tells you between 23,800 and 23,850, there is strong support for the frontline index. The 24,100 call writers have actually been caught by surprise. So we've seen some sort of short covering out there, which is why the open interest is sub 1 crore right now. But now we're still beginning to see some writing. So 24,100 call, a premium of 100 rupees, and the 24,200 call has a premium of about 70 rupees, telling you between 24,200 to 24,270 will be the resistance as we move along the next few trading sessions. Just keep an eye out on a couple of things. The Midcap index is underperforming a little bit, and that's largely led by a lot of these metal names. So we'll monitor that. And even the advanced decline, after outperforming for the last 3 or 4 trading sessions, the advanced decline, it's split right down the middle, an equal number of stocks advancing versus the number of stocks which are declining. But individual stocks, they are doing a thing of their own. We're seeing a lot of shots caught on the wrong side of Trent and Shree Cement, so short covering is propelling these stocks higher. And a lot of fresh shots added on GE, Vernova, as well as Solar Industries. So we'll monitor that as well.
Okay, Mangalam, thanks so much for that. That's the update in the world of F&O. On that note, let's bring on board Dharmesh Shah, Assistant Vice President at ICICI Securities, joining us now to talk to us more on the technicals, more of his trading strategies as well. Dharmesh, good afternoon. Thank you so much, as always, for joining us on the show. Let's just talk about, in terms of the levels for the Nifty Bank also, that one should keep an eye out on. Mangalam spoke about the Nifty, but what are you watching out for today, given specifically what we've seen yesterday and today we're seeing a bit of a recovery?
Yeah, so good afternoon, Vinny. And yes, absolutely, I think so. The way the recovery happened in today's trading session, it looks like I think so. Market seems to be in the mood of going higher much, and we believe I think so. 100-day exponential moving average, which has been acting as a major resistance for last few trading sessions around 24,200, should be get taken out, and we should be looking for a target of around 24,500 as far Nifty is concerned. Again, I would say that if you look at the Nifty, I think so. We have already seen the 1,100 points rally, and what we witnessed is more of a profit booking of a sharp rally. So one should not get too much of negative of yesterday's sell-off. And I would say that any dip towards 23,700, 800 should be looked as a buying opportunity. So we believe, I think so, the way that things are panning out as far as crude is concerned, and which was the biggest hurdle for Indian market, I think so that looks for target from 71, 72. That augurs well for Indian market. So overall, I think so we believe the way the things are panning out looks like, I think so, the Bank Nifty, which is again if you look at the ratio chart of the Bank Nifty versus Nifty, it is on the verge of a breakout of a 5 years of long consolidation, indicating, I think so, in the coming days, Bank Nifty should relatively outperform the Nifty. And we expect, I think so, for the Bank Nifty to head towards 59,300, giving a strong support in this range of 56,800 to 57,000. So overall outlook remains to be positive. Any dip should look as a buying opportunity.
All right, dip should be buying opportunities. Take that point, Dharmesh. Individual stocks, do you have any picks there?
Yeah, as far as picks are concerned, Mangalam, I think on the banking side, we remain to be positive for. And inside the banking, again, I would say that the Kotak Bank looks more positive from the current levels. If you look at the weekly perspective, from the weekly time frame, I think so a strong engulfing bullish candle supported by more of a minor profit booking in the current week. Looks to be, I think so, way the stock has been forming a base above 52-week EMA. It looks like, I think so, Kotak looks more positive from the current levels. Look for a target of around 448, keeping a stop loss of 372. Apart from Kotak Bank, again on the real estate side, we remain to be positive for Oberoi Realty. Again, for Oberoi Realty, if you look at the chart from the weekly perspective, the stock has been in a very narrow consolidation in this range of 1740 to 1630, expecting the breakout about 1750 and looks for a target of around 1850, keeping a stop loss of 1680. So Oberoi Realty and Kotak Bank remains to be a top pick.
Okay, Dharmesh, thank you so much for joining us on the show as always and giving us your individual bets as well as levels to watch out for in the market. On that note, a quick break, and after the break, you'll have Manisha Gupta, who will take us through a conversation with Rahul Mehta of Silver Emporium. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Now it's time to get to that commodity conversation, and Manisha is joining us, and with her is Rahul Mehta, MD at Silver Emporium. Manisha, over to you.
Well, thank you so much for that. And silver, we're talking about that because that clearly has seen a very, very volatile move in the last 24 hours. Sharp declines almost at the edge of breaking 60 and back at around $62 an ounce at this point in time. And there you have it. It's declining again. Rahul, with the kind of volatile moves that we are looking at in silver, how difficult is it to do business right now?
It is always tough because that's kind of volatility always drive away the customer because they are looking at stability in the prices when they're buying material. And what we have seen in the last couple of months, last 1 month, we have seen is there's always a downward content. At every rise, there's a lot of pressure on silver, and we are seeing correction in silver. $60 is acting as a strong support. I think so. If that holds on, and if there's some stability in the market, we will see demand coming up. But definitely, in last couple of weeks, we have seen retail demand picking up. But for that, I think the prices needs to be stabilized. Otherwise, even that would be disturbed over a period of time now.
Oh, absolutely. It's half of where the silver prices were at an all-time high in the month of January, and it's been a sharp decline since then. Rahul, you said retail demand is picking up. In what quarters, what are people buying in silver?
So I would say because now with the festive season coming up, with a lot of weddings coming up, there's a lot of demand for silver dinner sets, silver gifting. There's already started picking up. So majority of that demand is coming with the replacement of silver. It's not that new silver is bought. A lot of consumers have their own silver, which they have bought at lower levels, which they're exchanging with the new stuff. So that kind of demand has already started. We are seeing that demand coming to the store. And that's a very good sign, an early good sign. I think so. We have seen a lot of retail customers coming to the store after maybe if you see last 2 months has been for the industry has not been really good. But after seeing last 3 weeks with the consumers coming back to the store, it's an early good sign for everyone.
You said 2 months were not good at all, and the last couple of weeks have been good. Even if you look at the last couple of weeks, what would you say is the major quantum of business right now? Would you say you are at 50% of a normal business or less than that?
So if I compare with last 2 months, I think so we are seeing a growth about 30% in terms of volumes. So that's a good sign for us. But if you compare with last year, definitely the business is down by 25 to 30% in volume terms.
All right. As compared to last year, it's 30% down year-on-year basis, but the last 2 months, it's gone slightly better. Rahul, what's your sense really on the imports part of it? Because the kind of restrictions that we are looking at in imports, clearly the positive is that it will bring the import bill down. But for silver as an availability, where do we stand right now? Where are we headed?
So I would say there's enough silver available in the market. There's a lot of recycling silver is also there in the market because for prices to stabilize or premium to increase, the investment demand has to pick up. And that is something which is a major cause of concern for everyone because we are seeing investment demand not picking up. People still don't have confidence in terms of where the prices will head in going forward. So till the retail demand picks up in terms of investment demand, we won't see any premiums in the market.
Silver usually doesn't see a lot of recycling as a market. What is the overall tonnage in sense of silver right now, in sense of recycling percentage? Yeah.
So I would say in terms of if you look at last 4 months, we are seeing that the exchange has gone up by 40%.
And what is it usually?
See, usually it's always 10 to 15% at the lower levels, but now people are a little skeptical of buying silver at the higher levels with the volatility in the market. They want to exchange their old silver to the new purchase they want to do right now.
There also was a huge trend about silver jewelry coming back into the market, gold-plated, silver with stones and semi-precious stones, etc. Is that really picking up?
So I think so. The silver jewelry market is expanding. The expansion is merely because of the number of stores which are adding in silver industry. Because now with the gold pricing being so high, there are a lot of silver stores are existing gold jewelry brand who are expanding into silver. So it's more about number of addition of stores which are happening due to which the demand has been created. But definitely, if you see going forward with the festive season coming up, silver jewelry demand will also pick up in a very big way.
All right. Rahul, you're telling me that there is store expansion and that is the reason there is demand in jewelry, not so much from retail buying, is it?
Yes, that's because there's a lot of interest of number of stores which are added. I think so. If you see last 6 months, the number of interest of number of people who want to open the silver store, if we say it has gone by 300 to 400%. So those are the number of stores which are going to hit during the festive season in the market. And usually those stores are going to cater to the gold jewelry demand because of the gold prices are being high. The consumer who are going to shift from the gold jewelry to silver jewelry, they are looking at capturing this market.
All right. Rahul, also, so you're anticipating demand to pick up from the month of August. June is not so great. July would just about start getting it there. But August, September, October, and then, of course, Diwali and the New Year is what you're looking at. What is the sense in volume that you anticipate to do in the next couple of quarters, or let's say next 3 quarters, because the demand continues till March?
So if I say from August to October, that is always one of the peakest season for silver demand in India because a lot of festive season, a lot of vendings, Diwali, there's Varma Lakshmi, there's Navratri. So that is a period where the majority of the silver buying happens throughout the year. So that quarter usually forms 50% of the entire demand throughout the year. And we are seeing that kind of demand to definitely be there with silver pricing. If the silver pricing being stable as they are, demand will definitely pick up.
All right, in hope of that. Rahul, thank you so much for joining in. So clearly some concerns coming in for the silver business. Remember, last year it was the trade to do. Almost everybody seems to be getting in. But as he says, 40% is now exchanged. Old silver coming back into the market, and demand estimates for August to October as of now on the higher side. But with that, we'll go for a short break. When we come back, we will get you into our special Crypto Corner segment. We'll focus on the key developments in the space.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. As has been the case with other asset classes, is exactly what crypto seems to be going through as well. Some declines in last 24 hours, so much so that the overall cryptocurrency market cap has now declined to a 2.2 trillion, which used to be at 4 and 4.5 trillion in the previous year. But it really has to do with the US spot Bitcoin ETF outflows, where it has been a record 6 weeks of net outflows of around $6.35 billion. The net inflows have now declined to a $53.4 billion. The overall market cap decline, well, the reason for that is the hawkish policy shift from the central bank, especially in the US markets. There also is growing capital competition from the traditional AI infrastructure investments. The institutional allocators have dialed back from crypto exposures, and all of those reasons have led to decline into the markets. But even with after that, the blockchain technology overall continues to surge and continues to grow stronger. Solana, for example, the institutional traction remains active. The newly signed MOU with Bank to rebuild the South Korean remittance rails has been positive for this one. And then you have Ethereum Foundation, which on the other side seems to be announcing cutting staff by 20% and slashing operational budget by 40%. Take a look at the project Pangea, and this is banking alliance comprising of 47 European and South Korean banks partnering with Chainlink Group, planning to utilize stablecoins to settle international currency trades in near real time. You also have South Korean tax anxiety, speculation on proposed plan to tax unrealized crypto gains that has triggered localized market volatility and panic selling into the street there. But it also is about the major tech players entering the space now. You have Meta now coming in with an in-house prediction market app called Arena to capitalize on this boom. Take a look at the overall blockchain market, and within this you have stable coins, which are now a $300 billion of a market with nearly 33 trillion of kind of trades that we seem to be getting into this. The tokenized real-world assets also is a $25 billion market. The huge market cap also comes in from the fact that you have government debt, which is standing at $16 billion, and the gold trading volumes, well, they stand at a staggering $90 billion at this point in time. So it is within the space that is stable coins and real-world asset tokenization, which seem to be doing very, very well.
Okay. Manisha, thank you so much for that. That's about everything cryptos. So let's move on and now actually step into a very short break. After the break, we'll come back and tell you more on the stock markets, which individual stocks are moving around. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. The space that's doing extremely well in today's trading session is the IT space, where sentiment is getting more selective now. There's JP Morgan Chase, which has downgraded HCL Tech, Wipro and Tata Tech. Meanwhile, Axis Capital has upgraded 8 stocks but cut 3. Rima breaks down what brokerages are signaling after this spate of underperformance. Rima, are there any signs of life here in the IT space from a bull standpoint?
Well, Axis does believe, but let me begin with JP Morgan. And their view is that enterprises are facing FUD, fear, uncertainty and doubt. Tech budgets today are being redirected towards cloud, AI tokens and less towards services spend. As a result of which, the Indian IT companies have been seeing low growth for the last 3 years. And they say that this AI deflation will continue, which means at least for the next 2 years, we will continue to see low growth. So according to JP Morgan, even mid-single-digit revenue growth looks quite tough for the large-cap IT companies, which is why they've gone ahead and downgraded their rating on 3 of the IT names, HCL Tech, Wipro and Tata Tech. But Axis Cap has a different view. They've upgraded 8 stocks, downgraded 3 IT names, and they're saying that AI is not the reason why IT stocks have seen, companies have seen a slowdown in demand for the last couple of years, 3 years. They're saying the demand slowdown began even before AI became mainstream. Secondly, their argument is that these large AI companies, and they're spending so much money, the return generation that they need, the revenue that they need cannot be met by only providing coding productivity. So therefore, the way it will work is these large AI companies will work together with the IT services companies and enable broader enterprise adoption. There will be a role which is required for the IT services companies. And thirdly, Axis is arguing that these large cap IT companies, yes, they saw low single-digit revenue growth, 2.1% USD dollar revenue growth from FY24 to FY26, but the bottom line growth was more. The EPS growth was double-digit, close to about 10%. So they've done a slew of upgrades: TCS, Infosys, HCL, LTM, Persistent, Coforge, Hexaware, Zensar. But the one which stands out is Coforge, because here their target price is 2,140, and that's about a 60% upside. And their downgrades are for Wipro, Tech Mahindra, and Infosys. Back to you.
Okay, Rima, thank you so much for that. That's all about IT. But with that, actually, we're absolutely out of time on this edition of Halftime Report, leaving the Nifty at just below the 24,000 level. We'll watch out for that. But thank you so much for tuning in. Up next, your Business Lunch.
Stocks are at the highest point of the day after the sharp sell-off on Tuesday, with large caps gaining ground. The mid caps are also off the lows of the session. IT, financials and cement are the gainers, while consumer durables and auto stocks drag.
Infosys Chair Nandan Nilekani tells shareholders at the AGM AI will not replace IT services. He adds that AI services can be a $400 billion opportunity, and the company is already working with 90% of its top 200 clients on their AI journeys.
After Coal India, Central Bank of India, NHPC, GIC and NLC, the government now has launched an offer for sale to sell up to 2% stake in IRFC. This is the 6th sale, and that is likely to be among a long list of disinvestment offers lined up.
Gold slides to near a 7-month low, while silver drops to a 6-month low. Dollar strength and fears of Fed tightening drag the precious metals lower.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. Back with us today is Arundhati Ravanan. Arundhati, good afternoon.
Good afternoon, Hormuz. The market's now in the green after yesterday's brutal sell-off. Nifty holding above that 24,000 mark. Recovery in Asian markets and, oil prices lower. The India-US trade deal, all of them helping the bulls. Helping back for the bulls today.
Yes, indeed. And we've recovered 2/3 of yesterday's losses. The bulls would like that. What is also important, that is something that the bulls would like, is the fact that we are back above the mark of 24,000. So that is another one. We are trying to hold on to that level, yes. But the fact that we have managed to get past 23,800 and 23,900 very decisively and swiftly, and now get back to 24,000 is something that will encourage the bulls a lot. Tomorrow, of course, is the monthly expiry of the Sensex contracts, and of course the fact that it is the last trading day of the week, considering Friday is a holiday. So that will also have to be taken into account. The broader markets are doing fairly okay for themselves as well. The Midcap index had slipped to the day's low in just the first 15 minutes of the trading session, but since then it has been a recovery for that as well. 100 points higher now on the Midcap index. Then there is no taking away from the fact that there is a lot of stock specific action that's happening in the broader markets, but the bulls will like what they're seeing on the screen today.
Absolutely. And if you take a look at the sectors, what's putting their hands up to help the up move, it's those IT names and private banks, right? If you look at the private bank index, that's the top gainer today, and heavyweights like ICICI Bank, HDFC Bank gaining over 2% in trade, and we've got Kotak Mahindra Bank as well up 1%. The IT index doing well today, about 1% in the green as we speak. Infosys up over 1%, Tech Mahindra up over 2%. We've got TCS that's up nearly 2% as well, and Oracle Financial Services gaining 2.5%. Now, on the flip side, we've got those defense names that are not doing very well. It's the top losing index today. We've got Hindustan Aeronautics down 2%, MTAR Tech down nearly 4%, and Data Patterns down 2.4% in trade. Metals also not doing very well today, about 0.5% in the red. We've got Nalco down, Hindalco down, Tata Steel, all of them lower in trade today.
At a time when questions are being raised about the future of the traditional IT services in the AI era, Infosys co-founder and non-executive chairman Nandan Nilekani says that the company is more relevant than ever. Speaking at the annual shareholders meeting, Nilekani said that AI will not replace firms like Infosys. Listen in.
Existential question that is being asked of us is, if coding becomes automated, then why are we needed at all? More than 3 years after GenAI's launch, Infosys is more relevant than ever before and well positioned for the decade ahead. The AI deployment gap in our large enterprise clients is real, and closing that gap is where the work is. AI will not replace companies like ours. It will amplify those who move with purpose and adapt with speed. We're already collaborating with 90% of our top 200 clients on their AI journeys.
And moving on to the commodity space, we've got metal prices which continue to decline on a stronger dollar and growing bets on Fed tightening. Manisha Gupta joins us now with all of those updates in the metal space. Manisha?
Well, thank you so much for that. I'm looking at the base metal prices because this is where we have seen very sharp declines come into the space there. If you look at the overall prices, that has been down because of various factors, really. To top it all, it has been about the strength in US dollar index, holding above 100 and holding quite strongly. And then the hawkish US Fed statements is something that we've been discussing, and a higher probability now that you could be looking at one rate hike in the month of December from the US Fed. It also has to do with the weak weak China data, which has led to some concerns into the markets as well. We are also looking at industrial numbers, all of that coming on the weaker side from China. Add to that, it's also about the slowing automotive and industrial demand from China and various parts of Europe that seem to be impacting the market. It also is going to be about institutional profit-taking that we have seen in case of metal prices in the last 3 weeks or so, only getting more stronger in this week itself. The selling also has happened from investors to raise cash amid market pressures. The kind of sell-off that we've seen in AI and tech also has led to selling across commodities that were actually profitable for a very, very long time there. So I'll start with copper, which has seen a 3% of a decline in the overnight markets. The prices have declined 3.5% in the matter of last 1 month. Still positive, though, for 2026, still time. But for copper, it is about the global shipments, which seem to be coming back, especially in case of copper concentrate. With the West Asia conflict now easing, the sulfuric acid, which was a concern, also will start flowing into the market. So smelters, refining, all of that would see that availability of sulfur, pardon me, coming back. If you look at the copper imports therein for concentrate, well, that has remained slightly subdued also. The treatment charges also are at around record low. So everything that was in positive for copper seems to have turned around slightly. Take a look at zinc, though, and this actually has done quite well. Just about a percentage point down on a month-on-month basis and 12% up when you look at this current year. For zinc, it clearly is about regional polarization because what we are looking at is massive production surplus in China versus tight bottlenecks that we are looking at in various Western markets there. Aluminum has been a very volatile market in this year, but when it comes to the price movement, we've seen a very sharp decline on a month-on-month basis, but so far in this year, it still is trading 9% on the higher side. And with that should come the precious metals on your screen because it has been a very sharp sell-off that we've seen in all of these in the last 1 month, last 1 week or so. So with that, all the precious metals are now negative for 2026 after hitting all-time highs in the month of January. It has been a constant decline. So gold is down 10%, silver 21% of a decline in this in the last 1 month, and 15 to 12% of a decline. It's what we are also looking at in case of platinum and palladium. So another day when the metals have extended declines.
Manisha, thank you for that update there. Just pull up Oberoi Realty before we move on. Flashes at the bottom of your screens. The Haryana RERA website is suggesting that the 360 North project in Gurugram of the company has received approval from them, and this is their maiden foray in the Gurugram market. Now, BOFA is estimating that the first phase could have a gross development value potential of anywhere between 2.5 to 3,000 crore rupees, and Kotak is expecting this entire project, which is around 2.6 million square feet, to have a potential of around 10,000 crores in sales value. So at the highest point of the day now is the Oberoi Realty marking their foray into the Gurugram market. Predominantly Mumbai-based builder is Oberoi Realty. Has done well over the last couple of weeks now, 10% over that period. Now, the Reserve Bank of India has released a detailed FAQ answering questions on its recently announced swap facilities for the FCNRB deposits, ECBs and overseas foreign currency borrowings. Let's bring in Ritu for a lowdown of all that you need to know.
That's right. The RBI has now issued detailed FAQs on the FCNRB deposit swap scheme, and the clarifications are being seen as positive for banks that are looking to attract foreign currency deposits. The biggest takeaway is that Indian banks, including their overseas branches, can now lend against these FCNRB deposits. They can issue standby letters of credit to the overseas lenders and even mark liens on these deposits. Now, remember, before this FAQ was issued, there was some uncertainty among bankers on whether an Indian bank's overseas branch could directly use these FCNRB deposits as collateral to lend abroad or to support overseas borrowing. But the clarification now significantly helps things. It expands the utility of these deposits beyond just raising funds. Now, RBI has also made it clear that the swap facility is going to cover only the principal amount of deposits, not the interest component. And very importantly, banks are going to be allowed to offer differential interest rates based on the deposit size and the tenor, which is a move that the street believes can help boost deposit mobilization. Now, on the external commercial borrowing front, Borrowings with an average maturity of 3 years and above remain eligible for the swap window. And RBI has also said that the swap tenor is going to be linked to the repayment schedule, subject to a maximum period of 5 years. Now, overall, the street is positive on these clarifications. Jefferies, for instance, says the FAQs address some key concerns around overseas branch participation and deposit pricing flexibility, and they expect banks to now raise these deposit rates, especially for large ticket 3-year deposits. Citi even goes a step further. They say the clarifications transform the scheme from a simple funding cost arbitrage into a broader balance sheet expansion opportunity. They believe the framework could attract stronger foreign deposit inflows than what we saw in 2013, particularly for those banks that have a strong global franchise and execution capability.
All right, Ritu, many thanks for those details. Now, the centre has moved to dispel viral claims around ethanol, clarifying that reports circulating on social media are inaccurate and urging the public to rely on official information. Sudarshan Kumar is joining us with more details on this. Sudarshan?
So yesterday on PIB website, government has issued clarification related to ethanol blending program and calling the program scientifically validated and being closely monitored by the government. Oil Ministry has also issued the clarification saying the program was first launched in 2003 and after that it was implemented in a phased manner based on preparedness and consultations and rolled out 20% ethanol blending from 2023. And so far, there are no widespread issues of engine failure or vehicle breakdown due to ethanol blending. Now, the question is why government had to issue the clarification. So it says it has noted misleading and unsubstantiated claims being circulated on social media platforms. So what are those claims? First, hygroscopic nature of ethanol. Government says entry of water into fuel tank is undesirable for any fuel, whether ethanol blended or otherwise, and modern equipment that we have, it does stop from fuel getting into the tank. Second, claims videos falsely portraying sugarcane juice as being mixed directly with petrol. On that, government says such content is misleading and baseless because ethanol used for blending is produced via established industrial processes from feedstocks like sugarcane juice, molasses, broken rice and maize, and properties of ethanol are vastly different from the input feedstock. Third claim is claims of E20 fuel could affect vehicle insurance validity. On that, we had certain clarification from ICICI Lombard also, and they have said that those claims are completely baseless and misleading and are incorrect. Now, government has also talked about the savings that it's getting from ethanol blending program. So, the program has helped save over rupees 1.4 lakh crore in foreign exchange via reduced crude oil imports. It has created sustained demand for agri feedstocks used in ethanol production. And it's not only the India which is using or which is going in for ethanol blending program. Some of the other countries are doing too. So government says ethanol blending is a globally accepted practice and successfully implemented in several countries like US, Brazil and Japan.
Sudarshan, thank you for those updates there. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. On to updates from West Asia. U.S. Secretary of State Marco Rubio, who is on a West Asia tour, says any agreement with Iran will ensure maritime freedom in the Strait of Hormuz. He said that Iran will not be able to charge tolls in the Strait of Hormuz when a final deal is agreed upon. Meanwhile, the United States and Iran offer conflicting statements, including on nuclear oversight, as negotiators push for a final deal within a 60-day window. Tehran says there is no clear schedule for the nuclear inspections. CNBC's Dan Murphy gets us the latest updates.
Well, the Secretary of State Marco Rubio is in the Gulf this morning. The goal here seems to be a listening tour, really aimed at selling America's Iran deal to allies on the ground who, frankly, still aren't sure if they like this arrangement. The Secretary of State arriving in Abu Dhabi late last evening, the first stop on a three-nation tour that's also going to take him to Kuwait today and then to Bahrain, where he meets with the Gulf Cooperation Council. This is actually the first visit by a senior U.S. official since the Iran deal was signed, and his first message was on the Strait of Hormuz with a direct warning to Iran, which is still pushing to charge vessels for passage through the strait. Here's what he said.
It's an international waterway. No country is allowed to charge tolls or fees on an international waterway. That's existing international law. That's the way it is in international waterways all over the world, and that's the way we expect it'll be here. So I don't think we have anybody to convince around here in that regard. I think all the countries in this region would agree with us.
The Secretary of State there speaking in Abu Dhabi. There is some progress on the water. The UN's Maritime Agency saying it will start evacuating more than 11,000 sailors who have been stranded by the blockade, working with Iran and Oman and the United States. Traffic is returning as well. New numbers from Kepler counting 39 ships through the strait on Monday. That is the busiest since the war began, but of course still well below the roughly 100 a day before it started. And there's new analysis from Allianz as well that says there's about 1,150 vessels currently stranded and waiting to pass through. They're carrying an estimated $125 billion in cargo. The insurer also saying in a note today that even if the US and Iran agreement holds and the strait reopens, traffic will not return to its pre-war levels until the international community provides, it says, a solid assurance of safe passage. Of course, here in the Gulf, the concerns run much deeper than tolls and Hormuz. These are the states that Iran hit with missiles and drones during the war, and they're very wary of this deal and also some of the rewards that are being offered to Tehran. So it is quite a hard sell for the Secretary of State on the ground here, but nevertheless, his presence is being very welcomed. As you've just heard, it's likely that the United States is going to need to maintain a strong presence in the region moving forward, not just for its Gulf allies, but also for Israel. So leaders here are broadly welcoming up the opening of that dialogue and welcoming his presence on the ground here. And then finally, there are some signs of strain on the deal itself. Of course, this is still being negotiated, but Iran's president said on Tuesday that its missile program is off the table. It's not up for negotiation. And the two sides don't even agree on whether UN nuclear inspectors will be let in. Tehran saying no visit is scheduled, really contradicting what the vice president has said. He said a day earlier that Iran had agreed to that. President Trump saying, look, without inspections, he's going to cut off these talks altogether. So we are seeing some mixed messages from both sides on exactly what is happening with regards to those talks. But overall, great hope in the region here that it does hold and that we will see, of course, the resumption of normal traffic through the Strait of Hormuz, which is really helping prices to stabilize, at least in the oil markets for now. It's back over to you.
Dan Murphy there with the latest from West Asia. Take a short break. Back with more on the other side. Welcome back. India and the US are now holding high-level trade negotiations in New Delhi with Commerce Minister Piyush Goyal and US Trade Representative Jamieson Greer leading the discussions. Abhimanyu is here with all the latest updates. Abhimanyu, tell us more.
Well, the discussions are still underway between India and the United States to finalize the interim trade deal. Also, discussions are likely on the larger BTA, that is the larger trade deal between both the sides. Now, currently, 10% tariffs apply on all the goods which are exported from any country and enter the United States, including export from India. Now, that 10% tariffs are going to lapse on the 24th of July. And in case a deal is not reached by then, in that case, MFN tariffs are going to apply. So both the sides are looking to close negotiations. They are looking to have a tariff architecture in place before the 24th of July to not just ensure a better access and certainty for their exporters, but also possibly to increase the availability of a huge market, respectively, for both Indian as well as American exporters. It remains to be seen how early both the sides are going to close negotiations, not just on the interim deal, but also on the larger BTA. Now, several issues are being discussed between both the sides, which include issues like preferential tariffs, investment provisions, and rules of origin. It remains to be seen what all is going to be pointed out apart from these issues as part of trade negotiations between India and the United States. Also, they are looking to expand cooperation in different areas like critical minerals, defense, energy, and investment. So all issues on the table are going to be discussed, and more importantly, both the sides would be looking for certainty for their respective businesses. India is seeking preferential tariff access for its exporters to ensure not just certainty, but also to ensure a larger access. Now, despite the applicability of tariffs in the last financial year, India's exports to the United States had marginally increased. So there's a huge opportunity which Indian exporters are looking at, which the government is trying to provide them by means of a preferential tariff access through the potential India-US interim trade deal.
All right, Abhimanyu, many thanks for taking us through those details. Now, Mumbai has been inundated by monsoon rains, albeit 13 days late. Between 8 a.m. on Monday, June 23rd and 8 a.m. today, Colaba recorded 248 mm of rain and Santa Cruz 225, nearly half of each station's long-term average in June in just 24 hours. In the east, Powai saw 296 mm of rain, while King Circle and the Dadar belt saw about 250. Waterlogging has also forced the Andheri subway to be shut to traffic, but relief for Mumbai's water crisis remains elusive. As of 6 a.m. today, the city's 7 lakes stand at just 7.94% of capacity. The BMC has stated that only strong July rains can bridge this deficit.
And that is exactly what we would be hoping for, the lakes to be full in the city. That's the most important bit, right? We take a leave on this edition of Business Lunch. The markets have surged to the highs of the day now, 220 points higher on the index. They continue to march ahead. We take your leave. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer and with me today is Hormaz Fatakia. Well, Hormaz, what a recovery we've seen. We started off in the green, saw a sharp dip, and once again we are back near the day's highest point and the broader markets are comfortably outpacing.
The bulls will be very happy with this move, right? We are just, 90 odd points away from recovering everything that we lost in yesterday's trading session. It's a good midweek trade for the markets as of now. But just before we move on, here are the headlines that we are tracking at 1:30 this afternoon. Markets are at the highs of the day. The Nifty is now above the mark of 24,050, led by gains in IT and financials, along with realty names as well. Auto and consumer durables, though, are trading with marginal cuts. The mid-caps have recovered to move into the green but are underperforming.
Shares of textile players rally in trade as Motilal Oswal initiates coverage on the sector. Says textile demand has started stabilizing after a muted 2021 to 2025. Also says reduced tariff uncertainty and the UK and EU FTA implementation are key triggers.
IRFC is one stock in the broader markets, though, that's under pressure after the government has launched an offer for sale to offload 2% equity at a floor price of 91 rupees. That's a 7.5% discount to yesterday's close.
Mamaearth parent Honasa Consumer bets on nutraceuticals with the acquisition of the 58% stake in Fluence Pharma at an enterprise value of 135 crore rupees. The stock, however, trades under pressure.
And shares of Rashi Peripherals have gained on the back of a 67% stake acquisition in VDA Infosolutions for 369 crore rupees. The management tells CNBC TV 18 that the acquisition should help expand margin profiles and expand into the services business as well.
Welcome to Midcap Radar, and like we mentioned, a sharp recovery in the market, and one particular sector that's led the recovery is actually the realty pack. Names like Oberoi Realty, DLF Prestige, all of these stocks have moved to the day's highest point. A sharp recovery also seen in aviation names, with Indigo up over 5% in the session. But these stocks and a whole host of other stocks is what Upasana has on her radar. She's standing by the big wall with all the mid-caps that are moving around in the session.
Well, certainly the mid-cap index has also recovered today. Now, as we speak, it's up nearly about 0.3%. So let us focus on the top gainers in today's trading session. First up is Pace Digitech. The stock continues to remain in focus, has cooled off a bit now. Next up is Pine Labs. It's up nearly about 5% as we speak. JK Cement is also the another one, as the company has selected as a preferred bidder for the mining lease for a limestone block. And SIS Limited also in focus and is one of the key volume buzzers today, with volumes more than 62 times the weekly average. Now, placing the focus on some of the textile stocks that remain on our radar today, as Motilal Oswal has placed the focus on this sector, initiating coverage on several counters. KPR Mill is one of them, 10% uptick, Indocount 10% out here as well, and Pearl Global Industries. All these counters are surging in today's trading session, as the brokerage says that the narrative has changed for the textile sector, and certainly on the brighter side. Now, let's just place focus on the defense stocks. They continue to see some pressure. They have taken a hit today, be it the likes of MTAR Tech, Astra Micro, IdeaForge, Zen Technologies, Data Patterns. All these counters have taken a hit, down nearly about 2 to 4%. Now, on the flip side, let us look at the top losers in today's trading session. First up is IRFC, down nearly about 5% after government has launched the OFS with nearly 2% equity dilution. And also, Sterlite Tech is a stock that continues to remain in focus, but this time is on the other side, has seen a downtick of nearly about 4%. And lastly, coming to Physicswala, down nearly about 3% as we speak. So all in all, these are the stocks that are on our radar.
Thank you very much for that. What a move now on the markets. Now 24,065 as we speak, 240 points higher on the index. And the heavyweight banks are putting their hand up as well. ICICI Bank is up 3% now. HDFC Bank too, trading with gains of around 2%. Good going for a lot of these heavyweight banks as well. At the highest point of the day now is the Nifty. Time for our special segment, CNBC TV 18 Unpacked. And this week, Vivek had taken a deep dive into India's renewable energy space, where CleanMax is leading as an emerging key player in the corporate clean power ecosystem. Take a look.
Clean energy is fast becoming the backbone of India's corporate power demand, and one company leading that transition is CleanMax. Let's take a closer look at what makes this renewable energy player stand out. Remember, CleanMax is India's largest commercial and industrial or CNI renewable energy provider. As of FY26, the company has an installed power sales capacity of about 3.1 gigawatts. And when you look at its client base, it reads like a who's who of global tech, with big tech and data centers accounting for nearly 42% of its 5.7 gigawatt contracted portfolio. In fact, CleanMax recently announced a major 900 megawatt renewable energy platform with Meta, where the tech giant will purchase all environmental attributes. Now, what sets CleanMax apart? Now, unlike traditional power companies, CleanMax directly supplies renewable energy to businesses instead of relying on distribution companies, and it operates through open access routes as well as long-term contracts. Now, this particular model allows CleanMax as well as its clients to save close to 30 to 40 to 5% of power costs compared to grid tariffs, while also helping them meet rising sustainability goals. Now, when you're looking at what brokerage note HSBC has to say, it notes that CleanMax's business model, number one, is difficult to replicate thanks to its client-first approach, repeat customers, and its ability to invest upfront capital. Now, the commercial and industrial segment in India, which covers offices, malls, as well as data centers, is a massive opportunity. Remember, India's total CNI renewable installed capacity already stands at over 55 gigawatts and is growing. Now, CleanMax, with its 3.1 gigawatt installed capacity, remains a clear market leader in this particular space. Now, looking ahead, the company is targeting at least 1.5 gigawatts of new capacity in FY27, and over the next 3 years, plans to add 3 gigawatts more, while aiming to double its EBITDA from FY26 levels. Its customer pipeline continues to expand, including global giants like Meta, Google, Apple, Amazon, as well as Equinix. Now, talking about valuation, CleanMax trades at a premium to traditional utilities, and its FY27 estimated price to earning stands at around 71 times, higher than peers like NTPC, Tata Power, as well as JSW Energy, which reflects strong growth expectations in the renewable CNI segment. One thing to note, the stock has done remarkably well after opening out on a very weak note. Remember, this particular company listed at the height of the West Asia crisis.
That was CNBC TV 18 Unpacked. And to unpack this further, the management of CleanMax Enviro Energy Solutions joins in on the other side of this very short break. Stay tuned, we'll be right back. Welcome back. Now, sources say that HDFC Bank has shortlisted 3 names for the chairman position, including a former RBI deputy governor. Ritu is now joining in with more on this. Ritu, tell us what you're picking up.
That's right. HDFC Bank's this long-awaited leadership succession process, it appears to be entering the final phase. We've been given to understand from our sources that the bank has now shortlisted 3 candidates for the position of, the non-executive chairman, and that includes a former RBI deputy governor, and the board is likely to finalize its recommendation as early as the end of this month itself. Now, what is significant here is that the chairman appointment is very closely linked to the future of the current MD and CEO Sashidhar Jagdishan, with our sources indicating that the recommendation for extending Jagdishan's tenure is going to be taken up after the chairman selection is completed. Now, this, of course, comes against the backdrop of all that, governance scrutiny at HDFC Bank. Remember, former HDFC Bank chairman Atanu Chakravarti resigned earlier this year, citing differences over governance and ethical issues, following which Keki Misri was named the interim chairman, and his initial 3-month term has since been extended by another 90 days until September. Now, importantly, the bank is also expected to receive the findings of this external legal review that was commissioned to examine the issues that were flagged by Atanu Chakravarti, and that report is expected shortly as well, and that could help bring some closure to these governance concerns that have lingered since his departure. Now, sources are also telling us that RBI has taken note of both the delay in the chairman and the CEO succession processes, and it has explicitly asked the bank to expedite the submissions. Now, remember, Sashidhar Jagdishan's current term as the CEO ends in October this year, and typically RBI expects banks to initiate the reappointment at least 6 months before the end of the incumbent's tenure. So, that is already overdue, which is why you have the RBI now asking the bank to expedite the process. But, overall, Hormaz, for investors, of course, the key takeaway is that the market could soon get clarity on both the board leadership and the future of the bank CEO, and that potentially will end months of uncertainty around succession at HDFC Bank.
Thank you so much, Ritu, for joining us and giving us details on those important developments. We'll keep coming back to you as you get more on this particular development. But moving on, we just heard about, how the business model of CleanMax is, and we are joined by Kuldeep Jain, who's the MD at CleanMax Enviro Solutions. Thank you so much, Kuldeep, for joining us here at our studio.
Thank you all for having me.
Yeah. Well, first up, the first question is, last fortnight, we've heard so many deals come about, especially, we saw one from Meta. We also know that you have, clients like Apple. What exactly does CleanMax do for them? What exactly is the CNI renewable energy space, and how does it benefit clients rather than going to a traditional utility?
So what CleanMax does is we provide cheaper, greener electricity to corporates. So essentially, most of the listed renewable companies are in what you could describe as the wholesale market, which is that they win by participating in reverse auctions, sell their electricity to the power distribution company who sells it to a corporate customer. We sell directly to the corporate customer and use the power distribution company's lines, just like a manufacturer would use a toll highway and pay the toll to move his goods. We use the power distribution lines to move our electricity directly to the consumer. So this is, in a nutshell, what CNI is. It stands for commercial and industrial. It's basically the direct-to-consumer renewable energy model, as opposed to what most listed companies are the wholesale or utility business model, right? So these are just unpacking 2 different words. What is CNI? What is utilities? We are CNI, and it's a very old concept, but relatively new in public markets, because being the all India #1 player, the national leader, we're the first company to get listed from our space. So it feels new to public markets, but it's actually a very old concept. We are just the largest player and therefore the first one to be listed. Now, if you come to what are we doing with data and AI clients and hyperscalers, which is the likes of Meta, Google, Apple, Amazon, Microsoft.
All of whom who are your clients?
All of them are clients, and hyperscalers are very relevant because not just they're big names, but more importantly, 50%, half of all CNI power procurement last year was done by hyperscalers. So they may be, of course, the biggest names in the corporate universe today, but they're the biggest consumers of green electricity because they have these massive data centers, So that's the relevance. Now, and we are privileged, I would say, that we have multi-year, multi-format relationships with each and every one of them. Right. So, for instance, yes, you mentioned Meta, because there was a deal announcement a few weeks ago that Meta and we sort of jointly put out, where they are contracting, I think, slightly in excess of 800 megawatt of electricity with us. But if you look at Meta's post prior to that, they've often credited us with other deals prior to that. So it's a multi-year, multi-format relationship, and it was a big new deal they announced. But we also, for instance, have 2 joint ventures with Apple, where we co-invest. We own 51%, Apple owns 49%, and we co-invest in green energy projects. There was a recent announcement about a month ago of Apple putting in 100 crores of equity as their share in such a project. We also have similar deals with Google, right, and with Amazon. So we are privileged to have multi-year, multi-format relationships with each and every one of these hyperscalers. And they're extremely relevant, not just for their brand salience, but more importantly, they're half of all the global CNI deals. And what's going to happen now in the future is, as these people build out their big data centers in India, you will see incredible amounts of renewable energy demand which comes with that. So, for instance, for every gigawatt scale AI data center that gets built, it is 1 gigawatt of AI data center. Even if we meet 75% of the energy requirement, that requires 6 gigawatt of renewable power. Because, you know, when they say a gigawatt, they are saying what is called IT load, which is 1.5 gigawatt of round-the-clock power load. And that is at 100% utilization factor. Renewables is not 100% utilization, it's lower. So to meet 1.5 gigawatt of power.
The context for us, what is the total demand coming in from data centers, from hyperscalers in India? How much of it are you participating in? And what is the growth trajectory you see, you know, over FY27 and FY28?
Very good question, Vivek. And I'll take a slightly like 5-year view, not a 1-year view on this. So if you look at the data center business, everyone's talking about it. So everyone's saying, oh, it will go from 1.2 gigawatt operating today to somewhere between 7 and 10 gigawatt in 5 to 7 years. You know, who really knows, but that's the kind of growth that you're talking about. Every gigawatt of data center needs 6 gigawatt of renewables. So if you add 7 to 8 gigawatts of data center load, you're talking 42 to 50,000 megawatt of renewable power. Now here's another interesting thing. Today for CleanMax, 42% of all our volumes are for data and AI. And if you look at the hyperscaler business in India, we enjoy, as per our DRHP and CRISIL's report, we have a market share of about 35 to 38% of the hyperscaler business in India. So, you know, 40,000 megawatt coming in 5 to 7 years, you know, we've got a fair bit to come to us.
Okay. Now, the other question what we want to ask from you is, give us a sense of the tariff differential that is, you know, that you sign PPAs with your clients. And the second is, what is it that is discovered at the auction? You know, do you provide some competitive edge as far as, you know, some of these MNCs are concerned, or is it purely the relationship that you have over a multi-year period where they get electricity and they get electricity at a rate which is both sustainable over a long period of time, as well as electricity that they can depend upon?
So there are 2 relevant numbers here. First number is the consumer, whether a data center or general corporate, is having green electricity fully delivered, like-to-like comparable, at about 30% cheaper on average than grid power cost. You know, so green electricity today is cheaper than a brown heavy grid, right? So that's one benefit, which is cost savings. And therefore, it's very relevant for every consumer. But particularly because in a data center, 65% of your of your cost of running the data center is power. You know, 30% cheaper green power is very, very valuable to your operation. So that's first thing. Second is, our model is direct to consumer, right? Whether it's a data center or it's textiles or chemicals or something, it's direct to consumer. Our tariffs, like what are we charging? We are charging about 3 rupees 81 paise for the next 2600 megawatt that we are about to build. And that's far superior than the 2.5 to 3 rupees discovered in government auctions. So it's a win-win. We have tariffs by going directly to consumer, by going retail. Our tariffs are far higher than wholesale auction market. But our consumers are also getting cheaper power. So they are saving and we are earning more.
Right. You know, that's the bit, right? The street would want to know more numbers. Right? You grew, what, 30-odd% on the top line in FY26. You grew 30-odd% on the EBITDA front as well. Does that sustain in FY27? Or based on what you just told us, with the new initiatives, with the deal with Meta and so on, does that number better in FY27?
So our published run rate EBITDA at start of fiscal is about 1850 crores. And our reported EBITDA has historically been about 110% of start of year run rate EBITDA. So by that, you could say 2,000 crores, or let's say, if we want to give it a range, 1,900 to 2,100 crores. That compares with 1,300 crores last year. So that's about a 50% growth.
So you've said you're going to double EBITDA in over 3 years. You're adding 3 gigawatt over the next 3 years. Any guidance tweak, any upping of the guidance, given the kind of demand you're seeing?
No, so our guidance is that we'll add at least 1,500 megawatt this year.
This year. Yeah.
So then in 2 years, it's about 3,000 megawatts. So we'll double in 2 years.
So double in 2 years.
Double in 2 years is sort of the guidance that is broadly fair to give.
Pleasure having you today, Kuldeep. Thank you for
Thank you so
spending
much,
time
guys.
and joining us today. And I wish you good luck for the rest of
Thank
the
you very
year
much.
as
Thank
well. The management there of Clean Max. Take a short break. On the other side, back with more on the markets on the other side. 240 points higher on the index, 24,060 is where we stand as we head into the final 90 minutes of what has been a very, very good trading session for the bulls so far. Pine Labs is now moved to the highs of the day, 5.5% higher after the block deal earlier in the session, and a lot of other movers as well. Indigo's market cap is now back above the mark of 2 lakh crore rupees. The stock has now recovered everything that it lost during the Iran war, and that too has surged to the highs of the day, 4.5% higher on Indigo. Great going for the largest airline. 4782 was the close on the 27th of Feb. It has recovered everything it had lost. Take your leave on this edition of Midcap Radar from Vivek and me. Thank you for watching. Your stocks on the other side.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati Ramanan as well. Arundhati, good afternoon, and it's a good afternoon shaping up for the markets as well. So we're seeing good gains and about the 24,000 mark again, comfortably above that. No complaining. We're almost 0.9% of gain that we're seeing coming in for the Nifty. While IT is doing well, but Arundhati, there are some of these broader end of the names also, right? We have these textile names that are buzzing in trade. So whether you look at a KPR Mill, Welspun Living, all of them are among the top Nifty 500 gainers. On the flip side, capital good names, GE, Vonova, TND, Hitachi Energy. So capital goods is a bit more under pressure in today's trading session. So that is something to watch out for. But do not forget, they have seen a very sharp run up as well.
Absolutely.
But as of now, overall markets, quite good.
Yeah, Nifty marching higher above that 24,000 mark, 200 points in the green. After yesterday's brutal sell-off, this is really good news for the markets. Lower oil prices, India-US deal, a recovery in Asian markets, all of that boding well for the markets today. And as Vinny pointed out, it's the IT names and the banks that are marching upward, helping the Nifty stay in the green. We've got those private bank names that are leading the charge, and we've got ICICI Bank, Kotak Mahindra Bank, all of the heavyweights doing well in trade. IT names, that index is now 2% in the green. So a big up move there that we're seeing in those IT names as well. Infosys, Tech Mahindra, TCS, all of them gaining over 2% in the green. On the downside, Vinny, we've got those defense names that are not doing so well. And we've also got the metal pack that's not doing so well, although we've seen some sort of a recovery in that as well. So overall, the market's doing very well today. But it is time now to answer all of your stock queries. And joining us on the show today are independent market expert Shaina Mukadam and Somal Mehta, head of retail research at Mirae Asset Sharekhan, to answer all of your stock queries. Thank you so much for joining us on the show today. But let's go to our first query that's coming in from Shiva. He's writing to us from Hyderabad and he holds 50 shares of Jio Financial at 250 rupees. He wants to know the outlook for the stock for the next 6 months. Right now, he is making a loss on this. Shaina, let me come to you first. How are the fundamentals looking for Jio Financial and what's the 6-month outlook for the stock?
Well, I see the stock consolidating actually after the slight dip that we saw post the fourth quarter numbers, where while the revenues were okay, but profits took a hit basically because of the heavy investments that Jio is taking. Now, on a price to book basis, it's just about 1.1 times price to book 1 year forward, which is not expensive. So I would say you continue to hold.
Okay. Point taken there, Shaina. But Somal, on the technical front, what is your view coming in for Jio Financial Services? I know not much in terms of charts, but anything that the viewer should keep an eye on because it's short term that they're looking for.
Absolutely. See, it's in a downtrend for a very long time now, making low top, low bottom. But in the last couple of months, it's been taking support around 225 and 220 levels. So that has become a very crucial support zone for Jio Financials. I would hold this stock with a very strict stop loss of around 220. And if it sustains about these levels, I think the next level as a target on the upside would be 250 and 260 levels. 262 is the 200 daily exponential moving average, which is a very, very crucial hurdle for the stock.
Okay, Somal, point taken there. We'll keep an eye on those levels for Jio Financials. But let's move on and talk about the next one. We have Anuj, who's writing to us from New Delhi. It's an investment query. So they're looking to make investments now. Sirma SGS, NetWeb Technologies, Coforge, they've given a whole host of names. MTATech, Polycap, Cummins. Wants to know which one can he look to invest in, and it's a short-term query. 6 to 9 months is only the time period that they're looking at. Shaina, different names coming in, right? We have Sirma SGS, which is an EMS play, NetWeb Technologies, which is small IT, Coforge, larger on the side. We have defense play, you have capital goods, Cummins, which they're asking about. Which one would you pick? I don't know what is the amount they're looking to invest, but any couple of names that you are looking at right now?
Vinny, all the stocks look good for the long term. All the 5, the sectors also look decent. It's difficult to pick because valuations for all of them have run up quite a bit. But if I was to take 2 for maybe a 1 to 2 year holding at declines, at dips, corrections, I would go in for a NetWeb and Sirma. Of course, Sirma, as you know, the order book position is quite good. If you look at it, it's about 6,600 crores. If you compare it with turnover of FY26, it's about 4,800 crores. There, the management has given a guidance of continuing growth in FY27 of about 30-35%. So actually, if you hold it for a year's time, I think it should look good. But buy it at dips. Similar goes with NetWeb. They have got very good order books. AI, as you're discussing, the capital investment that is going on over there is pretty strong. And NetWeb will benefit, of course. They have got strong tie-ups with NVIDIA especially. So I would say NetWeb also, but both these stocks on dips.
All right, by both those stocks on dips, Somil, if I can come to you, I'll just list the stocks for you again. Surma, SGS, NetWeb Technologies, Coforge, MTAR Tech, Polycab, and Cummins. So these are the stocks he's looking at. He wants to know which one he can invest for in the short term, 6 to 9 months. And he wants to also know the entry price.
The Polycab and Cummins, they're very good stocks and definitely should be in a portfolio as mid-caps. However, they've run up a lot. Buy on decline should be the strategy there. So these two stocks are definitely there. But at this point of time, good risk-reward ratio. If you see, then Coforge and NetWeb, these two stocks are looking really good from here. Coforge, a little risky bet. However, you can keep a stop loss around 1350 in the short term. In the medium term outlook, around 1240 levels. So these are some levels for Coforge. I like Coforge in the IT pack, and the other one is NetWeb. NetWeb definitely looks good to me. Over here, it has been forming higher tops, higher bottom on the weekly, monthly charts. Great setup on the daily charts as well, trading above averages. I think you can keep a stop loss around 4,700 and 4,600 levels, around those levels, and you can hold on to the stock or probably enter the stock right now as well. So Coforge and NetWeb, both you can enter right now, but Cummins and Polycab, they both are looking good as well, but buy on declines.
All right, so Coforge, NetWeb looking good right now is what you're saying. Now, the next query is coming in from Matthew Tarakan, who writes to us from Kerala. He holds 30 shares of Torrent Pharma at 4,623 rupees. He is making a loss on the stock right now. He wants to know if he should stay invested for the medium term. So, Shaina, let me come to you first. In the medium term, is it looking good? Should he stay invested?
No, I would suggest that he switches from Torrent Pharma. The overall pharma sector, in my view, is looking very good. But Torrent Pharma, actually, the issue with it is the huge acquisition that it has made for JB Chemicals. Now, that is almost 27,000 crores. Recent acquisition, January 26. Now, that is reflected in the numbers. The merger numbers are reflected into the overall numbers, which is showing good growth in terms of top line as well as EBITDA. But profits are taking the hit because of the huge interest cost jump. Now they are trying to sort of offset this huge loan that they've got on the books by making there's a recent, they are recently announced they will look for a 5,000 crores fundraise. Even if you factor that in, I think at least for the next 1 year, the numbers are going to look pretty, weak in terms of higher interest, at least on the PAT level, and the stock could consolidate. Now we've seen a similar thing happen for Biocon. And I would suggest now Biocon, the issues are more or less behind it in terms of the acquisition. And FY 27-28 could be a better year because interest costs will come down. So I would suggest a switch to Biocon rather than continue to hold in Torrent Pharma. Though, fundamentals for the long term remain good. It's just basically technical issues.
Fundamentally, so they are okay holding it for long term. In their query, they're asking that is it okay then for the medium to long term? So next couple of years, if they're willing to hold, then is it okay to hold Torrent? Or would you
Still
just say switch
to Biocon?
Okay,
Yeah.
you would still say switch to Biocon.
Look at relook at it 1 year down the line, but not now.
Okay, relook at it 1 year down the line, but not now. Also, Matthew, thank you so much always for tuning into the show as well. He's mentioned that he's an avid CNBC TV 18 viewer. So thanks so much for that. Somil, taking this query to you. On the technicals, Torrent Pharma, would you say it's a good bet? They've started buying it on 12th of June itself. So just the recent time, but since then only they've seen that fall coming in. They've added almost 30 shares is what they're talking about. Does it merit holding it or should they just book out their losses today? The stock is at around 4,500, right?
Yeah, I think if it is a long-term bet, if it a long-term investment, definitely no issues at all. It's been in the upward trend, higher top, higher bottom on the larger degree time frame, trading above long-term averages, short-term averages. Everything looks great to me. But I would, even I would suggest that there are so many stocks which have not run up. They've just started running up, like Zydus Life or Mankind Pharma. Cipla is a good one at this point of time. So there are are a lot of stocks. Torrent Pharma in the last couple of years has run up a lot. So it is better to switch to some stocks which are looking good on the risk to reward ratio side of things. So Cipla, definitely a large cap, good turnaround right now on the charts. So there are a lot of stocks where you can diversify.
Okay, there are other stocks that you can look to diversify than this one. That's the word coming in from Somil as well. Let's move on then to the next query for today. We have Guru who's writing to us from Chennai. It's an investment query, right? And this is coming in on all the demerged entities of Vedanta, Vedanta Aluminium and other stocks that have gotten listed. Out of this one, which is a good bet to enter right now? Is it a good bet to enter any of the names at these current levels? Shaina, fundamentally, what are you looking at? Anything that they should look to pick up from the Vedanta basket?
Right now, no, not exactly. But if you're looking at picking it up on declines and then holding it for the longer term, I think Vedanta Aluminium looks good. Of course, that also contributed to a major chunk of the price before the demerger, as well as in terms of their revenues, EBITDA, etc. Why I say that don't buy it now, I would prefer somewhere, a deep discount, somewhere close to about 400 rupees would be a level I would be comfortable buying it at. Because if you look at it in terms of valuation currently, both on basis of replacement as well as in terms of earnings, EV by EBITDA, I think currently it is quite expensive. So I would wait for corrections, wait for the stock to actually find its level, wait for the numbers to come out and then value it. As of now, I wouldn't enter. For example, you compare it with Nalco, with Nalco, which has actually announced that it's expanding. Even if you compare it with the cost that they are going to invest in setting up new capacity, I think it is pretty expensive. So I would wait. Don't buy it now.
All right, so you would wait and not buy it now, wait for it to hit those 400 levels is what you're saying. But Somil, what about you from the Vedanta pack, right? All of the stocks, the demerged stocks, which one do you think would be good for a long-term bet and any levels that they can enter at?
There's less charts for the other stocks. Vedanta is definitely looking good. It is trading at 280. I'll be expecting the stock to go down till 250, 260 level, and that will be a great time to buy Vedanta again for your portfolio, for your investments. But one thing I would like to mention, I'm very bullish on the power sector overall. So Vedanta Power probably would be my pick once we have more, a chart and have more history on the chart. I think that will be a better bet. But right now, I would say that power sector definitely looks good and it is good to hold on for a long time.
All right, so you're bullish on the power sector. All right, Somil, Shaina, we have to take a quick break, but stay with us. Before that, a big milestone for us today. CNBC TV 18 has crossed 5 million subscribers on YouTube, and that number belongs to you. A big and heartfelt thank you to every viewer who's tuned in, shared, subscribed, and stayed with us through the highs and lows of the market. Here's to many more milestones together and to telling India's growth story the way only CNBC TV 18 can. Welcome back to Your Stocks on CNBC TV 18. We still have with us independent market expert Shaina Mukadam and Somil Mehta of Mirae Asset Sharekhan to answer all of your stock queries. Now, the next query is coming in from Shivakumar, who's writing to us from Coimbatore. He holds 10,000 shares of Z Entertainment at 118 rupees. He is making a loss on this. It's currently at 113 rupees. And he wants to know if he should continue to hold or should he sell right now. So, Shaina, what are the fundamentals looking like? Is it a good time to continue to hold Z?
First, let me congratulate you, Vinny, the whole team at CNBC for your milestone achievements. And I'm sure you're going to go way ahead from here.
Thank you so much.
Yeah, sure. So as far as Z goes, let me first list the three positives that I see. One is, of course, they are going to have a fundraise. Okay, so that should help the balance sheet a bit, which it doesn't require too much of help, but yes, okay. And Z5 is doing pretty well, in terms of their platform. They're going EBITDA positive, as well as I think the last one that is positive is their overall network share is about 17% plus, which all three are positive. Having said that, I think this becomes a very high risk trading stock in my view, because the very low equity stake is held by the management, and really we don't know what they're likely to do plus minus here and there. So what I would say is that hold it for a bounce, but you could switch.
Okay, hold it for a bounce, but could look to switch. That's the word in the fundamentals. Somil, what's the view on the technicals, right? They're making significant loss on this one right now is what they're saying, right? 10,000 stocks at 118. So they're making some bit of a loss. And they want to understand now, is the strategy hold or sell and book out your loss?
It has bounced back a little bit in the last couple of months. It's trading about 200 daily moving average, trading about the short-term averages as well. But overall, the trend is still negative. I don't see this, bouncing back towards the previous swing highs of quarterly or yearly charts, which is around 150. So I don't see those targets at this point of time. However, it can still go up till 122. That is my short-term target, and I'm not looking beyond 122. So probably hold on for some time. Once you get your price, book out, and you can switch to some other stock.
Okay, hold the price comes and then maybe you can book out of this one. That's a word on the technicals. Let's move on to the next query. We have P. Srinivasan, who's writing to us from Coimbatore. He's holding 1,500 shares of HFCL. Price is 30 rupees per share. They're making a profit on this one. Short-term outlook for the stock, Shaina. Is it time to get out of this one, book out your profits? They've bought it at 30, right? So they're making good profit on this one.
Wow, very nice. They've really caught it at the right time. But at the same time, I think if you see last 6 months, the stock has gone up by almost 3 times, 300%. And if you look at it and compare it to the short-term valuations, medium-term valuations, it does start looking expensive. But at the same time, if you are a long-term investor, then yes, having gotten at a good price, you continue to hold. They've got a very good order book position, and if they're able to execute it over the next 1.5 year, yes, the stock should start looking attractive. So I would say you can take some money off the table if you like, and then relook at it if there is any further correction, or then hold it for the very long term, because there is a lot of investment, as we discussed, that is going on into data centers, into capital investment, and both domestic as well as global. Also, defense is becoming an additional segment that is there for fiber optics. So I think you can continue to hold if you're a very long-term investor, or take some money of some part booking of the profits.
Part booking of the profits, but you can hold for the long term. Somil, in the last year, the stock has rallied 143%, right? And he is making a handsome profit on this. What's your view? Should he book some profits or continue to hold it?
I think for long term, definitely hold on to it. In the very short term, keep a strict stop loss around 187. So 187 is 20 daily moving average. This stock is still moving up, still making higher tops, higher bottom, holding on to all the averages, even the 10 daily moving averages today. This stock has taken support at 10 daily moving average and again started moving up. So I would hold on. 187 would be my stop loss, and you can hold on in the short term, in the medium term, in the long term, all 3 time frames.
So you can hold in the short term, long term, medium term, in all three time frames. But the point is to hold the stock. The next query is coming in from Augustine Thomas, who's writing to us from Bangalore. He is a retired person and he holds 300 shares of Pine Labs at 148 rupees. He is making a profit on the stock. The stock is currently at 160. And he wants to know if he should continue to hold, sell, or add more shares at current levels. Shaina, he is retired. So at this point, what do you think he should do with his holding in Pine Labs? What is the fundamental looking like?
See, I think, there's a lot of 6 months are over since the IPO. So we are seeing a lot of institutional selling as well as buying also is coming on the other side. So there is a bit of change of, the stock between hands, between strong hands, I would say. And this could continue for some more time. So we could see the stock consolidating, sometimes a little bit up and down. It is, of course, below the IPO price and valuations are still, in my view, expensive, which limits the upside in the very short term. If you look at valuations, EV by EBITDA is about 30 times FY28 in my view. And if you compare it to turnover, it's about 5 times. So I think in the next 6 months, it should consolidate. Overall business prospects for the very long term remain stable. So I would say hold with stop loss.
Okay, hold, but with a stop loss. That's a word in the fundamentals. Somil, I know technically on the charts there's not much data, but do you have any view on Pine Labs?
Yes, there's not much data. However, in the very, very short term, a small triangle pattern has broken on the upside on the daily charts, trading about 20 and 40 daily moving average. Good stock at the moment in the short term, 7% up, I think. And the stop loss should be around 148 itself. Sorry, 146. And my targets in the very short term would be 180, 185 levels. So you can hold on to the stock in the very short term. But in the for medium to long term, I think you can go with the fundamentals.
Okay. Medium to long term, go with the fundamentals. On the charts, there's very less to read, but Somil has given us a short term target, 180, 185. Keep the stop loss that he's mentioned as well. So do that. And yes, that's a word there. But that's the last query for today. Somil as well as Shaina, thank you so much as always for joining us on the show, helping us answer all those stock related queries that we've received. So thanks so much for that. But viewers, thank you so much for tuning in. Do remember to email us your queries, send us your queries on WhatsApp as well. And the email address as well as the phone number will be at the top of the screens for you all. So do send it to us. But with that, thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade. So don't go anywhere.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng has recovered from the initial lows, is now trading with gains of over 0.5%. Although the Taiwanese index is continuing to witness some profit booking.
It's an international waterway. No country is allowed to charge tolls or fees on an international waterway.
Now back in the green now, 23,850 guys on the Nifty.
India as a whole has done pretty poorly. I was looking at the 42 major indices that we track.
We expect that the Q1 forecast that we had, we are in line with that at the group level.
It's also about the slowing automotive and industrial demand from China and various parts of Europe that seem to be impacting the market.
Banks are going to be allowed to offer differential interest rates based on the deposit side and the tenor of the deposit.
We've recovered at least a third of what we lost in yesterday's trading session. So the bulls would be happy for that, and also for the fact that we are trading at the highest point of the day.
Nomura has a neutral call and target is 402 rupees per share. It says market share gain, margin discipline and non-cyclical growth remain key priorities as far as Tata Motors commercial vehicle is concerned.
The Nifty has gone ahead and reconquered the 24,000 mark.
The Indian IT companies have been seeing low growth for the last 3 years, and they say that this AI deflation will continue.
We started off in the green, saw a sharp dip, and once again we are back near the day's highest point, and the broader markets are comfortably outpacing.
Well, that was the day so far, and such a strong day it's been. 1% up now on the Nifty and the Sensex. The Nifty above the 24,050 mark. Buying seen in blue chip, IT and banking names. The Nifty IT index rebounds 2.5% after a 5% decline in June. 26% fall since the start of the year. And banks, large cap private sector banks right on top of the heap. You're watching Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Prima Tendulkar. With me is Nigel. And Nigel, the other very supporting factor is the continuous decline seen in crude prices. I think that Brent crude level should come up for you on your screen. It's sub 76 now, and this is the lowest level that we've seen since the war began.
Well, that's right, Rima. Very important point, because we track the equity markets, but otherwise the Brent crude prices are important. And the rupee earlier today, it showed signs that it wants to go closer to around 95. From there, it's pulled back a little bit, which is good. And this is in the backdrop of the dollar index strengthening. So both those two cues are extremely important. Brent crude prices sub $76 per barrel mark, and the rupee showing signs of stability after initially, showing some weakness. So I think hopefully, Rima, it's time to perform after underperforming. And your tech stocks, actually, they made a comeback. But that's, they've been very, very volatile. They've been trading with a bit of a negative bias for the last few trading sessions. But today, it's up close to around, I think more than 1%. And that's outperforming 2.3% now, outperforming what the Nifty is doing.
Well, indeed, we'll talk more about it, what's driving the up move, what brokerages are saying. For now, let's get you through the top stories at this hour and how the next 1 hour is going to shape up. Markets shrug off tentative global cues to trade strong. IT is the top gainer, banks outperform, and the Nifty is sustaining comfortably above the 24,000 mark. The broader markets relatively underperform. Trend is your top Nifty gainer today. The stock has surged over 4%. Motilal Oswal reiterates their buy call on the stock following the commentary at the company's AGM. We'll get to the details. And IT, contrasting brokerage views coming in from JP Morgan and Axis, but the street is looking at the positives. The stock is surging, and Axis Capital today has upgraded 8 IT stocks, while 3 of them have seen a downgrade. The other pillar of support are banks, outperforming as RBI has released the FAQs on the FCNRB scheme. The rupee is also gaining, so we'll get chatting with Ritu. For now, let's talk about last hour trades. How should you position yourself? Rahul Mohinder is now joining in. Rahul, a good comeback for our markets after yesterday's fall. From here on, we're still in that range. That 24,200 mark is still the resistance that we have to conquer. But it's a good day. What's the trade?
Yes, absolutely. I think it's a welcome comeback. In fact, there was a lot of fear looking at that close yesterday. But, are we out of the woods from a slightly bigger perspective? No. I mean, like you said, 24,200 is the near-term hurdle. But I kind of expand that picture. Look at the last 2-3 months of data. We're just not able to get past 23,500, 600. That, for me, is going to be something more relevant from a slightly longer term perspective. So I think we're still in the woods. We're still going to be sideways. It's the stock specific action. And like you were earlier pointing out, the banks are the ones making a comeback. And even when I look at the internals, it clearly looks like the Nifty Bank is the one that might just outperform. In fact, I'd peg the Nifty Bank going past 60,200. And, one could continue holding or getting into the Nifty Bank with a 57,600 stop loss in mind. Coming to some stock specifics and this view in line with this view, I would say HDFC Bank, after a huge, phase of downward price action, there is some sigh of relief. There are some signs technically of some indicators exiting oversold. I would clearly look at 812 if I'm a short-term trader, keep a stop loss below 775. Another two on my list would be Bajaj Finance. I'd look at the stock moving to about 1,070, keeping a stop loss just below 948. And finally, Tata Communications is another stock which makes it to my list today. I'm looking at 2240 as a near-term target. But if you have a little bit of time in hand, I think the stock is actually headed closer to 2,400. I'd keep a stop loss of 1940 for a near-term trade.
Okay, got that. Thanks a lot for that, Rahul. We'll keep all those stocks on our radar. By the way, from the broader markets, a few stocks are showing some bit of traction. Hey, Madhuri Chemicals, I think that stock has spiked up in the last few minutes. A good move is what we're seeing out there. Stovecraft continues to do well. That stock is now up close to 2.5%. And I think this month it's up close to 25%. A rank underperformer that's perked up a little bit. And from the Welspun Group, the Welspun Specialty Steel, keep an eye out on that stock. It's been rallying in the last 2 months or so. And as we speak, it's moved back into the green. It corrected, I think, close to 15% from the recent peak. And Welspun Specialty Steel, that's the stock that's moved up as well. It should come up for you in just a bit. That's the one that's owned by Welspun Corp. Welspun Specialty Steel has perked up a little bit. But let's talk about frontline names. Trent has climbed to the high point of the day following a bullish note coming in from Motilal Oswal. Additionally, the management has highlighted the strategic store expansion plans going forward at their AGM. Mangalam's on top of all of that with all of those details. Mangalam, what an exciting sector you track.
It is extremely exciting, I must say, and which is why we go with FMCG is life. But tell you a little about Trent. The annual general meeting happened yesterday, and a fair amount of commentary that came in from the chairman. It was optimistic, nothing that the street does not know about, and just the fact that Noel Tata reiterated these things has enough for the street to be excited about it, and which is why Motilal Oswal as well, they've kept their target price or estimates unchanged, but they've just reiterated their buy. And remember, the stock over the last couple of trading sessions was consolidating, so it needed a reason to spike, and that's exactly what has happened. They've said that the company remains early in its overall growth journey. The opportunity that India has, especially from a consumption standpoint, retail, fast fashion, all these things are fairly big. And they are confident of adding 50 West Side stores, 200 to 250 Zudio stores, and 25 to 40 Star stores annually as well. And that's something that most analysts are baking in as well. Importantly, the medium to long-term opportunity that they've guided for, 700 West Side stores. The number right now is 300. So obviously they believe that this could more than double from here on. And Zudio also, from current 960 stores, could go all the way up to 5,000 stores over the medium to long term. So those expansion plans continue and have been reiterated once again by the chairman in the annual general meeting. Now, the important part to track from a Trent stock point is that they continue to aspire for early double-digit like-for-like growth. Remember, earlier the company had said that this number could be sustained at around 25%. And now between 15 to 20% is what the company has been reporting over the last few quarters. So early double-digit like-for-like growth, continuing that will be very crucial to track. And they are also looking to diversify into the international markets via Westside and Zudio over the medium term. So what are these international markets that they go into, and how their success pans out there will be extremely important, largely because in the international market, while the opportunity is big, the competition is equally strong as well, and the runway for growth is a lot more in India than abroad. So let's see how these two strategies of the company pan out, along with all the other formats that they are seeding, which includes the likes of Samo, which is the ethnic wear business, or Burnt Toast, which is streetwear. So all these factors doing well for them, management sounding confident once again, and the street trying to show its belief. The stock up 4%.
Well, indeed, thank you very much for that trend. That's the big mover. And separately in the news, in the retail news, Amazon CEO Andy Jassy is also in India, and he's talking about expanding Amazon Now. That's the quick service, the quick service offering of Amazon to more than 300 cities. He wants to build India's largest delivery in minutes network. He goes on to say that Amazon Now has become the fastest growing e-commerce business unit within Amazon India's history, with orders having doubled every quarter since launch. So Amazon Now going big on Amazon Now, which basically is competition for a Blinkit or an Instamart. Siddharth Khemka is also now joining in, Head of Research, Wealth Management at Motilal Oswal Financial Services. Siddharth, first, let's begin with trend. I mean, we all know the positives. Manglam was just telling us how the company has reiterated the long-term ambitions, etc., and it's been delivering on the numbers. But the question always is, when it comes to trend, companies like Trend, is today a good day to buy?
Hi, good afternoon, Rima. So yes, I think if you look at Trend, it is evolving from a Zudio-led growth engine to a multi-format retail platform, and that is something that is definitely positive. I think after last couple of quarters, several quarters of deceleration, we saw the healthy growth in Q4, and even our recent channel checks suggest that the sales decline that was being seen in some of the cannibalized stores, that has eased, and the like-to-like recovery is underway. So we expect a strong runway of growth ahead for Trent. The management seems to be very bullish, and they are seeing so some of the highlights was that they see potential for 700 West Side stores compared to 300 that is right now. For Zudio, the potential is up to 5,000 from currently about 960. So I think there is definitely a long runway of growth ahead, and in retail channel, the way they have shown the strong execution, I think that is something that we need to give credit to them. And the company has proposed fundraise, which will support warehousing, technology, AI investments. So I think some of the key things that is that the store economics and the discipline expansion, that will be the key for the stock to continue to do well. For now, I think, as I said, valuation looks comfortable. We are factoring around 18 to 20% kind of earnings growth for the next few years. And hence we believe that while today there is a sharp uptick, this is a stock to gradually accumulate whenever the market gives an opportunity, and we see consistent compounding, 15 to 20% compounding over the next few years.
All right, that's a consistent compounder. That's Trend for you. Let's talk about IT, because here Axis has come out with a note on the IT sector, Axis Capital, and they've got an interesting take. So Nigel, they're saying that AI is not the reason why IT is underperforming. While IT has underperformed, growth has slowed down. They say the problems for IT began even before AI became mainstream. It is on account of, there was so much disruption, spending generally, macroeconomic volatility. That's the reason. AI may have only compounded it. Secondly, the argument is that many of these big companies have spent so much on AI, on infrastructure. They need to make money on it.
Yes.
Just by offering coding productivity, by saying that, oh, with mine, you can do coding for free, that is not going to be enough. They will need, you need to expand the offerings. So if you want to do, transformation for any enterprises, you can't do it directly. You will need the help of IT companies. So that's the second point that, Axis Capital is making. And the third one is that from FY24 to FY26, the top line growth of large cap IT companies was only 2.1%. But the EPS growth was double digit, close to about 10%.
Okay.
So even if you assume that revenue remains weak, there is a case for the bottom line to do very well. So on the whole, Axis Cap is fairly bullish. Today, they've upgraded 8 IT stocks, and that list will come up for you on your screen. TCS, Infi, HCL Tech, LTM, Persistent, Coforge, Hexaware, Zensar. The one they're most bullish on is Coforge, where the target price is about 60% plus from where we are currently at 2,140. And they've also downgraded 3 names. That's Wipro, Tech Mahindra, and Infosys. So that's the call coming in from Axis. Though JP Morgan today is still sounding
very cautious.
Yeah, they've been cautious, and they're still saying that things are, it's going to take a while before things actually improve. So they're expecting about maybe 2 years more of a very low growth period for the IT companies. So that, when it comes to IT in an AI era, the street is always divided. Where do you stand? You can make enough arguments on both sides. There are enough people batting saying that valuations are comfortable and therefore, these companies, they don't face an existential crisis. They will be needed. They will do well. But there are enough who can counter that. Where do you stand at Moti, and what are the stocks you would recommend today?
Definitely, I think a lot of discussion going on around IT since Feb this year. And so we are clearly, in the near term, we are clearly on the underweight or negative side on IT. We believe that the growth expectations for FY27, which were earlier at about 3 to 5% for large caps before Q4, has now been reset at about 1 to 3%. And even the recent earnings down, the outlook downgrade by Accenture, that is also a bearing on a much softer Q1 for the Indian IT companies. What we believe is that while there are other several challenges, the AI deceleration is there for real, and productivity gains, whatever is being seen, is being passed on to clients. So that is compressing the current growth in these companies. So clearly, in the near term, we see softer growth, at least in Q1, Q2, and maybe gradually some of the companies which are having strong growth. I think that is where you can focus on. Valuations have come off, but I think bearing some occasional buying interest in the market, largely we believe that the sector could remain under pressure for some more time. What we believe a bottom-up approach would be much better in this environment, given that the earnings visibility is very low in the near term. Stocks like Coforge, KPIT in the mid-tier, HCL Tech to some extent is something that we like in the large cap space.
Got it. Okay. All right. Well, a quick word, Siddharth, on these metal stocks. Today they started off in the red, but gradually there has been some buying from lower levels. What supports these companies is that balance sheets are in far better shape, across the board. 10 years or so ago, you'd still get dicey because, when the cycle turns, then these guys are sitting with big loans. But now their balance sheets are in far better shape for the kind of scale that they've gone to. Any of these metal stocks you like, from the ferrous or the non-ferrous pack, because they have seen a decent correction. Nalco, from $450, it's come down to $350. Vedanta Aluminium, from 530 rupees, it came down to 450 rupees or thereabouts. Hindalco as well has corrected 15%. And similar is the case with regard to the ferrous names. SAIL at 200, everyone liked it. It's at 170 today. What's your view?
Yeah, I think, Nigel, we discussed the entire metal pack several times, and we remain constructive, positive on the metal cycle. We believe that the next few years would see a strong earnings upcycle for the entire metal pack, largely led by the base industrial metals, which is your copper, zinc, aluminium, and then maybe followed by the ferrous side. But I think the recent near term, if you see last few months of sharp outperformance from metals, plus the fact that there is a dollar index which have moved up after the West Asia peace deal announced. So there is some bit of profit booking in the near term, but we believe that the Q1, Q2 earnings for some of these metal packs, especially on the base industrial side, would be pretty strong and much ahead of what the street is expecting. So companies like Hindalco, which is our preferred pick in the non-ferrous space, we have a target price of 1280 there, which is almost 20-25% upside. Q2, Q3 onwards, we'll see the new capacity expansion also kicking in Novelis, which should drive strong earnings growth there. Some of the other base metals in the copper and zinc space that could do well. I think National Aluminium also figures out well now that there is a fair bit of correction in the stock. I think it's become attractive. Same for some of the ferrous side. So what we like Tata Steel, JSW Steel, as well as SAIL. So these are some of the picks, but I would largely remain on the non-ferrous side, with Hindalco being our top pick there.
Okay, let's talk about banks, because that's leading the recovery. The Nifty Banking Index is up 7.5% this month. ICICI Bank has rallied 9% this month. SBI up 8%. Axis Bank, HDFC Bank also up 6.5% to 7%. Now, today's news up-move can be attributed to RBI releasing a detailed FAQ, frequently asked questions, answering questions related to the recently announced FCNRB deposits, ECB, overseas foreign currency borrowings. Ritu joins in to explain all this to us. Ritu.
That's right, Reema. That bit of a rally you're seeing in banking stocks today, thanks in part to these clarifications that have come in from RBI, because there was some confusion among bankers about some of these provisions, and now RBI has come out with this clarification, which is overall being seen as positive for banks. The biggest takeaway is that Indian banks, and that includes their overseas branches, can now lend against these FCNRB deposits. They can also issue guarantees to overseas lenders, and they can also mark liens on all of these deposits that they raise. So in simple terms, overseas branches can now make fuller use of these FCNRB deposits, and that makes it easier for banks to raise and deploy foreign currency funds. In addition, RBI has also said that the swap facility is going to cover only the principal amount of deposits, clarifying that the interest component will not be covered. And very importantly, banks will be allowed to offer differential, that is different interest rates based on the deposit size and tenor of these FCNRB deposits, which gives them more flexibility to attract deposits with better rates. On the external commercial borrowing front, borrowings with the average maturity of 3 years and above, RBI says, will remain eligible for the swap window. The swap tenor, however, is capped at 5 years. Now, the street moves, sees all these as positive overall. For instance, there's a note from Jefferies that says the FAQs address the key concerns around both overseas branch participation and deposit pricing flexibility for banks, and they now expect banks to raise these deposit rates, especially for large ticket 3-year deposits. Citi even goes a step further. It calls these clarifications, a broader balance sheet expansion opportunity for banks, and they believe that now with these clarifications, the framework could attract even stronger deposit inflows than previously expected, particularly for banks that have a strong global franchise and execution capability as well.
Got it. Okay, all right, Ritu. Thanks a lot for joining in and neatly explaining all of that to us. Sid, what do you like from the banking pack? The markets feel good when these larger private sector banks do well because, it has a ripple effect, right? It supports the Nifty bank, large constituent of the Nifty as well. So the headline indices, they are supported. When you have the likes of HDFC Bank, ICICI Bank, Axis Bank, all of them doing well. But what do you like?
Yeah, Nigel, I think that is a big relief that the biggest segment of the market, especially the Nifty, has now started performing. And I think the policy front has been supportive. The clarification from RBI only helped to support the argument that this year we could see a strong deposit growth coming in from these FCNRs, and what we are expecting about $35 to $40 billion of deposits that could be garnered through this FCNR deposit scheme. Some of these large banks, they have been struggling in terms of share price for the last couple of quarters. But now I think the credit growth improving and deposits also kind of seeing that kind of growth, we believe the large banks will do much better. And I think some of them have a decent franchisee in overseas as well. So ICICI Bank and SBI are two preferred picks. HDFC Bank now we believe should start delivering on both performance as well as in terms of stock price movement. I think within the mid-cap space, Federal Bank is one which has a large base in some of these countries where you can garner the foreign currency, especially given that they have a strong presence in the southern India where you have a lot of money coming in remittances. So I think that is another mid-cap bank that we could look at is Federal Bank.
Got it. Okay, all right. Thanks a lot for joining in. Federal Bank is the bank that Sid likes. Appreciate you joining in, Sid, discussing all those ideas from across sectors. Have a good remainder of the day. Talking about banks and financial stocks, actually pull up Chola. That stock, I think in the last 2 weeks, I was reading a DAM Capital note and they were saying that their ground checks indicate that things are improving on ground. And Chola, I think the stock was around, 1,450 or thereabouts, just around, less than 10 sessions ago. From around 1,450, the stock has moved all the way to around 1,800. That's a big move for that sort of a counter. So strong move is what we're seeing on Chola Investments as well. But let's turn our attention to the F&O pack. Well, it's looking quite good actually in terms of cues. Remember this morning when we had covered trade setup, we said that yesterday we fell, but the need to worry was actually less because the institutions were not sellers and there were some mild shots that were added into the system. Now take a look at what's happened today. Both the opening batsmen, so to call it, for the Indian markets, they have done well. The tech pack is in top form, 2.3%. It's pulling back some of those losses. And the Nifty Bank is doing very, very well. And the larger banks actually have come to the party. HDFC Bank, a big underperformer for the last few years. We had some news flow as well that came in for Ritu. That has come in for a bit of a short squeeze because the stock is up 2%. You have open interest as well that's low out there. So that's clearly a bit of a short squeeze that's taking place. And there is some rollovers that we're seeing on HDFC Bank as well. ICICI Bank, there is some signs of fresh buying on that particular counter. So good move is what we're seeing. Open interest up close to around 10%. And on a couple of other underperformers coming in from the Tata Group, whether it's Trent or TCS, both those two have corrected a good deal from the top. They have come in for a bit of a short squeeze in today's trading session. And the India VIX, it had popped up from around 13 to around 14 overnight. That is by the end of yesterday. Today, it's cooled off yet again. Normally, you have an inverse relation between the two. So the Nifty moves up. You have the India VIX that cools off. The PCR has moved to around 1.2. Remember, earlier today, it went down to around 0.85 or thereabouts. That's because the put writers have come back into play. 23,900 put. Take a look at the premium. From 190 rupees, it's come down by half, closer to around 100 rupees or thereabouts. Similar is the case at around the 24,000 put. The premium was at around 250 bucks. That's come down to around 145 rupees or thereabouts. So, the writing at around the 24,000 put tells you that the bulls believe they can defend 23,250. 24,000 minus 250 or thereabouts. But I think the Nifty is still in that range. It needs to conquer the 100 DMA, which is at around 24,200 on the upside. And the reference point on the downside is closer to around 23,600, which is at around the 20 DMA. So we'll need to breach this band that's clearly mentioned for you on the screen to see a further move. You'll have to bet on the Nifty Bank actually taking us above that level because leadership is coming back from the likes of HDFC Bank, ICICI Bank, Axis Bank. All of them finding their form will be good news from a banking perspective and the market's perspective as well. That's about the FNOQs. Time to slip into a short break. On the other side, we have Aman Chaman of Abacus Asset Manager who's waiting for us. Stay tuned.
Welcome back. Markets holding on to gains, 1% up. But let's talk about individual movers, where we are seeing a lot of momentum. Hormus, as always, joins in with the buzzing stocks.
You know, a lot of frontline names that are doing well in today's session, and Indigo is one such name. The stock has snapped a two-day losing streak today, and you take a look at the stock is up around 4.5%. The premiums on the 5200 call option too, they have more than tripled in value, is up almost 270%. The volumes today as well are fairly decent. 14.5 lakh shares traded today so far, 20-day average of around 8 lakh shares, and close to 60% of those are marked for delivery. And with this move today, the stock is back above its 200-day moving average as well, which was above the mark of 5,000, and therefore it has recovered all the losses it made during the Iran war, and its market cap is also back at the 2 lakh crore rupee mark. Now, JSW Infra is among the top movers in the broader markets today. The biggest single-day jump that the stock has seen in over 2 months, this 9% move that you're seeing. In fact, over the last 10 sessions, the stock has gained in 7 out of them. It has launched a QIP, mind you, currently ongoing to raise funds, and 3 crore shares have been traded so far. The 20-day average is around 30 lakh shares, and 42% of those shares are marked for delivery as well. And this move, the outperformance that it has had recently remains above all of its key moving averages, and the stock is up around 20-25% in the month of June, turning out to be the best month it has had since March of 2025. And the next level to watch on the upside is the 52-week high of 349. And lastly, the one frontline name that has been very resilient in this market consolidation / fall has been ICICI Bank. Today too, among the top contributors to the Nifty Bank gains, and in fact the index gains as well. The stock has gained in 10 out of the last 13 trading sessions. Premiums on the 1370 call option today too have gone up almost 4x in today's session. Over 1 crore shares have been traded today, in line with the 20-day average, but 65% of those shares are marked for delivery so far. And among the top traded stocks on the Nifty 500 today, back above its 200-day moving average as well, which is 1345. And this too, similar to JSW Infra, is seeing its best month since March of 2025.
Got it. Okay, all right. Thanks a lot for that, Hormus. Well, let's welcome Aman Chavan, fund manager, Abacus Asset Manager, who joins us on the show. Hi, Aman. Good to see you in. Aman, the last few days, these chip makers, the AI trade, that's got a little bit nervous. What are you all making of it? You know, the optimist in me says India should do well from here on, you know, because we didn't participate on the way up, and now that's unraveling a little bit. You know, the SpaceX IPO as well listed, and then it came back down from space. What are you making of the entire moves you're seeing on the globe? And do you think India actually is much better placed now?
I think the move in India is more to do with oil than to the AI trade or the Korea markets seeing a correction kind of thing. Clearly, we were the worst impacted when the crude went up, and now it's below 80, almost 75 levels, which is a very decent level, or rather a manageable level in that sense. And that, I think, has got the investor interest back to equity markets. And yes, relatively, we have been underperformers. So you can say all the right ingredients for us to continue to do well if oil stays where it is.
Oil has cooled off. That's the big trigger. Got that. How do you play this, though? If oil cools, will you buy any of those stocks? You know, Interglobe Aviation, take a look at that. The flash was telling you on the screen, I think that's 2 lakh crore of market capitalization. What a big recovery out there. The market leader, you know, a lean, mean machine. How you're playing it? Aviation stocks? Is it OMCs, paint companies? I'm just trying to look at direct beneficiaries of a cooling off of crude oil prices.
So, Nigel, what had happened is when the oil went up, we did not take a tactical call. We never had OMCs in a big way in our portfolios. We never had aviation. So it's not that we sold them because oil went up, and hence we are not buying them either because oil is down. The sectoral preference that we had, we are stuck around with that. So financial remains a big bet for us. Within that, preference today is private versus public. We had sold IT almost 6 months back and in no hurry to buy it back. So being neutral there. Pharma, we continue to be very positive. So that is something that we like, continue to add that. Renewables, we feel, can be a new theme. Solar, wind, both look good from that sense, because in this current environment, I think the government policies has to be pro-renewables. So that is something that can get re-rated. So broadly, just held on to what we had predominantly before the war, holding on to the same names right now, seeing a recovery along with the market. So that's had kept it simple in that sense.
Aman, hi. Afternoon, Rima here. I believe you all were overweight on metals. Am I Remembering, yeah, but metals are now unwinding. We've seen the dollar index surge. There are expectations that there will be a rate hike towards the end of the year from the US Federal Reserve. And the Nifty Metal Index, just as a barometer, down 6.5% this month, 10% gone from the recent 52-week highs. What is the call you're taking on metals?
So we have not changed any stance. Yes, you are right. $97 index is now 101, headed maybe slightly higher also, maybe to 103 levels. That is when the Trump got elected. It will be a near-term move. Overall, we feel metals should do well because ultimately, if China demand has to revive and China has to handle the metal prices, then broadly, we feel that metals should continue to do well. We are more positive on steel than other metals this year. Last year, even aluminum is something that we have added in the recent times versus last year when copper and precious metals did much better. So stance remains positive for metals for now.
You all played that special event as well, right, in metals? Among the conglomerate that demerged, which part do you like right now? Which are you most bullish on? You like steel is what you said. Out here as well, there's a small steel component. Will you all hold on to that asset or are there other bigger steel companies that you like?
So we have other bigger steel companies since multiple years now in our top 10 holdings. So continue to hold to them. Besides that, aluminum is also looking good to us.
The conglomerate, you all have played it as a tactical play or you're holding on to it?
We are holding on to it. So we invested in long back and continue to own it.
Oh, that would have been a beautiful, beautiful move for you all because even if you bought it one day before the record date, you still got a 25% return, sum of all parts out there. And as you're saying, you all got in early, so the returns would be good and you're holding on to that. You briefly mentioned renewables. Which part of it are you all playing? I mean, what pocket, if you could give us a description? Solar, wind, earlier today we had CleanMax. That's a different business model that they have, the C&I. Which part of the renewable theme do you like?
We like both solar as well as wind, but preference is solar over wind. So our exposure is predominantly in the solar space.
Solar space. Got that. What else are you incrementally adding? You've given us broadly what you like right now, financials, etc. But every dollar rupee that you're getting, where is that going?
So domestic manufacturing is a theme. So anything related to that is something that we're adding. I mentioned pharma, both the global generic players as well as the CDMO players. Both that space looks good to us. So we're adding more of pharma. And besides the normal banking. In banking, as I mentioned, NBFCs over banks, and within banks prefer private banks over PSU banks.
What is a complete avoid for you right now? Is there anything?
IT, no hurry to buy IT as of now. So that is, you can say, kind of a complete avoid.
And from the financials, from the NBFCs, which part do you like? The vehicle financiers, the gold financiers? Because the street is picking and choosing what they like. There are plenty of opportunities out there. One argument we heard last week is that these NBFCs are going to grow at a faster clip in comparison to the private banks. So they demand a better valuation, which that valuation gap actually had narrowed between the two. So from NBFCs, what is your preference?
That's always been the case. If you see the larger NBFCs, growth rate was even higher than banks, and that is the reason they trade at a premium. We are spread across. So we have housing finance also. We have non-fund based financials also, like a wealth management company or a capital markets linked company. So we are spread across. We don't have direct exposure to gold loan NBFCs as of now. In the past, we used to have. Right now, is a very small exposure that way. So it's spread across. There is no specific preference. It's more stock specific than a sectoral call per se.
Got it. The point that I was mentioning is we had a sell-side analyst who joined us in the studio. They said that obviously those NBFCs get a premium in comparison to private banks. But of late, they have noticed that their valuation gap narrowed, which they believe should expand yet again. So that was the point that I was making. Appreciate you joining in, Aman. Thanks a lot for giving us your views on various sectors that you like. Pharma, steel, those are sectors that you like. IT continues to remain in a void. And renewable energy is something that you like as well. We catch up soon, Aman. Thanks for joining in.
Thank you.
Well, I think it's that time of the show when we can get Nimesh in to tell us what is he picking up on D Street Chatter. Nimesh, yesterday people went home a little bit sad, but today the green is back on the screen. What are you picking up?
Absolutely, Nigel. So again, it's very volatile, as you rightly pointed out. Yesterday's fall was unexplained, and today's even up move is unexplained to some extent because there is no specific reason
for yesterday's fall and for today's gain. From a flow perspective, again, a mixed day with a positive buy. So, but again, it's not like there is a very large buying to say that there is a Nifty rally of 200 points only on back of that large FI buying. There is buying, but it's very selective, largely into some select IT names, and financial as a theme that stands out in terms of flow. So these are two sectors where there is a bit of buying in today's market. Technically, I think another 200-300 points from here on, and you will see further short squeezing squeeze. So that's the level to watch, 24,300, 24,350. About that, on a closing basis, you might see further short covering. But I guess today's up move largely, I guess, is because of that the crude has fallen a bit more. Macro looks a bit easy, and there is a bit of momentum back. So clearly, yesterday's fall was explained, so is today's up move.
Got it. What about individual stocks?
Well, the broader market momentum seems to be quite strong, right? So the first stock is Pine Labs. Big move on that name. For the last 2 days, there are blocks happening, and I guess today's block was a clean-out trade. And at least a couple of large influential investors have been active buyers in Pine Labs of late. So that's the reason why an up move in that name in today's market. The second stock is Capri Global. Again, a large block in today's trade. Nearly 1% equity got changed hands. I believe one of the leading global long-only fund, FI, was a buyer in today's block deal. So any disclosures could be interesting to track in Capri Global. The third name is GMR Airports. Again, a stock where we're seeing very strong delivery-based buying in today's market. So I'll watch out for the delivery stats very closely. But my sense is there is very strong buying from larger FIs in GMR Airports today. And the last is Innova CapTab, a small company, not small though, but 5,000 crore market cap, a bit thinly traded. But I believe there could be a large block deal in this particular name very soon. But let me clarify, it's not the promoter entity which is selling. So it's a non-promoter entity which is going to sell a block, and that's something to track in Innova CapTab.
Got it. All right. We'll keep an eye out on that one. Innova CapTab, I think over the years, the stock has gone up quite well. But as Nimesh said, thinly traded, but we're expecting a large trade, not from the promoter group. Well, we'll slip into a short break. You come back, we'll continue our focus on markets. We'll also get you some trading ideas. Stay tuned. Well, we would like to go home closer to around 24,100, but it appears from higher levels there is some profit taking that we're witnessing. NTPC, that's moved to the low point of the day. I think we should get that one up for you on the screen. BEL has also come in for some profit taking. So pull up the intraday chart on that one. And Bharti Airtel, that's a larger name in there. That as well has moved to the low point of the day. Explains why we've slipped a little bit from the top. Rahul Mondar joins us to help us out with a quick couple of picks. Rahul, if someone bought, the intraday dip that we saw earlier today, what would you do? Take money off the table and also fill us in with a fresh couple of trades?
Well, just going with that question from an index perspective, well, if it was a Nifty, yes, we're at a hurdle, 24,200 odd, very strong short-term resistance. Thereafter, we're looking at 24,500 odd levels. So I think from that perspective, yes, but the Nifty Bank, as I was expressing earlier, that continues to look good. So I'd still hold on to that. Coming to stock specifics, let's look at banking first. So AU Bank, that looks pretty good. Very robust price move it's made today. I think the follow through will continue to about 1120. That's the target I'd peg it for. So keep that as a buy with a stop loss of 1,030. Another stock which fills my radar today is a stock called Delivery. And the reason I like that stock is if you look at, since about June or July 2023, we've not been able to get past 490. I know we've not done that today. But why am I bringing this up? If you look at the last 3 days of volume, well above average. The price move is suggesting a breakout. If you look at the weekly volume, we're not even done with the week. And we're probably going to end up with one of the highest weekly volumes too. So I think we're shaping up for slightly bigger breakouts here. But if you're a short-term trader too, 520 could be a reasonable target you buy for, keeping a 460 stop loss.
Okay, got it. Thanks a lot for that, Rahul. We'll catch up with you rather soon. Well, time to welcome, I think, Sudarshan, who's joining in. It's a steady day of gains for Tata Motors commercial vehicles. Management has marked potential for double-digit margins and 40% market share. Sudarshan, sorry, just want to give our viewers a sneak peek into that. But you give us all the details.
So yesterday we were talking about Tata Motors commercial vehicle after company held the investor day, and we had given all the details that company had presented regarding FY28 outlook. But just reiterating the same fact, for market share, company is targeting domestic CV market share of 40%, and that's an increase of almost 500 basis points from the current market share. As far as margin is concerned, company is saying that in the entire cycle, margin is expected to be in double digits, and if there is an up cycle, that it can be in the teens. If you talk about investment, it would be in the range of 2 to 4% of total revenue, and on ROCE the range is 30 to 35%. Company has also talked about the opportunity after Iveco acquisition. If you remember, last year company had acquired an Italian company, Iveco, and now that acquisition is expected to be completed by Q2 of FY27, and post that company believes that there is an opportunity to become number 4 CV player globally. Now after that, today brokerages have come out with a note. First one is CLSA maintains outperform call target here is 527 rupees per share. It believes that new product launches will aid market share gain for company. HSBC 2 maintains positive stance with a buy call target price is 490 rupees per share. It says the near-term demand remains very strong. Competitive position at MNCV also is very strong, and underperformance in LCV seems to have bottomed out. Nomura though maintains neutral call and target is 402 rupees per share. It says market share gain, margin discipline and non-cyclical growth will remain key priorities for Tata Motors CV.
Thank you very much for that. A sector which is doing well across the board are the textile names. So whether it's Trident, Gokuldas, KPR Mills, Arvind, SP Apparels, Banari Spinning, all gaining in trade. Now, Motilal Oswal has also come out with a note today. And they believe the narrative around the textile sector is changing. Devyani joins in with details on this.
Well, the Indian textile space is all buzzing today, and it's not because of a single event, but the strengthening investment narrative around the entire Indian textile exporters. Now, Motilal has come out with a coverage on the textile space, and it says that after a flat and volatile current year 21 till 25, textile demand has finally started stabilizing. The key reasons for that include India emerging as a major sourcing alternative against China under the China Plus One strategy, with Motilal emphasizing on the supplier consolidation, which favors larger compliant players with streamlined audit processes over the smaller ones. And the upcoming implementation of the UK and EU FTA is also expected to eliminate or reduce import duties on the Indian textile and garment exports, which will be a big boost for our exporters. Now, reduced tariff uncertainty is also positive for textile companies, with US tariffs having normalized around the 10% mark, while competitors are largely still facing around the 20% mark tariffs. Now, the major US retailers have also largely completed their inventory correction cycles after 2 to 3 years of destocking and are resuming their regular ordering cycles, which is a direct positive for our exporters as well. In light of all of this, textile companies are now incurring fresh capex to grow their capacities, and Motilal has initiated coverage on this particular space, with Gokuldas, Arvind and Pearl Global emerging as their top picks in this particular space.
Thank you very much for that very comprehensive. Ashish Chaturmutha, Managing Director, Fund Manager at JM Financial Limited, is now joining in. Ashish, are you all betting on textiles?
Hi, good afternoon, Rima. So I think textile is definitely looking very strong, because we can say that after almost 2 decades, this space is entering into a very strong structural upcycle, and this is obviously driven by many factors. So obviously FTAs is one very big event which has happened, not just with EU, but EU, UK and Canada, and this is also going to put us from a tariff perspective in a very advantageous position. Second, with US, there is a trade differential of almost 7 to 8% tariff difference over China, and that is going to put us in a very advantageous position. Plus, there is a political instability in Bangladesh and Pakistan, which are the competing players in this space. So I think again India is going to be a key beneficiary of the situation which is emerging geopolitically. What we believe is that man-made fiber capacity is where the government is putting a lot of efforts in terms of PLI schemes, in terms of capacity expansion by some of the OMC companies. So clearly this is also going to reduce our import dependence, and ultimately we believe that the domestic industry itself is growing at almost 8 to 9%. So definitely we believe that the textile industry's fortunes are changing, and this is also getting reflected. Markets are also rewarding these names. So we believe, yes, structurally this space looks very, very promising from current levels.
Thank you very much for that, Ashish. We'll come back to you. For now, it's a break, but as we do that, we've got some very exciting and happy news to share with you. We're celebrating a big milestone today because CNBC TV 18 has crossed 5 million subscribers on YouTube, and that number, my friend, belongs to you. So it's a big heartfelt thank you to every viewer who's tuned in, shared, subscribed and stayed with us through the highs and lows of the market. So here's to many more milestones together and to telling India's growth story the way only CNBC TV 18 can.
Welcome back. Well, final few minutes of trade, but we still have Ashish who's with us. Ashish, what is your call on some of these pharma names? Pyramid Pharma and some of these other names, they have corrected big time from the top, CDMO players. Even Newland Laboratories went through a period of consolidation. What do you all like from the pack?
Hi, Nigel. So I think CDMO space is growing extremely well. If you look at one of the company like Navin Fluorine, its CDMO business grew almost 61% this year. So I think there's a clear growth visibility in terms of CDMO opportunity. I think there's some correction profit booking, but we firmly believe CDMO is going to grow at 18 to 20% kind of growth rate in terms of top line, whereas the EBITDA and PAT is going to grow much faster than this. And ultimately, companies like Navin Fluorine, SciLife, DV's Lab, and Newland Laboratories. These are the names which we like within this space, and many of these we are holding in our portfolio as a long-term bet. Even Laurus Lab is one stock, but it has done very well in the last 1 year. So maybe the risk reward at current levels is not so favorable. But from a longer-term perspective, even Laurus Lab on dips looks very, very promising. But at current levels, Navin Fluorine and SciLife, these are the two stocks which looks very good from the risk reward levels, even at current levels.
Ashish, Swiggy's corrected 3.5%. Eternal is down 1%. Amazon now is talking about a push to 300 cities and doubling down on quick commerce because it gave away the lead that it had to other companies. The e-commerce lead, which should have helped them in quick commerce, they sort of gave it away, the early mover advantage to other peers. But now they're making a strong comeback in this. What is the view on Swiggy and, at this level, or even in Eternal at this level? Is it a buy?
So for that matter, we are avoiding Swiggy because the amount of dark store additions which Eternal has done versus Swiggy is huge, and the way the competitive intensity is coming from Amazon, Zepto, it is going to further put a lot of pressure on Swiggy. So I think at current levels also, although the stock is trading near its 52-week low, but our sense is that the margin profile of EBITDA of Eternal versus Swiggy, there's going to be huge difference. So even if we have to take a bet in this space, I think Eternal would be a preferred bet. Swiggy is avoided at these levels. But broadly, we believe that this overall space is not going to do so well because of the huge competitive intensity which is there. So broadly, we are underweight. But yes, if one has to really take a bet in this space, Eternal looks much better than Swiggy.
Okay, got it. Well, we'd love to thank you on that note, Ashish, for joining in. Thanks for joining in on Closing Bell, and look forward to chatting up with you more often and discussing more stocks, particularly from the broader markets. Well, time to wind down the markets. Then we go with a gain of close to around 200 points. But what stood out today was actually the Midcap index was a relative underperformer. The headline index did well because we still go home with a gain of close to around 200 points. And both the pillars of the markets did well. The banking names, that's the IT, the Nifty banking index, that did well. And the Nifty IT index as well did put on weight in today's trading session. And the private banks, they came back into play in today's trade. So you had the likes of HDFC Bank, ICICI Bank, both of them did do well. Now, since things are returning back to normalcy and tourism should pick up globally, well, you had Interglobe Aviation that has spiked up. Not just that, ADF prices as well could be revised downwards. So that stock was up close to 5%. Trent posted its AGM, that stock was up 3.5%. Adani Enterprises was up 3.5%. A couple of brokerage notes as well did come in. They were quite optimistic on the stock. And from the tech pack, Tech Mahindra as well as Infosys, both of them were outperformers. A couple of these other names came for profit taking. Bajaj Auto was down 2.3%. You had Tata Steel that was down close to around 2% in trade today. And you had NTPC as well that was down in trade today. What did do well from the broader markets? JSW Infra flying away, 7.5% higher. Pine Labs, one of those sellers getting absorbed out there. So that stock did pretty well. Vedanta Group stocks, they've been all over the place. Vedanta Iron and Steel as well as Vedanta Oil and Gas, the two smaller players. Well, out there, both those two stocks went to circuit in the final 30 minutes, actually. They were under some pressure, but they popped up. Textiles was the way to go today. Pearl Global was flying away. You had Gokuldas Exports that did do well. Welspun Living as well was up and about in today's trading session. All those headwinds are turning to tailwinds. The street likes it. Those stocks, in fact, were flying away. Net, a pretty good trading session. The breadth of the market was pretty much even Stevens, but the big boys, they partied on the Loud Street today. Well, we'll wrap up on this edition of Closing Bell. Stay with us. The teams of Market Forward is coming up next.
Markets end near day's high with benchmark indices gaining nearly 1% each. The Sensex surged over 700 points while the Nifty reclaimed the 24,000 mark. Midcaps underperformed.
Shares of textile companies rally after Motilal Oswal initiates coverage on the sector with a positive outlook. The brokerage believes demand is finally showing signs of stabilization. It also highlights reduced tariff uncertainty and FTAs as key triggers going ahead.
Brokerages are sharply divided on the outlook for India's IT sector, while JP Morgan warns AI-led disruption could keep growth subdued for years. Axis Capital believes broader AI adoption will create fresh opportunities. The index gains over 2%. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vivek Iyer and with me is my colleague Ritu Singh. Well, Ritu, what a session we had. What an intraday rally that we witnessed, especially as far as the Bank Nifty is concerned, ending over 1.7% higher and a sharp recovery as far as the IT pack was concerned. We came in with slightly positive cues, especially as far as the Asian markets are concerned, with Korean markets rebounding, but there was significant volatility there. We too witnessed volatility, but managed to end the day with healthy gains.
That's right. Strong comeback for the markets after the kind of session we had yesterday. Nifty reclaiming that 24,000 mark and how ending up, pretty well with gains of almost 200 points in the Sensex, like you said, almost 800 points of gains. What we saw strong buying was IT. That was one pack that's shown in trade today, doing pretty well. Nifty Realty was also one of the top performers in trade today. In the IT pack, heavyweights like Infosys and TCS also did pretty well. Bank majors, whether that was ICICI Bank, HDFC Bank, they were all key drivers of the Nifty rally on the back of some of those news developments. So we've got you covered for the next 20 minutes with all of this action, the big news, the key developments in the last week, the top corporate voices and the events to track ahead as well. So let's get to it, Vivek. Here's the lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Hormaz Fatakia. Brokerages drove the action on the last week today. Fresh views emerging on IT, on textiles, Tata Motors, CV Business. We'll also break down the key calls and the stock prices very shortly. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So with that, our first segment of the day, Hormaz Fatakia joins us now from the big wall with all of the top movers and shakers. Hormaz.
It was a good day for the markets, and we recovered almost most of what we lost in yesterday's trading session. And a big courtesy that goes to financials in today's session. The big outperformers that were the banking names and the financial names. Look at AU Small Finance Bank as well, did very well, ending 4% higher. But it was the heavyweight banks that put their hand up today. Both HDFC Bank and ICICI Bank gaining 2.5% each. That was a principal contributor to the Nifty up move in today's session. And IndusInd Bank too putting in its fair share of gains as well. IT as a sector saw some rebound today, and this is despite contradictory reports coming in. Axis upgrading a few names, JP Morgan downgrading a few names. But look at Tech Mahindra, look at Infosys, TCS. Infosys and TCS were the big underperformers yesterday. They clawed back some of those losses. And Oracle Financial continuing its outperformance. Another 6% added in today's session. The only IT name that is still positive on a year-to-date basis. Real estate as a sector also did very well in today's session with Brigade, Phoenix Mills, Oberoi Realty. Of course, there was a news flow driven reaction, and Lodha too seeing gains of anywhere between 3 to 4% in today's session. KPR Mill at one point was up almost 18%, still managed to hold on to a double-digit advance, or not quite really, 7% higher on the stock. Pine Labs after the block deal ending almost 7% higher. IRFC with the OFS non-retail portion fully subscribed, but the stock not recovering from the lows. 6.5% knocked off here. And Tata Motors CV, some positive commentary coming in from the brokerages as well as from the management as well. Some of these capital goods names saw some profit booking in today's session. GE Vernova ended 7% lower. Hitachi Energy also not having a good day at the office. Neither did Triveni Turbine. Some underperformance coming in there. The fall in crude oil prices continues, and that is having a positive impact on a lot of these oil marketing companies. HP, BP, IOC seeing healthy gains in today's session. And lastly, stocks ending at 52-week highs. Sirma SGS continues to grow from strength to strength. Another 4% added in today's trade. Naveen Fluorine ending 3% higher at 52-week highs. And Federal Bank among the financial names having a good day at the office. Close to 2% added, but the stock at 52-week highs.
Well, thank you so much, Hormaz, for joining us and giving us a neat wrap of all the top movers and shakers in the session today. But one particular sector that you alluded to was the Nifty IT pack that saw quite a sharp up move today. And this is what's happening. There's a sharp divide emerging as far as the outlook for India's IT sector is concerned. While JP Morgan warns AI-led disruption could keep growth stuck in the low single digits, Axis Capital is turning bullish, arguing AI could actually create the next wave of demand. Rima now joins in with the key takeaways and the stocks at the center of these views.
Well, Axis does believe, but let me begin with JP Morgan, and their view is that enterprises are facing FUD, fear, uncertainty, and doubt. Tech budgets today are being redirected towards cloud, AI tokens, and less towards services spend. As a result of which, the Indian IT companies have been seeing low growth for the last 3 years, and they say that this AI deflation will continue, which means at least for the next 2 years, we will continue to see low growth. So according to JP Morgan, even mid-single-digit revenue growth looks quite tough for the large-cap IT companies, which is why they've gone ahead and downgraded their rating on 3 of the IT names, HCL Tech, Wipro, and Tata Tech. But Axis Cap has a different view. They've upgraded 8 stocks, downgraded 3 IT names, and they're saying that AI is not the reason why IT stocks have seen, companies have seen a slowdown in demand for the last couple of years, 3 years. They're saying the demand slowdown began even before AI became mainstream. Secondly, their argument is that these large AI companies, and they're spending so much money, the return generation that they need, the revenue that they need cannot be met by only providing coding productivity. So therefore, the way it will work is these large AI companies will work together with the IT services companies and enable broader enterprise adoption. There will be a role which is required for the IT services companies. And thirdly, Axis is arguing that these large cap IT companies, yes, they saw low single digit revenue growth, 2.1% USD dollar revenue growth from FY24 to FY26, but the bottom line growth was more. The EPS growth was double digit, close to about 10%. So they've done a slew of upgrades: TCS, Infosys, HCL, LTM, Persistent, Coforge, Hexaware, Zensar. But the one which stands out is Coforge, because here their target price is 2,140, and that's about a 60% upside. And their downgrades are for Wipro, Tech Mahindra, and Infosys. Back to you.
Rima, thank you very much for putting that into perspective. So let's take this discussion forward. We're now joined by Sudeep Bandyopadhyay of IndiTrade Capital, and with him, Ruchit Jain of Motilal Oswal Financial Services as well. Gentlemen, thank you very much for taking the time out for us. Ruchit, let's start with you. If you have a view on the IT pack, there are two sides of the market. One that believes the worst is behind, the other that believes that, the likes of Axis Bank, that this demand slowdown started even before this AI fear came in. In fact, they've upgraded some of these stocks. Where do you see, sectorally as well, this settling in the near term?
Yeah, hi, very good afternoon. Well, we have already seen a good price-wise correction in the IT pack from the swing highs which were there. So the momentum readings are also in oversold zone. So the price-wise downside now seems to be limited from here on. But it's too early to access where the bottom has been done and we would see the next leg of up move. Because generally what happens when we see end of such price-wise corrections, there may be some time-wise correction left. Hence, we may see some consolidation in the near term rather than any price-wise dip. So we think that IT as a space could go through some time-wise corrective phase now. We won't see much price at lower price declines from current levels, but rather some range-bound trading can be seen. So those oversold setups, I think, would get relief with minor pullbacks from here on.
Well, thank you so much, Ruchit, for your views as far as markets are concerned. Moving on, brokerages are now turning their focus to Tata Motors' commercial vehicle business, with the outlook for freight demand, infrastructure spending, and replacement cycles taking center stage. So what are the expectations? Sudarshan now joins in with the key details.
So yesterday we were talking about Tata Motors commercial vehicle after company held the investor day, and we had given all the details that company had presented regarding FY28 outlook. But just reiterating the same fact, for market share, company is targeting domestic CV market share of 40%, and that's an increase of almost 500 basis points from the current market share. As far as margin is concerned, company is saying that in the entire cycle, margin is expected to be in double digits, and if there is an up cycle, that it can be in the teens. If you talk about investment, it would be in the range of 2 to 4% of total revenue, and on ROCE, the range is 30 to 35%. Company also talked about the opportunity after Iveco acquisition. If you remember, last year company had acquired an Italian company, Iveco, and now that acquisition is expected to be completed by Q2 of FY27, and post that, company believes that there is an opportunity to become number 4 CV player globally. Now, after that, today brokerages have come out with a note. First one is CLSA maintains outperform call target here is 527 rupees per share. It believes that new product launches will aid market share gain for company. HSBC 2 maintains positive stance with a buy call target price is 490 rupees per share. It says the near-term demand remains very strong. Competitive position at MNCB also is very strong, and Underperformance in LCV seems to have bottomed out. Nomura, though, maintains neutral call and target is 402 rupees per share. It says market share gain, margin discipline and non-cyclical growth will remain key priorities for Tata Motors CV.
Sudarshan, thank you very much for bringing us that update. Let's now go across to Devyani. We also have textile stocks that gained in trade after Motilal Oswal came out with this report. It initiated coverage in the sector with a positive outlook. Now, the brokerage cited stabilizing demand after what has been a muted few years, and the reduced tariff uncertainty as the key triggers for tailwinds. Devyani is with us now with the key highlights of this report. Devyani.
Well, the Indian textile space is all buzzing today, and it's not because of a single event, but the strengthening investment narrative around the entire Indian textile exporters. Now, Motilal has come out with a coverage on the textile space, and it says that after a flat and volatile current year 21 till 25, textile demand has finally started stabilizing. The key reasons for that include India emerging as a major sourcing alternative against China under the China Plus One strategy, with Motilal emphasizing on the supplier consolidation, which favors larger compliant players with streamlined audit processes over the smaller ones. And the upcoming implementation of the UK and EU FTA is also expected to eliminate or reduce import duties on the Indian textile and garment exports, which will be a big boost for our exporters. Now, reduced tariff uncertainty is also a positive for textile companies, with US tariffs having normalized around the 10% mark, while competitors are largely still facing around the 20% mark tariffs. Now, the major US retailers have also largely completed their inventory correction cycles after 2 to 3 years of destocking and are resuming their regular ordering cycles, which is a direct positive for our exporters as well. In light of all of this, textile companies are now incurring fresh capex to grow their capacities, and Motilal has initiated coverage on this particular space, with Gokuldas, Arvind and Pearl Global emerging as their top picks in this particular space.
Thank you so much, Devyani, for joining us and giving us a lowdown on what drove textile stocks higher in the session. Most of the stocks from that particular space higher in today's trading session. Well, Sudeep, coming across to you, Devyani just highlighted quite a few of the triggers as far as the textile space is concerned. Are you positive on this particular space, especially with the UK FTA on the anvil?
I am positive. In fact, UK FTA has been implemented. EU is expected to be implemented before the end of this calendar year. And at some point of time, I'm sure the US FTA also will get done. So I think things are looking positive. And apart from these FTAs, I think Government of India also has, over the last about 8-9 months, given multiple benefits to this sector through different measures, including GST concessions for blended products and things like that. Now, overall, the ecosystem is going to support this industry in the foreseeable future. And that's why we have been positive on this sector for some time. Remember, the competition is not with China so much. It's with Bangladesh, Vietnam, and the likes. And we have to keep monitoring the tariff and the trade agreements which these countries execute with geographies like UK, EU, and USA, which are the largest markets. So we have to keep a watch on this sector, but generally we are positive. We like Welspun leaving, and we like Gokuldas export. KPR was our favorite stock, but it has moved up quite a bit. So at this level, we are not recommending a buy in KPR.
Okay, KPR no longer the favorite, but you like Gokuldas. Sudeep, do stay on. The other stock we want to focus on, HDFC Bank. Now, their long-awaited leadership succession process that appears to be entering its final phase. Now, we've been given to understand that the bank has now shortlisted 3 candidates for the position of the chairman, which includes a former RBI deputy governor, and the board is now likely to finalize its recommendations as early as this month end. What is significant is that the chairman appointment is going to be linked to the future of Sashidhar Jagdishan as the CEO, because the sources are indicating the recommendation for extending his tenure is going to be taken up only after the chairman selection process is completed. Remember, this is coming against the backdrop of the governance scrutiny that's been ongoing there since the exit of their former chairman Atanu Chakravarti, who resigned, citing differences over governance, ethical issues, after which KK Mistry was appointed as the interim chairman, and since then his term was extended by another 90 days. Now, importantly, we also understand the bank is expected to receive the findings of this external legal review, which has been commissioned to examine the issues that were flagged by Atanu Chakravarti, and that is expected to, bring some kind of a closure to these governance concerns that have been lingering since Atanu Chakravarti's departure. Now, sources are also telling us RBI is not too happy with the kind of delay that the bank has made with the chairman and the CEO succession process, and they've now asked the bank to expedite it as well. Remember, Sashidhar Jagdishan's current term as CEO ends in October, and typically RBI expects the banks to initiate this reappointment process and submit, their application 6 months before the tenure end. So that period is already kind of lapsing. Now, for investors, of course, the key takeaway here really is the market could soon get some clarity on both the board leadership and the future of the bank CEO, and that potentially, brings some relief, ending months of uncertainty around this succession issue at HDFC Bank. Ruchit, if you're still with us, any thoughts on HDFC Bank in light of these developments? The lingering concern, of course, has been, it started with Atanu Chakravarti's exit and the subsequent issues. Do you think this will bring some kind of closure, some upside after, years of underperformance on the bank stock?
Yes, quite probably, because if you look on the charts itself, the stock has formed a strong support base around 720. When all these issues were going on at the end of the March, the stock formed a bottom around 720. And post that, after a pullback move, when it corrected again, in the month of June, itself in second week of June, the stock managed to recover from same 720 levels. So double bottom kind of pattern has been formed over there. And also, if you look at the momentum in today's session as well, most of these private heavyweights now seems to have taken the leadership again, be it Axis Bank, ICICI Bank, HDFC Bank. The volumes are flowing there. So I think the worst is behind in the stock. So we were even speaking about this IT sector as a whole, where whether they've bottomed out now. So I think from a risk reward ratio perspective, these private banks which have not shown any good returns over the last few months, these are better placed in terms of risk reward ratio for a recovery from current levels.
Well, thank you so much, Ruchit, for your views as far as HDFC Bank and how it's looking on the chart is concerned. So they've coming across to you as well. Now, within the private banking space, where does your preference lie? Is HDFC Bank attractive to you?
Well, HDFC Bank definitely looks good. Performance has been improving, and B, I think government's this FCNRP scheme, as well as the external borrowing which banks have been allowed with hedge benefits, I think definitely will help HDFC garner quite a lot of deposit, and will, their credit deposit ratio will improve significantly. This is a significant benefit for banks in particular, but HDFC specifically, because they had a drag of the HDFC Limited merger and their loans. So this should get corrected now. Apart from HDFC, we do like Federal Bank. They have a fantastic network in West Asia, and this FCNRB mobilization should benefit from that network, and that in turn will give Federal Bank significant benefits. Even otherwise, with the change of management and things like that, Federal Bank has been doing well. So we are positive on both Federal Bank as well as HDFC Bank.
All right, Sudeep as well as Ruchit, thank you both for taking the time out and joining us here to share your views. We appreciate it. And with that, we'll slip into a short break, get you all the top corporate voices, along with the key market events to watch out for when we return. Welcome back. You're watching Markets Forward and on to the top corporate voices of the day like we promised. Rashi Peripherals is the first one. It expects its acquisition of VDA Infosolutions to boost margins and expand its enterprise technology offering. Speaking to CNBC TV 18, the company's management said VDA delivered up to 30% annual growth over the last 3 years with profit margins of up to 5%.
Agrochemical major UPL expects double-digit revenue and EBITDA growth in FY27 while continuing to reduce leverage and simplify its corporate structure. Speaking to CNBC TV 18, the management said it will combine its global and India crop protection businesses as part of the restructuring plan. It also expects a stronger second quarter this fiscal when compared to the same period last year.
CleanMax says India's data center capacity is expected to expand 6 to 7 times from the current 1.5 gigawatts. The company estimates that as data centers scale up, they're going to require nearly 40,000 megawatts of power, with a majority of that demand likely to be met through renewable energy sources.
And before we wrap, we bring you the key market events to watch out for tomorrow's trading session. Devyani is standing by with the key events to focus for tomorrow.
Well, let me start with the global events first. Now, in the US, the final Q1 GDP data, the jobless claims and the critical core PC inflation data drop tomorrow. From a European standpoint, watch out for the ECB economic bulletin as well as a key policy speech by economist Philip Lane. Now, in the Indian domestic market, the retail bidding window for IRFC's offer for sale officially opens tomorrow, while the board of Suryodaya Small Finance Bank is expected to meet for their fundraising plans. Now, it's also the last day to apply for the Waterways Leisure IPO. So these are all events we'll be watching out for tomorrow.
All right, Devyani, thanks very much for setting that up for us. So IPOs, fundraisers, it promises to be another action-packed day tomorrow. But for now, Vivek and I take your leave on this edition of Markets Forward. Thanks very much for tuning in. We are going to be back with more news and updates on the other side, so stay tuned to CNBC TV 18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US and Iran disagree on nuclear inspections and the future of the Strait of Hormuz. US claims Iran will not be allowed to charge tolls in the strait, but Tehran insists there will be no return to the pre-war situation in the waterway. Crude oil prices dropped to levels seen before the war in Iran. Brent crude trades below $76. President Trump accuses oil companies of price gouging consumers and calls for an investigation. Dalal Street rebounds after yesterday's sell-off. Sensex and Nifty gain over 1%. Nifty moves back above 24,000. Rupee regains some lost ground against the dollar. Gold prices declined to the lowest level in nearly 7 months. The yellow metal is down 10% just this month. Silver prices also hit a 6-month low after dropping more than 20% this month. Strong dollar hawkish US Fed and weak data from China dent sentiment. US Trade Representative Jamieson Greer and Commerce Minister Piyush Goyal hold negotiations for the second and final day. Both nations are looking to finalize an interim trade agreement before the 24th of July when the 10% tariff structure enacted by the White House expires. HDFC Bank is likely to finalize a new non-executive chairman by the end of this month. Sources say 3 names have been shortlisted and the RBI has asked the bank to expedite the process. Gautam Adani announces a 2 lakh crore rupee capital expansion plan for the power business, aims to build 45 gigawatts in power capacity over the next 5 years. Amazon doubles down on quick commerce business as global CEO Andy Jassy visits India, plans to expand services to 300 cities. Shares of Swiggy and Blinkit's parent eternal decline in trade. SEBI considers a common ad code for regulated entities, proposes permitting celebrity endorsements at brand or entity level, also seeks to expand the definition of celebrities beyond film stars to include sportspersons and social media influencers and even virtual avatars. Any influencer with more than 5 lakh followers on a single social media handle may be treated as a celebrity. The government clarifies on its ethanol blending program, dismisses concerns that the use of E20 fuel could affect the validity of vehicle insurance, says no widespread engine failure has been reported on account of ethanol blending, also rejects claims that sugarcane juice is directly being mixed with petrol. Cristiano Ronaldo scores twice as Portugal thump Uzbekistan, becomes the first player in the history of the game to score in 6 different World Cups. Ghana holds tournament favourites England to a goalless draw. All right, to the top story this evening, the administration of the Strait of Hormuz and inspection of Iran's nuclear facilities continue to be points of contention as Tehran and Washington continue talks. Here are the latest developments. U.S. Secretary of State Marco Rubio has said that Iran cannot charge tolls for shipping in the Strait of Hormuz. Speaking to reporters in Abu Dhabi, Rubio said that the strait is an international waterway and that U.S. would provide for freedom of navigation in the strait. Tehran has insisted there will be no return to the pre-war situation in the waterway. U.S. President Donald Trump also claimed that 19 million barrels of oil flowed through the waterway yesterday. Addressing a rally in Pennsylvania, President Trump said that oil prices will come down further. Separately, in a social media post, President Trump accused oil companies of not lowering fuel prices in line with falling crude costs. Trump said that he has instructed the Justice Department to immediately start looking into the matter. Meanwhile, Iran continues to insist on the withdrawal of foreign forces from the Gulf region. Speaking to state media, Iran's chief negotiator Ghalibaf said that the deal to end the war, and I quote, is America's declaration of defeat, end of quote. In the oil market, Brent crude prices slid below the $75 mark, hitting its lowest level since February 28th. According to shipping data from Kepler, 31 vessels have crossed the strait today. 2 India-flagged crude tankers are scheduled to arrive in Gujarat today. This as Oman announced a shipping transit corridor in the strait with the International Maritime Organization.
Yesterday, 19 million barrels of oil flowed out of the Strait of Hormuz, a very beautiful place. That's the most oil in the history of the strait. No, it's never been any, you've never seen anything like that. It's called an oil gush, and most importantly, we are ensuring one thing very importantly, because this is why I did it. I did it for this reason, 99% for this. Iran will never have a nuclear weapon, and they've agreed to that.
Well, that's the law. It's an international waterway. No country is allowed to charge tolls or fees on an international waterway. That's existing international law. That's the way it is in international waterways all over the world, and that's the way we expect it'll be here. So I don't think we have anybody to convince around here in that regard. I think all the countries in this region would agree with us.
We have not had a meeting with the Director General of the International Atomic Energy Agency, nor do we have any plans for an agency inspection of Iran's nuclear facilities that were damaged as a result of the military attack by the United States and the Zionist regime. Basically, there is no procedure at all in this regard.
All right, on to the day's market action. Market ended near day's high with Sensex and Nifty rising nearly 1% each. Nifty ended above 24,000 led by financial heavyweights and Infosys. Nifty IT emerged as the top gaining sectoral index while all constituents of Nifty Bank ended in the green. Reema Tendulkar is here with the market track.
It is indeed a strong comeback Tuesday for the Indian markets. The Nifty closing above the 24,000 mark. So the bulls firmly in charge after yesterday's weakness. Midcaps, though, relatively underperformed, in fact, flirting with a flat line by the time we closed up for trade. But before we get to the movers, here's what changed the mood. Brent crude prices. Brent crude is now back below $76 per barrel, which is the level it was pre-war. So in a way, the crude risk premium that was impacting the Indian markets is now fully unwound. There were two sectors where we saw which did the heavy lifting, and we saw blue chip buying. One is IT and the other one is banks. The Nifty IT index rebounding more than 2%, but to put it in context, it's down 5% this month, 26% lower from the start of the year. The other one, which has been quietly moving up, is banks. So banks were up 2% today, and from the start of the month, it's up more than 7%. Individual movers, trend. This is on the back of the FY26 AGM, where the company said they're still in the early stages. They're targeting 50 West Side stores, 200 to 250 Zudio stores every single year. Adani Enterprises, in fact, the entire Adani Group complex were hired today. There was an AGM today, but on Adani Enterprises, Morgan Stanley has initiated coverage with an overweight rating, and they believe that this is India's premier incubator with an exposure to multi-decade themes. Talking about the IT names, well, you had TCS, Infosys, Tech Mahindra all participating in today's banks, in today's rally. In talking about banks, the trigger was the RBI clarifications on those FAQs. So basically, they're saying that banks, including overseas branches, can now lend against the FCNRB deposits, marked lean. So you're seeing a big move in private sector banks, not just today, but as I said, they've been quietly moving up. So ICICI Bank has gained in 10 out of the last 13 sessions.
Indian benchmark bond yields and swap rates fell to their lowest levels in 3 months. This comes a day after the Reserve Bank released a detailed set of frequently asked questions to clarify on its forex swap scheme to attract NRI deposits. Right, metal stocks have continued to extend losses amid weak global sentiment and a strong dollar. Gold prices also declined to the lowest level in nearly 7 months. Manisha Gupta brings us more. Manisha, what led to the fall?
Well, yes, yet another day and further extension in sense of decline in base metal prices is what we are dealing with. Overnight was 3 to 4.5% of a cut in base metal prices, and we are just looking at further declines today as well. This is happening on the back of strength in US dollar index, which is holding quite firmly above 101.5 therein. Also, when you look at the hawkish US Fed statements that the street is still digesting and anticipating a probability of a 25 basis point rate hike by the time this year ends, also has led to some decline coming in for the markets. It also is about the weak China industrial data that the street is dealing with, and the fact that there is weakness or slowing down in sense of automotive and industrial demand is also weighing on in case of metal prices. The opening up of Strait of Hormuz and the West Asia conflict, as of now subdued at least for the next 60 days, is what also has led some premium of the prices. And then it is about profit taking as well. Remember, the metal prices had gained quite a bit. We've seen multi-year highs and all-time highs in case of some of those metal prices. So institutions seem to be getting in some profit taking. There also is selling from investors to raise cash amid losses that you have seen in AI and tech related stocks. So metals have bore the burnt of that as well. So when you look at the last 1 week or last 5 or 6 trading sessions, we've seen a negative return in many of these metal prices. Copper, for one, has declined 5.5% in last 1 week. Aluminum is down 7%. You have zinc, which has declined 4% as well. And this is not just limited to base metals, because the precious metals have continued to decline. Gold is down 4.5% in last 1 week. Silver is down 10% in the same time.
All right, thank you, Manisha, for that. Moving on, U.S. Trade Representative Jamieson Grade and Commerce Minister Piyush Goyal held negotiations for the second and final day. Both nations are looking to finalize an interim trade agreement before the 24th of July, when the 10% tariff structure enacted by the White House expires. Abhimanyu Sharma has more. Abhimanyu.
Well, India and the US have concluded a series of meetings which were held over the course of 2 days, that is yesterday and today, in which India's Commerce and Industry Minister Piyush Goyal had met the US trade representative, and teams from both the sides had engaged in discussions on several issues surrounding the interim trade deal and also the larger BTA, the larger trade agreement which both the sides are discussing. The Commerce Ministry has issued a statement to the same. It has said that in multiple rounds of discussions, both the sides held discussions and explored avenues to further deepen economic partnership, and they reviewed the core elements of the BTA, while they noted progress in the recent months as far as the negotiations between teams from both the sides were concerned. Now, market access, digital trade, supply chain resilience, non-tariff barriers, expanded cooperation in strategic sectors was discussed, even as both the sides welcomed the momentum in talks which has been noted in the past few months. Now, it remains to be seen how early both the sides are going to discuss as well as finalize the tariff architecture which is going to apply on goods flowing into both the countries respectively, and both the sides are looking for a preferential tariff access for their respective goods to not just provide certainty to their exporters but also to provide benefits to exporters, businesses and agriculturists in both the countries. Now, all eyes of course would be on how early this tariff architecture will be implemented, since the 10% tariffs are going to lapse on the 24th of July, and in case a deal is not done by then MFN tariffs are going to apply. So both the sides would be looking to intensify negotiations in the coming days and would be looking forward to come up as well as implement a tariff architecture as early as possible.
All right, thank you, Abhimanyu, for that update. Shifting focus now, Noel Tata will step down as chairman of Trent after a 3-decade stint. The 69-year-old joined the group's flagship retail company as a director in 1998 when his mother, Simone Tata, established the company after the divestment of Lakme. Tata Group governance norms mandate retirement at 65 for executive directors and 70 for non-executive directors. Now, SEBI considered a common ad code for regulated entities. The market regulators proposed permitting celebrity endorsements at brand or entry level. It also sought to expand the definition of celebrities beyond film stars to include sports persons, social media influencers and even virtual avatars. Any influencer with more than 5 lakh followers on a single social media handle may be treated as a celebrity. On to a CNBC TV exclusive now. The hunt for a new chairman for HDFC Bank continues to gather pace. Sources have told CNBC TV 18 that the bank has shortlisted 3 names for the position, including a former Reserve Bank deputy governor. Remember, the central bank had approved K.K. Mistry as the interim chairman for 3 months after Tarun Chakraborty's exit. Ritu Singh joins us now with more. Ritu, what are your sources telling you?
Well, yes, HDFC Bank's long-awaited leadership succession process appears to be entering its final phase. We've been given to understand from our sources that the bank has now shortlisted 3 candidates for the position of the chairman, and that includes a former RBI deputy governor. And now the board is likely to finalize its recommendation as early as the end of this month. Now, what is significant here is that the chairman appointment is closely linked to the future of MD and CEO Sashidhar Jagdishan, with our sources indicating that the recommendation for extending Jagdishan's tenure is going to be taken up only after the chairman selection process is completed. Now, this comes against the backdrop of, this governance scrutiny at HDFC Bank, because remember, you had former chairman Atanu Chakraborty resigning earlier this year, citing differences over governance, ethical issues, following which K.K. Mistry was named the interim chairman, and his initial 3-month term has since been extended by another 90 days. Now, importantly, the bank is also expected to receive the findings of this external legal review that has been commissioned to examine the issues that have been flagged by Atanu Chakraborty, and that report is expected shortly, which could help bring some closure to these governance concerns that have lingered since his departure. Now, sources are also telling us that RBI has taken note of the delay both in the chairman and the CEO succession processes, and it has asked HDFC Bank to expedite the submission because remember, Jagdishan's current term as CEO ends in October, and RBI typically expects the banks to initiate the reappointment process 6 months before the end of the incumbent's tenure. Now, of course, for investors, the key takeaway is that the market could soon get clarity both on the board leadership and the future of the bank CEO, and that could potentially end this months of uncertainty around succession at HDFC Bank.
All right, thank you, Ritu, for that. The government will divest a 1% stake in Indian Railway Finance Corporation. DIPAM Secretary Arunish Chawla said that the government could exercise a green shoe option of an additional 1% stake if the offer receives strong demand. The offer for sale will open for institutional investors today, while retail investors can bid tomorrow. Axis Bank has raised $800 million through a dual tranche of US dollar bond sale. The private lender raised $500 million through perpetual AT1 notes and $300 million through 5-year senior unsecured notes under its global medium-term note program. Messaging platform Telegram has resumed services after a temporary ban linked to the NEET examination controversy. However, according to a report by the Ministry of Home Affairs, the platform is being exploited for illegal activities like drug trafficking, child exploitation and terrorism. The report alleges that the platform is the new dark web and has alleged misuse to steal personal information as well. The Telecom Department has notified new rules to operationalize the Telecom Act. This marks a shift from the existing license-based regime to a modern authorization framework for telecom services. The new rules will also entail an open transition pathway for telecom operators and single window clearance introduced via a digital portal. And on that note, we'll take a short break. Coming up next, the government clarifies on its ethanol blending program, dismisses concerns that the use of E20 fuel could affect the validity of vehicle insurance. That and much more on the other side. Welcome back. A quick look at the other headlines we're tracking. Mumbaikars woke up to flooded roads, uprooted trees and disrupted train services as southwest monsoon made its onset after an almost 2-week delay. The city received over 200 millimeters of rains. Officials claim all major subways remained open and traffic movement across Mumbai was largely unaffected. The Met Department has issued an orange alert for Mumbai, Thane and Palghar. Incessant rainfall triggered flash floods and landslides in Arunachal Pradesh, damaging homes, disrupting a national highway and leaving several people stranded. 3 people are reported missing. Landslides have also affected road connectivity in the region. Officials have mentioned that the flood wave is expected to move downstream through multiple Assam districts over the next 2 days. The government has clarified on its ethanol blending program. The oil ministry has dismissed concerns that the use of E20 fuel could affect the validity of vehicle insurance. Sudarshan Kumar brings us more details. Sudarshan, please take us through the centre's clarification.
So yesterday on PIB website, government has issued clarification related to ethanol blending program and calling the program scientifically validated and being closely monitored by the government. Oil Ministry has also issued the clarification saying the program was first launched in 2003 and after that it was implemented in a phased manner based on preparedness and consultations and rolled out 20% ethanol blending from 2023. And so far, there are no widespread issues of engine failure or vehicle breakdown due to ethanol blending. Now the question is why government had to issue the clarification. So it says it has noted misleading and unsubstantiated claims being circulated on social media platforms. So what are those claims? First, hygroscopic nature of ethanol. Government says entry of water into fuel tank is undesirable for any fuel, whether ethanol blended or otherwise, and modern equipment that we have, it does stop from fuel getting into the tank. Second, claims videos falsely portraying sugarcane juice as being mixed directly with petrol. On that, government says such content is misleading and baseless because ethanol used for blending is produced via established industrial processes from feedstocks like sugarcane juice, molasses, broken rice and maize, and properties of ethanol are vastly different from the input feedstock. Third claim is claims of E20 fuel could affect vehicle insurance validity. On that, we had certain clarification from ICICI Lombard also, and they have said that those claims are completely baseless and misleading and are incorrect. Now, government has also talked about the savings that it's getting from ethanol blending program. So, the program has helped save over rupees 1.4 lakh crore in foreign exchange via reduced crude oil imports. It has created sustained demand for agri feedstocks used in ethanol production. And it's not only the India which is using or which is going in for ethanol blending program. Some of the other countries are doing too. So government says ethanol blending is a globally accepted practice and successfully implemented in several countries like US, Brazil and Japan.
All right, thank you, Sudarshan. Moving on to some international stories. Chinese tech major Alibaba has launched a legal challenge against the US government, seeking to remove its name from a Pentagon blacklist. The US Department of Defense has accused Alibaba of having links to the Chinese military, arguing that its compliance with Chinese tech regulations effectively makes it an extension of the military apparatus. The company has rejected the allegations, filing a lawsuit in a California federal court, calling Washington's decision without basis in fact or law. Meta Platforms has announced a new set of smart glasses for $299 in collaboration with Ray-Ban. This at least $80 lesser than the previous model. Meta and Ray-Ban dominate the smart glasses market with estimated market share of more than 80%. Also, millions of units sold since they first launched in 2021. All right, let's talk about the FIFA World Cup. Cristiano Ronaldo scored twice last night as Portugal thumped Uzbekistan in their second group match. The 41-year-old is now the first player in the history of the game to score in 6 different World Cups. Meanwhile, Ghana held football powerhouse England to a goalless draw. And before we wrap, it's a big milestone for us today. CNBC TV18 has crossed 5 million subscribers on YouTube, and that number belongs to you. A big and heartfelt thank you to every viewer. Thank you so much. Stay tuned and stay subscribed and stay with us through the highs and lows of the market. Here's to many more milestones together and to telling India's growth story the way only CNBC TV18 can. That's all on this edition of Business 360. News and updates continue on the other side.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. June 28th is marked as the International Insurance Awareness Day. It's a global initiative to spread the word on the need of proper and adequate insurance. The day is celebrated, of course, here in India as well. And we here on Let's Talk Money are using this as an opportunity to bring you a very, very simple conversation on the non-negotiable insurance products that you must have in your financial plan. Remember, insurance is something you need to think about even before you can start thinking about investments. So over this week and the next week, it's a two-part special, we will be covering all aspects of insurance, and this includes life insurance, health, house and motor policies, products that ensure your peace of mind and the well-being of your loved ones as well. This week, we are kicking off the conversation with General Insurance. And joining me for this are Santosh Puri, Head of Retail, Health and Travel Insurance at Tata AIG, and Amit Chhabra, who is the Chief Business Officer at Policy Bazaar. Gentlemen, thank you so much for joining in. It's a pleasure to, welcome you in. And I thought, usually these days are just another, date on the calendar, but at least they become a bit of a milestone for us to, again step back and have the conversation. So, Amit, let me open with you. Let's just walk over the kind of trends, broad trends that you've seen with respect to insurance adoption, say in the last 1 year.
Well, I think a lot has happened, in the insurance space in India. I feel the big milestone step was GST being removed. So it essentially means that insurance and health and term insurance specifically is considered at par with food or something as important as food, right? Because
zero
GST now.
Yeah.
So the government of India does say that having health insurance and term insurance is important. Some bit of context here. See, India is not very well covered in terms of social security. We're getting there, but we are not there yet fully. Hence, protection from death, disease and disability is something that people need and they don't have right now. What happens if, the sole earning member of the family passes away? What happens if a surgery is required and it costs 20 lakh rupees? People don't have that kind of money or as backup. That is where insurance comes into the picture. And I think a lot of steps have been taken. Awareness has gone up. The IRDAI has also taken a lot of steps in the direction of creating more awareness, promoting people to buy health insurance and life insurance. I think a lot has definitely happened. But that said, I feel we have still scratched the surface. The penetration numbers are still fairly small. A lot of people, specifically once you move out of the tier 1 cities, don't have insurance. They're not even thinking about it. They would prioritize going to a movie or getting a cup of coffee over buying health insurance. That's not such a great thing. So it's improving, but long way to go, I would say.
I couldn't agree more. And I think sometimes adversity is the only way you learn. You go through a period of pain and you realize there could have been something done to financially secure yourself. And by the time it's too late. But anyway, as long as adoption grows, I think we are fine. Santosh, welcome to the conversation as well. And I want to take that point up on penetration with you. I was shocked when I came to know about the latest stats that the penetration of general insurance, I think, is still just about 1% in India. That's like an abysmally low number. So clearly something is completely off track. Now, whether it is marketing, whether it's communication, I don't know, awareness. But your opening thoughts?
Thanks, Surabhi. I think, rightly said that, the penetration of insurance, it has been, concentrated towards metros earlier. And with the newer reforms and especially, post-COVID and after GST, a removal of GST, doing away with GST, the focus emphasis has grown a lot on retail health insurance product. Now, if you see, every insurance company has their strategy towards moving beyond from metro and focusing not just tier 2, but tier 3 and beyond, customer segments. That's number one. Second important thing is that, the cost of hospitalization, medical inflation has gone up. So it's just not about, hospitalization, medical advancement that has happened in metro, but even in tier 3 towns or cities, we are seeing this trend. Awareness levels have gone up. And I think this will be an enabler for, getting penetration, reaching to market segments. Even distribution strategies are laid down for, focusing towards, tier 3 and tier 4. And I think, eventually, at least in next 3 to 4 years, we will see substantial increase in terms of penetration of retail health insurance.
Okay. So, I want to, gentlemen, make it very, very simple for our viewers. And the objective of this show is to just take a step back, put our thinking caps on. And since we're talking general insurance now, talk about those 2 or 3 insurance policies that are non-negotiable. It's a no-brainer. You need them. Now, how expensive or how large the cover is or how many special features they have, that is the point of discussion. But there's no discussion on the fact that you need them. So I'm very sure that health insurance is going to top that list. Santosh, you look at the health business. Just tell us from your perspective, COVID was a big learning lesson. Now we have this, GST relief coming in. So what is happening in the market? Which are the kind of products that are being well received? What is the kind of product innovation that we're seeing and that we'll continue seeing in the months ahead?
Sure. I think, we'll come to innovation later, but I think first is essentials, what is being required. I think, preferences are moving towards higher sum insured. So earlier what we used to talk about, 2 lakh, 5 lakh cover. Now that trend no more, is true. People are looking, at higher sum insured options, moving to 15 lakhs and above. Given the definitely, the cost of medical or cost of healthcare cost, the advancement in the procedure, and also the lifestyle, which is contributing to, chronic ailment or serious ailments, which have, higher severity in terms of hospitalization costs. That's number one. Second important thing is that, with respect to the restrictions in the product. So it should be simpler, like you correctly mentioned, Shobhi, that it should be simpler product, fine prints should be avoided. So especially the restrictions, cappings, waiting period should be clearly known to the customers at the time of buying. And customers' preferences are shifting, I want to recall the statement which you made in the starting itself of this talk that, peace of mind. Customers are looking for peace of mind. So let it be hospitalization, no capping, sublimits, waiting periods. So they are looking totally at peace of mind. At the time of moment of truth, they don't want to actually, get into hassles of financials, paying. The whole purpose of insurance, health insurance, will be defeated. So that's the second point. Customers are moving to open-ended products and higher sum insured products. Third thing is that they're also getting conscious with respect to products which offer, preventive healthcare aspects, like annual health checkups being done so that they can monitor their health, track their health, and more focus is getting also from just not a claim payer, but also to a health management. So these are the, top 2-3 trends which the customers are looking at.
Okay, all very interesting points, and good to know that this is how the market is evolving and we have more choice, more flexibility in products. But Amit, then all of this comes at a cost, I'm sure, right? So there is the cost of just medical inflation, procedures becoming more expensive. And then now that policies are going to be becoming so feature rich, there'll be some cost to that, to that as well. So just explain to us what has happened in the last 1-2 years. And then let's talk about how to, what's the checklist for health insurance? The must-have features in any policy.
Sure. See, first of all, I think it's important to understand India is right now the cheapest health insurance market in the world. It is by far the cheapest health insurance market. When you adjust for purchasing power parity, you adjust for healthcare costs and all, you don't get insurance as cheap anywhere else as you get in India. Second, you don't get health insurance as comprehensive as you get in India. For example, today, there are now plans that give you unlimited sum insured. So there's actually no capping of sum insured. You can, theoretically spend 100 crore rupees in the hospital as well and it will be paid. You don't have any co-payments in most plans. Whereas in most other countries, co-payments are a standard part of every health insurance policy, which means a part of the claim has to be paid by the consumer.
But co-payment is still a reality if you have pre-existing diseases, isn't it?
Not really. So you just have to serve the basic waiting periods and then 100% of the bill is paid by the insurance company.
Even if you have existing chronic ailments or health conditions.
Absolutely. In fact, you have plans which cover chronic ailments from day one as well. So you can buy out those
the waiting periods
and actually get coverage from day one.
Okay.
So actually, if you look at all of that, and you can buy a 5-year plan, which means that you can actually lock in your price for the next 5 years as well. So there is no inflation that's going to come to you as well.
Okay.
What I'm trying to say is, India is actually the best place to buy health insurance.
Because of the number of options now.
Because of the number of options and the low cost that is there.
Sure.
However, that said, to your point, I think costs will go up. The reality is maybe in the next few years, what might happen is co-pays, deductibles, they will start to become a more reality, because as the cost of health insurance grows, people will start adopting these options to lower the cost. That said, I think again some very progressive steps that were taken by the regulator. One is the launch of the monthly mode or the EMIs to buy health insurance. I feel that was a great step. It happened at the right time. It was announced during the COVID times that every insurance company has to offer EMIs to a consumer. So let's say your premium is 24,000 rupees for the year. Instead of paying 24,000 rupees up front, which is a lot of cost for a lot of people, you actually pay 2,000 rupees a month. You put a standing instruction and pay only 2,000 rupees a month.
So let's go back and put up that table, and that was only an indicative table that the Policy Bazaar team helped us with, just to understand, broad brush, if you're taking one certain prototype of an individual, with a standard cover, then what the cost variance could be. This will vary greatly with respect to age and what is the, if there are any ailments. Yeah, that's the table coming up. So, Amit, could you just broadly kind of explain this? Right now, if you're talking, we've taken a mid-30s male, right, for this particular analysis. So, and assuming that this male does not have any pre-existing illnesses or ailments, then what is the ballpark in which he can perhaps get a reasonably comprehensive cover?
So for a mid-30s person, you should look at about probably 12,000 to about, it varies, but 12,000 to 15,000, you should get a good 10 lakh sum insured kind of cover. If you extend the envelope a bit further, for about 20K, you can get unlimited sum insured. So the delta is not so much, but the sum insured delta is massive.
And you get these unlimited covers by buying up a super top-up plan, is it?
You can buy a super top-up. Now there are base plans also available which give you unlimited sum insured.
Unlimited
because the risk for the company practically remains the same.
Santosh, come in on this and let's break this down for people. Someone who doesn't have pre-existing ailments, someone who's buying insurance early, obviously it's much better for them. And then let's also talk about people who have certain kind of pre-existing illnesses. It could be certain chronic ailments. What are the options they have? What should they look for when they go to their insurance provider or their aggregator? What are the questions to ask and what to look for to ensure that you get the right product?
Right. So I think, before starting with insurance, I would like to go a step behind and talk about customers, right? Customer, whenever, are suffering from any medical condition, they should upfront disclose it at the time of, wherever proposal, underwriting, etc. is being done. So disclosures are to be promoted amongst the customer. That's number one, because that significantly impacts the contract as well as the claim settlement. And it should be a seamless process or journey, because considering the lifelong contract, which we talk about health insurance, it shouldn't be a short-term vision from the customer's point of view. That's number one. Second important thing, with respect to medical conditions or chronic conditions, the customer, apart from disclosure in the product, they have to definitely look at, at least 2 to 3 things. Number one, what are the waiting periods applicable in the product for that particular disease, by when it will be covered, its diseases and complications. Is there a buyback option? The customer should opt for it, buyback option, so that they at least ensure that coverage triggers immediately for pre-existing condition. That's one thing. Second thing, are there any cost-sharing mechanisms in terms of pre-existing disease, or there are like copay restrictions, capping, sublimits? These are the second important thing which the customer should look at before buying a policy. Third important thing is that definitely premium is an important factor. But what would be the loading, after disclosing a medical condition? The customer should also weigh that option of affordability in terms of premium when we consider other aspects of coverage as well. So broadly, these are 3 things which the customer should think of. But I would lay major emphasis on disclosures when it comes to customers at the time of buying insurance.
Okay, so I think the learning lesson here is have an honest conversation with your insurance broker, or if you're talking to the insurance company directly, be honest, disclose and ask lots of questions to ensure that when the time comes, you get your claim settled. All right, on that note, we have to take a very, very quick break, but we've only just started. This is just health insurance. General insurance includes a lot of other products that could be very essential when you're talking about your financial plan. We'll discuss them on the other side.
Let's talk money. Talk Money.
Welcome back. Here with us on Let's Talk Money, and this week, and in fact, even the next week, it's going to be all about insurance because we are marking the International Day for Insurance Awareness here on the show. And this week, we are putting the spotlight on the most essential, non-negotiable, non-life insurance policies that you must have to ensure peace of mind so that you can focus on your job, your investments, your wealth creation without any kind of concern or anxiety. So we've discussed health insurance. Clearly, it's a non-negotiable. Amit, the next one that I want to bring up, which I don't think we talk about enough, is protecting your home. And the reason I say that is we've seen so many fire instances, and one happened close to my house, I mean, very recently, where the entire house was burnt down. And then you wonder that there are products in the market, but I don't know how many people have insured their next most important possession, which is their own house. So let's talk about what to do to ensure that our house is protected from any such eventuality.
Sure. I think you're right. It's one of the most underspoken, underpenetrated product in the country. And in fact, it's again very specific to India, because if you look at the, some of the other developed markets, home insurance is actually a very common product out there. Everybody has it. In fact, in the US, for example, if you don't have home insurance, it impacts your credit score. It's that important. But in India, most of us don't have it, unfortunately.
Unless you take a home loan.
Yeah, but typically that's also a loan protector kind of a product.
It's not about the contents of the house.
Not so much. Yeah, so home insurance typically includes two types of protection elements. One is structure and second is content. Structure is basically, the house, the walls, the house. Specifically, if you have an independent house and you don't live in a condo or a society, that's where the structure of the house has to be insured by you. But if you live in an apartment complex, then typically the structure is already insured by the builder.
Okay.
But in an independent housing, you have to, one, insure the structure. So what if there's an earthquake and the entire structure comes down? There's no insurance. You have to build it all over again. But the structure protects you from that and covers in case there is any harm to the structure because of a natural calamity, because of an act of God, because of fire. It could be anything.
So earthquake, fire, all this is typically...
all of that is covered in structure.
Okay.
The second is content, which is basically the contents of the house, which could be all the electronic items you have. Today, a lot of people spend crores of rupees on the interior decoration of their house, right? You put up so much to make the house look beautiful. Now, is there any insurance for that? Answer is no. So what if there is water coming into the house because of heavy rains, which is happening right now, or because of floods, or or something else happens, there is a fire, which is very, very common again. There's no protection even for that. So that is what the content coverage does. It even protects you from thefts as well. So in case...
So theft, flooding, earthquake, fire, a lot of these issues would be covered under some of these policies.
Yeah, correct. So the difference is structure and content. Structure is about the walls and the the building, and content is everything else.
Okay, costing?
So it's not actually very expensive, and typically what people do is they buy a longer term plan, because this is something which is going to stay. There is no inflation. Your sum insured will remain the same, because the cost of the house and the cost of contents is not going to change dramatically over a period of time. So typically what we see is people end up buying a 5-10 year plan at one go.
Okay.
The pricing typically is in the range of 25 to 30,000 rupees. On an average, it varies a lot because it depends on where you are.
Okay.
It depends on how much money have you spent and how much are you trying to insure. So it depends how much money have you put in the interiors of the house, how many televisions are there.
So let me throw a rough example, a little unfair, because we'll plan this and do a much more deeper conversation on this. But for the sake of understanding, say that you're living in an apartment, maybe in Delhi or in Mumbai. A lot of our viewers are from these cities. So take any one example. You're living in a 2 BHK apartment in, say, Delhi or in a Gurgaon. Now, what would the cost be if you own? Then would you look at taking an insurance policy which covers structure plus the contents? Versus if you're only renting, then will you be protecting only the contents? And then how should you, what kind of a policy should you go in for, and then therefore how the cost will be?
So if I'm a tenant, then the right thing to do is to take only the insurance for content, because structure is
not my
problem. If I'm living in a society anyways, then it's not a problem, because the structure is insured by the insurance by the builder. Because they sort of take care of the entire building. If something happens, they already have that insurance. What I need to worry about in an apartment complex is practically only the content. If I'm in an independent house, which bulk of India is, then having a structural insurance is also very, very important.
But tell me something, that the contents of the house could also include jewelry. I mean, where the value would be supremely high. So does an insurance policy cover the gold and the ornaments in your house?
Absolutely, it does.
Okay.
The only thing, and it's important in an Indian context again, you have to declare everything upfront. So you have to tell what all do you have and what is the value of it.
Okay.
Based on that declaration, the premium is calculated and then it is covered. But yes, you have to declare it. You can't suddenly show up and say that I have this much gold as well.
So like I promised viewers, we can go on to a whole 1 hour show only on this, and I promise we are going to come back and do a much deeper discussion on the need for having the right home insurance, and I'm booking Amit's date for that already. But, Santosh, we want to also talk about other policies. There is motor, there is travel insurance. So again, if you were to advise someone, I go back to my starting question, the non-negotiable must-have general insurance policies. Health is definitely one. What else would you add to the list?
So I think apart from motor, definitely that's an, regulatory or, requirement by the Motor Act. So that's a no-brainer. But I think another important aspect is having especially the personal accident policies, so accidental death, which is getting covered, accidental death. So there are other coverages offered by life insurance in terms of when we talk about term insurance, etc. But I think accidental death, and when we talk about general insurance product, when we talk about personal accident per se in it, so disability is something which is also an ignored factor. We talk about permanent total disabilities or temporary disabilities, given the kind of exposure the people are having. So I think disabilities is something that, people, they ignore it, and they are not inclined towards or understanding that personal accident policy with disability cover is something they should look at. That's the second I would recommend. And third, definitely, when we talk about benefit plans like critical illness, wherein I think it's an hardship cover, which we call hardship cover. So critical illness. So there are liabilities in terms of loans, home loans, or education, marriage expenses, construction of house, etc., etc. So in the event of grievous injury or serious ailment happening to a sole bread earner or sole member of the family, I think critical illness policies are something which one should also explore. But having said that, it starts in the sequence of, health, home, then definitely motor is something, and then accidental death cover with disability and critical illness. That's something, the sequence I can put up.
Okay, all right. It's very, very helpful. I mean, we've only scratched the surface, like I'm saying, but the purpose of this conversation is to create the awareness that these are the kind of conversations that you need to have with your planner, you need to have with your insurance provider, and think about the liabilities that you want to cover. Be aware and make sure you have the right insurance. Thank you very much, gentlemen, for being with us to mark this important occasion and to raise the decibel level when it comes to the need for having right, proper and adequate insurance. Good to have you with us on the show this week. Thank you for joining in.
Thank you.
All right. Well, viewers, that's a wrap. But remember, this is only episode 1 of the insurance special. Do come back next week, because next week it's going to be all about life and a simple, pure life cover. The kind you need, how comprehensive can it be, what is the cost, all of that is going to be discussed when we come back next week. Thank you for watching.
Let's talk money.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the two-day trade talks between India and the United States have concluded, with both sides seeking to seal an interim trade deal before July 24th, when the 10% tariff regime announced by the White House is set to expire. Now, while India Inc. is eagerly waiting for an early deal, New Delhi continues to push hard for preferential tariff treatment and is unwilling to settle for a deal that falls short of its key demands. Now, following this meeting with United States Trade Representative Jameson Greer, Commerce Minister Piyush Goyal said that the two sides explored avenues to further deepen the economic partnership and are advancing discussions in a constructive and forward-looking manner. Now, both countries are aiming to conclude an agreement by mid-July, according to the Commerce Ministry sources. The proposed deal could include preferential tariffs, rules of origin, and investment provisions. The two sides also held extensive discussions on expanding cooperation in defense, critical minerals, and investment. Now, ministry sources maintain that while India is open to finalizing the broader deal after the outcome of Section 301 probe, it wants tariff decisions to be driven by the USTR negotiations rather than findings of the Section 301 investigation. And well, joining us now to help us decode what some of this negotiation could lead to, what that interim framework may look like, is with us now US ISPF President, Mr. Mukesh Aghi, to discuss the India-US trade agreement, the potential agreement, of course, in the works at this stage. Mr. Aghi, thank you so much for joining us. It's an early start. A very good morning to you. Let me take you quickly through some of the statements that have come from the Indian Commerce Ministry. They've said that there's been substantial progress by negotiating teams. They've said that there is a focus on pathways to conclude an interim agreement. They've said that there was a comprehensive review of core BTA elements. Any of this indicates to you that we're moving closer to an interim trade deal?
Absolutely, Ashmit. You have to understand that both countries are keen to wrap this up and move forward. You have basically a trade between the two countries, which is around $200 billion. And with the trade deal or without the trade deal, that trade is continuing to grow. From last year, this year, it grew by almost 14%. I think important thing is while India is asking for professional treatment, you have to understand under the current 301 finding, India is being penalized 12.5%. and Pakistan is being penalized roughly 10%. So it is a sensitive issue for India. And I think that's where US has to come in and see how to find that balance. So I would say the issue is no longer technical or business-wise, it's more political. And I think it has to go back to the White House for the president to decide. But overall, the sentiment, the momentum, and basically the process of trade continues to grow. Today in Washington, D.C., we are having a packed Silica meeting where both countries are looking at how do you basically drive a strong partnership, critical mineral. India provides certain expertise, certain minerals, and U.S. brings in some technology. So we are seeing a stronger, greater partnership taking place in that arena also. On the technology side, both Trust and Compact, both countries are working together to see how they can leverage each other's strength. So let's not just get focused purely on a trade deal. Regardless of it happens or not, the trade continues to grow, creating jobs between the two countries.
Sure. On that issue of course, this issue requiring political momentum, I want to get your thoughts on the optics of it. We recently saw the G7 summit where, again, the two leaders, Prime Minister Modi and President Trump, they shared a table. They talked about how they were moving towards moving closer to an interim trade deal. Now we have the USTR visiting India, calling on the Indian Commerce Minister. To your mind, do you think there's enough political capital to overcome some of these sensitive issues that you flagged?
I believe so. I think beside Jameson Greer, we earlier had Secretary of State Rubio come in for a few days into India, talked about the Quad Summit, Quad Partnership. And now on the trade side, Prime Minister met with the president, and they talked about multiple issues itself. I think there's enough political capital on both sides to come to an understanding. So the issue is no longer technical, it's political, and they have to basically have some kind of a discussion between the White House and the PMO to sort this one out. But I think you have to also understand that while we're talking about a political issue because of sensitive or Pakistan getting 10%, there's also 301 interim finding which come in, and there's a threat from that perspective that India could get 30% tariff. So keeping that in mind, and you have to understand also that no nation will negotiate under threat, and India's position is that also. So I strongly believe that the camaraderie between the president and the prime minister, the Secretary Rubio's visit, Jameson Greer's visit, and we also have Ambassador Sergio Gore driving that, I believe will come to some understanding in a very quick manner.
Mr. Aghi, let me get your thoughts on the two issues that you flagged. Number one, the 301 issue. There are conversations in Indian circles which say that, look, let's take the example of the EU or let's take the example of Japan. Both of them signed a deal with the United States and now looking at additional levies under Section 301. That is something that is a prickly issue as far as Indian negotiators are concerned. Is it conceivable that we have a bilateral trade agreement between India and the US that has a special carve-out, some protection against any further unilateral levies by the United States?
Well, it's difficult to guarantee under current political leadership. So far, what we have seen in a couple of cases, as you mentioned, that basically the administration went back to negotiating table. So I would not say that is 100% guaranteed, but I think the relationship will drive that. And I strongly believe the relationship between the Prime Minister and the President will help take this forward. But I would also say that in our previous example of Europe and also Japan, you cannot have a 100% guarantee that this will be moved forward.
The other prickly issue, Mr. Aghi, is, of course, the fact that we're running against the clock. July 24th is when the existing tariffs run out. And then post that, there's a lot of uncertainty as to what the Indian exporters may have to deal with. But given that we are up against the clock, there are again questions being raised that should India push ahead with even an imperfect deal if it means clocking it before July 24th? The question, the reason being, because many are asking and arguing that, look, even under tariff pressure, India managed to export even higher in fiscal year 26. So maybe perhaps continue with the same arrangement and keep your fingers crossed and hope for a better deal in the future.
Well, no nation basically concludes a deal under pressure. And India also will not do that. You have to keep that in mind. And I think a deal has to be equitable. A deal has to be fair. It has to be win-win. And if the deal is one-sided, it will not succeed. You can sign it, but it's going to collapse and fail. So I think it's important to basically keep in mind a fair, equitable deal is more important here, not the timeline. If the tariffs goes up, they go up. Indian exporters manage under 50% tariff. They can manage under 30% also. But it is important that it's not just about tariff. The relationship is much bigger, broader, from defense, technology, from critical mineral. And hopefully we'll find a balance to ensure that there is a fair, equitable deal between the two countries.
Mr. Aghi, in the last 6 months, we've seen a lot of voices emerging from both Washington and New Delhi, which are pointing towards closer ties. So whether it's the Pax Silica arrangement that you've spoken of, India, of course, joined the alliance as a part of the AI summit. We've also had the US talk about India as a trusted partner. We've had delegation visits by nuclear energy suppliers from the United States to India. What, to your mind, are the three biggest business-to-business connect that can perhaps build greater momentum between closer ties, closer synergies between the two countries?
See, you have to understand that the relationship is not just political between the two countries. It's economic, it's technological, it's people to people. Yes, there is some turbulence on the political side, but that you can see that with US-Israel, US-Italy, US-Japan, US-Europe. So we should not react to those political turbulence by saying the overall relationship has been disturbed. When you look at the economic side, the US companies continue to invest in India. If you look at the GCC investments, they continue to grow. India has over 2,000 plus GCCs. and 60% are American-based companies. And when you look at the benefit they're getting, the IP they're generating is tremendous. In the last 3 years, US companies have generated over 300,000 IP and IPR from Indian GCCs. When you look at it from technology side, both countries are working together on AI, quantum, and GE engine manufacturing. So that partnership continues. And then you have the Indian Americans in the US, which are around 6 million people, making 1.5% of the population, and they're generating almost 6% of the GDP. So the relationship is beyond political platform. It's economic, it's technological, it's people to people. And I think you have to keep that in mind, that those things will keep on driving the relationship forward. I have to say, when you ask the question, what are the three things? I must have talked to over 100 plus CEOs, global CEOs in the US. Not a single one said that they will de-invest in India. Not a single one said they will move their supply chain out of India to somewhere else. We are talking to companies who are moving the supply chain quietly from China into India itself. And Apple is a classical example, which is able to export roughly $20 billion of electronic goods from India to the rest of the world. Apple also has crossed roughly $10 billion of domestic market. So there are other companies which are doing the same thing. So I think we should not look at the relationship purely from a political perspective, look at it from other platforms also.
Well, there are multiple moving parts as far as the relationship between the two countries. One quick question before I let you go, Mr. Agi. You spoke of business synergies. It's not very long back that we had Meta investing in an Indian fintech company and appointing Kunal Shah at the helm of WhatsApp's global operations. Again, just a word on that as to what, if that signifies perhaps greater synergy, Kunal Shah being at the helm of WhatsApp?
Well, that signifies the intellectual talent India has, and it keeps on producing. It's not just, congratulations to Kunal, but you look at, Satya Nadella, Shantanu Narayana, you look at Arvind Krishna at IBM, you look at Ajay Banga at World Bank, and when you look at the C-suites, we have hundreds of Indian Americans basically plowing the economic engine growth in America itself. That partnership is tremendous itself. So I think India will keep on producing global talent. They will go to America, they'll go to Europe. And I think this is just one small success story, a big one, but it is a success story for Indian Americans.
Right, Mr. Agi, always a pleasure speaking to you. Great to have you on board with CNBC TV 18. We'll, of course, keep coming back to you for your perspective as these conversations between India and the US travel forward. But with that, it's time now for slipping into a very short break. We'll continue this discussion on the other side. Welcome back to News Center. We're now joined by Dr. Amya Chandra, visiting fellow at the Vivekananda International Foundation. Also with us, Kent Bhupati, chief economist and co-founder with Market Theory. To both the gentlemen, thank you so much for joining us. Dr. Chandra, let me come to you first. I was having a conversation with a senior journalist in the newsroom. The question that was posed to me was, does India need this trade deal at all? Given as how FY26 we did even better exports to the United States than we did in FY25. So again, the same question I posed to you, is it better for India to wait out and perhaps keep the fingers crossed to hope for a better deal even after July 24th?
A deal is required for three reasons. The first is that you need to have export competitiveness. If you do not have a deal, possibly you will be edged out through many tariff and non-tariff barriers. We have 10% right now over and above the customs surcharge, and they may increase it if the deal is not there after July 24. The second issue is that in many ways, through sectoral tariffs, we are edged out. For example, with Bangladesh, they have a deal where if they export cotton to Bangladesh, Bangladesh does the value addition and sends it back to the US. It's zero tariff. We are also trying to do that, but it has a double jeopardy because our exports of cotton to Bangladesh has washed away and Bangladesh export to US is at our cost. Second important part is that a deal gives us a predictability in terms of tariff. And that's most important. We need to have a bankable tariff. And the last important point is that most of the things from US is from MSME, agriculture, textiles, gems. So these are the sector which is labor intensive. So if there is a stability of the tariff, such a deal is going to give us a great advantage.
Sure. Mr. Bhupati, let me take that across to you now. The fact that a deal is needed, we're hearing it from the private sector as well, that, look, it's good to have some kind of certainty. But that's where the Indian negotiators come in, that even if we do get certainty by way of an interim trade deal, what's the guarantee that tomorrow India won't face fresh tariffs under Section 301?
No, that's a great follow-up. And as I like to say, there are no solutions, only trade-offs. Ultimately, it is in India's best interest to have a deal, even if it is imperfect. I'm not going to pretend to disagree with what was just said on that regard. But ultimately, the deal needs to respect some of the elements that are very explosive here in India. It needs, if in America, the agricultural sector is struggling in some regards. Well, this is politically explosive for here in India, so the deal should still respect the dairy industry, broader agriculture and farming here in India, also generic pharmaceuticals, but also very importantly, the sovereignty of India's data. And I know that's something that in the United States, many of my clients and just companies by and large want to access the Indian markets and get access to that data. But the future of anything from AI to marketing work involves having a secure data environment. So in general, there should be a deal, but it shouldn't come at the cost of what India needs to protect.
Sure. Dr. Chandra, again, the same question to you as far as Section 301 is concerned. The position by India appears to be is that, look, whatever decision that we take as far as tariffs are concerned, it's better that it comes from the USTR rather through the 301 route. Is that a point that, to your mind, will weigh on the minds of Jameson Greer as he gets set to depart from New Delhi?
There are two parts of Section 301. One is the structural excess capacity, which was basically aimed against China. The basic presumption is that you are producing more than your domestic requirement, which China had been doing, US accuses in many sectors. And the government has made it clear that we are not producing in excess of our capacity in terms of domestic market. It has said, in fact, in steel, it is against China, it's against us also, that the government will handle. There is not much issue. But the second part relates to the forced labor. And that's an important part. You see, today, the exporters must realize that trust, traceability are not a part of ethics. It's a part of the product. Social auditing is very important, and we must include it as a price of the product. So once you begin the negotiation, these become the filter. They are no longer ethics. So it's a compliance one, and I'm sure once the exporters go through the compliance routes, through country of origin, through ethics, that there is no forced labor, or there is a traceability which is there in their product, I'm sure this additional duty of 12.5 is more of a pressure tactics than actually they are going to reimpose upon us. In any case, we do not actually fall into most of it. And they have introduced it against 60 countries. India is one of them. So it's a USTR's one of the kind of pressure tactics to most of them. And knowing the industry, Indian industry, once we introduced the trust and the trustability factor in the exports compliance balance sheet of the exporters, I think we will overcome that. The need is just to change the outlook where we basically focus on pricing and to focus also on traceability and trust factor, which is going to give us an edge in the competitive market, not only in US, but also in EU.
Right. That's in fact references to the 301 sections. There were 2 investigations, as you correctly pointed out. We know the result of only one of them so far, which is in fact suggesting a 12.5% levy in India. We still don't know the answer to what the other 301 investigation could lead to. Mr. Bhupati, let me come to you. I was talking to a senior former US ambassador who was essentially indicating that even if there is some kind of strategic divergence between the two countries, that perhaps they're not seeing eye to eye on the geostrategic side of things, on the economic side, there are a lot of synergies to explore, which is what Mukesh Aghi was also pointing out. To your mind, what are some of these levers that could perhaps push the two countries to sign an interim trade deal?
So, to push for an interim trade deal, there would be more synergies on the structural elements of doing business in India. One of the key elements that really pushes a lot of American industry back are the standards that India has across getting started with business. So that I know is one of the elements of that is being negotiated right now, is the ease of doing business in India, especially as it pertains to pharmaceuticals and chemicals. This is aside from the suits brought about by 301, for example, the investigations brought about by 301. So aside from that, ease of doing business is really important. India has a lot of safeguards to protect its industries, and America has a lot of deregulation. So kind of coming to terms on the economic cultural grounds is difficult, but very worth exploring. And aside from that, India in the United States need to kind of come to terms on what are the different layers of tariff that they can absorb. Now, fortunately, fortunately for India, the GDP is mostly built around consumption and investment. And so for India, there needs to be certainty in what the trading environment would be so that CapEx can continue and foreign direct investment can continue to flow. But aside from that, on the Indian side, it's really about having a preferred relationship on how India can be the China plus one policy, which I know gets a lot of pushback, but that's how a lot of American investment looks to India as Asia as kind of a monolith.
Sure. Dr. Chandra, let me come to you again. Even as we discuss the nuts and bolts of what it will take to put ink to paper as far as an interim trade deal is concerned, given the fact that there is a lot of sensitive issues at play, we were just talking to Mr. Mukesh Aghi, who pointed out how preferential access could be one of those sensitive issues that India is trying to drive home, but perhaps the final sanction will only come from White House, will only come from President Donald Trump. You think this is more a political exercise than it is perhaps one of negotiations?
You know, I was listening to Mr. Kent Bhupati, and my take is that while there should be an urgency to sign the deal, there should be no anxiety to it. Because a bad deal is a result of a deal which is not happening on a time is a result of negotiations, but a bad deal is a result of economic output. So a bad deal will put us many years back. So my issue is that we need to do a smart deal. And when I say smart deal, what do you mean? In fact, we have to SMART. We have to have a kind of a strategic involvement. Both US and India have sensitivity around certain products, and we must be aware of it. The second part is that the market access focused. US is looking for certain markets, India is looking for certain market, and our market is more labor intensive, where China is not very competitive there. So we need to get that market access. The third part is it need to be adaptive. Today technology is so disruptive and so many multiple deals are being concluded with other countries and in different sectors that whenever there is an adverse impact on an economic deal with USA, we need to realign it. The fourth is that it has to be reciprocal, responsive, and most important is realistic. I was, in fact, in one of the articles, I was saying that most of the deals which we do, we see the results after 6 months. India, it's high time should start monitoring on the real-time basis with analytics built on. In fact, Mr. Bhupati he's a great AI person, but most of the deals, whether it's FTA or economic deals, we do not monitor it on the real-time basis. If we have the data where we set up at the ice gate and we can see the kind of import which is going to harm our industry, we can immediately raise a red flag. And the last part is that the T, which is the tariff smart, time-bound, and transfer of technology, on which US is most reluctant. So we need to have a smart deal rather than an immediate deal.
Right. We're running out of time, Mr. Bhupati. Quick 30 seconds again. The same question to you. Do you think to cross the line, we'll need the political blessings coming in from the White House, from the Washington as well, before we're actually able to put ink to paper?
Ultimately, I think the answer is yes, to be quick about it. And just history over the last year and some months shows us that. But ultimately, this, while I won't disagree that a smart deal is absolutely the best way forward, the likelihood of a bad deal is just not as likely as having an interim that will be agreeable. And as long as there's a roadmap for bilateral trade agreement to happen in the coming few months, then that would be best in line for India, because ultimately, looking at the latest data from the Bureau of Economic Analysis, the total amount of trade back and forth with the United States and India has decreased over the last 6 to 7 months. But at the same time, the U.S.'s export dependency from India has also decreased. So the United States is actively trying to diversify. And so having a deal brings certainty and clarity to India's economy and capex going forward to 2026.
Right. So clearly a number of moving parts that we need to keep our eyes on. I'd like to thank Dr. Chandra as well as Mr. Bhupati for joining us and sharing their insight. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
than 4 decades, Kanwal Rekhi has been a defining force in Silicon Valley's technology and venture capital ecosystem. From becoming one of the first Indian origin CEOs of a NASDAQ-listed company to backing generations of entrepreneurs through venture investing and mentorship, Rekhi has helped shape the global innovation landscape.
She would say, Kanwal man sing. Let's go dancing.
Now, as the AI revolution triggers a new technology cycle and capital flows into the next generation of innovators, Rekhi offers a front-row view into what comes next for startups, investors, and India's place in the global innovation race.
I'll be back.
Hello and welcome to this very special edition of Voices from the Valley. I'm Shireen Bhan. My guest today is quite literally the OG of the Silicon Valley. He came to the Valley before it was even the Silicon Valley in the 1970s, early 1970s. And if Valley folklore is to be believed, he got here from IIT Bombay with $5 to the US and then, of course, made his life and has left a legacy that spawns not just his company that he started and took public, but of course a whole host of companies that he has invested in. Joining me on the program today is Kanwal Rekhi. It's great to have you back on Young Turks. What an absolute pleasure to see you doing all that you're doing and thriving at 81.
Oh, it's my pleasure. Well, the age is just a number, right? Like to say. And I'm hoping to do this at 91 and maybe at 101.
And there's a reason why 101 specifically.
102 specifically.
102 specifically, yes.
Because that'll be 100th anniversary of India's independence. And I was born in 1945, so I have to be 102 to be around.
To celebrate the great Indian dream.
The great Indian dream, see the emergence of India, it's already happening, but by that time it should have happened.
Let me start by talking to you about entrepreneurship. Through the scores of companies that you've invested in, through the dozens and dozens of founders that you've backed and believed in, if I were to ask you to distill for me the top lessons of entrepreneurship, what would those be today?
So entrepreneurship is achieving your full potential. It is a self-empowerment. It's a self-empowerment where you become an independent person and reach your maximum potential without any hindrance, without any, when you work for somebody, somebody has to give you the promotion, somebody has to have to acknowledge your work, somebody has, it's sort of in charge of your destiny. Entrepreneurship is taking charge of your life. So I love that part of it. And the part I really love is, you see a young, timid, shy, tentative person, with a dream, and 3, 4, 5, 6 years later, is a very confident person making it happen. That transition is, I just love to watch.
And that was a transition that you made yourself because you came to IIT Bombay and I believe you couldn't speak any English at IIT Bombay. You were quite socially awkward. And then you made the transition of moving here to the US and starting afresh.
So I use myself as a role model for people. If I could do it, given where I started from and how far I went, what is stopping you? So that's where I start with the entrepreneurs. Don't let anything stop you. Don't let your shortcomings, whether you stutter, you don't speak English, nobody believes in you. Don't let anything stop you. Empower yourself. Overcome your shortcomings. Overcome your things and make it happen. So that's the core message of entrepreneurship to me. Entrepreneurs are, so when I start thinking through, I could do it. Am I the only one in India who could have done it? Then I come back and say, no, there are millions and millions of me out there. Just waiting to be inspired and interested. So that's my starting point, and that was the basis of TIE. That's and I see it happen. I was in New Jersey on Saturday. There was an event held by TIE New Jersey. It was amazing to see the energy, young people. I was getting mobbed. And So I think something is happening. Something is happening now. The Indians are finding their place under the sun.
Indians are finding their place under the sun, but let's talk about what's happening here in the Valley. And you've gone through pretty much all the eras of tech shifts, of innovation, of consequential impact on account of technology. We're talking about living in an AI world today. We've just seen SpaceX list a historic listing. What do you make of the changes that have taken place just in the last few months?
It's amazing, right? It's really amazing. So let me put this thing in perspective. So when I arrived here in the Bay Area in 1971, the chip industry was in its infancy. Intel, National, AMDs were startups. They were startups. They are not done public yet. And we had just transitioned from using discrete components like transistors, resistors into integrated circuits. Simple functions, simple functions. I lived through that wave. The SSI, small scale integration, to MSI, medium scale integration, to LSI, large scale integration, to VLSI, and simple gates between microprocessors, DRAMs. I saw that transition into the desktop computers, and then into networking, software revolution, turning into internet revolution in 90s. Internet revolution going on to become dot-com revolution, social, local. So there's been a wave after wave after wave after technology. Every new thing builds upon what was there before. And so what you're seeing now, the AI is the final culmination of all that. The compute power has become massive, essentially free. Memories have become essentially free. The bandwidths have become essentially free. So you can use all the compute power you need to make those AI type of applications. So I describe this whole thing like surfing on the beach. You draw out on the beach and you paddle out and catch the wave and ride the wave. And the wave brings you back to the beach. Then you paddle out and catch the next wave. Now, each wave is bigger than the wave before. And this AI wave is almost a tsunami. It's a massive wave. And it's not going to stop. It's not going to slow down. It's not going to slow down. Just to give you the Anthropic number, I will talk about the SpaceX also. Anthropic did a $10 million quarter. $10 million quarter last quarter. $10 billion quarter. They only have 3,000 employees. Do your math. They are going to have $3 million revenue per employee. India's GDP is $2,500 per employee per person. Imagine 1,000x of that number. So the technology is producing value, which is translated into the wealth for a large number of people. Every employee at Anthropic is going to be multimillionaire. SpaceX is the same thing. SpaceX valuation now is close to 3 trillion, over 3 trillion. And look at how many employees they have. It's amazing. So the wealth creation is happening on a mass scale. And see that, and that it feeds back. Now there's a wealth available to go back and take higher risk, more risk, invest in more far out ideas, right? So this has turned nuclear. It's a self-sustaining nuclear reaction.
I want to go back to entrepreneurship. The companies that you have backed, the founders that you have believed in and invested in, what have been, if I would ask you, the common qualities that helped you identify your big bets?
So there's no one formula. See, that's the beauty. There's no one trait, no one formula. There are Punjabi entrepreneurs, there are Bengali entrepreneurs, there are Gujarati entrepreneurs, there are Telugu entrepreneurs. So there is a combination of traits. There are combination of traits that starts to make an entrepreneur happen. It always starts with a person who is restless. Who wants more? That sounds right. The dil mange more, right?
Dil mange more, absolutely.
Yeah. You need to have a person who starts to say, is this all there? Is there life for me? I achieved my maximum technical potential when I was 35. There was no more technical ladders runs to climb. And I'm saying, is this all there is to life for me? I'm not stay here. Or, that's when I made the leap and become an entrepreneur. The entrepreneurship is a limitless opportunities. You define what you want to do, and then you redefine. Maybe I want to do more. So when I start at the person, I start to assess how much fire he has. What is driving him? If money is driving you, you're not going to sustain it. You have to have this burning desire to prove how good you are. And willing to take all the risk, give up a nice job, paying you lots of money, in security. You're willing to trade that for achieving your potential. So it takes me a while to assess this person has what it takes. It's not anything to do with technology, nothing to do with markets. Technology and markets are always changing. They are always changing. So you can't bet on a technology market. What was good yesterday is obsolete today because of AI. All those software as a service companies were golden about a year, 2 years ago, right? Now they are in the tank. So new technology obsoletes the old stuff very quickly. So you cannot bet on technology, and you cannot bet on markets, but you can bet on a person. And so I start to assess a person. Does he have the fire? Does he have the what it takes to take the risk?
I want to understand from you, one of the aspects of entrepreneurship is also learning to cope with failure. Because not everything that you do is going to be successful, but learning to bounce back from failure, learning the lessons from failure, and destigmatizing failure, which has been a culturally a hard one to do in India.
The failure has been stigmatized as bad. Failure to me is a learning experience. It's a feedback. It's a feedback to you. You did something wrong. You cannot blame failures on others. Once you start to blame failures on outside factors, you lose. You always say, what did I do wrong that time? What I need to be doing different. So failure is a learning experience. It's a feedback from system to you. And you should learn to embrace and own your failures. Be proud of them. Be proud of the, so failing, it's like learning to ride a horse. You're going to fall. You're going to fall. Learning to ride a horse, you don't fall. What do? You get back on the horse. You fall again, you get back on the horse. So that's the thing. Eventually you learn to ride the horse. So to me, once you start to say, failure is something to be ashamed of. No, it's not a shame that you failed. In my opinion, it will be a shame that you didn't even try. You didn't even try to. Failure is a part of life, especially when you live on the edge, when you play the high-risk game of entrepreneurship. In a competitive sport, not everybody will win, right? NFL football in America, right? IPL cricket in India, the best teams lose. But you get back in the game. Every game is a new game. Every day is a new day, right? So you have to learn to put things in perspective. Failures are not catastrophic. When you're in 20s, the fact that you failed doesn't mean anything. You get back in the game. So I look at the failure. Without you fail because you're going for the stars. You're overreaching. And you're going to fail sometimes.
Well, since we are talking about lessons in life, I also want to talk about lessons from love. And you have quite the love story. You met your wife, courtesy a friend of yours, and you were pen pals for what, almost 4 years before you first met her?
Yeah, almost 4 years. Anne was a Yankee, from Connecticut. And I was
a Punjabi from India. How did this love story happen?
We connected through various means and became pen pals and started to write to each other. And we wrote to each other for 4 years. And so Anne grew up in a dysfunctional household in Connecticut. Her parents were alcoholic. So when she was a young girl, Sarah was on her own. She was always looking out to see what's there in life. And she went to New York World Fair and signed up at the Parker Pen Pavilion, to find pen pals. And so eventually, I'm sure she was reaching out. So we got connected, and we started to write to each other. And long letters.
9-10 pages.
9-10 pages letters. In the handwritten, long hand. There was no word processor back then, right? And so we got to know each other really well. So when she joined the Air Force, U.S. Air Force, and so I am here in the U.S. now. I done my master's. I am living in New Jersey, and so she finally says, "Oh, I'm coming home for vacation. Maybe we can find time to meet." New Jersey and Connecticut are not too far from each other. And so we, I had moved to Fort Lauderdale by the time she was coming for vacation. So we met in Fort Lauderdale, and it was love at first sight for both of us. And after a week, together, I said, why don't we get married? And she sort of had that in the back of her mind, but she was surprised with the speed with which I moved. But she said yes.
Can you replicate the valley, the mentality at least of the valley in India?
Absolutely. So let me give you a different perspective of India. So the India has spirited Punjabis. It has literary Bengalis. It has cerebral Madrasis. It has business wala Gujaratis. You have all the things you need, and you're making khichdi out of that one in places like Bangalore and Hyderabad. Bangalore and Hyderabad are the makings of the next Silicon Valley. You just need to loosen up the environment. Just loosen up the environment. You have to acknowledge that India is a syncretic, multi-ethnic, multicultural, multi-religious society, and that's good. That's not bad. That's good. Syncretic part. So let me give you a little bit more perspective. There was a Hindu period, Jain period, Buddhist period, Muslim period, British period. That brought us here. So imagine India, which didn't have the Hindu and the British influence. You have Afghanistan to show. India that didn't have Muslim and British influence, that's Nepal. You can see the difference between them and India. Pakistan, India were the synthetic part. Pakistan chose to become Muslim and starting to renounce their Hindu past and all that, and we can see them redressing very rapidly. Should India follow Pakistan's path and say we're going to renounce our Muslim past and be Hindu? They will just start to redress. We have a khichdi of all types. Let them compete. Let it open up. Let it happen. So we have nothing missing in our genes. We are the smartest people. We are the most creative people, right? What is holding us back is the policies, the socialist mindset, looking back at some past glory that we are trying to achieve rather than looking forward. Hey, how do we move forward? Why do Indians, by the way, Indians of all types come to America, Muslims, Hindus, Sikhs, Punjabis, you name it, they all do well. You cannot say this subgroup does better than others. They all do well. Bengalis are doing really well in startups. Telugus are doing really well in startups. Punjabis are doing really well in startups, right?
Indians are doing really well.
Indians, that's the point I'm trying to make.
Yeah.
So we need to get back to being we are a khichdi, and it's very good. Let it happen. Let it happen. How do we free up? How do we provide the Silicon type of environment? Easy access to capital. The government has so many rules, unnecessary rules, which don't make sense. You can do a startup overnight here, incorporate on the internet, and start your business tomorrow. You do financing, you can do mergers, acquisitions, like that. There are no rules defining any of that stuff. You can go bankrupt overnight. In India, you cannot go bankrupt. Merger and acquisitions, there are 50,000 rules. You cannot do this, you cannot do that, you cannot send this money. So we have companies in India. When we send money from the US, they cannot use that money for certain purposes. When they sell stuff in India and raise money, they cannot use that money for other purposes. Money is money is money. Money should be fungible. Oh, the money you raised in India can only be used for this purpose. Money you brought from US can only be used for this purpose. Whole bunch of rules which consume a lot of energy. So our problems are not problems British left behind. They are self-inflicted. The British have been down for 80 years. How long are you going to blame them, right? How long are you going to blame them? It's been 3 generations, right?
It has been 3 generations. Let me end by asking you, at 81, the life that you've lived, all the experiences that you've had, to a young startup founder today, what is it that you would tell them?
Aim for the stars. Shoot higher than you think you can. You can. Go all out. If you didn't make it, you're still going to be better off than you were otherwise. If you aim for the stars, you may end up on the moon. You aim for the moon, you may end up nowhere.
Well, so keep trying and don't let anything come in your way or hold you back.
No, that's the other point. Don't let anything stop you. Don't let anybody tell you you can't do it. Don't let anything, your personal short-term means find a way to overcome. I had speech impediments. I was physically awkward. By the way, I didn't speak English very, very well. But in 1989, when I was the EVP at Nobel, I was a Nobel spokesperson on the Wall Street. For 2 years in a row, I was voted as the best spokesperson of any company on the Wall Street by Wall Street analysts. Which was very surprising to people. People with a speech defect like me is being voted because I spoke with the clarity. I spoke I was a good storyteller. Storytelling is, by the way, at the heart of entrepreneurship. You develop a story and then make it happen. So I went from being a stutterer to a best spokesperson on the Wall Street, by sheer determination.
Kavareki, what an absolute pleasure. Thank you so much for joining us on Young Turks and on Voices from the Valley. We wish you the very best of luck and we look forward to seeing you back in India.
Thank you.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US and Iran disagree on nuclear inspections and the future of the Strait of Hormuz. US claims Iran will not be allowed to charge tolls in the strait, but Tehran insists there will be no return to the pre-war situation in the waterway. Crude oil prices dropped to levels seen before the war in Iran. Brent crude trades below $76. President Trump accuses oil companies of price gouging consumers and calls for an investigation. Dalal Street rebounds after yesterday's sell-off. Sensex and Nifty gain over 1%. Nifty moves back above 24,000. Rupee regains some lost ground against the dollar. Gold prices declined to the lowest level in nearly 7 months. The yellow metal is down 10% just this month. Silver prices also hit a 6-month low after dropping more than 20% this month. Strong dollar hawkish US Fed and weak data from China dent sentiment. US Trade Representative Jamieson Greer and Commerce Minister Piyush Goyal hold negotiations for the second and final day. Both nations are looking to finalize an interim trade agreement before the 24th of July when the 10% tariff structure enacted by the White House expires. HDFC Bank is likely to finalize a new non-executive chairman by the end of this month. Sources say 3 names have been shortlisted and the RBI has asked the bank to expedite the process. Gautam Adani announces a 2 lakh crore rupee capital expansion plan for the power business, aims to build 45 gigawatts in power capacity over the next 5 years. Amazon doubles down on quick commerce business as global CEO Andy Jassy visits India, plans to expand services to 300 cities. Shares of Swiggy and Blinkit's parent eternal decline in trade. SEBI considers a common ad code for regulated entities, proposes permitting celebrity endorsements at brand or entity level, also seeks to expand the definition of celebrities beyond film stars to include sports persons and social media influencers and even virtual avatars. Any influencer with more than 5 lakh followers on a single social media handle may be treated as a celebrity. The government clarifies on its ethanol blending program, dismisses concerns that the use of E20 fuel could affect the validity of vehicle insurance, says no widespread engine failure has been reported on account of ethanol blending, also rejects claims that sugarcane juice is directly being mixed with petrol. Cristiano Ronaldo scores twice as Portugal thump Uzbekistan, becomes the first player in the history of the game to score in 6 different World Cups. Ghana holds tournament favourites England to a goalless draw. All right, to the top story this evening, the administration of the Strait of Hormuz and inspection of Iran's nuclear facilities continue to be points of contention as Tehran and Washington continue talks. Here are the latest developments. U.S. Secretary of State Marco Rubio has said that Iran cannot charge tolls for shipping in the Strait of Hormuz. Speaking to reporters in Abu Dhabi, Rubio said that the strait is an international waterway and that U.S. would provide for freedom of navigation in the strait. Tehran has insisted there will be no return to the pre-war situation in the waterway. U.S. President Donald Trump also claimed that 19 million barrels of oil flowed through the waterway yesterday. Addressing a rally in Pennsylvania, President Trump said that oil prices will come down further. Separately, in a social media post, President Trump accused oil companies of not lowering fuel prices in line with falling crude costs. Trump said that he has instructed the Justice Department to immediately start looking into the matter. Meanwhile, Iran continues to insist on the withdrawal of foreign forces from the Gulf region. Speaking to state media, Iran's chief negotiator Ghalibaf said that the deal to end the war, and I quote, is America's declaration of defeat, end of quote. In the oil market, Brent crude prices slid below the $75 mark, hitting its lowest level since February 28th. According to shipping data from Kepler, 31 vessels have crossed the strait today. 2 India-flagged crude tankers are scheduled to arrive in Gujarat today. This as Oman announced a shipping transit corridor in the strait with the International Maritime Organization.
Yesterday, 19 million barrels of oil flowed out of the Strait of Hormuz, a very beautiful place. That's the most oil in the history of the strait. No, it's never been you've never seen anything like that. It's called an oil gush, and most importantly, we are ensuring one thing very importantly, because this is why I did it. I did it for this reason, 99% for this. Iran will never have a nuclear weapon, and they've agreed to that.
Well, that's the law. It's an international waterway. No country is allowed to charge tolls or fees on an international waterway. That's existing international law. That's the way it is in international waterways all over the world, and that's the way we expect it'll be here. So I don't think we have anybody to convince around here in that regard. I think all the countries in this region would agree with us.
We have not had a meeting with the Director General of the International Atomic Energy Agency, nor do we have any plans for an agency inspection of Iran's nuclear facilities that were damaged as a result of the military attack by the United States and the Zionist regime. Basically, there is no procedure at all in this regard.
All right, on to the day's market action. Market ended near day's high with Sensex and Nifty rising nearly 1% each. Nifty ended above 24,000 led by financial heavyweights and Infosys. Nifty IT emerged as the top gaining sectoral index while all constituents of Nifty Bank ended in the green. Reema Tendulkar is here with the market track.
It is indeed a strong comeback Tuesday for the Indian markets. The Nifty closing above the 24,000 mark, so the bulls firmly in charge after yesterday's weakness. Midcaps, though, relatively underperformed, in fact, flirting with the flat line by the time we closed up for trade. But before we get to the movers, here's what changed the mood. Brent crude prices. Brent crude is now back below $76 per barrel, which is the level it was pre-war. So in a way, the crude risk premium that was impacting the Indian markets is now fully unwound. There were two sectors where we saw which did the heavy lifting, and we saw blue chip buying. One is IT and the other one is banks. The Nifty IT index rebounding more than 2%, but to put it in context, it's down 5% this month, 26% lower from the start of the year. The other one, which has been quietly moving up, is banks. So banks were up 2% today, and from the start of the month, it's up more than 7%. Individual movers, Trent. This is on the back of the FY26 AGM, where the company said they're still in the early stages. They're targeting 50 West Side stores, 200 to 250 Zudio stores every single year. Adani Enterprises, in fact, the entire Adani Group complex were hired today. There was an AGM today. But on Adani Enterprises, Morgan Stanley has initiated coverage with an overweight rating, and they believe that this is India's premier incubator with an exposure to multi-decade themes. Talking about the IT names, well, you had TCS, Infosys, Tech Mahindra all participating in today's banks, in today's rally. In talking about banks, the trigger was the RBI clarifications on those FAQs. So basically, they're saying that banks, including overseas branches, can now lend against the FCNRB deposits marked lean. So you're seeing a big move in private sector banks, not just today, but as I said, they've been quietly moving up. So ICICI Bank has gained in 10 out of the last 13 sessions.
Indian benchmark bond yields and swap rates fell to their lowest levels in 3 months. This comes a day after the Reserve Bank released a detailed set of frequently asked questions to clarify on its forex swap scheme to attract NRI deposits. Right, metal stocks have continued to extend losses amid weak global sentiment and a strong dollar. Gold prices also declined to the lowest level in nearly 7 months. Manisha Gupta brings us more. Manisha, what led to the fall?
Well, yes, yet another day and further extension in sense of decline in base metal prices is what we are dealing with. Overnight was 3 to 4.5% of a cut in base metal prices, and we are just looking at further declines today as well. This is happening on the back of strength in US dollar index, which is holding quite firmly above 101.5 therein. Also, when you look at the hawkish US Fed statements that the street is still digesting and anticipating a probability of a 25 basis point rate hike by the time this year ends, also has led to some decline coming in for the markets. It also is about the weak China industrial data that the street is dealing with, and the fact that there is weakness or slowing down in sense of automotive and industrial demand is also weighing on in case of metal prices. The opening up of Strait of Hormuz and the West Asia conflict, as of now subdued at least for the next 60 days, is what also has led some premium of the prices. And then it is about profit taking as well. Remember, the metal prices had gained quite a bit. We've seen multi-year highs and all-time highs in case of some of those metal prices. So institutions seem to be getting in some profit taking. There also is selling from investors to raise cash amid losses that you have seen in AI and tech related stocks. So metals have bore the burnt of that as well. So when you look at the last 1 week or last 5 or 6 trading sessions, we've seen a negative return in many of these metal prices. Copper, for one, has declined 5.5% in last 1 week. Aluminum is down 7%. You have zinc, which has declined 4% as well. And this is not just limited to base metals, because the precious metals have continued to decline. Gold is down 4.5% in last 1 week. Silver is down 10% in the same time.
All right, thank you, Manisha, for that. Moving on, U.S. Trade Representative Jamieson Grade and Commerce Minister Piyush Goyal held negotiations for the second and final day. Both nations are looking to finalize an interim trade agreement before the 24th of July, when the 10% tariff structure enacted by the White House expires. Abhimanyu Sharma has more. Abhimanyu.
Well, India and the US have concluded a series of meetings which were held over the course of 2 days, that is yesterday and today, in which India's Commerce and Industry Minister Piyush Goyal had met the US trade representative, and teams from both the sides had engaged in discussions on several issues surrounding the interim trade deal and also the larger BTA, the larger trade agreement which both the sides are discussing. The Commerce Ministry has issued a statement to the same. It has said that in multiple rounds of discussions, both the sides held discussions and explored avenues to further deepen economic partnership, and they reviewed the core elements of the BTA, while they noted progress in the recent months as far as the negotiations between teams from both the sides were concerned. Now, market access, digital trade, supply chain resilience, non-tariff barriers, expanded cooperation in strategic sectors was discussed, even as both the sides welcomed the momentum in talks which has been noted in the past few months. Now, it remains to be seen how early both the sides are going to discuss as well as finalize the tariff architecture which is going to apply on goods flowing into both the countries respectively, and both the sides are looking for a preferential tariff access for their respective goods to not just provide certainty to their exporters but also to provide benefits to exporters, businesses and agriculturists in both the countries. Now, all eyes of course would be on how early this tariff architecture will be implemented, since the 10% tariffs are going to lapse on the 24th of July, and in case a deal is not done by then MFN tariffs are going to apply. So both the sides would be looking to intensify negotiations in the coming days and would be looking forward to come up as well as implement a tariff architecture as early as possible.
All right. Thank you, Abhimanyu, for that update. Shifting focus now, Noel Tata will step down as chairman of Trend after a 3-decade stint. The 69-year-old joined the group's flagship retail company as a director in 1998 when his mother, Simone Tata, established the company after the divestment of Lakme. Tata Group governance norms mandate retirement at 65 for executive directors and 70 for non-executive directors. Now, SEBI considered a common ad code for regulated entities. The market regulators proposed permitting celebrity endorsements at brand or entry level. It also sought to expand the definition of celebrities beyond film stars to include sports persons, social media influencers and even virtual avatars. Any influencer with more than 5 lakh followers on a single social media handle may be treated as a celebrity. On to a CNBC TV exclusive now. The hunt for a new chairman for HDFC Bank continues to gather pace. Sources have told CNBC TV 18 that the bank has shortlisted 3 names for the position, including a former Reserve Bank deputy governor. Remember, the central bank had approved K.K. Mistry as the interim chairman for 3 months after Tarun Chakraborty's exit. Ritu Singh joins us now with more. Ritu, what are your sources telling you?
Well, yes, HDFC Bank's long-awaited leadership succession process appears to be entering its final phase. We've been given to understand from our sources that the bank has now shortlisted 3 candidates for the position of the chairman, and that includes a former RBI deputy governor. And now the board is likely to finalize its recommendation as early as the end of this month. Now, what is significant here is that the chairman appointment is closely linked to the future of MD and CEO Sashidhar Jagdishan, with our sources indicating that the recommendation for extending Jagdishan's tenure is going to be taken up only after the chairman selection process is completed. Now, this comes against the backdrop of, this governance scrutiny at HDFC Bank, because remember, you had former chairman Atanu Chakraborty resigning earlier this year, citing differences over governance, ethical issues, following which K.K. Mistry was named the interim chairman, and his initial 3-month term has since been extended by another 90 days. Now, importantly, the bank is also expected to receive the findings of this external legal review that has been commissioned to examine the issues that have been flagged by Atanu Chakraborty, and that report is expected shortly, which could help bring some closure to these governance concerns that have lingered since his departure. Now, sources are also telling us that RBI has taken note of the delay both in the chairman and the CEO succession processes, and it has asked HDFC Bank to expedite the submission, because remember, Jagdishan's current term as CEO ends in October, and RBI typically expects the banks to initiate the reappointment process 6 months before the end of the incumbent's tenure. Now, of course, for investors, the key takeaway is that the market could soon get clarity both on the board leadership and the future of the bank CEO, and that could potentially end this months of uncertainty around succession at HDFC Bank.
All right. Thank you, Ritu, for that. The government will divest a 1% stake in Indian Railway Finance Corporation, DIPAM Secretary Arunish Chawla said that the government could exercise a green shoe option of an additional 1% stake if the offer receives strong demand. The offer for sale will open for institutional investors today, while retail investors can bid tomorrow. Axis Bank has raised $800 million through a dual tranche of US dollar bond sale. The private lender raised $500 million through perpetual AT1 notes and $300 million through 5-year senior unsecured notes under its global medium-term note program. Messaging platform Telegram has resumed services after a temporary ban linked to the NEET examination controversy. However, according to a report by the Ministry of Home Affairs, the platform is being exploited for illegal activities like drug trafficking, child exploitation and terrorism. The report alleges that the platform is the new dark web and has alleged misuse to steal personal information as well. The Telecom Department has notified new rules to operationalize the Telecom Act. This marks a shift from the existing license-based regime to a modern authorization framework for telecom services. The new rules will also entail an open transition pathway for telecom operators and single window clearance introduced via a digital portal. And on that note, we'll take a short break. Coming up next, the government clarifies on its ethanol blending program, dismisses concerns that the use of E20 fuel could affect the validity of vehicle insurance. That and much more on the other side. Welcome back. A quick look at the other headlines we're tracking. Mumbaikars woke up to flooded roads, uprooted trees and disrupted train services as southwest monsoon made its onset after an almost 2-week delay. The city received over 200 millimeters of rains. Officials claim all major subways remained open and traffic movement across Mumbai was largely unaffected. The Met Department has issued an orange alert for Mumbai, Thane and Palghar. The government has clarified on its ethanol blending program. The oil ministry has dismissed concerns that the use of E20 fuel could affect the validity of vehicle insurance. Sudarshan Kumar brings us more details. Sudarshan, please take us through the centre's clarification.
So yesterday on PIB website, government has issued clarification related to ethanol blending program and calling the program scientifically validated and being closely monitored by the government. Oil Ministry has also issued the clarification saying the program was first launched in 2003 and after that it was implemented in a phased manner based on preparedness and consultations and rolled out 20% ethanol blending from 2023. And so far, there are no widespread issues of engine failure or vehicle breakdown due to ethanol blending. Now the question is why government had to issue the clarification. So it says it has noted misleading and unsubstantiated claims being circulated on social media platforms. So what are those claims? First, hygroscopic nature of ethanol. Government says entry of water into fuel tank is undesirable for any fuel, whether ethanol blended or otherwise, and modern equipment that we have, it does stop from fuel getting into the tank. Second, claims videos falsely portraying sugarcane juice as being mixed directly with petrol. On that, government says such content is misleading and baseless because ethanol used for blending is produced via established industrial processes from feedstocks like sugarcane juice, molasses, broken rice and maize, and properties of ethanol are vastly different from the input feedstock. Third claim is claims of E20 fuel could affect vehicle insurance validity. On that, we had certain clarification from ICICI Lombard also, and they have said that those claims are completely baseless and misleading and are incorrect. Now, government has also talked about the savings that it's getting from ethanol blending program. So, the program has helped save over rupees 1.4 lakh crore in foreign exchange via reduced crude oil imports. It has created sustained demand for agri feedstocks used in ethanol production. And it's not only the India which is using or which is going in for ethanol blending program. Some of the other countries are doing too. So government says ethanol blending is a globally accepted practice and successfully implemented in several countries like US, Brazil and Japan.
All right, thank you, Sudarshan. Moving on to some international stories. Chinese tech major Alibaba has launched a legal challenge against the US government, seeking to remove its name from a Pentagon blacklist. The US Department of Defense has accused Alibaba of having links to the Chinese military, arguing that its compliance with Chinese tech regulations effectively makes it an extension of the military apparatus. The company has rejected the allegations, filing a lawsuit in a California federal court, calling Washington's decision without basis in fact or law. Meta Platforms has announced a new set of smart glasses for $299 in collaboration with Ray-Ban. This at least $80 lesser than the previous model. Meta and Ray-Ban dominate the smart glasses market with estimated market share of more than 80%. Also, millions of units sold since they first launched in 2021. All right, let's talk about the FIFA World Cup. Cristiano Ronaldo scored twice last night as Portugal thumped Uzbekistan in their second group match. The 41-year-old is now the first player in the history of the game to score in 6 different World Cups. Meanwhile, Ghana held football powerhouse England to a goalless draw. And before we wrap, it's a big milestone for us today. CNBC TV 18 has crossed 5 million subscribers on YouTube, and that number belongs to you. A big and heartfelt thank you to every viewer. Thank you so much. Stay tuned and stay subscribed and stay with us through the highs and lows of the market. Here's to many more milestones together and to telling India's growth story the way only CNBC TV 18 can. That's all on this edition of Business 360. News and updates continue on the other side.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Amazon doubles down on quick commerce business as global CEO Andy Jassy visits India, plans to expand services to 300 cities. Shares of Swiggy and Blinkit's parent Eternal decline in trade.
Customer engagement platform MoEngage acquires AI startup AMP in its first ever acquisition. The deal comes as MoEngage looks to deepen its presence in the US market, with AMP counting several global consumer brands among its clients.
Bengaluru-based space communication startup Cosmic raised $3.33 million in a seed funding round led by Accel and Process. The fresh capital will be used to support commercial deployments, manufacturing expansion, and in-orbit testing of its optical communications technology.
India's new age consumer brands has grown into a $7.5 billion ecosystem. A study by Bain & Company and DSG Consumer Partners reveal that the new age brands have grown nearly fourfold over the last 5 years, outpacing their respective markets.
AI marketing platform Just AI raises $17 million in a Series A funding round led by Base 10 with participation from Y Combinator and Peak 15 partners. The fresh capital will be used to expand its agentic AI infrastructure and scale its enterprise customer base. Well, those are the headlines we've been tracking for you this evening on What's Brewing. Marketers have spent years talking about personalization, yet most customer engagements today still happens through segments and cohorts. Agentic customer data and engagement platform MoEngage wants to change that. The Bengaluru-based company has acquired San Francisco-based AI startup AMP, whose technology enables a dedicated AI agent for every individual customer, where AI doesn't just automate campaigns, but actively makes decisions for every user in real time. Joining me now is Raviteja Doda, the co-founder and CEO of MoEngage. Raviteja, welcome back to Startup Street. Let's talk about the acquisition itself. AMP is a Silicon Valley-based AI company whose technology is already being used by brands like Swiggy and Grab. How did this deal come together, Ravi? Can you walk us through the contours of the transaction as well?
Firstly, thanks, Shruti. It's great to be back on CNBC TV 18. We have known the AMP team for a while. We have common investors and joint customers like Swiggy. And we were genuinely impressed by the science behind what they have built and the impact they have had for customers like Swiggy with regards to incremental orders per user and other metrics. And over the past year, it became clear that we were solving the same problem for both ends. We have the scale and enterprise platform. They have a breakthrough in AI decisioning. So it made a lot of sense to join hands.
Sure.
And on the transaction itself, it is a strategic acquisition that brings the AMP's technology and team onto MoEngage. And we are not disclosing the terms as of now. It's an all-cash deal, which we are funding through our balance sheet.
Okay. So you've not disclosed the numbers. But Ravi, the claim here is quite striking. One AI agent for every customer. Help us understand what that means in practice. What decisions is the AI actually making? And how different is this from the recommendation engines and personalization tools brands already use today?
Yeah, so if you look at current personalization solutions today, right, they're either optimizing for a single use case or a single journey at a given point, or solving for things like channel optimization, timing optimization, and content like recommendations that you mentioned in isolation. However, the true winning experience for an individual user is a complex combination of what is the right content across all the different journeys, and also in terms of the combination of timing, frequency, and channel, right? So AMP enables this complex combination with a reinforcement learning engine that deploys an dedicated AI agent for every individual single user. And each agent learns that person's preferences with regards to content, timing, what actually moves that user to act, and carries that kind of understanding forward across multiple campaigns, right? So recommendation just tell you like what product to show. This decides also about how, when, and why to engage a given individual. And it's also very explainable. It can tell you why it made a choice.
Understood. So let's dive deeper into that. MoEngage serves over 1,300 brands globally. How quickly do you expect this technology to be integrated into your platform, and what measurable outcomes should customers expect? Will there be higher conversions, lower churn, better retention, or is it something else?
Yeah, so because of the technology architecture the AMP has been built on, we're talking about rolling the capabilities in progressively, but with the first version of an integrated product in less than 2 months.
Okay.
And with regards to outcomes, the honest answer is it has impact across the funnel, whether it regards to higher conversions, better retention, and also reducing the message fatigue, which leads to lower unsubscribe rates and opt-outs for brands, right?
Sure.
But what also I believe I care most about is also that the engagement that actually compounds,
Okay.
where the system gets smarter with every interaction.
Sure.
So the gap versus like a rule-based approach widens over time.
Okay. If you could quickly tell me this acquisition also comes at a time when AI is reshaping the SaaS industry itself. Many software companies are moving from being workflow tools to becoming decision-making platforms. Do you see agentic AI fundamentally changing the economics of marketing technology over the next few years?
Yeah, definitely. I think agentic AI changes the entire category. For 2 decades, like MarTech sold tools where a marketer has to kind of log into a dashboard, build a campaign, then the software executes it, right? So the ceiling was always the human bandwidth. Agentic AI basically removes that ceiling.
Okay.
The software stops being a tool you operate.
Sure.
And becomes a system that makes millions of decisions on your behalf.
Okay.
So that shifts the value of the pricing from like seats and more towards outcomes. And the winners won't be either like the ones who has the most features. It would be the ones who have the best decisioning capabilities and the data and the context to fuel it.
Okay. So Ravi, as AI becomes the next battleground, how do you think about competition now? And not just from traditional marketing platforms, but also from AI-native startups that are emerging around the world?
Yeah, so a large part of our growth over the last few years has been driven by migration of enterprise customers from the likes of Salesforce Marketing Cloud and Adobe Experience Cloud, which are, we would call it as legacy enterprise marketing platforms. And with our AI native capabilities and products, it is giving more reasons for enterprise customers to look at modern solutions like ours. And when it comes to new age AI startups that emerge, right, the challenge for them is the distribution.
Sure.
So before they crack the distribution, companies like us have to be agile and operate with that agility.
Okay.
And that's what we are doing it.
Sure.
And when we find very good companies like AMP, we are able to do acquisitions like the current one.
You bring me to my next and final question. We've seen a wave of consolidation in enterprise software as companies race to acquire AI capabilities. Should we expect MoEngage to be more aggressive on acquisitions going forward? And what does that roadmap look like as you build what you call an agentic customer data and engagement platform?
Yeah, so we have a very strong balance sheet. We have been growing at over 40% year on year in terms of our top line. But we don't need to do acquisitions to drive growth. So we want to be selective with regards to our M&A strategy. So we will definitely be on the lookout. We will look at complementary products which helps us expand our TAM or help us cross-sell to our existing customers.
Okay.
And we'll also look at companies which can help us accelerate our go-to-market in markets like US and Europe, which have expertise in certain specific industries or specific countries in these markets. So we will be on the lookout.
All right. On that note, it's time for me to wrap up our conversation. Ravi Teja, many thanks for joining us on Startup Street today and wish you the very best.
Thank you, Shruti.
And moving on what's brewing today, India's waste management and circular economy stories attracting fresh investor interest. Recycle has raised $23 million in a bridge round as it doubles down on technology, deposit return systems and global expansion. The company also reported strong FY26 performance with revenue growing over 53% and losses narrowing. Joining us now to discuss the fundraise, growth outlook, product roadmap and the next phase of Recycle's journey is founder and COO Abhishek Deshpande. Abhishek, thank you so much for taking time out and being here with us on Startup Street. Your performance is showing a great improvement, right? You've delivered over 53% revenue growth in FY26 while reducing your losses from 6% to 4%. So what's sort of driving this improvement in operating leverage and when do you expect Recycle to turn fully profitable?
First, thank you for a warm welcome and having me here today. Definitely what we are doing with it was an interesting year for us because we did about 1,498 crores, which is a 53% growth from 978 crores a year before. And obviously losses reduced, but it's an internal discipline. And then what we are doing is we can see a strong growth possibilities. So our path to profitability is clear, and we are focusing and leveraging on the new opportunities what we have started investing so far in last 3-4 years, and that's going to give us the very soon. I can't commit right now, but then very soon we can see recycle profitable.
All right. And, one of the things that you're using your money this time that you've raised is to sort of boost that deposit return system that you have, right? It's become a major growth pillar for Recycle. How large can this business become in India? And do you see DRS eventually overtaking your traditional EPR and waste management businesses in terms of revenue contribution?
So definitely, it's a major growth engine for us. And we don't look at DRS opportunity only from the Indian perspective. It's a global opportunity, what we have. It's a simple idea. Obviously, in Indian context, if I have to talk that you have to pay a small deposit on a bottle or a packaging, and you get back when you return it for the recycling. So we already have done the pilots in multiple states in the country, like Uttarakhand, and very soon, and very proud to share that implementation is already started in Goa as a state. While we are talking, we have started expanding to the global similar opportunities available in globally also in South Asian market, as well as Europe, where DRS opportunity is massive because DRS is a matured opportunity there in the other parts of the world. So when we are talking about DRS, Recycle is not only focusing on the India, it is a global opportunity for us.
Right. It is a global opportunity, and I'm going to come to that in just a bit. But you've also spoken about strengthening the technology platform with the funds that you've raised. So what are the key product launches or platform upgrades that we can expect over the next 12 months? And which of those could become meaningful revenue drivers for you?
So major revenue driver is going to be for us is obviously definitely DRS. So I would like to share here is Recycle. At Recycle, we are building this almost a decade now. What I always feel about, we are an Indian company, a proud Indian company, making the products for the global market as well. What we have seen really is Indian market is very complex, and the waste management ecosystem is way different than other parts of the world. But what so far a decade's investment, what we have done is to solve that complex problem, and our capabilities, not only from the platform perspective, but we have started building the very strong hardware capacities also for the DRS. And we felt that every Indian state acts like a country. And now we are able to cater to all the states. Multilingual geographical challenges are different in the country. So the preparation was over the time was done for this, and similar Asian market opportunity we have, and then obviously global opportunity what we have, that is giving us the leverage, and we're gonna double down on this, building the stronger capacities further for the global expansion. So our investment, our time is gonna be making the DRS more stronger and ready for the global markets. That's gonna be a focus area for next 12 months for us.
All right, so DRS is going to remain your top focus for the next 12 months. You currently work with brands, producers, recyclers, and governments across the value chain, right? Where are you seeing the strongest demand right now? FMCG, beverages, retail, or government-led projects? And what does your client pipeline look like for FY27?
So we have a very strong pipeline because of the existing relationship with all these brands. And then if you can see that we are Recycle is in business of marketplace and EPR as well. So where we have a very strong existing relationship for 4 to 5 years with the major FMCG brands and enterprises. And now, even though on the DRS, it is like a kind of relationship is getting strengthening with these partnerships. So definitely we have a very strong pipeline, and then we are just focusing on to grow the what Recycle has proven over the time that in the industry leading growth, which we are targeting again for the same year also.
All right. And, you know, before I let you go, you have spoken about these global expansion plans, and you're looking at Europe and UK through partnerships and potential acquisitions, right? Are there specific markets or targets that you're evaluating right now, and how different are these markets from India? Also, are you in talks with anyone? Where can we see that first acquisition come through?
Definitely, we have kept certain amount for the acquisitions. And we are exploring, but not a very active conversation at this moment. But definitely, we are in a very early stage of conversations with few global companies as well, and the Indian companies as well. So if there is some news, definitely would love to share with all of you very soon.
And which is the market you're keen to enter apart from India first?
The Europe is the focus, and Bhutan, which we are targeting at this moment.
All right, Abhishek, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best on this journey going forward.
Thank you. Thank you.
Well, on that note, it's time for us to head into a short break. But coming up next, billions spent, decades of effort, and the Yamuna is still struggling. A Gurugram startup claims the solution could be something as unexpected as human hair. More details on that when we return.
Welcome back. You're still with us on Startup Street. India has spent thousands of crores trying to clean the Yamuna. Treatment plants, interceptor sewers, bioremediation. None of it has been enough. But a founder in Gurugram thinks the answer might be sitting in your salon's dustbin. CNBC TV 18's Aishwarya Anand reports on the hydro hair barrier system and what an independently tested pilot in a Gurugram drain actually found.
sound strange, but what I'm holding in my hand could be better at cleaning India's polluted rivers as compared to those 1,000 crores worth of machines that we've built to do the same job. In India, most of the salons will sweep these into the bin. But today, I'm going to show you someone who's pulling them back out and using them to fight one of the most polluted rivers on earth. This is hair, just hair. No chemicals, no binding agents, and when it goes inside the water, there is no need for electricity as well. Now, the founder tells us that he's going to show us how this can pull out oil from the water. So let's go and check that out.
What you're looking at is a mat made entirely of donated human hair. No synthetic fiber, no chemical treatment. The Kesa Kambali Foundation collects it from salons, brings it here and processes it through a felting machine. It then goes into a floating barrier system and gets dropped into some of India's most polluted drains. Now, what happens to the water on the other side is what the story is about.
Hydro hair barrier system, how does it work?
We made this floating barrier. What it does is when you install these mats into the barrier, when the water passes through the barriers, filters, it absorbs the contents like suspended solids, fecal coliform, and then the oil, especially the oil actually, hair filters. Creates a biofilm. The bacteria starts eating the pollutants. And it is a continuous process.
Now, you ran a pilot in Gurugram stormwater drain and you shared the lab report with us, which has been verified by Vardhan Enviro Lab, which is an independent accredited facility, right? So, if I am a skeptic who is watching this and thinking, wow, this sounds nice, but how does this actually work? What do the numbers actually say on that front?
It is a NABL accredited lab. We did the pilot in on the GMDA, Gurugram Metropolitan Authority, Development Authority's site, where we installed these hair barriers. On the spot, we did the testings like inlet and outlet of the water. BOD levels, it came down from 143 mg per liter to 80 mg per liter. And the COD levels also, and the TSS, if we talk about TSS, total suspended solids, fecal coliform came down from 500 to 523 something to 70.
Even after the treatment, your outlet water's BOD, COD level is still above the permissible limit for discharge into surface under government norms. So this isn't a finished solution yet. What does that gap tell you about where this technology actually stands today?
This is not a replacement for the STPs. So what STPs can do, you cannot just rely on our hydro hair barrier system on that. But it will increase the efficiency of the STPs. If we put it together, even if we can get like 30% of the pollution less from this solution, I think we are good right now.
Once the mat has done its job, absorbed all it can, what happens to it?
In two ways we are actually recycling these mats. If the pollutants, chemicals or some hazardous waste, it is stuck to the mat, we are going to give it to the waste to energy plant. But if it is waste which is coming from households, organic waste, we can treat it with the bacteria and then put it as a mulch.
India has spent thousands of crores trying to clean the Yamuna. Treatment plants, interceptor sewers, bioremediation. Now, decades of large, expensive engineered solutions. What I've seen today is one pilot independently lab tested showing genuine improvement, pollution levels cut by nearly half in places. But even after that improvement, the water still doesn't meet the government's own safe discharge standards. Now, this isn't a finished fix, it's a promising first step. And maybe that's exactly the point. If a mat made from hair nobody wanted can meaningfully move the needle, even without solving the problem outright, it's worth asking what else we're throwing away that could be doing the same. With camera person Gaurav Kumar, this is Aishwarya Anand for CNBC TV 18.
While moving on, Queen Maxima of the Netherlands is in India and she has a message beyond digital payments. The UN Special Advocate for Inclusive Finance praised India's UPI ecosystem and AI-led financial solutions, calling them a global benchmark. She also pointed to startups like Jupiter and Salary as examples of how technology can help people build savings, manage unexpected expenses and improve their financial health. CNBC TV 18's Rachna Dhanrajani caught up with her. Listen in.
I've been working a lot with India for a long time on financial inclusion. That meant, having people have access to financial services. But now it is about financial health. And this issue is extremely important because it's very nice to actually have an account. The issue is, does that account improve my life? Can I actually have savings? Can I have insurance? Can I actually make it to all that health expenses that actually sometimes unexpectedly come across? And do I have to get myself into unexpected sort of debt? Or can I actually do that with an insurance or with a savings account? I just had 2 visits. One was in Jupiter and the other was Salary. And basically they're all technology companies that actually help people get that credit sometimes for the unexpected costs, but then help them to actually increase their savings by sometimes gamification, by sometimes helping them have insights on their expenses and see how they can actually improve their budgeting, so therefore they have more money over to actually have that sort of, savings, so they in the future can actually buy a house that they can actually rent or buy a house of their own, or that they do not have to have sleepless nights because if something actually happens, they don't have the money to affront it.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates on the other side. Stay tuned.
Education platform Coursera says AI course enrollments on it have risen from about 15 per minute a year ago to nearly 20 per minute today, roughly 1 every 3 seconds. The company has also expanded its enterprise reach to thousands of organizations as demand for AI-related training accelerates across sectors. In February 2025, Greg Hart took over as president and CEO, stepping into the middle of what he calls a rapid shift in how people learn and work because of AI. He joins Shireen Bhan at Coursera's Silicon Valley headquarters to talk about what the surge in demand means and whether traditional models of online learning can keep up.
What a year it's been for you, Greg. Coming into Coursera, you joined in February of 2025. You're in the middle of the AI onslaught. Describe to me what the journey has been so far.
It's been fantastic. So, as you mentioned, I started in February of 2025 at a time when AI, had already been a burgeoning, topic of interest for learners around the world. That has just accelerated. We are seeing the pace of interest in AI skyrocket. A year ago, we saw about 15 enrollments every minute in AI content. So far this year, we're up to 20 enrollments per minute on Coursera, so 1 every 3 seconds.
1 every 3 seconds?
Yes, somewhere around the world, somebody enrolls in an AI course on Coursera every 3 seconds.
Okay.
So it's been phenomenal. And then, of course, as you know, we announced and then closed the acquisition of Udemy, one of our competitors, about a month or so ago now. And so a lot of focus on bringing the two companies together. So it's been an eventful first year.
It has been an eventful first year, and I'll talk to you about the integration of Udemy in just a second. But let's go back to the landscape that we find ourselves in. And I think the question that everyone seems to be asking each other here in the Valley and around the world is, are you going to be cloudified or not? And do you have an answer to that?
Well, I have a really strong perspective on that. First of all, everyone around the world needs to upskill and reskill in this age of AI, because AI is changing what's possible so rapidly that if you're not upskilling and reskilling yourself to enable the right way to take advantage of those capabilities, you will be left behind. That's true of companies, that is true of individuals. That is Coursera's mission. We are aiming to help upskill and reskill the entire modern world for the moment that we're in. There has never been a more pressing need for upskilling and reskilling, post-secondary education than the moment that we're in right now, with the way that AI and technology generally is changing the landscape of what's required in the workforce.
As far as AI is concerned, from a market standpoint, they see it almost as a double-edged sword for Coursera, and that's reflecting on your stock, right? So how do you address some of those concerns on what you can do with AI, but also how do you deal with the headwinds that you have to encounter on account of AI?
Well, I think that one of the things that we're seeing is that there's skepticism that in an age of AI, the content that Coursera has to offer and Udemy has to offer is less valuable. I have a different perspective. My perspective is that in an age where it's easier than ever to create content, the value of expert human-created content from the leading universities in the world, which was how Coursera was founded, and the top technology companies in the world, because we have content from Google, from Meta, from Microsoft, from Anthropic, from OpenAI, from AWS, is even more valuable. And then what Coursera brings to the table is not just a catalog of that content, but a deeply rooted in academia and an education perspective on how to deliver that learning in a way that gives verified assessment and proof of learning. And we see that reflected in the huge demand for micro-credentials across all of our platform. And so I think we are uniquely positioned to actually help with that.
Will that ensure that you can enjoy the pricing premium that you have so far?
Well, I think that that gives us an opportunity to both do a few things. One, continue to expand the audience that we serve. So with the combination of Coursera and Udemy, we now have close to 300 million registered learners around the world. That is a massive, massive number. And we serve 18,000 enterprises. So we're not just a consumer-focused company, but we also help both businesses and universities and governments adapt to the pace of change by enabling them to leverage Coursera to help upskill and reskill their constituents, whether those are employees or students or faculty or government civil servants.
The number that you gave me of individual users who are signing up, what's happening on the enterprise side? How many are you adding every second on the enterprise side?
That number is actually a combined number across both enterprise in terms of enrollments across enterprise and consumer. But we're seeing huge interest in AI-related content, not surprisingly, on the enterprise side as well. And so the primary reason that enterprises come to Coursera or to Udemy is to help upskill or reskill their workforce. Historically, pre-ChatGPT, in November of 2022, that was probably on more technical content or a more general, learning and development type benefit. Now that is increasingly on how do I leverage AI within my workforce? And so what we do with enterprise is really sit down and try and understand the objective that they're trying to accomplish, and then work with them to craft exactly the right approach to enable them to get that upskilling and reskilling in a function by function way. So it's not just general AI education, but it's actually very practical, targeted AI upskilling for a given function within an enterprise.
So how does that change the rules of engagement as well as the partnerships that you have with enterprises, the likes of Anthropic and so on and so forth?
Well, in terms of rules of engagement, we have content from Anthropic on our platform. With OpenAI, we both have content from OpenAI that is offered through Coursera to some of their partners. And then we've actually helped to develop capabilities on OpenAI that they leverage in their OpenAI certificates. And so, which are all AI-focused certificates that they offer, primarily for education purposes. And so we are both a content creator, a content receptor, and a technology creator that works with them.
So what, if I were to ask you to simplify for all of us, what will be the big differentiator and the moat for you going forward in an era where it is easier to create content? I know you gave us a glimpse into why you believe that the content you create is different and not commoditized, but what will be the key differentiator going forward as people refine these skills?
I think one of the big things that we're focused a lot on right now is learning about AI through AI deployment in the flow of work. So using technologies like MCP, Model Context Protocol, we have integrations already with ChatGPT. You know, we were one of the very first partners that they had there. We recently launched our integration with Microsoft Copilot. We have integrations as well with Anthropic, with Claude. And so deploying that within the flow of work, and then also leveraging all of the data that we have on the right way to help people learn. What is most effective at not just going through content, but actually delivering true learning. And we're very focused on skills and skill delivery, skill assessment, and proof in a verifiable way of mastery of that content. That, we believe, will be what sets us apart. It's the history of the company coming out of academia, but it's also what we believe will set us apart as well.
So all the new signups that are happening, everyone coming for AI, or is there anything
Oh, no,
else?
there are a lot of other, so obviously AI is the topic du jour around the world, but there are a lot of other things that we see, not just in sort of response to AI, but generally. So huge amount of interest in human skills right now. So creative thinking, communication skills, resiliency, flexibility. And I think one of the reasons for that, and we've seen interest in content and courses in those areas more than double over the last year. One of the reasons for that, I think, is that our people recognize that as technology is capable of doing more and more, and your technical skills might not, you know, perhaps matter as much as they used to, that the human skills you have actually become a really important differentiator. That's one of the big areas of interest. We're also seeing a big increase in sort of more domain-oriented learning. So in particular, healthcare has been a big increase over the last year. It's one of the few sectors in the US economy where you're seeing a lot of job growth within that sector. And so we're seeing a lot of need for training and learning around healthcare as well.
You know, let's talk a little bit about India, because that is a big focus market for you, not just in terms of the number of users that you have there, but also what you get done out of India. How has that played out for Coursera? And over the next few years, how do you see India playing for the Udemy, Coursera, combined entity?
Well, it's an extremely important market for us, both strategically and also from a, you know, how we build what we build. So more than 20% of our workforce is in India. And that's not just engineering and product. That's across data, operations, marketing, finance, sales, content. We have a huge set of teams in India that are helping us continually improve the product and grow the business. It also is one of our most important strategic markets from a business perspective. So on the Coursera side, it's our number 2 market in terms of registered learners behind the US. And my bet is that India will pass the US at some point in the next few years in terms of just sheer size of number of learners. And then on the Udemy side, it's also an incredibly important market. We believe that there is a real need within India to benefit from exactly what Coursera and Udemy offer. Obviously, the Indian population is massive, and India has historically had a really powerful and important role in sort of initially, you know, offshoring and service organizations, et cetera. A lot of, and of course, it has gone well beyond that, but that's still an important part of the economy in India. A lot of those roles are being directly impacted by AI. And you know, the Indian government forecasts that AI can add about 40% to the economy by 2035. that's only going to be recognized if India can actually upskill and reskill their population to take advantage of that opportunity. That's where we come in. It's one of the reasons that we're, partnering with the government on Karma Yoga Bharat, and we think that's a really important part of helping the government achieve their overall goal of Viksit Bharat. And so we're looking to partner not just with the government on things like that, but also with universities in India. And one of the things that we see a huge interest in India is micro-credentials. And because the Indian government has what I think is a very forward-thinking approach to online learning, where you can take up to 40% of your credits online, we are very focused on working with NSQF to get as many micro-credentials as possible available for credit, just because we see really strong signals, not just from students who are interested in those, but also from employers. 100% of Indian employers would be willing to pay a higher salary to a student who comes out of university, not just with a degree, but with a micro-credential. So there's clear demand for that. And my perspective is for India to actually address that opportunity that AI represents, they need to continue to be very forward-thinking, and we're very excited to continue to play a role in that.
You did a significant price cut for India, down about 60%. We spoke then. How much has that changed the trajectory of growth for you in India?
It's definitely helped. I mean, I think we've been really pleased by the fact that, number one, we're more affordable and therefore more accessible to a much broader set of the population. We are priced in a way that makes much more sense than it had historically. And I think it helps, have a broader portion of the population really understand the value of the offering that we had. Whereas before, it was priced in a way that, a lot of people just unfortunately couldn't afford. Now it's much, much more accessible. And so we've seen that, help with a growth acceleration perspective.
Let's talk about AI within Coursera. I mean, everyone working at Coursera now skilled in AI. How much of AI are you using within the organization already?
Everybody is using AI all the time, every day, in many, many different ways. And so when I joined in February, one of the first things that we focused on is how do we make sure that, because we had been using AI, well, obviously we had lots of courses on AI on the platform, like we've spoken about. We've been using AI on the platform as well as part of our product efforts from very shortly after the launch of ChatGPT back in November of 2022. But I felt like internally, we weren't necessarily like upskilling and reskilling ourselves as quickly as we needed to. And we're a learning company. We need to make sure that we are not just preaching it, but also practicing it. And so one of the things that we did is we created we created sort of a tops down and a bottoms up approach. The bottoms up approach is something that we call AI Sparks. So everybody has access to Gemini, to Chat, and to Claude.
With token limits.
Yes, we are very mindful of token limits. But actually, really, when we started it, we weren't focused on that. We were focused more on making sure that we just gave people the ability to experiment and to really learn. And what we wanted to do is bring people together on a regular basis to just share what they'd learned. And so every month we do an AI Spark session, which is people across the company are volunteering to share, here's what I did, here's how it changed the flow of my work, here's how it improved it. And then people just start sharing, and they're among the most popular meetings that we have as a company. We also have a centralized organization in India, the SOC, we call it, and the SOC takes in requests from any different department within the company of, we have a need for a workflow that we've been doing by hand, or we've been doing in, sort of a semi-automated way, but it's not nearly as efficient as it could be. Can you help us create a better workflow leveraging AI? The SOC will take in that request. In a week, they'll turn around a pilot. They'll then work closely with the team that submitted it. In another week, they'll hand it over. And so we go from idea submission to handover of an actual workflow in 2 weeks, where the SOC has also trained the team in how not just to maintain it and run it, but also to improve it. Because one of the real things that we're focused on doing is every time any team is engaging with AI, we want to make sure that they are improving their baseline of what's possible tomorrow or next week, et cetera. So it's not just using it for, a query to get a question back, but how do you actually create a workflow? How do you create an agent that can help you be more efficient in your role? And how do you cost savings from an efficiency perspective, but also in terms of ROI for things like outbound sales on our enterprise side. And we see really positive signals across all of that. One of the things I'm most proud of about the SSC is that their pilot success rate is 95%.
No.
And so very
And this
few
is
of
all
the
happening out of
pilots-
India.
It's all happening out of India, in collaboration with folks around the world. That is very different than what we've seen from other companies. And MIT cited a study that the opposite was true. Most of the time, 95% of them fail. And so I think that's in part because of the passion of that team and the way that they engage and the way that they are very focused on not just creating a tool, but then also training and helping the people learn how to fish.
In a way, do you think we're at that point where we're only going to see an accelerated pace of creative destruction and we're going to see more entrepreneurship, not less, even though the narrative is that big tech is sort of, controlling everything. There is this tech oligarchy in place. But, do you think we're actually going to end up seeing more creation?
I think we will, for two reasons. One, not everybody's going to work for big tech. And the ability to create a startup is far easier now than it was 20 years ago. And if you think about, just the US technology industry, one of the reasons that the US technology industry is often the envy of the rest of the world is because it created an environment in which it was easier to create startups and raise money for startups in the US than anywhere else. Well, now AI is democratizing that around the world because you don't necessarily have to have access to nearly the capital or the network or the engineering talent to create an idea and create a business around it. So I think it will be very much a diffusive force in terms of the number of ideas that come up, not a destructive force, and in terms of the pace of change that we see.
If I would ask you in terms of direction and in terms of what we can expect from you, in terms of AI offerings, and of course on the back of the Udemy deal, what would the next few months look like? I mean, what could you potentially end up doing at the end of 2026 and 2027?
Well, one of the things we're very focused on right now is bringing the two companies together. So right now we have a Coursera platform and a Udemy platform. Our goal is to obviously get to a single unified platform. That is the number one focus for the
But when do
company
you hope
right
to get
now.
that?
We'll come back to you a little bit later and share that. We're prototyping on that now, and we've been doing a lot of planning on it. It will be, what I can tell you is that that platform will look very different than either Coursera or Udemy do today. It will be, we believe, a far more effective vehicle for not just learning, but skill delivery, and not just skill delivery in a check the box sense, but in actually a verified assessment and proof of that skill delivery, because that's what employers are looking for. And that's certainly when consumer learners are coming to us, that's why they're coming to us. It's why our certificates are so popular, our micro-credentials are so popular. And so it will have AI as a core feature of that platform, and one that helps us deliver an experience that is more in the flow of work or in the flow of life, more interactive, more engaging, and more effective at delivering outcomes.
So, what is the one skill that you have learned in the last 12 months that you've been here? And what is the one skill that you hope to put down on your to-do list?
In terms of the skill that I think I always want us to improve at as a company is how do we move faster? I just think there's so much benefit from speed that will, even if we're moving at 2x the pace that we are today, in a few months' time, I'll still want us to move faster. So that's always the thing that I'm focused on for improvement. In terms of what I've learned over the last year, I would say that one thing that stands out for me is how important it is to ensure that the entire company is aligned around our mission, and that no matter how much you think you've said that and made that clear across the organization, reinforcing that in a regular basis, both of the wins and where you might be struggling against that mission, is so important to give people context and help focus their attention. And so that would be the thing I would say that as I've taken away from the last year.
So what is the message that you want to send out to all the Courserians in India?
Well, I would say, first of all, thank you for everything that you do for not just Coursera and for Udemy, but for all of our customers around the world, whether those are individual learners, whether those are enterprises or universities or governments that leverage Coursera and Udemy. Thank you. Second, continue to focus on those customers, continue to invent the future of learning every day on their behalf. And I look forward to seeing you on my next visit.
Well, we hope to see you in India, and look forward to seeing a lot more of you there as well, Greg. But we wish you the very best of luck with all the plans that you've laid out for us here on the program. And thanks very much for your time today.
Thank you so much. It's been an absolute pleasure.
Well, with that, it is time for us to take a break here, but the conversations and headliners will continue on Voices from the Valley. We'll be back with you in just a moment.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about a year and a half ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is
and
absolutely.
And how do you plan for it?
Absolutely. Everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is one is it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to like work more hours, we're going to invent more days of the week, like while those things they would be nice, they still probably won't keep up, right? So a lot of it is really making sure we are adapting faster and faster. And so that is a lot of how you kind of change the team dynamic. So one is making sure we do have time to learn, to observe, to be curious with our customers. Two is making sure our iteration cycles are very fast, right? So we don't do, for example, planning over a really long period of time, because you can go and make a plan for a roadmap for 6 months or a year, and within like a few weeks that it's going to be out of date.
Right.
So you want these short iteration cycles of what you're doing. You absolutely want a North Star, but you want to be iterating kind of week by week.
So is it literally
adjusting.
week by week?
It's day by day for some teams, at most kind of week by week. Yes.
Agentic future that everyone's talking about at this point in time. Where are we in that journey? Are we close to that inflection point? I'll link that back to what Satya said in his post yesterday, that we have to reimagine the workforce and reimagine work with human capital and token capital coexisting. So what does that mean now as far as the way that organizations are structured? What do you prioritize today?
Yeah, so there's going to be a few things. One is just the overall system that is supporting this new way of working, right? So it's going to be the tools that we use as employees to do our job, whether you're in finance or you're a developer or whether you're a salesperson. There's where these applications and how those applications are going to run within your enterprise, as Satya mentioned in his post, where there is this end-to-end system, right, that has to come together that does allow you to manage kind of your human capital, your tokens, and then really we got to be focused on these different outcomes, right? And knowing what we can do with the power of the technology plus the power of our people. What types of new problems should we go tackle? What is the ROI on that, and what more value can we build? Either stuff that we may be able to do to save, because some organizations and some teams may get the biggest benefit there, but also what else can we tackle together? So it's really bringing those together and not as disparate concepts. But for me, what I focus on in all of the stuff that we do in our team, it's really how do we get to a new cycle of delivering that value, that quantifiable ROI to the customers.
When you came up with the idea of the Agent Factory, and as you look at where we are today, what is the most exciting aspect of it, and what is it that we should be prepared for as we look at 6-12 months down the line?
Well, I think for us, it is continued change, right? So that is something that is
by, Jeetu Patel arrived in the United States as a 19-year-old with little money in his pocket, waiting tables at Sizzler for just $4 an hour. Today, he is one of the most influential Indian origin executives in global technology. After spending over 2 decades building and scaling enterprise software businesses, Patel was appointed President and Chief Product Officer at Cisco in 2025. Under his leadership, Cisco has accelerated its push into artificial intelligence, cybersecurity, and enterprise software, helping drive record-breaking growth in recurring software revenues and AI infrastructure demand. As businesses race to adopt AI, Patel's mandate is clear: transform Cisco from a networking giant into the software and security backbone of the AI era.
Hello and welcome to this edition of Young Turks. I'm Shireen Bhan. We're celebrating our 24th year at Young Turks and our 14th year of bringing you voices from the Valley. So it's a great pleasure to have with us on the program a man who's quite literally at the center of things here in the Valley related to all things AI and tech. The man leading products for Cisco, the CPO. Thank you very much. And President Jeetu, it's great to have you here.
Welcome to Cisco.
Thank you very much for having us. And wow, I mean, this gives a seat at the table an entirely different meaning, doesn't it?
There's a lot of seats at this table.
There's a lot. But are there really that many seats at the AI table today?
We just actually had our Silicon meeting here with our entire Silicon leadership team, and every seat was filled. But it was a fun day. We spent 2 days over here.
But what about the AI table? Is the AI table shrinking or is the AI table expanding?
Ever expanding.
Ever expanding.
Yeah.
What's the most exciting thing? I know you've been talking a lot about the fact that you believe we're in networking super cycle. And what does that mean exactly for all of us?
So as you and I have talked about before, we're moving from this world of chatbots to agents. And these agents tend to be far more consumptive in their network consumption patterns than humans are. So for example, we just did a study. An agent consumed about 450% more bandwidth than a human for the exact same task.
Because they're not sleeping.
They're not sleeping, they're working around the clock. And by the way, what is an agent? An agent is basically a file that actually describes the skills, a file that describes its memory. And so you have to keep making sure that those files get uploaded to the model. So there's a fair amount of kind of network bandwidth because of the chattiness of the system. So what we have here is an infrastructure that's completely going to need to be reimagined to accommodate agents. And we're not even at the physical AI realm yet, where the moment physical AI takes off in a big way, you'll see an even more consumptive pattern on that front. So the reason it's a networking supercycle is because you're going to see this not just in the data center. Now what you're seeing is these agents are also running on your desk side. In fact, there's a whole new class of computing called desk side computing. I don't know if it's actually been something you've talked about during your trip over here, but think about an agent not just running in the cloud.
Right.
You now have people saying, hey, I have a laptop for the human to work on, and then I have like a Mac Mini or a Mac Studio or an NVIDIA PC or an AMD PC, and that's what they call a desk side computer. And that's where the agents run. And you might have hundreds of agents running over there and doing and conducting tasks for you. And that's going to have an enormous amount of bandwidth consumption because for every human, you might have 10, maybe 100, maybe 1,000 agents.
Yeah.
And they're working 7/24. They're 450% more consumptive in their infrastructure needs. So think about what that does to the network, to the compute, to the power.
Yeah.
It's going to be enormous.
It is going to be enormous. So how do you reimagine the network when we're talking about this kind of surge in traffic and consumption? And what are the numbers telling us? I mean, what is the kind of traffic surge that we're already starting to see?
Well, I'll give you some numbers that'll actually just be completely eye-opening for you, which is if you think about our campus branch networking, which is what we call our workplace networking, in offices like this, when you have Wi-Fi access points, you've got switches, you've got routers, that business for us grew at about, it was pegged to inflation. It grew about 3 to 4% a year.
Right.
Last quarter, we had 25% order growth. So imagine that.
Yeah.
And that's not something that's a blip for a quarter. I think we can see sustained level of double-digit growth for a while. And that's because of this kind of pattern shift that's going on in the architecture of the networks itself. So when you look at the numbers from the financial standpoint, there's a fair amount that's going to be spent on these networks because everyone wants to modernize their workplace. When you look at it from agents and what they're doing, every human is going to be a manager of agents. And we now have at Cisco our first product that is completely written with AI.
Okay.
No human lines of code.
At all?
At all.
Okay.
Humans will verify the code, but the agents wrote the code, right? By the end of the year, we'll have about 6 products that are completely written with AI.
Wow.
By the end of next year, get this, we will have 70% of our products that will be 100% written with AI. And in 2 years, Cisco will have no legacy code. We will have refactored all of our code. So when you start thinking about that level of implication on of agents on the workplace, there's going to be a tremendous amount that changes in the campus. Of course, we've been working with data centers, as you know, on the numbers. 3 years ago, there was barely any revenue with AI-related, kind of data center revenue. Last year, Chuck Robbins, our CEO, said, hey, let's make sure that we actually let the market know what we think we're going to be able to do. So we put out a number. We said we'll do $1 billion in year 1 in AI revenue for data centers. We ended up at 2.3.
Yeah.
So we said, next year, what do we do? Which is this year, this fiscal year for us. We said, let's do 5 billion. Let's double it.
Yeah.
We're going to end up at 9.
Wow.
And so there's this kind of massive exponential curve of increase in infrastructure. And then you add on top of that things like security because of Mythos and what's happening over there. And you see different models that are going to be there from OpenAI and from Anthropic that are going to be very, very potent. I think there's going to be a tremendous amount of emphasis placed with every class of customer we have, whether it be a hyperscaler, whether it be a neo cloud, a sovereign cloud, a service provider, or the enterprise, in completely kind of changing their architecture to go out and accommodate for these new patterns of work, the new ways that security is going to be implemented, the new kind of exploits that the agents are going to be participants in and drivers of sometimes, and they'll also need to be participants of the defense against the agents through machine scale.
Yeah. I'll address that and what you're doing on that front in just a second. But that was pretty mind-boggling what you just said, that in 2 years, all legacy code will be re-architected as far as Cisco is concerned.
There will be no such thing as legacy companies anymore. That's a thing of the past. But
what does that mean exactly?
So what does a company... But by the way, this is an interesting thing because legacy used to be where I, as a company, have actually enjoyed so much success. And products being used so much by so many people that I need to now make sure that I slow down my innovation so that I don't go, because I've accumulated tech debt over time.
Right.
And so large companies had a harder time in moving as fast and with the level of agility like a startup would. Now what's happened is we are starting to see that when you actually do write this code and you do have success in the market, you can continue to keep refactoring the code. So for example, in our security business, we had our firewall. I'll give you a couple examples. It's just mind-boggling. So we have our firewall management console. And what we did was we said, let's refactor the code here. 8 million lines of code. Within 6 weeks, the teams were able to refactor it to less than 1.5 million lines of code. So firstly, you've compacted the code. What does that mean? Performance is faster. It's more efficient. It's actually got less security vulnerabilities. The way in which we've designed the product can be updated faster. All of these things have a profound effect on the customer. And now, all of a sudden, our scale of being with all those customers, but being able to go out and innovate at a very, very fast speed becomes our very asset. And so I feel like as time goes on, you're going to have very little legacy code because everyone's going to write code using agents. And what you're going to then do is we have about 32,000 engineers right now.
Yeah.
I think in 2 to 3 years, they're not going to be writing code. So then the question is, well,
what are they going to do?
What are they going to do?
Yeah.
Well, they're going to review the code. And in a world where you can write anything, what you choose not to write and what you choose not to build is actually far more important. So the product judgment and the product intuition is going to be really important. The other thing that these engineers will do is they will actually be the front lines for our customers because they will help our customers adopt better. So every engineer will become a forward deployed engineer at some point for a certain percentage of their time. And so you'll see the configuration of the entire workforce change, where a product manager is going to actually become a product developer of some sorts. And the first prototype will actually be built by the product manager and the designer. The engineer is not even involved. The engineer gets involved in the architecture. And then the engineer is involved in the front lines with the customers. And so I think you'll actually start to see a workforce shift, which is very different from what we've been used to. But I don't think it's going to be around this notion that there's going to be fewer jobs. What I've started to see and observe is every single time we've seen a massive step function improvement in AI, actually the bottlenecks have been largely human. So when we have much, much higher volumes of code, now my bottleneck is code review. So I say, okay, I'm going to automate code review. My bottleneck then is going out and building a test harness. So I automate that. My bottleneck is going to be what kind of products do I build, and do I need to do the right kind of market research, and do I need to do deep thinking and apply intuition to it? So I think there's going to be a snowball effect, and I think you're going to need more people.
Really?
I think over time you will have a shortage of people that are dexterous with AI and have fluency in AI. Now, by the way, the gap between someone who is really fluent in AI and someone who is not fluent in AI is not going to be like a 10% productivity gap. I think it's going to be 50x or 100x. What does that mean? That means it's going to be very hard to justify someone who's not AI fluent to be in a job. It would be like saying, let's hire someone that doesn't know how to use the browser or the internet today. It would be an absurd concept in knowledge work. So I think that'll be an area that we'll have to make sure that collectively, between public-private partnership, we will have to make sure that we raise the dexterity level of people with AI. But if you look at every single person that we hire today that is fluent with AI, they get paid really well. In fact, I would say if I was in my 20s getting paid that kind of money, I'd be in trouble. So they get paid really well. They have a tremendous amount of shortage of those people. And the value that they add is enormously high compared to what they're getting paid. And I think you're going to see more and more of the workforce get there. So there's going to be more of a demand, but there will be this painful period where the retraining of the workforce will require some displacement, and there will be some people that'll lose their jobs. I think every job is going to get refactored, and there'll be entirely new industries created.
Have we moved now to production cycles, production stage in companies, or is it still sort of, okay, let's sort of experiment and figure things out before we actually make those big calls?
No, it's actually completely a non-controversial issue at this point in time, that chances are you're not going to lose your job to AI, you're going to lose it to someone that uses AI, but actually that's not even the most non-controversial thing. Now what people are saying is, if I don't use AI, I don't even know how I'm going to get my job done. Right? And so that I don't think, now that's not an evenly distributed viewpoint yet. I think you go to different geographies in the world, it's different. I think we live in Silicon Valley, we tend to live in a bubble. That's why I tend to travel a lot, because I want to make sure I keep my pulse on the ground and like what is actually happening in the field with the customers. And what you do find is across every industry right now, there's a fair amount of momentum, but certain industries are doing much better than others. I think if you look at the life sciences industry and biotech, amazing levels of innovation happening over there. You look at financial services, crazy levels of stuff happening there. Software was the biggest industry. And by the way, in software, the thing that was really strategic in my mind is the fact that it started with this whole notion of, hey, I'm going to use software to write software. And you're going to use AI to write AI. That self-learning loop that got created has actually created an exponential curve that is a vertical line. And so that's why the time is so compressed. So I think it was a genius move to say that's the use case we should start with, because one, it had the most amount of data that you could train the models on. Two, the data was very quantitative in ways, so you could know right from wrong very quickly. There wasn't too many shades of gray. And now what you're starting to see is it's become almost a habit where we have to figure out ways that the use of tokens. In fact, we were recruiting a candidate recently that went to another company and then came to us. And I said, hey, why are you leaving there so quickly? He said, well, I went there and they weren't going to give me tokens. Like, I don't know what I'm going to do without tokens. That's like not giving me a computer to work on and saying code. And so that was his entire reasoning in 6 months for him saying, you know what, I'm going to throw in the towel there. That to me is very telling on the state of what the expectation is going to be from the talent pool. Poverty will get eradicated. Education will get evenly distributed. Those are things that we never could have the audacity to think that those would actually happen. And I think those things are going to happen.
But is that optimism real? And what do you base it on?
I base it on the level of exponential progress that we've seen in the past 3 years specifically. And there's a snowball effect. And that snowball effect is creating not just a high rate of improvement, but that rate of improvement continues to keep compounding and getting faster and faster and faster. And now you have this completely, kind of reinforcing self-learning loop where these systems are building themselves and they're learning. And every single time you ask it a question, it's not only answering you, it's learning from you in the way that it's answering the question. And it just keeps getting better and better and better. And that over time, if you just extrapolate that, most people have a hard time thinking exponentially. We all think very linearly.
Yep.
When you have to start thinking exponentially across multiple different domains, it's actually just humanly not a very intuitive thing to do. But just start thinking about what happens if 4 or 5 industries simultaneously start showing that exponential curve of improvement. What happens to society? Capital flows easier, healthcare gets better, education is actually going to be, like the amount that I can teach myself today compared to what I could teach myself a decade ago is night and day different. Night and day different. In 2 weeks, I am almost a different version of myself every single time. And it's not just me, everyone's that way.
Yeah.
Like we're all learning at a very fast pace. So that's good. Now, what I do think is important is not forgetting the fact that we can't leave behind people in this because that'll cause suffering. And I do feel like that's an area that Cisco is very concerned about. And so what we do is we partner with governments all around the world. We've got tens of millions of people all around the world that we try to make sure that we get up to speed from a upskilling perspective. We had this network academy that we called NetAcad, and now we've added AI programs to it. We've added cybersecurity programs to it because that propels the economy forward.
Since we're talking about opportunities and we're talking about not leaving people behind, I also want to understand from your lens and all the work that Cisco's been doing in India for several decades now, on how confident and optimistic you feel about the role that India is likely to play in all of this. I think the natural assumption is that India should play the applications layer and that is our strength and that should become our competitive moat. How do you see it?
So my take on India is maybe it's a little biased because I came from there, right? And I'm just fascinated by the pace at which the country has developed and grown. Entrepreneurialism that the public sector has shown over there, because like every single time I go to India and I meet with government leaders and Prime Minister Modi and others, I feel like I'm talking to startups. And they're very keen on, like, I'll give you an example. Like one time I was with Chuck there and we were talking about some export control license that we were trying to get approved. And that conversation that we had with some of the ministers was very much around, hey, what do you think is broken? How do we need to fix it? Let's make sure that we actually talk about it. Immediately, few people got on it. And by the time we had landed in India and what the issue was, by the time we left India, the issue had been resolved. And I think that level of entrepreneurialism in public sector is very rare to find. You're now starting to see that in many governments, and that speed and scale, you're seeing it in the US, you're seeing it in India. I think that speed and scale is going to be really, really important. And I'm superbly optimistic. I also feel like India has a demographic advantage, which is almost unheard of compared to any other company because the size and scale of the population you have of people below the age of 30 that are in the workforce. I mean, it's a superpower of India, and you should be able to take advantage of that. And like I said, if you assume that there's going to be a human shortage of talented pool of workers, India is in a tremendous advantage.
What are some of the other mega trends that you're focusing on as the CPO, as president here at Cisco, that you intend to double down on?
I'll give you like 4 or 5. First one is robotics. I think physical AI is going to be pretty huge. And you will see, I was at an event recently with TSMC and their, you know, our partner for manufacturing chips. We make our own silicon. And a lot of the presentations that were there at that event, I was keynoting, others were keynoting, were around physical AI. So physical AI is actually here already, just unevenly distributed. So I think that's a pretty important trend. And that's only going to actually change, because you can't just change the world as dramatically as you want to, only with software. You need to have the physical dimension factored in. That's one. I think there's going to be models beyond large language models that'll need to feed physical AI, like things like spatial models and world models. Those are going to get much, much more prominent in the next 3 to 5 years. And by the way, there's a shortage of data on that one. So just like language models were pretty easy because you could take large swaths of data that, you know, were human generated data, publicly available on the internet, and train the models with. With physical AI and spatial models, harder to do that because you don't really have readily available spatial data. So you have to go out and generate synthetic data. But you're starting to see great advancements in synthetic data for training models. So that entire field will get to be pretty interesting. One big area that there's a huge shortage is power, right? We will see tremendous amount of advancements in power and efficiency of the use of power for terrestrial data centers on Earth. But you'll also see tremendous amount of demand and movement towards suborbital data centers in space. And so I think the SpaceX IPO tells you a lot about like the kind of momentum that can create. But that'll be an area that you'll see. Because why is that the case? Because you will have 90% of the apparatus in Iraq is cooling apparatus from a weight perspective. In space, you have a very different way that you can actually go out and handle cooling. The energy is 30% more potent in space with the sunlight, and solar is 30% more powerful in space than here. And the sun never sets, which means you don't need to have batteries. You can actually just get round the clock, you know, kind of powering of the sun. And now you've got payloads that can be taken up on a very regular basis. I think Elon's talking about like a spaceship every hour being launched with a payload. If that were to happen, you actually have a tremendous amount of promise in space. We're not quite there yet today. I think you ask some people, they say 3 to 5 years, might be 5 to 7, maybe 7 to 10, but it's definitely going to happen within the mid to long range. So that's the other piece. I'd say quantum is going to be a big one because of the way in which you'll actually be able to do computing, which is going to be at a very different kind of scale. And you're now starting to see quantum networks. In fact, we have a quantum entanglement chip that we just recently announced that is still in the labs, but it doesn't require, you know, kind of cryogenic chambers to go out and do this stuff. You can do this in room temperature, which is pretty cool. And then what you'll find is a ton of application layer advancements that'll get made in the future around this stuff, which is what specifically do we need to do to innovate in every business process that you have in every company to be rethought.